Welcome back. Hope you're having a good morning. For starters, the gift rate is suggesting that we start off a little bit on the back foot. Remember yesterday as well, we came off the top. So put yesterday's pullback from the top as well as today. We'll be down roughly around 250 points from yesterday's high. But Harmas joins us to tell us about some of the big movers yesterday on good volumes, as well as some of them were backed by delivery. Harmas, morning.
Morning, Nigel. Earnings reactions, most of them, and a positive one at that. First up was BHEL, and not only after the earnings, the stock has run up significantly even before the numbers were announced, but yesterday the stock went up as much as 12% after the results were announced, then ended around 7% higher. The stock, in fact, has gained in 16 out of the last 18 trading sessions, has a BHEL. On the F&O side, of course, the 390 call option, the premiums were up almost 150% yesterday. The volumes on Monday were the highest since June of 2024. 10.5 crore shares were traded on BHEL yesterday. That's 5x its 20-day average, and a quarter of those shares were marked for delivery. So close to 3 crore shares for delivery, the 20-day average of around 80 lakh shares. And it was the second most traded stock on the Nifty 500 in yesterday's trading session. And over the last 1 month, the stock has gone up by almost 55% and has nearly doubled from its 52-week low as well. The other positive earnings reaction yesterday was Dr. Lal. The stock at one point was in a 20% circuit, ended 15% higher. The biggest single-day gain that the stock has had since its listing in 2015. And in fact, before its results, the stock was down in 5 out of the last 6 trading sessions. Volumes on Monday were the sum total of the last 25 sessions put together. 80 lakh shares were traded. The 20-day average is just 3 lakh shares, and around 15% of those shares were marked for delivery. So around 13 lakh shares for delivery. The 20-day average here too is just over 2 lakh shares. And after that move that you saw on Monday, Dr. Lal has reversed all of the losses of 2026 and has turned positive on a year-to-date basis. And a couple of underperformers from yesterday's session from the Nifty. Kotak Mahindra Bank was an earnings reaction. Bharti Airtel too was down around 3%. Both of them saw delivery volumes of close to 60 to 70% in yesterday's session. And the premiums on the put options yesterday were up anywhere between 20% to as high as 90% for Bharti Airtel. The volumes for Kotak were 7.5 crore shares were traded. The 20-day average is less than 2 crore shares. Bharti Airtel's volumes were around about its 20-day averages. Same for the delivery as well. But for Kotak, 5 crore shares were marked for delivery. That's 70% of the total traded volumes. The 20-day average is just 1.2 crore shares.
Thank you very much for that. Mayuresh Joshi, Director Research, Marketsmith India, is now joining us on the show. Mayuresh, morning. Thank you for joining us. Manappuram Finance, while the gold loan business of the company is firing, the other businesses, the Ashirvad microfinance business, as Ananya was telling us, is still getting cleaned up. It's a work in progress. It's recovering. NIMs were a bit subdued. What is your assessment of Manappuram Finance's numbers?
Morning, Rima. As far as the gold financing business is concerned, I think it is a very decent set. But again, I think when it probably comes to the NBFC part of the business, which Manappuram has chosen to diversify and probably increase a part of its share in terms of overall revenues and part of the EBIT contribution as well. I think softness continues on that part as well. So I think for a large part of the gold financing universe, I think the numbers should be pretty decent as we exit Q4. So whether it's Manappuram, Muthoot Finance, the core gold financing business should do well. But I think the other NBFC business might continue to be a drag on earnings. There is some hope that microfinance, SME, MSME lending should probably have some element of respite. But again, I think it might be back-ended in my opinion. So I think the other NBFC business might still continue to be a drag in terms of over consolidated numbers.
Okay, Mayuresh, request you to stay on and listen in to the conversation we're going to have with Quess Corp. The company reported a muted set of Q4 numbers. General staffing revenues has seen a decline, but the overseas business is showing some momentum. Lohit Bhatia, CEO of Quess Corp, is now joining in. Lohit, morning, Rima here. Let me begin with the NBFC insourcing, as a result of which there was a big headcount loss in Q4. I believe 7% of the book, 38,000. Was a headcount drag, which is why your general staffing, which is the bulk of your revenue, 85%, reported a revenue decline on a quarter-on-quarter basis. Can you explain what happened with this NBFC insourcing? Does it spill over into Q1? How large a client is it? And are there any other customers where there is that insourcing risk which can hurt?
So good morning. Glad to be on your show, Rima. That event that you're talking about is more than 365 days old. That happened in Q4 of last year. Not this Q4. Just to come back to the results for this year, Overall, the company has actually grown this year on 4% on headcount, 6% on revenue year-on-year basis. We've ended the year at 479,000 workforce, of which about 6,000 are working for us globally, 7,000 work for us in the technology and the professional staffing space. If you look at our global markets, they today achieve almost 6% EBITDA margin. Our professional staffing business achieves a 12% EBITDA margin, and our general staffing business, which continues to remain our largest book, also delivers 1.4% margin. To your question on muted growth, maybe for this quarter, as far as general staffing is concerned, there were a lot of global factors, if you really look at it in the fourth quarter, along with some domestic elections, which were quite, aggressive in nature. We found that on the supply side, when elections like this happen, a lot of supply and migrant workforce reduces, which impacted our manufacturing business. However, Quess over the last 3 years has had a diversification strategy. Today, exiting Q4 at 2.2% EBITDA margin, our diversification has given us a solid foundation. The PAT for the year has come at 230 crores. Net cash position is 271. The EPS for the year has come at 15.4 rupees per share. And the board, as you must have seen in yesterday's results and announcement, has recommended a 3 rupees special dividend, which has been approved, and 3 rupees final dividend, which is subjected to shareholder approval at the ensuing AGM.
Lohit, apologies. That was my bad about the NBFC bit. But just taking that point forward about margins, now on the back of professional services and that diversified book, your margins have expanded. Now stands at 2.2% EBITDA level. Is there scope to expand margins further?
Again, thank you for that question. At Quess, we've had a North Star that we want to go towards the 2.5% to 3% range in the medium term. And for us, the medium term is the end of this decade. However, getting to that point, we started from a baseline of 1.4, 1.5%. We wanted to first stabilize the company at 2% margin plus. If you notice, in the last 2 to 3 quarters, we've consistently delivered a margin over 2%. In the fourth quarter, actually, it's 2.2%. And that's again happened because of the back of the growth that our professional staffing with 12% margin book has now contributed 30% to the overall company. And our international book contributes 20% to the margin profile of the company. So we would like to keep it in this range of between 2 to 2.4 for an immediate term, and then guide towards the 2.5 to 3% on the medium to the long term.
Got that. Lohit, hi, good morning. The narrative around sort of Quess or others, right? I mean, not just you, staffing companies, is that, fundamentally, directionally, the number of staff required is less. So staffing as a business is, so that, and we've spoken about this in the past. I mean, just if you want to push back against that, because that's the broader narrative without people not looking into the numbers, etc., and what is actually happening.
So thank you. If you really look at it, I would not push back. I would request everybody to look at the data itself. India sends about 600 million people every day to work. Of the 600 million people, only 20% are in formal work today. How do we define formal work? Formal work is backed up by a contract. It's backed up by financial inclusion. It's backed up by social security. It's backed up by skilling and benefits and over the long-term growth in your own employment, your own career, and your outcomes. That's only 20% of India. While 1 million workforce comes every month to the labor market, 80% still goes into the informal labor market. Everything that India has been doing and the government's structural story towards formality, towards growth, will eventually aid Quess Corp. And you would notice that we are the largest as far as India is concerned by headcount, by number of customers, by revenue, as well as the margin profile, which has come in strongly at 2.2%. I think the structural story for India and embedded story within India is Quess Corp is at least another 18 to 20 years of structural story. So, that's where I would put it. The second point is we work a lot in the technology segment as well. And you know that a lot of GCCs are being created in India. This is because India has the supply of technology talent, which the rest of the world doesn't have today. And for that reason, a lot of transformation work has already started happening in India.
Lohit, if I can ask you, no, I completely agree, and I take that point. So not pushing back, but yeah, look at the data. So just by end segment, end user segment, where are you placing these people? What does it look like now? I mean, which are the end user industries?
So consumer continues to remain, consumer, retail, telecom continues to remain our largest segment. That is followed by, if you really look at it, is the banking industry, closely followed by the manufacturing industry, and then followed by the technology, telecommunications, ITES, the knowledge processing industries. And then we have a long tail of e-commerce and logistics, public enterprises and services. There are also new green shoots which are coming out, and Questcorp has worked aggressively in the last 1 to 2 years. Some of those I'd like to mention briefly. One, obviously, is construction. While construction today gives us less than 3,000 people, the kind of margin profile that we are getting on construction, it's part of our press release as well. It's over 8% EBITDA margin. It still falls under our general staffing space. And that's a business that we are very bullish about, because India has about 5 crore workers in the construction segment, with 99% of them are informal workers.
How are you making more margins on construction jobs, Lohit?
So, the skill enablement in construction enables us to get better per day realizations, both from the supply side as well as the demand side. Even today, majority of the clients that we work with have a demand which is almost 2x of the supply that we are able to give.
This is a shortage of skilled labor in construction. That's essentially the point.
Right.
Okay.
That's right.
And you got about 3,000 people on it, right? My only thing, and the reason why I asked that, how are you able to, and maybe that answer, what you said answers it, but across industries, I mean, so the big job generators, right? IT services, we speak with all large companies. Hiring is looking down, not up. GCCs perhaps is the only exception. And you already alluded to it, banking. I mean, it's the sector is doing well, but it's not hiring gangbusters. Telecom, So I'm just saying, your realizations will depend on whether you're placing well-paying jobs, staffing well-paying jobs, or at the lower end, right? And are we really saying that well-paying jobs are exploding on the upside?
I wouldn't put it that way. What I would say is that if you look at the professional services business of ours as well, you will realize there are 3 broad constituents. Our biggest book of 71% actually comes from GCCs. Our second biggest book at about 20% comes from IT services to enterprise customers, which could be banks, e-commerce companies, retail companies, manufacturing companies, design companies. It's the smallest book, which is at 10 to 11%, comes from IT services companies. As a staffing company, we pivoted ourselves towards the GCCs and less towards the IT services way back about 5 years ago. And that has what has aided the kind of growth and the niche segments that we operate in.
And GCCs, all the big guys are already here, right? I mean, the biggest, everyone is here. Now, of course, it's a smaller, more niche operations which are coming in that sense. Would you agree, Lohit?
India has close to about 2,000 GCCs, but two-thirds of those GCCs have come only from one country, which is the North Americas. Right. We still don't have enough GCCs which have come in as Generation 1 companies from Europe, or from Middle East, or from Far East. What we have to also look at is, like you rightly said, a lot of Fortune 500 companies are already here. But the companies between the $5 billion to $15 billion revenue size, which actually require more of India's support to take their work to the back office, actually is the one which is going to which Quest operates.
All right. So you're saying within what you define as IT, 70% is GCCs, right? IT services itself is only 11-12%, I think you said, right? The rest is services to enterprise.
Yeah.
Okay, fair enough. A good conversation. Lohit, thank you very much for joining us. Appreciate your time here, and thank you for being here on CNBC TV 18. Questcorp management on numbers, but of course the bigger conversation, I think, which is the dominating driver from a share price perspective as well. 212 on Quest. We'll take a break. We're back. Mayuresh is going to be with us. Mitesh also with us. Sudarshan Sukhani. So technical trading ideas with Mitesh and Sudarshan in just a bit. Okay, welcome back. So lots of action with regards to individual movers, even as the market this morning will open slightly on the downside. I think Kempro, which is Kempro was, I'm just looking at it now, it was the number one volume traded, volume-led gainer yesterday, was up 14%. Now, this is ITD Cementation, formerly known as ITD Cementation. The Adani Group took it over. So it's an Adani Group company. And, we were talking about elections and whether there are individual stocks perhaps which are movers. It's basically, by the way, based out of Kolkata. ITD was based out of Kolkata. From 680, it's moved to 950, 960 yesterday in 2 sessions flat. So it's a massive move, which we've seen in the last 2 trading sessions or so. I mean, the thing with this company is that most of the projects, etc., which Adani does and, on the civil side, construction side, perhaps comes to this. At least that's the hope, that's the expectation. Last year was good. 2025 was a consequential year for this company, and this year is turning out to be already pretty good. It's up 20% for the year so far. Just any thoughts on this one, Mayuresh, if you track it?
Morning, Prashant. I think they delivered a solid set. So for the quarter gone by, I think the revenues were up quite significantly. The EBITDA margins were close to 15%, which is one of the highest in the recent quarters. And that is obviously getting backed up, as you rightfully pointed out, Prashant, in terms of a very solid order book, which stays at 24,800 crores. And that's very well spread out against maritime projects, in terms of urban infrastructure, in terms of industrial, and in terms of data centers, etc. as well. And therefore, I think on a consolidated basis, for the annualized number as well, a 20% EBITDA margin is reasonably decent. The expectations in terms of solid growth expected to come through is something that can still play out on numbers very, very positively in the next few quarters.
Lal Pathlabs was another massive mover yesterday. Actually, yesterday was a big day for a lot of stuff. Lal Pathlabs was up 14. RR Kabil was up 14. Idea Forge, it's a bombed out name. It's the right space, defense and drones in particular. Idea Forge, there was an IIFL equities initiation yesterday morning. And the stock was limit up 20% yesterday, 731. There were others as well. Loris was up 6. And by the way, we had managements of Dr. Lal and Loris, etc., with us on the show yesterday. On Idea Forge, Mayuresh, any thoughts?
I think decent set, Prashant. And again, I think this entire thesis in terms of escalation that you're probably seeing in the Middle East is prompting a lot of economies to probably go for drone and drone technology, which has probably become the most pivotal aspect in terms of the entire flashpoint as far as use of technology is concerned. Now, a decent set of numbers, but I think the entire thesis that the market is probably looking forward is more adoption that probably happens both in terms of drone, anti-drone systems, etc. And I think that is why I think the markets have taken numbers and the expectation in terms of more orders coming their way, whether it's domestically driven or export driven. Making a base case scenario of order book probably improving over the next few quarters with relatively better margins, probably leading us to believe, or leading the markets to believe, that earnings probably might remain very, very stable in a very volatile environment, at least for the next year.
Mayuresh, KEI Industries reported numbers, and we'll have the management on the show now. But prima facie looks good. Q4 revenues at 19%. For the full year, the company's growth was 21%, so slightly ahead of the guidance of 20% that they'd laid out. Your assessment? And in the cables and wires business, yesterday, RR Kabel did well. We had Havells numbers already out. How would they compare with KEI, and which one would you pick?
Prima, I think a decent set of numbers by KEI Industries. I think a good set, in fact. And again, I think if you probably just compare what RR Kabel also probably did in terms of their earnings delivery, it was again a very solid set. RR Kabel has a very small component in terms of the FMEG part of the business as well, which accounts for 10%. But a large bulk of the revenues comes in from the cables and wires business, where at least on an exit on Q4, I think the EBIT margins for wires and cables were relatively higher compared to the overall business, obviously, because FMEG business has a relatively lesser EBIT margins. However, I think with the kind of supply chain issues that can probably crop up in Q1 numbers, whether it's KEI, whether it's Havells, whether it's RR Kabel, and the kind of jump up that we've probably seen in copper prices, what kind of inventory level do they hold on to is something to be watched out for in the management calls. I've not heard the call so far, but I'd probably read through that as well. And the second aspect in terms of both supply chain and the ability to pass this through completely and what kind of an effect does that have on demand dynamics. So exit Q4 numbers are very, very good, whether it's KEI or RR cover. However, I think how Q1 will play out, and if this continues for a longer period of time in terms of supply chain issues, etc., how does that play out in the first half numbers? And whether that has some element of, say, in terms of overall annualized numbers as far as FY27 is concerned, is something to be watched.
All right. Hi, Mayuresh. Good morning. Good to see you in. Mayuresh, I wanted your word on the cement industry. I'll tell you what. Q4 was good. Problem is that Q1 as well, we may not see that much of an impact with regard to input costs going up. But Q2 is going to be a big hit. 200, 250 rupees as well is what you're factoring in terms of a EBITDA per ton hit. Now, the other news is that overnight, you had Ambuja Cements that had their con call. And they hinted to analysts as well that, they may not go very aggressive in terms of volumes, in terms of expansion. Now they'll focus on profitability. I believe that there was a site visit a couple of months ago, and at that time they indicated. Now they've laid it out even in the con call that aggression is something that will be put on the back burner and profitability will be at the forefront. How do you read this for the cement industry on the whole? That could mean, better profitability. Because when they came into the system, they were pushing a lot of volumes, which was depressing prices and then in turn profitability. So what's your top pick from the cement pack?
Morning, Nigel. I think the industry is clearly moving towards a phase of organized consolidation, if I have to put it that way. And therefore, I think with additions that are expected to happen, both in terms of organic growth as well as mergers and acquisitions that are probably happening for the industry as a whole, you're probably going to see the top 4-5 players actually having a larger share in terms of both pan-India operations, as well as expectations in terms of how the capex is probably expected to play out. Interestingly, I think if you probably look at ITD Cementation, which is Sam India's slide that they probably put out in terms of their earnings presentation, I think the capex slide is very, very interesting that they probably put out, both in terms of housing, infrastructure, railways, etc., expected to go up significantly. Add to that, the consolidation that is probably happening within the industry will probably mean that pricing probably remains far more intact compared to what it was a few years back. And therefore, I think with intermittent issues that probably come up, and it will obviously show up in terms of input costs going higher as we report Q1 or even Q2 numbers, which is traditionally a soft number because of monsoons, etc. I think structurally, we are probably heading to a scenario where profitability is going to probably take a front seat. And with a lot of operations, specifically the energy consumption that is probably happening at their captive use as well, along with mines which are probably coming up as well, the profitability of the industry on an EBITDA per ton basis should probably go higher. So I think structurally remain positive. We stay with leaders, actually. Stocks like UltraTech or JK.
UltraTech and JK, got it.
All right, Mayuresh, stay on. We need to slip into a very short break. We'll come back with the pre-opening. We'll also connect with Warren Kevin Harris of Tata Technologies to talk about their Q4 earnings. Stay tuned.
Welcome back. Well, we're almost getting into market open, so let's welcome our technical experts. We have Mitesh Thakkar as well as Sudarshan Sukhani who join us on the show. Good morning, gentlemen. The markets yesterday celebrated a thumping victory and, good outcome, what the market was anticipating. And now the focus is going to be on what kind of reforms can we see, since we're going to have 10 months of a clean slate, no state elections, and hopefully some of these states as well that otherwise have been drifting towards populism start seeing some kind of economic activity. That said, on the technicals, how are you seeing things, Mitesh? Yesterday, we again went to around 24,300. That level got rejected. And now we are starting off on the back foot with a cut of 150 points. Buy the dip or wait buy?
Morning, Nick. So, I've maintained that the Nifty might do a range of about 23,800 to about 24,350, 400. That's what's been playing out for the last few days. Ideally, I would be looking to buy the dip, but there's one worry, which is clearly visible on the charts, is the negative traction on the charts of Bank Nifty. So it's the banking stocks and the banking index which is slightly turning negative, and therefore that could put Nifty under pressure. So if I am to attempt a long on Nifty, it has to be very close to about 23,850, 800 zones, and then you can take a 80, 90 point kind of a stop loss and go long. But for the timing, I think the immediate 120 point kind of a gap will not interest me to buy.
Yeah. So you buy a bigger gap, Mitesh. That's what you're saying. A bigger gap down.
That's right.
Got that. Sudarshan, morning. What would you do?
Yeah, good morning. Well, the idea is that the Nifty has done a test of 23,800 last week and successfully did it. Now we'll see choppy market action, but so far as that level holds, 23,800, I would be a buyer on a dip. So today's 150 point dip or 120 point dip is actually a buying opportunity for me. My stops are tight, but yesterday I explained, I'm repeating, these are positional trades, not intraday trades. The idea is that sooner or later, the Nifty will see a very decent rally. So we have to be positioned for that. If 23,800 breaks on the downside, we exit, wait patiently for new levels to form, but still only as a buyer.
Yeah. Got that. Now, what would your trades be, Sudarshan? Individual, stock specific?
Well, delivery is a buy with a stop under 460. The stock has been making a pattern of higher highs, higher lows. Lupin has been in a trading range for almost 10 weeks now, and that was after a big up move. I'm assuming the breakout will be on the upside. Buy Lupin with a stop under 2,300. NTPC is a short with a stop above 405, and IRFC is a short with a stop above 110.
Mitesh, what about you? What are your picks?
I have a mix of buys and sells, and as I mentioned earlier, Prashant, the selling calls are on the banking names. So Bank of Baroda is a sell with a stop just about 270 for a target of 255. Similarly, Indian Bank is a sell with a stop at 846, half 847. And traders can look for targets of 795. On the buying side is Britannia, buy with a stop at 57.50 for targets of 58.80. And Lupin for me is a conditional buy. It's been hovering around this level of 23.55, 23.60. And a breakout above this 2360, 2362 range would call for a long position with a stop at 23.39 and a target of 24.10.
Okay, gentlemen, we'll come back to you for more trades at 9:10. For now, let's invite the management of Tata Technology. Reported a strong showing on the top line. The company's revenue growth at 12.5% was ahead of expectations. Kevin Harris, the CEO of the company, now joins it. Kevin, congratulations. I remember 3 months back when we chatted, you had guided for a revenue growth of 10% in Q4, and you've done better. You've delivered that and more with 12.4%. How much of it is on account of the Estec contribution? That's the acquisition that you did, and how much was organic?
Yeah, I can certainly break up the first quarter performance. Of the 12.5%, about 4% of that was Estec. The rest was organic growth that we posted. And the encouraging thing from our side, not only did we deliver against what we had said we were going to do, the improvement was broad-based. It was not just within the anchor accounts. It was across both the automotive, IHM, and aerospace accounts. And we also had very strong performance from our education business. So, all of our lines of service and all of our industry verticals were firing, and it was our expectation that really reinforced the guidance that we provided, not just for Q4 but for fiscal year 27. We are not only confident of double-digit growth, we're confident of kind of consistent performance across the quarters, and our deal signings in the last 3.5 months are the best we've ever seen. So, we couldn't be more bullish about the prospects that we've positioned for ourselves in the new fiscal year.
Well, that's good to hear. The deal signings in the last 3.5 months are the best ever, and you're confident of a double-digit organic revenue growth next year. Let's talk about margins. Margins expanded 190 basis points to 16% quarter on quarter. What led to it, and how much more by way of margin expansion from here on?
I think we will continue to apply all of the operating levers, but as volume improves, as scale returns to the business, you'll start to see us get back to where we were 18 months to 2 years ago. And the guidance that we provided at the beginning of this calendar year is to get back to a run rate of somewhere north of 18% in the fourth quarter of this year. And that's certainly something that we stand by.
Well, that's 200 basis points of margin expansion from Q4 to Q4. 16% becomes 18% plus by Q4 FY27. Kevin, what about the long-term guidance, the aspiration, the North Star in terms of revenues and margins?
Well, the long-term guidance, our North Star is that we are committed to becoming a billion-dollar company in the next couple of years. And so the growth rates that informed our progress after the pandemic and before the slowdown 18 months ago is something that we expect to return to. I think with scale will come incremental improvement in operating margins. Our North Star has always been 20-21%. We remain committed to those numbers and those targets. But I think what we're also excited about is just the nature of the opportunity that we're driving. And I think this is one of the reasons that our bounce back is somewhat counter to what we're seeing across the rest of the market. I think our ability to be able to take on turnkey product responsibility, complete vehicle responsibility, complete work package responsibility is giving us a seat at the table with our strategic customers. We're influencing their decisions, and therefore our performance has been predictable in the recent short term, and we expect that to continue going forward. So again, we see market conditions improving. We see Tata Technologies leveraging that to steal a lead on the rest of the engineering services market here in India, and that should be something that we can further scale from as we continue to close deals this fiscal year and beyond.
Well, thank you for laying out that long-term ambition, $1 billion in terms of revenues, 20-21% margins. Whenever we've spoken in the past couple of months now, you've highlighted how automotive OEM decision-making remains uncertain. There were tariffs, German auto weakness, there was JLR restructuring, softness there. Are all those headwinds behind us? Because you've clocked in a very strong quarter. How sustainable is it? And what are the risks ahead of us?
Well, I don't think all of those headwinds are behind us. I think the challenge in the Middle East, I think one of the things that is not yet talked about is the impact that that's likely to have on the commodity market, and things like aluminium and plastics are likely to be impacted going forward, which will represent further headwinds, not just for the automotive market but also for the industrial heavy machinery market. But I think, one of the things that I've said constantly is that automotive, construction equipment, off-road, on-road, commercial trucks, those businesses are product-led businesses. And after companies have not invested for a couple of years, they have to get back to investing in new products. And that's what we are seeing after the new normal was established after the tariff announcements. And I think we have been the beneficiary of that, not just in Q4, but in terms of the deals that we've signed in the first month of this fiscal year. And it's those things that are really informing our confidence and our expectations for the foreseeable future.
So auto is doing well, but what about non-auto? While aerospace is also actually pretty okay, the overall non-auto business is about 19% of your services. What would it look like 4 or 8 quarters down the line?
I think if we were to look out in 12 months' time, I think that the growth of aerospace will continue. I think commercial truck will continue. But what we're seeing at the moment is a bow wave of automotive opportunity. And so, if I look 12 months from now, I'm not sure that we will make too much in the way of incremental improvement from a percentage perspective, simply because we're tapping into investments that have not been made in automotive for the last 2 years. So I think medium to long term, we're likely to trend towards 70% automotive contribution, 30% contribution from non-automotive. But it's going to take 2 to 3 years for us to get there.
Thank you very much for joining in. It's 9:10, time to get back to our technical call. Sudarshan and Mitesh are back with us. Sudarshan?
Buy delivery with a stop under 460.
Mitesh, yours?
I'll go with the sell on bank on Indian Bank. That's the call here.
Delivery, buy delivery, sell Indian Bank. Pre-opening rates are coming in and it's down about 66 points. We're getting limited cues from the Asian markets, Japan, China, Hong Kong and South Korean markets. 4 of the key Asian emerging markets are shut today. So therefore, we could see a little bit of muted activity. But back to tracking stocks, BHEL was a big mover yesterday. Good numbers. Volumes were very large. Vinny now joins in to make a bull and bear case argument on BHEL.
Hi, morning. So first up, BHL, yesterday we had the numbers, they reported the numbers. The stock saw a run-up of almost 12% intraday, a new 52-week high that came in for the stock as well. And then it started seeing a cool-off. Now today, obviously, what are the brokerages saying about this as well? CLSA, they're maintaining the underperform rating. Target price they've given is 282 rupees per share. What they're highlighting is that BHEL, yes, turned quite positive in terms of the top line. That was good. Margins also was driven by this good top line that came in. But the quality of the growth, they highlight that that's not good. Gross margins fell 150 basis point. Obviously, and the expansion that came in on the EBITDA margin front also included some cash provisions as well as forex gains. So what they're highlighting is that BHEL has already rallied a lot in the last 1 year. If you look at it, it's almost 60%. And that's on the back of the energy security theme, which is phasing out now in the past few months as well. It's become more expensive, so they do not find value in BHEL as of now. Now, JP Morgan too, they're maintaining the underweight rating. Target price is 220 rupees per share. They're similarly highlighting that the sharp outperformance, which is coming in the stock price already in the last 1 year, is a good exit point and an opportunity to exit the stock, given the deeply cyclical names, especially given the thermal power plant theme that's coming off as well. So obviously, because of that, when you look at it, they believe BHEL's FY25-26 profitability has actually was boosted by those provision write-backs that came in and forex gain. So now if that goes off, maybe it will come off as well. And obviously, the outperformance that we've seen in the stock versus the Nifty and other companies as well is a reason to make that exit coming in. Energy storage systems, that's seeing a rise. Solar, that's seeing a rise. And that because of that, coal-based projects, that's power generation projects, they'll be coming off as well. So they're not too positive on this one. Let's move on and talk about some of the bull cases now. We have Morgan Stanley maintaining their overweight rating, raised the target price to 444 rupees. They said that overall the macro positioning of the stock is improving in India. They believe BHEL turnaround could continue and surprise the markets going forward as well. There were a lot of surprises that came in Q4 as a positive surprise, but they expect that strong operating cash flow, that will be a key driver for the company, and the improved revenue execution, consistent power segment margins, as well as increase in market share are the factors that could lead for a better performance for BHEL going forward as well. So that's the bull case.
And Vinny, from anything from Morgan on forward-looking? I mean, what are they expecting from here? More ordering? Because as you said, JP Morgan is saying, well, bulk of the large ordering is behind.
So for here, they believe that actually the receivables, the order book is not that bad. There's a bit of a decline that's come in this time, but they still have order book that is strong. So they believe that that will be something that is still giving a revenue visibility. So that's why they believe that there will be improvement in the receivable positions going forward as well. And cash flow conversion, that's also going to see a better improvement. So that's what they've highlighted so far as of now.
Okay, all right. Big run-up and opposing views, 380 on BHEL. You know, but some of the points which JP Morgan makes with regards to energy storage systems, battery storage systems, basically, you know, it's going to be a big one. Solar versus coal, in terms of how electricity is produced. You need both, but how do you balance both? As solar comes up in a big way, and you know, it's an interesting debate at that. Well, we'll just quickly run through some of the stocks that okay, we will address stocks straight away. There's about 8 seconds and counting down to the market open. You got the Sensex, which is down about a quarter, the Nifty, which is down about a quarter, Bank Nifty and the small cap indices all starting is largely flat to sideways, basically. So about 1/3% down on the Nifty, 23,993. The Nifty Bank is down about 0. Okay, Nifty Bank is starting slightly, down 0.6, 54,400, 54,500. The mid-cap index is down about 1/3, and the small-cap index is coming up with about a 0.13% of a cut as well. Small caps, of course, last week and the month of April have had it very, very good, and that continues to be an area of strength for the market. 140 points lower on the Nifty, 23,988. If you can just quickly put up the Nifty 50 heat map, will give you a sense of where we start. ONGC is up as oil is up. Tata Consumer, Adani Ports, Cipla, ITC, Dr. Reddy's are some of the others. Adani Ports is a big high-quality buyer, as Nimesh had highlighted in his D Street chatter. Adani Ports is high on the back of it, I guess. Shriram Finance, Indigo, Bajaj Finance, and Asian Paints are some of the others, which are starting on the other side of the spectrum. But it's a 100-point cut, down 0.4%. Rima.
Well, the big drag is coming in from the IT stocks. The Nifty IT index is open with a cut of 1% this morning, with names across the board. HCL Tech is lower in trade. Pull up TCS, Infosys, weak. So IT is under pressure. Along with that, the banking names. The Nifty Banking Index is down 0.5% in line with the frontline indices, but HDFC Bank is the big culprit here, and ICICI Bank too, selling off about 3/4 of a percentage point. Pull up some of the others like Axis Bank as well. But on the way up, you've got Realty Index doing well. The Nifty Realty Index, I think the last time I checked, was higher in trade. Okay, now it's slipped into the red. Metal Index will also come up. Pharma is holding up. In terms of stocks on the way down, Shriram Finance, Bajaj Finance, auto names are weak in trade. Maruti Suzuki, Hero MotoCorp, M&M. These two come out with numbers later today. Oil marketing companies on the back foot, BPCL, HPCL 1% lower. L&T ahead of the numbers is selling off nearly 1%. On the way up, not too many gainers, but Adani Ports is your top mover. Reliance Industries is now seeing buying, so continuing with the rally that started post numbers, up about 0.5%, and now IT names are pulling back. Opened up in the red, but now TCS and Infosys, Wipro are back in the green. Mixed picture, but a little more subdued, given the rise in crude prices, and the advanced decline ratio has now flipped in favor of the gaining side.
Well, the next few interactions you'll definitely want to tune into with regard to managements, because you have KEI Industries actually that's down close to around 5%. Morgan Stanley, they've downgraded the stock to equal weight. The target price, though, they've raised to around 5,200. They point out that the stock has outperformed big time in comparison to what the Sensex has done over the past 6 months. So those are one of the reasons. So that stock is under pressure. We'll hear the management in just a short bit from now. Aarti Industries as well. That stock has opened up with a bit of a cut in today's trading session. I think we should get that one up for you on the screen. Aarti Industries down close to around 3%. That company is due in the next 30 minutes or so. The other one is Jindal Stainless. The numbers look pretty okay, actually. No operating leverage played out, but yet the EBITDA per ton improving. The share is a little bit skittish with regard to the input costs going up, and they'll want to know what kind of volume guidance can the management give us. We'll have that at 10 a.m. itself. Other stocks that are doing pretty well, Vocart, that's one of the stocks of the morning. Big uptake is what you're seeing out there. Shobha, the other stock that's flying away. So a couple of big winners is what we have on the list today. And Sterlite Technology is what a stock it's been moving from strength to strength. Today as well, it's up close to around 4.5%. Yesterday it was up close to around 5%. Sunflag, that's the other stock that we are tracking. Mr. Bansali yesterday went ahead and bought a large chunk in the company. And it seems the street has got quite excited. Remember, you had Lloyd Metal that's seen a big re-rating from around 1100 rupees to around 1800 rupees. But Sunflag, well, it hasn't moved. And remember, they have 10% stake in Lloyd Metal. But what will they do with that stake? Will there be any kind of value unlocking? You know, the promoter intent is something that has been tracked over the last few years, and they haven't done much in terms of Sunflag. But for the time being, large investor buying a stake, the street likes it, so the stock is up close to around 10%. It has valuation comfort. Idea Forge, one of those bombed out names, stock has bounced back yesterday, and today it's bouncing back in style yet again. So good move is what you're seeing on Idea Forge. So net, the advanced decline ratio is more or less even Stevens. The Nifty is down close to around 60 points, but we are seeing some kind of buying at lower levels, which is heartening. And Reliance Industries, that's the one that's holding one end up. The problem is the Indian rupee has dipped yet again. 95.4, we can't go on at this sort of a pace. You need some stability, you need some pullback from these levels.
Okay, well, 24,000 odd on the Nifty. So basically, we've got about a little over 24,100, and now we're back around the 24,000 levels once again. Pankaj Tibriwal is with us. He's founder and CIO, Ikigai Asset Managers. Pankaj, good morning. Good to have you with us here. Thanks for joining in. You've been constructive, and you said, well, perhaps the worst is behind. Some of the stuff which is happening is completely outside the control of what companies can do, how efficiently they can run their businesses, and what they can do to mitigate, right? I mean, one is energy, cost of energy feeding through everything. And the longer this stays at a very high level, the longer perhaps damage, even at good businesses, well-run businesses, Pankaj. So how do you kind of sort of weigh it off against what you're seeing, which is this, some amount of positivity which was starting to creep in, which perhaps on the other side is being pushed back against by the cost of very high energy prices?
So good morning, Prashant. A very relevant question in current times. I think our sweet spot now is about $85 to $90 of crude. And anything above that probably will be a pain point from an overall macro perspective. And obviously, it will flow down to company-specific and sector-specific problems. Obviously, nobody knows when the West Asian crisis gets resolved. But our sense is that the reason we were positive in the end of March and said that it's the time to go all in was that 18 months of time and price correction had happened over the broader markets. Valuations were looking attractive. Sentiments were at the lowest point we could ever see in the last 2.5 years. And obviously, nobody saw April coming, and April is the best month for broader markets, especially mid and small caps in the last 20 years. The way we look at things is that the world before 28th of Feb and after 28th of Feb will be two different worlds. The last decade was determined by disinflation or lack of inflation. And the next foreseeable future, we believe that inflation will be the core theme because of the underinvestment which has gone into the energy sector or metals and mining, and the disruptions which we are seeing will not let inflation come down. And hence your portfolio construction and the companies which will do well could be very different from what we have seen in the last decade or so. Hence our belief is that own leaders of the sector, because what we have seen in the past that whenever inflation comes in, these smaller players give away market share to the leaders of the sector. And we are seeing across home improvement, we are seeing across tiles, plywood, PVC pipes, you name any sector where there's a large unorganized portion sitting out. The reason is that in a high inflationary situation, the companies find it difficult from a working capital credit perspective, raw material volatility, they don't have the balance sheet and cash flow. And intuitively this time around, in the last few conference calls, we are hearing the same commentary coming out of management, that they gain extra market share in this disruption. And this is just the start in my view. This disruption is not going to end overnight. And hence companies which are leaders in the sector will gain. Also, Prashant, don't forget, this is after 12 quarters in a row that India Inc. will see top line growth in double digit. What India Inc. delivered over the last 12 quarters was margin expansion. But now the top line growth has started to come in, and our belief is that 12 to 13% top line growth can't be ruled out, and which brings in operating leverage, even if there is some dilution on the gross margin. And let me give you some data on the earnings which have spanned out. Till a couple of days back, out of the NSE 500 company, 109 companies have reported, and almost equally between large caps, mid caps, and small caps. Large caps have delivered about 8.5% earnings growth. Mid caps have delivered about 50% plus earnings growth, and small caps have delivered about 27 to 28% earnings growth. So last quarter results are spanning out quite nicely. However, this quarter, in our view, it could be a little slower quarter because new raw material cost will get into the system. There will be a lead lag between the raw material cost and how much you can pass on to the end consumer. And April has started slow across many industries in terms of demand because a lot of dealer distributors are worried because of the volatility that they don't get stuck on the wrong side. So maybe first quarter could be a little slow quarter, but I think inflationary situation helps the leaders of the sector to perform better and gain market share over a period. And hence our focus is bottom up. I think this will be a clear market trend that if you can pick up companies which are gaining market share, which can grow their earnings in this environment, I think your portfolio should do well. And our preference lies in the sectors which we can discuss at a later point of time.
So your view is that we are in a high inflationary environment and therefore we should see market share gains for the larger players, the more organized and the larger companies. So this would be across which sectors? Because we have unorganized a sector in specialty chemicals, auto ancillary, your paints, pipes, cements, tiles, laminates, jewelry. Which sectors would you back to play this theme?
Across the board, if you look at, for example, the home building, the moment Morbi was shut down, the pan-India players who have outside Morbi plants, they gained market share in the month of March, and it continues in April as well because the disruption is still there. The same voice has been echoed in the wood panel space. So the couple of con calls which happened on the wood panel space, the managements were clear that the leaders are gaining market share at the expense of unorganized. And wherever you find that there's a large unorganized sitting, there has been a huge raw material inflation. Trust me not, the leaders will benefit out of it. In a disinflationary situation, normally the competition mushrooms across regional places, and which creates a headwind for the leaders to grow. And the opposite happens the situation we are in, where the supply chains are stretched, labor is an issue right now, and hence people who have a good balance sheet cash flows will gain disproportionately. And that's what we are seeing. So it will span across sectors. In chemicals, a very interesting thing is happening. That over the last 3 years, if you speak to any chemical company, the biggest pain point was China. The Chinese imports were happening at a price which was lower than the cost of production of Indian players. 3 things have happened post that. One, yuan has appreciated almost by 20% versus rupee. The second is the logistic costs have doubled from China to India. There is supply chain disruption across. And the fourth thing is that Chinese government has removed export rebates from 1st of April. And we believe that a good cycle is starting for most of the chemical companies. And we may be in a new cycle for chemical. Also, the top line growth will be in double digits because they are all derivatives of oil, most of the raw materials, and hence they have been able to pass on to the end consumer. And margins, there could be some dilution. But coming to EBITDA margins, I think there could be operating leverage, which could kick in, and hence earnings growth of this sector, which has been subdued for last 3-4 years now, probably starts to look into double digits. So that will be my dark horse for this year. Last year, we spoke in January, February, dark horse was commodity. It still continues. Now it's a consensus call. But from here on, I think the dark horse could be energy. It could be chemicals, it could be power-related themes, all of them which probably could outperform over the next 12 to 18 months.
Okay, all right. Hi, Pankaj. Good morning. Always good to see you in. And I remember that call on, commodities that you spoke about. Also, some of those pipe makers like Welspun Corp. You were talking about it, I think, at around 800 odd rupees. And that's done quite well. But I'll get back to those sectors and themes in just a bit. I wanted to ask you about the biggest skew that we got yesterday, which was the state election outcomes. You're a numbers man. I'm sure you have done some kind of number crunching on that. How positive is it for the economy on the whole? And in terms of a market perspective as well, suddenly you have one part of India that's not seen a lot of development. Maybe growth as well has been relatively low, and per capita income as well has been relatively lower. Now, there's going to be a lot of focus on West Bengal. Have you put any numbers together? If you could give us a sense in terms of GDP impact, in terms of company-wise impact, something on those lines.
So good, Nigel. I come from Calcutta. That's my hometown, as you know.
So I ask you.
Coincidentally, over the weekend, I was in Kolkata and I attended a social function where all the industrialists and companies out of Calcutta were there. And there was a unanimous optimism. And mind you, over the weekend, the votes were not still counted. So nobody knew the results, but everybody was optimistic that BJP is coming with 180, 200 seats. And they were looking this change with a lot of expectation and optimism. I believe it's a very, very welcome change. For 34 years, the left was there, then 15 years, Trinamool was there. And just to put numbers in perspective, West Bengal has been the lowest growing state in terms of per capita over the last century in India. Among the states, it's West Bengal which has seen the lowest growth, led by many other things, which we don't want to get into details. And if you go into the past, Nigel, I don't know whether you are aware, in the 1750s and 1800s, Murshida was the richest place on the planet. And from there to the times of glory, which Bengal has seen to where we are, it's a state of disappointment. But this state has everything. Cheap labor, cheap power, port, fertile land, you name it. For any industry to grow there, it's a dream come true. And I believe that this is a very welcome change. People want development in Bengal. People want industrialization in Bengal. And people want the per capita income to grow. So the growth of Bengal could definitely add incremental GDP to the overall country, the way it happened in Bihar, if you remember, the way it happened in Jharkhand, and the way it is happening in UP. I can only tell you with our experience when we speak to companies, the kind of positive feedback we are getting for the administration out there in UP is just unbelievable, that how a leader there can change the entire circumstance of law and order, industrialization. Companies based out of South India who have never ventured into North, they have gone into UP and have full praise about that state in terms of law and administration, the way they were assisted in terms of setting up businesses. So I think that same template can be replicated in Bengal, and we would be surprised at the growth which this state can deliver. And there was a glory in the 1700s, 1800s, and Kolkata was the capital of British Raj. And then since then, we have seen a downfall over the last century. We are hopeful. The entire community in Bengal is hopeful that this change could bring in development. And overall, it's nice. Now, 21 states, either in form of direct or alliances, are ruled by BJP in terms of their governments, which is a welcome step that they can have a pan-India policy and things can be implemented at a faster pace. The next election is in March, April in UP. That's a big one. So you have a window for reforms, which I think if this government goes after, we could be surprised.
Absolutely. Apologies, sorry, but point well taken, Pankaj. And thank you very much for joining us. We are on the earnings treadmill, you would understand. We've got management's waiting back to back in that sense. I think the management of KEI Industries is with us, and let's just go across to them for a quick chat. We have Anil Gupta, CMD. Mr. Gupta, good to have you with us here. Thanks very much for joining us. So I just wanted volume numbers from you first up, because I think growth is strong, price-led, but what has been volume growth in the quarter compared to the same time last year and quarter on quarter?
Good morning, Prashant. The growth, volume growth in the quarter is around 12.5%. Actually, some revenue was, export revenue was hit because of the non-dispatch of, manufactured materials due to Middle East crisis, and shipments were not leaving to the Middle East, which is our potential export market. So that led to some fall in the revenue in March. And otherwise, we could have grown by another 2% in this quarter.
Oh, volume growth is how much, sir? You said
around 12.5%.
12.5%. This is in the quarter that we are in. How is that trending so far?
No, it's very positive. It is very strong. In this quarter also in April, we have seen a very strong momentum, and there will be a strong growth in the first quarter also.
You know, we've spoken about prices, very high prices impinging on volume growth. And you've said in the past that at very high price levels, maybe there is some curtailment in off-take demand, etc. Is that showing up at all or no?
No, I don't see any change in the demand pattern because of the high prices. So buyers can, at maximum, defer the purchase decisions by 10-15 days. But since their projects are ongoing, their timelines are critical, they can't delay the purchase.
So you said there was a loss of 2% on your top line on account of shipments which are stuck, dispatches which could not go through to the Middle East, which is an important export destination. And this happened in Q4 where there was a 1-month impact. Now the Middle East crisis is still playing out. What is your expectation on exports for the current quarter?
Exports will be positive because our export destinations are spread all over the world. It is only the Middle East where it is impacted. But now the only way is that we have dispatched a lot of cables to Middle East in April by absorbing very high freight. Because now the materials are going to some Fujairah port, and from there by land route, they are going to different destinations in Abu Dhabi and other Qatar, etc. So it is moving, but we are sharing the increased freight cost with the buyers, and some we are absorbing.
Okay. So what could be the potential volume growth in exports in Q1, and what is the impact of the cost increase that you've had to take?
No. I mean, since export forms just 17-18% of our total turnover, the impact on the overall margins will be very, very small. And so far as export growth is concerned, actually it will be in line with, I'm sure that it will be more than 20%, but we have not yet quantified it because we will still have to figure out that how the Middle East crises are impacting. Some decision making in Middle East has slowed down because of the non-availability of people in the offices, and but decisions are being taken, and we have still received substantial orders from Middle East even in April as well.
And for FY27, sir, you stick to the 20% revenue growth guidance that you pretty much maintained as medium term. And since you will get some additional production from Sanand in Q4, will volume growth in FY27 be better than FY26? And what's the number that we're looking at?
We are confident that our revenue growth in FY27 will be 20% and more. And it will be purely led by production from Sanand, because all our other plants are already producing at the highest, their peak capacities. So that is why our volume growth was lower in the last financial year. But we are confident that our growth will be very substantial in FY27 because of the commissioning of Sanand facility.
All right, Mr. Gupta, just to reconfirm this, cables and wires, you're saying the growth was 12.5% on volumes for the past quarter on year-on-year basis. Is that correct?
Yeah, correct.
That would mean that value growth was only around 7 to 8%?
Yes.
Okay, all right. Just reconfirming that, because a couple of sales notes, in fact, were working with far lower numbers, but you're giving us that volume number. We have taken note of that. Let's focus on margins. Margins for the past quarter were around 11%, which is the best since Q4 FY24. And on your core wires and cables business, the EBIT margin stood at around 12.4%, which is the highest since Q2 FY21. Give us a guidance on both these two aspects, because input costs have gone up, though you have taken some price increases as well. So what's the broad band we work with?
See, I have always maintained that our EBITDA margin in FY27 could be anywhere between 10.5 to 11%. I am always conservative in projecting our EBIT margin. And we always strive to improve it during the course of execution in a quarter. But I'm confident that whatever we are projecting, we are going to do better than that. But it is impossible for anyone to absolutely predict the margin percentages.
Yeah. But this input prices, I mean, that's just, and we've discussed this before, this is pass-through for you, right? I mean, it's just simply pass through.
Absolutely. It is
Right.
simply pass through. And you have seen, I mean, in our 15 years of history, we have now seen several, price cycles, and our margins have not gone down.
Yeah, yeah. Just one last quick bit on competition. Is competitive intensity same, higher, lower? Have we spoken about this in the past?
See, competition intensity is same and higher as well. But we have our own market. We have our own customer base, and I think that is growing even in India as well as abroad because of our good execution.
That is not going to lead to lower margins, higher competitive intensity. I mean, that is the only kind of consequence in that sense.
Not at all.
Okay.
So your order book declined on a quarter-on-quarter basis. Any particular reason for that?
Because we have not booked any EPC order during the year, and you know that our EPC sale is declining as a as a policy of the company. So and so far as cable orders are concerned, more than 55% is the dealer sale, where the orders are not taken into consideration while giving this figure. Rest are project orders. So then there are only that much orders, and those are executed maximum within 3 months.
Okay. All right, Mr. Gupta, we wish you and the team all the very best for FY27. We'll keep chatting periodically as the year progresses. Thanks a lot for joining in.
Thank you very much.
Well, let's move to Coal India then. That's the next management on our show. It reported a mixed set of numbers to discuss what's the past quarter and what's the way ahead. We're joined by Coal India's chairman, Mr. B. Sairam, as well as we have the company's Director of Finance, Mr. Mukesh Agarwal, who joins us on the show. Hi, gentlemen. Thanks a lot for joining in. Well, Mr. Sairam, let me come across to you first. You've got off to actually a softer start in April 2026 on the volumes. That's despite such strong power demand. Tell us, what are the production dispatch targets that you have for FY27?
Actually, what happened that in the month of April, normally it happens that we take up overall of our machines and plants. So that is what exactly happened in the month of April. But May onwards, we are very much hopeful that the production as well as the offtake quantities will definitely pick up. And this year, the production target which has been assigned to us is 815 million ton. And this target is based on the historical averages as well as the projected demand from power sector as well as non-power sector. So 815 million ton production will be there. And then we are sitting on a comfortable stock of 130 million ton as on 1st of April. Last month, we could moderate it to the level of 122 million ton. So this production program as well as the stock gives us a lot of operational buffer to meet the growing demand. And demand is naturally going up. Last year, 240 gigawatt the peak capacity. This year, in the month of April itself, the peak demand had risen to the level of 243 gigawatt. And the analysts say that it will go up to the level of 270 gigawatt. So means there is a need to up our sleeves, and we are braced for the whatever demand comes up from the power sector. Yeah, that is our take on this. And with all these things, we will be landing at a closing stock of 95 million ton. So there will be a 6% growth in production. There will be dispatch growth of 10% in the likely scenario, and there will be closing stock for maybe 20 to 27% reduction.
Okay, a soft start to the year, but you're optimistic that things pick up from here on. Got that. We're going to hold you to these numbers. Let's focus on a couple of aspects then. What will be the dispatch growth for the e-auction segment? And also, if you could help us out with e-auction premiums. It's not increasing despite global prices moving up. Indonesia as well is likely to export less. What's the trajectory on e-auction realizations?
The e-auction depends on two things. One is the demand, which is a natural thing, and second is how the prices across the globe move up or down. So last year the demand was less, so that was a factor which was responsible for subdued premium. And second, global pricing was also more or less stable, at least for the first 8-9 months. In the last quarter and in this financial year, the dynamics of global coal demand as well as global supply chain is taking a lot of dynamic reactions and actions. So we are hopeful that there will be an increase in the notified price in this year. Last year, the notified price increase, the premium was 38%. We can expect a 4 to 5% additional premium this year.
Correct. All right, Mr. Mukesh, let's get you in then. What is the increase in the cost of production? Since you mentioned that the cost of explosives as well as industrial diesel, both of them have spiked up from March onwards. Also, why are you not passing it on?
We had given that we are insulating the prices of the increased diesel and the explosive. On the other hand, the Coal India always believe on the volume growth. Volume growth, as the CMD sir has told, we are planning 815 million tons against the last year 716.8. There will be 6 to 7% growth in the volume. And the second factor will be the natural attrition of the manpower. These two factors will help to offset the current level of increase in the diesel prices and the explosive, so that our EBITDA will remain at the constant level of the 32 to 33%. These two drivers we are using.
All right, Mr. Mukesh, can you quantify the point you make on attrition? How many employees will superannuate in the coming year?
We are expecting some around 9,000 to 10,000 non-executive will superannuated in the natural course. This will help us to rationalize the increased cost of the diesel and the explosive.
Okay, all right. So there's already been a dip and you're saying another 9 to 10,000 employees will superannuate. Got that. Mr. Mukesh, what is the capex plan this year and how much will be non-coal based business contribute, say in revenue terms, in the coming year, since there's a lot of focus on that as well?
Actually, last year we had done a capex of 16,000 crore. And if we see that we had planned a 1 lakh crore capex down the next 5 years. So it works out around 16 to 20,000, 25,000 crore in the progressively in the coming years. So out of 1,00,000 crore, we had planned 66,000 crore towards the gasification project, 15 to 20,000 crore rupees towards the renewable energy, 10,000 crore rupees is towards the thermal energy, and some acquisition which we are planning for our critical mineral and other resources. So these are the capex, and we see that after 5 to 10 years, after 5 years, around 10% non-coal business revenue will be there in our top line.
Okay, 10% of the total mix coming from non-coal business. We'll have to track that number. Also, what supports Coal India in terms of valuations is cash in the books. Mr. Mukesh, what's the update on that? What is the current cash in books?
As on 31st March, it was around 51,000 crore rupees cash was available. But these cash are going to be, because basically we have two companies where the more cash are there. There is the NCL and the MCL. In NCL, we had already taken a big project of Singrauli Visthapan, where a lot of land is required. So these cash are going to be adequately utilized in the coming expansion project. And similarly, MCL has also taken up the 2-3 new projects where this cash is going to be utilized. Otherwise, other subsidiaries are maintaining a normal level of the cash. But considering the huge requirement of big ticket size projects in the NCL and NCL, cash are there.
Having cash in books is good, sir. But what about dividend payouts? That's been quite healthy over the last few years. Could you tell us what is the guidance on that front?
Last year, in 24-25, we had given 26 rupees 50 paisa. And the 25-26 also, we had given the 26.50. But the payout percentage has increased from 46 to 52% in this financial year. And we will strike a balance between the capex requirement and the dividend in the coming year, as we are doing previously also.
Okay, all right. Well, before we let you all gentlemen go, Mr. Sairam, I'm coming across to you. There's a lot of talk of there is some shortage of coal stocks in India. Would you like to clarify? Because you're the biggest coal miner in the country. What's your stance on it?
Yeah, absolutely not. Absolutely not. This is my one-word comment on this. Because the thermal power plants, and they are maintaining a stock of 50 million ton. On 1st of April, it was 55 million ton. It has come down to the level of 51 million ton rather. And we hope that with all the coal sector production ramping up, we will be able to maintain the coal stock in this range itself. Add to this, we at the Coal India pithead plant, our mines pithead, we are maintaining a stock of 122 million ton. Add to this, there is an in situ coal exposure to the level of 48 million ton. So all these things gives us a lot of comfort, not the level of comfort, but the operational flexibility that we can ramp up the supply whenever demand spike takes place.
We take your point, Mr. Sairam, as well as Mr. Mukesh. Thanks a lot for joining in. Wishing you all the best. We're going to hold you to these numbers. 815 million tons of total volumes is what you're guiding for, with margins in the band of around 32 to around 33%. Thanks a lot for joining in and clarifying there is no shortage of coal. Enough adequate stock is what is there. Thanks for joining in. Well, we'll slip into a short break. You come back, we'll connect with the management of Aarti Industries to discuss the past quarter's numbers.
Welcome back. Let's continue with Corporate Radar. Aarti Industries is in focus. Strong set of numbers, revenue margins coming in healthy. In fact, volume growth was witnessed across all key products. Suyog Kotecha, CEO and Executive Director of Aarti Industries, is now joining in. Suyog, hi, morning. This is Rima here. You know, we were just chatting with Pankaj Tibrewal of Ikigai Asset Managers, and he was talking broadly about the chemicals industry. He said the industry struggled for the last couple of years on account of dumping from China, but that is changing now. He said yuan is appreciated nearly 20%, logistics costs have gone up, and Chinese government has stopped export rebates from 1st of April. Is this something that you are seeing on the ground, and what will be the implication for Aarti Industries?
So it's definitely something that's visible on the ground. I think it changes from value chain to value chain, but in select value chain where Chinese government has taken a stance related to anti-involution, where they are taking several measures in terms of removing subsidies like VAT subsidies or restricting exports. Those value chains have started to see pricing and margin conduct improving in those value chains, especially for Aarti Industries. You know, nitrochlorobenzene is such value chain where we have seen significant shift in terms of Chinese behavior, in terms of their export product placement, and that has had impact on the global pricing as well as the volume flows.
Suyog, hi, good morning. Talk to us a little bit about the current situation. Is raw material sourcing a problem, Suyog, because of what is happening in the Middle East? And, if across the chemistries that you operate in, where is it an issue? Where is it a problem?
Yeah. No, so I think West Asia war is, of course, a major event for the industry in general and for us. And I think it has sort of impact in multiple ways. From a direct impact point of view, we do have roughly 10% of revenue coming from Middle East, which, of course, we have to figure out alternate market till the time the situation stabilizes in the Middle East. That's kind of direct impact. On the raw material front, frankly, we have well-diversified supplier source. So availability is not a major challenge, though we have to, figure out a spot purchase given some of the contractual suppliers from Middle East have declared force majeure. But availability, we are still able to figure out. It comes at a significantly escalated pricing, given the way crude and the other raw materials have moved in the last 6 to 8 weeks. But availability in general, we have been able to figure out. I think the impact that we have to watch out for is, how much it is going to cause damage in terms of medium to long term. We think the price rise overall will lead to a kind of an inflationary scenario globally, which could potentially have impact on the global demand. And as a 55 to 60% export-oriented organization, it could have an impact in a 3 to 6 months time frame. As far as the near term is concerned, raw material, we've mitigated the impact to some extent by diversifying our supplier sources. And in terms of product placement, the effort continues to diversify away, at least for the near term, till that situation stabilizes in Middle Eastern markets.
Is the cost shock? As you said, you had to buy on spot. So what is the? Give us some sense. What are you buying at now compared to pre-28th of Feb?
No, look, I think the raw material escalations have been phenomenal. And forget spot versus contract, because even contracts moves with the index. In general, any of our large raw materials, if you look at it, benzene, aniline, toluene, the price escalations have anywhere in the range of 40 to 60%. That's the kind of price escalation that we have seen. In most of the cases, we are pushing very aggressively to pass on this price rises to customer. And I think everyone is understanding the situation, given it's a global phenomena. But there will be certain lag. There will be certain contracts that we will have to also honor from our mid to long term commitment kind of stuff. But it's a significant increase compared to mid-Feb kind of scenario, right? Anywhere between 40 to 60% is a kind of increase in the raw material cost.
Right. And you, as you said, you're pushing hard to try and pass on this, right? I mean, but it's not possible in all cases.
Yeah, I think there will be always, different applications will move differently. I think some applications, usually, the bulk chemicals, the passing on the price happens relatively quickly. I think more specialty, more, contractual customer, where sometimes the pricing formulas are quarter average or 6-month average. There it does take time to pass on the price rise. So it will be a mixed impact at some point in time. If the scenario continues like this, then of course, over a course of 3 to 6 months, the price rise will be passed on. But it depends on how soon the situation stabilizes in the Middle East.
Yeah. Just one more thing. One is, price increases. The other is availability itself. Has availability been an issue in some chemistries, in some of these value chains for you? Inputs?
No, I think at a certain price point, frankly, everything is available, right? So by and large, for us,
I'll be specific. Like, for example, sulfuric acid, right? I think China imposed some curbs.
Yes. So we are a producer of sulfuric acid, and we buy sulfur domestically. And yes, the price rise have been quite phenomenal, but we have been able to secure our requirement from an availability standpoint.
And these 10% exports to Middle East, has it stopped? Or are you able to divert the supply? Has that impacted your growth? And for FY27, what are you penciling in, volume and value growth?
Yeah, no, I think so. The export to Middle East have significantly reduced from 1st of March onwards. We are, of course, trying to secure alternate markets for these products. Again, it does take a little bit of time to diversify away and place those kind of volumes to alternate geographies. I think we've had partial success, and we continue to remain on track to figure out alternate markets for many of these products. I think for the year, I think we've given the midterm guidance. We continue to remain sort of focused on delivering that. There will be near-term volatility. I think quarter on quarter, given the scale of the event happening in the Middle East, I think there will be some impact. But I think we are not deviating from where we want to reach in a 2 to 3 year time frame. That's the guidance that we had given. I think what's important to understand is, while we focus on the near term, it's also important that we continue to deliver on our long-term aspirations. And we did close, 2 long-term contracts in the last quarter. One of which was a repeat contract with a global major for a 15-year term with a relatively secured earnings. The second one was a $150 million contract over a 4-year time frame. So I think what's important is, while we navigate the near-term challenges, I think we continue to execute our long-term agenda to give, high-quality portfolio growth from a midterm standpoint.
Yeah, no, absolutely. Are there any labor shortages? Any projects which were about to start where they're not able to start because of all of these issues?
It is. I think it's an indirect impact of West Asia war, because I think the commercial LPG issue did see a significant impact in terms of contract labor availability in the region where our capex projects are getting executed. We are roughly 30-35% short on the contract labor right now as we speak, compared to where we were 1 quarter back. And that has led to a kind of a 3 to 4 month delay in terms of our capex project execution. But we are actively mitigating it, including figuring out how do we give assurance to contract labor in terms of no impact being caused because of the commercial LPG issue. But yes, it does have an impact on the project execution timelines for us.
Yeah. Yeah. So just leave us with the guidance, Suyog. Is it possible to leave us with something?
Look, I think we talked about, three fronts, and we have been consistent in the story for now last 4 or 5 quarters, right? I think we have cost angle of 150 to 200 crores. We have operating leverage of 350 to 550 crore, and then we have capex-led growth for the remaining portion to achieve our midterm guidance. I think on all the cost initiatives, we are frankly mostly done. I think all of them are implemented. They should start accruing fully from the coming year. I think on operating leverage related issues in terms of our volume and the capacity ramp-ups, we are very much on the track. I think whatever we said, we are executing it. And it's happening as per the timelines. Apart from near-term volatilities like West Asia war, but I think from a mid to long-term point of view, all of them sort of kind of remain on track. I think it's the capex-led growth where we have had 3 to 4 months of delay. Though all of these projects will get commissioned within the FY27 timeframe, I think compared to our expectation, today we see a roughly 3 to 4 months delay to sort of commission and commercialize this asset. So I think we are not changing anything at this point in time, while we remain watchful of some of the latest developments and figuring out way to mitigate the impact from a midterm standpoint.
Okay, good conversation, Suyog. Thank you very much for joining us. Good speaking with you, and good luck as you navigate through some of this over the next many months, hopefully not quarters, and things resolve and get better. Thank you. Well, I think commodities are what we are sticking with in that sense, and it all, of course, all this chemistry and products, etc., flows from oil, crude oil, and that's what Manisha is focusing on. She's here with what's top of mind. Manisha, over to you.
Thank you for that, Prashant. Well, absolutely. There are two sets of fundamentals to talk about. One on why the crude prices ran up and why we're looking at a bit of a profit-taking in the Asian markets right now. One, first of all, is the price movement. The implied volatility continues to be very, very high. We saw 6% of gains in the markets at one point in time. We closed 4% on the higher side. On a weekly basis, we've seen 8% of gains come in for the crude oil prices, and that totals up to nearly 85% of gains till time in 2026. Well, the latest crux really comes in from the Strait of Hormuz itself, where we have seen West Asia tensions intensify as US and Iran exchange fire in Strait of Hormuz. The US Central Command says that 2 American flagged ships passed through the strait, but this is because of the effort that the US military is putting in there. The US military also said that they have destroyed 6 Iranian small boats, intercepted cruise missiles and drones as well coming in from Iran there. There have been also reports that Iran has attacked 4 ships in Gulf in the past 24 hours, including vessels from South Korea and UAE as well. And then you have statements from the UAE media also reporting interception of Iranian missiles and fire at its Fujairah oil terminal there. These are the reasons that you saw the crude oil prices surge up. Now take a look at the reactions from some of the biggest ones that happened in case of crude. Chevron's CEO yesterday has said that the physical oil storage appears to be shortening or declining around the world therein. He also continues to say that it is about commercial markets, whether it is about shadow feeds and national strategic reserves. All of that seems to be getting absorbed into the international markets right now. Goldman Sachs, in the meanwhile, said that the global oil stocks are approaching the lowest level in 8 years. Goldman Sachs goes on to say in its report that the global oil stocks are at 101 days of demand and could fall to 98 days by May end if this status quo continues till the end of the month as well. Barclays, in the meanwhile, has increased its oil average forecast in sense of prices to 110 by the end of the month of May. Now, the reason that you have seen that 1.5% decline coming for the markets is that every data suggests that there is some increase in supplies coming in from the non-conventional areas. So when you look at the US oil and rig numbers, that has continued to increase for a second straight week. You also have the Venezuela oil exports gaining up by 14% for the month of April. This is the highest in 7 years. You also have seen OPEC Plus increase production for a third straight time in a meeting there by 188,000 barrels per day. This would start kicking in from the month of June. And then we do understand that the Strait of Hormuz is mostly shut and 17 to 20 million barrels per day is getting lost. But there is pipeline capacity ramping up happening from Saudi Arabia to UAE, We do understand that both of these countries together are via pipelines putting out nearly 7 million barrels per day of a crude oil there. That is what the street seems to be looking at. And then it also is about IEA, which says that the global oil demand austerity measures that have been taken by the governments also will start impacting the sense that you wouldn't need that much of a crude. So 0.8 million barrels per day of a contraction in this year is what perhaps we could be looking at. And then this is something that most analysts have been arguing, that earlier oil supply shocks, and this one is different because right now we are less energy intensive versus the previous oil shocks. So whether it comes to electricity, renewables, we are working with all of that direction as well. So it is lesser and is the reason that you haven't seen prices sustain above 120.
All right, Manisha, thank you very much for that. We'll see where we head from here, but hopefully lower. Otherwise, I mean, it's problematic. As you can see, the dollar rupee is at the bottom of the screen, and it's at a new high. The dollar, that is, and the rupee is at a new low this morning. We'll take a break. Metals and focus, commodities very much has been the theme throughout. Jindal Stainless Management joins in to talk about their fourth quarter performance and outlook. Stay tuned, coming up.
Welcome back. Well, let's focus on Jindal Stainless. They reported actually a good showing in Q4. Operating profit was up closer on 37%, though the volumes are more or less flattish because there were some constraints due to gas availability. To discuss this and what's the outlook ahead, we're joined by Tarun Kumar Kulbe, the CEO and CFO of Jindal Stainless. Hi, Mr. Kulbe. Good morning. Good to see you, and always a pleasure, sir, to catch up. Let's understand a couple of aspects. First, on the gas availability. Globally, there's been a lot of uncertainty that's been at play. And because of that, gas availability has become an issue, not for you, for the entire industry. But for your company, how is the gas availability situation? And are you using now alternate resources to fire your plants?
Thanks, Nigel. Well, on the gas availability front, we have to see, Nigel, that in our different plants, while predominantly we use propane and LPG as a fuel, but in our Mundra plant, we use natural gas. Now, when the Gulf crisis started, on the natural gas also initially there were restrictions, but availability of LPG and propane became immediately a problem. Gradually, I will say the situation has improved, but the cost what we paid multiplied. I'll say 3 to 4 times. The cost went up on the LPG prices for the obvious reasons that the availability was a constraint. Now, going forward, we are now working because natural gas availability and price stability is better. So even in our Jatpur plant, in our Odisha plant, we are working to increase the usage of the natural gas. Mundra plant availability is already better. Availability of LPG and propane also now better, I will say, but the prices remains high.
Okay, all right. Availability is good, but the input cost is still high. Okay, Mr. Kulbe, let's get 2 big numbers that the street will be waiting by for. One is on the volume growth. For last year, you were guiding, I think, in the vicinity of 8 to 10%. You've ended up with around 8%. So what kind of volume growth are you targeting for FY27? What will exports contribute as a percentage of the mix? Because that, I recall, used to be in low teens. That's come down to 5-7% or thereabouts. So what kind of contribution will you get from there? And point number 3 is, blended EBITDA per ton, 19 to 21,000 rupees is what you were guiding for. Last quarter, you did around 21,000 rupees. So for this year, what will it be? Volumes, exports, as well as EBITDA per ton. Go ahead, sir.
Okay. So on volume front, Nigel, we had guided 9 to 10%, and we were on course to deliver whatever we had guided, that volume increase for FY26. Unfortunately, the March month, we faced the sudden disruption in our operations, due to which we ended up attaining 8.1% volume growth in FY26. Now, for this FY27, we are targeting again a volume growth of 7 to 9% for the whole year. But and we are expecting not so much of disruption here onwards. So far as the market, our export market is concerned, in our Q3, our export share of the total volume had come down to 5%, which is back to 8%. And for the FY26 also, our export has been 8% of the total volume. Now for FY27, Nigel, export markets, I will say, if not very booming, then stable. We are able to sell in the markets like Americas and all, where in the near past we have not seen much of disruptions. All in all, we are targeting around 8 to 10% of export share in our total increased guidance, whatever I have provided to you.
All right. And EBITDA per ton?
EBITDA per ton, right now, we will provide the guidance only for H1 because, as already I stated, that due to this war, a lot of uncertainties are there. And the cost also, as I said, the fuel prices are very high. We hope that gradually the normalization should come. Looking at all this for H1 only, right now I'm providing guidance that is 18 to 20,000. We are just watching it. Maybe after H1, or we will review the whole thing and then we'll provide you the revised numbers.
Very quickly, sir, there was a notification that came with regard to imports that look like it's making imports relatively easier, because they have relaxed some quality controls. Is that a big risk for your business? Do you see that, or was it something on expected lines? And also quickly, if you could comment on your net debt. Just a 20-second answer, sir.
Okay. So on the import front, this is basically the QCO removal, what we are discussing. This means that the government has allowed the import of substandard quality product, which earlier was restricted. So we don't see this as a positive move for the industry because this definitely will allow particularly substandard material coming from China, mainly, and of course Vietnam also, it was getting routed through before. So we don't see as a positive move because within the country a good capacity is available and we should be encouraging the good quality product usage into the various end products where it has been removed. So far as our net debt is concerned, we have ended up at 3040 crores, whereas our guidance was 35 to 3700 crores for FY27. So far as guidance is concerned, we would like to further reduce it, and we are targeting anything around 26 to 2800 crores.
Appreciate you joining in, Mr. Kolbe. Always a pleasure talking to you. We've got the broad numbers out, a quick but effective chat. Looking forward to chatting out with you soon. And maybe, in fact, we could have an interaction once you announce your Maharashtra capex plans as well, which the street is waiting for. Thanks a lot for joining in. Well, time to slip into a short break, but on the other side, our special Indianomics segment. After strong April auto sales numbers, Lada speaks to two economists and a market research firm to examine if growth may be stronger than market expectation. Stay tuned for that conversation.
Welcome to Indianomics. Ever since the war on Iran began on Feb 28 and crude prices started climbing, questions have been raised over India's 7% growth pace. However, in the past 2 weeks, some pleasant surprises have sprung up. Many FMCG companies like Hindustan Unilever and Nestlé, which had been reporting low single-digit volume growth for the better part of the last few quarters, reported higher volumes. Quite a few reported double-digit volume growth, as you can see, for the Jan-March quarter. April should have been worse, 2 months into the war. But take a look at the auto sales numbers for April. Almost all of them showing, over 30%. Many of them showing over 30% growth. Likewise, take a look at the tractor sales, commercial vehicle sales, and two-wheeler sales. All of them also growing impressively. So April sales volume growth is excellent. Therefore, is the Indian economy witnessing better growth than we all feared? Or is April just the last hurrah before growth slumps under the combined weight of triple-digit crude prices, El Nino, and possible export slump? Joining me to discuss the India growth picture as well as emerging worries in other macros like inflation and current account are experts, three experts: Abhishek Upadhyay of ICICI PD, Sakshi Gupta of HDFC Bank, and Lalit Bhise of the market research firm Bajaj. Well, Sakshi and gentlemen, thank you very much for your time. Let me start with you, Abhishek. What's the sense you are getting with the April numbers? First of all, did the Jan-March numbers surprise you pleasantly? I was quoting the FMCG numbers. And is April, at least auto sales-wise, not as bad as we feared?
Well, so the high-frequency data available since war started, mostly for the month of March, some for April, I would say paints a mixed picture, but overall would still term it quite resilient. Auto sales, particularly, you pointed out, has been quite strong. So, I mean, the so-called tier 1 data, auto sales, core GST collections, credit growth, these indicators, which are more correlated with domestic demand situation, have been quite strong, and that means economy entered this crisis in a good place. At the same time, what we are starting to see is external sector indicators such as non-oil exports growth, which is available for the month of March only, which was down 9% YOY, a marked shift from growth that was seen for the full fiscal overall, or tier 2 data such as diesel sales, for instance, which really slowed down in the month of March. GST e-way bills, which has also slowed down, are indicating that, or I would consider these as leading indicators that growth could weaken. As we know, bulk diesel prices, industrial diesel prices have gone up, and some of that weakness could be a result of that. Going ahead, we are likely to see external sector indicators weaken much more as terms of trade shock, spills over more broadly into the economy. From the framework perspective, when we are looking at how much growth will be, what matters is how the burden sharing of this higher oil prices happens between the government, the firms, and the households. I mean, if most of the shock is absorbed in terms of lower savings from government or corporate sector, we will not see as much impact on growth. But I would not say that is a good outcome, because that means current account deficit could be higher. That means because fiscal deficit could be higher, interest rates overall in the economy could be higher. So government needs to calibrate the policy responsibly.
Abhishek, I'm coming to the coming quarters in a minute. Just tell me if if the Jan-March quarter surprised you positively.
I think it would be, growth in that quarter would be in line with what CSO indicated, around 7.4, 7.5%, which is a good number.
Okay. Sakshi, your take. Do you think Q4, Jan-March, all analysts were pleasantly surprised by the FMCG numbers and the auto sales numbers. That's why I'm asking you, was Jan-March better than you thought?
No, absolutely, Radha. I agree that we knew that Jan and February, there was a strong momentum in the economy. Some of the indicators, like you pointed out, for the month of March, and let me add the IIP growth number that also came out for March, I think was slightly better than what we were anticipating, given the fact that there was an extreme shock, that the system was kind of handling in the month of March, and oil prices and the Indian crude basket at that time, if you look at the month of March, was actually very, very high. So I would kind of agree with you and say that, some of the indicators have performed better. I think it is a strong signal of the fact that the absorptive capacity of the system at this point, if I talk about households, if I talk about the corporate sector, definitely seems to be better positioned. And therefore, our estimate for Jan to March quarter is close to 7.4%, which is, the derivative of the annual numbers that the CSO came out with.
Okay, so 7.4, you would stick your neck for that number. Lalit, now let me come to the month of April itself, for which only you have data. Of course, we have auto sales data, but auto sales is a consumer discretionary number. How did the rest of the consumption basket perform in April compared to normal Aprils or compared to the previous quarters?
Right. So thanks, Artha, for having me. But yeah, so April was also a pleasant surprise. All of us expected that war might have impact on consumption and stuff like that. But turns out even in April, the whole FMCG consumption has gone up overall by 6.3%, primarily driven by rural, which continues to be really strong. Also, the whole heat wave seemed to have increased the consumption of stuff like beverages, which has gone significantly higher. Packaged foods is surprisingly high up, which essentially indicates that maybe the LPG shortage has allowed people to stock up on packaged foods. Other interesting thing was commodities, at least in value terms, have gone up. Packaged commodities, which is like packaged oil, rice, atta, all of that, has gone up quite significantly in the month of April compared to last year. So overall, it's been about 6.3% compared to last year, which is obviously a pleasant surprise for all of us, negating the effects of war, at least in short terms.
Okay, so you're saying that the April consumption trend did not show too much of a slowdown?
No, it did not. It overall actually went up to about 6.3%, which was actually quite pleasant surprise, as I said. I think the only category which significantly degrew was home care, which essentially meant that people preferred the food rather than surfaces in general. And obviously, urban continues to not show as exciting growth. Urban, I think, overall grew only by about 2%, but it was more than compensated by rural. So it turns out, I think, like the brands like Nestlé and public brands who are claiming, I think there still seems to be a distribution-led growth that is available in rural. We also see regional brands growing quite fast, which also indicates, a rural consumption growth overall.
No, that's a very important point, that it isn't just the listed stocks, but you're saying there was also a transfer to unbranded, and
Correct.
that would mean that, the growth is more than what the listed space is telling us. But Lalit, the very important point, and let the table come up again, rural-urban. Urban growth in April has been as bad as 2% for FMCG products.
Correct.
Abhishek, what would you take away from that? Do you think that the slowdown has started well and proper? When you look at cars, you don't get that feeling. But when you look at the urban numbers that Bizom is putting up, it's looking troubling. What would you conclude of the April, May, June quarter?
Well, so urban demand has held up much better than I thought. I mean, after GST cuts, we thought that growth will be strong for a few months, but then will taper out. But what we saw from auto sales numbers that you pointed out was growth was strong till, the very recent data that is available. Because we have yet not seen these higher impact from food prices being passed on to consumers in a big way, and therefore inflation still stays low. I would not think that we should see abrupt weakness in urban consumption demand indicators immediately. Would rather wait for more data to confirm that. My thought process would be that external sector indicators worsen first, and that then leads to further spillovers into other indicators. So accordingly, we'll think that domestic demand indicators should still hold up well for in the first quarter, therefore.
Okay. That assumes that the Reserve Bank will not pass on fuel price hikes anytime now. The expectation is that commercial LPG has been passed on. It won't be long before petrol and diesel is also passed on. Are you factoring that in? And what is your GDP number?
I think it is highly likely that retail prices for auto fuels will go up. The kind of shortfalls that all marketing companies are facing right now is clearly not sustainable, and it will be prudent for government to allow some of this price adjustment to happen so that demand adjusts suitably, and that could then bring down current account deficit a bit, and rupee could stabilize also. Accordingly, I do think that it is quite likely, and it will show up in inflation numbers. Our estimate for inflation really for the full year is around 4.7, 4.8%. So quite a sharp increase from what we saw in the last fiscal year. Of course, only partly this is because of higher crude prices. Also, what we're likely to see is food inflation is likely to go up from very low levels last year. There's a risk of subpar rains, which could have some impact there. But we're not building a very big upside at the same time from that side. Overall,
Abhishek, 1 minute.
we are seeing at...
Abhishek, I'll come to the inflation bit in just a minute. Just tell me your growth number. RBI stands at 6.8. Will we do that?
At 95 crude, we are also at 6.8, but risk is for weaker number for the full year.
Okay, and Sakshi, what's your growth number? I'll come to the details later. Very quickly, your growth number for the first quarter.
So for the first quarter, Lata, we are estimating 6.5% growth. assuming that oil prices average somewhere around $95-100 per barrel in the first quarter.
Okay, well, at the moment it's running at an average above 100, at least for the month of April. But we'll come back and discuss what the inflation problems are likely to be, and more importantly, current account deficit and the rupee, with the currency touching fresh lows practically every day. We're back with all those questions. Bazaar viewers, Chartbusters time for you. You'll get to hear the entire conversation after market hours.
Strong earnings-led move on Tata Technologies. Top-line growth beats expectations. The margins rebound to 16% levels. The management tells CNBC TV18 they see robust margin of 18% by the fourth quarter of this financial year. Stock up 9%.
KEI Industries Q4 results surpass expectations. The Q4 revenue is up by close to 19%, while margins improved to 11%, the best in nearly 2 years. The management tells CNBC TV18 they expect 20% revenue growth, led by production at Sanand. The stock, though, is off the morning lows, but continues to remain under pressure, down 3.5%.
Strong fourth quarter fails to buoy shares of Aarti Industries. Consistent volume growth across product lines, but select projects see delays on account of the geopolitical uncertainty. Management flags near-term volatility. Tells CNBC TV18 they are exploring alternate export markets amid war-led disruptions.
Wockhardt swings to a 166 crore profit in the March quarter. The company reports an over 1,400 basis point expansion in margins. The emerging market revenue more than doubles to around 320 crores odd. Turnaround to profitability lifts the stock in early trade.
Quest Corp delivers a muted show in the fourth quarter FY26. General staffing revenue logs a 2% decline even as headcount continues to be steady at 466,000. Management issues optimistic long-term guidance. Tells CNBC TV18 they expect margins to be between 2.5% to 3% by 2030. The stock up 8% in early trade.
Well, hello and welcome to Chartbusters. We're coming to you live from the CNBC TV18 Motilal Oswal studio. I'm Nigel, with me is Mangalam, and the markets have given off all that we put on yesterday. But the global cues itself are in a bit of a flux with, the rupee as well weakening. The rupee now is holding at around 95.3. And also, the price of Mangalam continues to remain at elevated levels, more than $110 per barrel mark. So a bit of a tricky scenario.
Bit of a tricky scenario, Nigel. Yesterday the street was resilient on the domestic positive cues that came by, but now the global cues are back on the front foot. Right now, Brent at around 113. But the important part is where we are right now on the Nifty. Very crucial to track because it's the 20-day moving average, which is 23,950 thereabouts. So any sort of support coming in here will be extremely crucial to track. And the put-call ratio too has moved to 0.72. Typically between 0.65 and 0.7 is where we see the market, at least consolidating or seeing a bit of a relief rally from oversold zones. So from a technical and F&O standpoint, extremely crucial to track. And the second half will have the expiry that plays out too. Dharmesh Shah of ICICI Securities joins in for a quick technical check on the market. Dharmesh, what is your reading of this range-bound consolidation over the last few days been?
Yeah, good morning, Well, absolutely, I think so. The market, if you look for the last few trading sessions, we have been trading in this range of 23,700 on the downside, on the higher side, 24,400, 500 has been acting as a resistance. But we should not forget, I think so, the market has seen already 11% move, making the index into the overbought condition. So what we believe, I think so, the current consolidation is helping the index to cool off the overbought condition and forming a strong base in this range of 23,600 on the downside, on the higher side, 24,500 will act as an immediate resistance. But in this process of base formation, we believe, I think so, the market is getting ready for the next leg of upside. So we should not treat this as a negative, but should we look as a move for base formation in this trading range. But stock-specific actions as we enter the earnings season is likely to continue. So not too negative for the market. Yes, market requires some or the other reason to fall. This time is again back to the crude, on the higher crude oil prices. But we still believe, I think so, market is in the range, and any dip towards 23,600 to 23,400 should we look as a buying opportunity.
Okay, all right, Dharmesh, what about individual stocks? You're saying you look to buy the dip, but on individual stocks, what are the targets you have out there?
Yeah, as far as stock specific is concerned, Nigel, I think so the way the momentum happening for the power space, I think so the power index itself has witnessed a 10 months of consolidation range breakout. We believe, I think so, power grid is something, the one which we like from the current market price, where the stock seems to be witnessing a bullish flag breakout, supported by falling trend line breakout, indicating the end of the corrective phase for power grid, indicating a target of towards 352, keeping a stop loss of 289. So power grid is one which we like among the power space. Apart from power grid, again, in the capital goods space, we like Engineers India, the one clearly outperforming in this current corrective phase. The stock has been forming higher top, higher bottom formation on all time frame, supported by, if you look at the trading range for last 14 months, it has been trading in this range of 255 to 180. Finally, has witnessed a breakout supported by strong sets of volumes, indicating a target of around 280, giving a stop loss of 249. So power grid and Engineers India remain to be our topic at the current market price.
Right, we take that point. Just a couple of staple stocks doing extremely well. We have Dabur's numbers this week as well, and increased possibility of a revival in the staples space. Has that stock excited? So Dabur is up around 2%. And alongside that, we are seeing some traction in a few of these pharma names as well. Aurobindo Pharma, for one, has moved to the high point of trade. Do you have a call on any of these stocks, particularly in the FMCG staples space and Dabur?
Yeah, so as far as FMCG space is concerned, Mangalam, we remain to be positive for Marico. I think so, the one. Where again,
that reports its numbers today.
Yeah, so again, I would say, okay, so maybe I think so the stock has been making a high top, high bottom formation, and the way the technical setup seems to be indicating, I think so the stock looks more lucrative. I think so the way we believe the strong support is placed at around 760, keeping a stop loss of 760, one can look for a target of around 810, 815. But apart from Marico, again, I think so for Dabur coming to, I think so the Dabur, I think so the more for trading range is indicating for Dabur going forward.
Dharmesh, I'm not sure whether you track it, but the Indian rupee is showing a lot of weakness. 95.3 is what we are at. Are you tracking it on the charts? Fundamentally, the various arguments being made that it's not so bad for the economy. But you can't get flows if you see this sort of a depreciation in the Indian rupee. On the charts, what is it looking like?
Yeah, so as far as the Indian rupee is concerned, absolutely, I think so. Dollar getting stronger, 95.33 higher. I think so. Looks to be, I think so, for a target of from 95.75 to 95.80 in the coming days. So yeah, absolutely, I think so. 94.40 remains to be the very strong support for the dollar.
All right, 94.40 is the strong support for the dollar. Take that point, Dharmesh. Thank you so much for joining in. With that, we'll get you some ideas of profit coming in from our colleagues at Money Control Pro. And today we have Lekha Badlani Jamnani joining in with the stock that she's tracking.
Yes, sir. So we like PM Industries, which is a leading auto ancillary specializing in comprehensive lighting solutions. Now, PM emerges as a moderate beneficiary in light of the recently announced Delhi EV policy. The company supplies lighting systems, including components tailored for electric vehicles, and has already established relationships with EV-focused OEMs, particularly in the two-wheeler segment. The consumer sentiment remains strong in the electric two-wheeler segment, and within EVs, scooters are becoming increasingly feature-rich, such that the value contribution from lighting systems is also trending higher. This will likely result in higher content per vehicle for the company. PM is also strengthening its electronics capabilities with investments in EMCs, which stands for electromagnetic compatibility testing, and in-house immunity testing. Now, it has already started trials and product validation at its Gurgaon facility. Now, this is expected to drive a meaningful increase in content per vehicle while also enabling participation in higher value premium lighting technologies. Moreover, optionality in the passenger vehicle segment is steadily building up as the company expands its presence and secures orders from leading OEMs such as Mercedes and Mahindra. The strategy is clearly defined to enter through smaller lighting components to establish credibility and subsequently scale up into more complex and higher value systems over time. Additionally, FIAM's domestic focus protects it from the global risk and geopolitical tensions. Given a firm business outlook, the company's valuation of around 20x FY28 estimated earnings reflects future upside.
We'll keep an eye out on that. Lekha, thanks a lot for joining and giving us that explanation. Well, we'll slip into a short break. On the other side, we'll continue to focus on markets. We'll also focus on stocks that are moving around. Stay tuned.
Welcome back. Even as the markets are lower, we have a bunch of stocks which are spiking right now. IRCTC from the broader markets up at the high point of trade. A decent traction is what we've seen on HFCL as well, up 5% for that stock. And since we spoke about Aurobindo Pharma earlier, look at Biocon. That one too has recovered a fair bit from the lows, currently at the high point of trade for that counter too. But let's go across to Rima, who joins in with Tata Tech. That stock is up nearly double digits after their fourth quarter performance, where the numbers beat the guidance set by the management, and they guided for even better. Rima.
Thanks so much for that. Indeed, Q4 revenue growth for Tata Tech was 12.5%, ahead of the 10% growth guidance that the company told us just 3 months back. And the good part is the organic revenue growth was also very strong. It came in at 7.8%, the highest amongst peers in the ER&D space. The company is also guiding for double-digit organic growth for FY27, and according to some analysts, it's realistic or maybe even conservative. So JP Morgan says this FY27 guidance of double-digit should be easily available because the asking rate every quarter is just 1.5%. Secondly, they say that the company has won 4 large deals in Q4, two more in April, and 2 more expected to close in the next 8 to 12 weeks, which provides visibility for the coming year. And they go on to say that the guidance could actually be conservative if there is an improvement in the macro environment. So as of now, the guidance doesn't assume an improvement, but if there is, then this guidance could be conservative. On margins too, the company has delivered a 190 basis points margin expansion to 16% in Q4, and going ahead, for next year, by Q4 FY27, the company is talking about an additional 200 basis points margin expansion, so 18%. The company has also won its first sizable engagement in Japan, so that opens up as a new geography. The long-term guidance, which the company shared on the channel, is to become a $1 billion company in the next couple of years and get margins to 20 to 21%. The reason why many brokerages have a neutral or a sell call on ER&D is, one, it's gone through a very rough patch in terms of slowing growth, but secondly, valuations too are on the higher side. The stock trades at about 25-30 times forward multiple. Back to you.
Okay, all right. Thanks a lot for that, Reba. Well, let's shift focus then to the state-run BHAL. That's on the spotlight on the back of its Q4 numbers. The stock, remember, has rallied 50% the last 1 month. Vinny joins us to give us a bull versus bear argument. Vinny?
Hi, good morning. So first up, do not forget, yesterday when they reported their numbers, the stock actually hit a 52-week high, 12% intraday up move, and then we started seeing a correction. Now, obviously, numbers were good, but there are some concerns that came in from brokerages. So there's a bull case as well as a bear case. Starting with the bear case, CLSA is maintaining the underperform rating. Target price is 282 rupees per share. What they are saying is, operationally, yes, BHAL had seen a turnaround in FY26. Top line, specifically, margins were good, but the quality of the growth, that's a bit of a concern, and that was not good. Gross margins overall, when you look at it, were down by 150 basis points. What is working for the margins or expansion in terms of the margins this time was a forex gain as well as some cash provisions. So these were the things that was helping the margins of the company. Now, what they believe going forward will not do well for BHAL is that given that the energy security theme over the past month has already rallied, they do not see any new orders coming in on this front as well, and they find the stock expensive. So these are the negative triggers here. JP Morgan too, they're maintaining the underweight rating. Target price is 220 rupees per share. When you look at the outperformances the stock has seen versus the Nifty mid cap, it's significantly higher. So now they believe it's the right time to exit the stock, book out your profits and take that opportunity as well. What they also see as a concern is that thermal power plant ordering cycle. That's come off now, that's phasing out now. And overall, the rise in energy storage systems, the cheap solar prices that are there as well, that becomes a crisis or a concern that comes in for coal-based power systems or energy generation plants. So that's why a bit of a negative impact that could come in for BHAL here as well. And obviously current stock price, they're not finding it too attractive even to look at it. That's why book your opportunities. Now Morgan Stanley on the other hand is quite positive on the stock, outperform rating. They've raised their target price to 444 rupees. They said the stock is well positioned to improve in terms of the context of India story. They believe that BHAL's turnaround, which came in Q4, a good growth or FY26 as well, that is expected to continue going forward. And overall, the catalyst they believe for the company going forward would be revenue execution. That was good in Q4. That would continue going forward. Power segment margins, that could increase furthermore as well. And improvement in receivable positions, the cash flow, operations, that would also further improve going forward.
All right, Vinny, thanks a lot for that. As we speak, the markets are at the low point of trade. A lot of stocks trading at the lowest levels this morning. So Reliance, for one, comes up for you. We've also seen some decline in the Nifty Bank, and that's led by SBI. That too has moved to the low point of trade. But we'll monitor the 8th of May, an important occasion there, which is Tata Trust's important board meet, where a lot will be discussed. Shireen joins in to tell us what's on the agenda. Shireen.
Well, thanks very much. Yes, the reason why this meeting of the Tata Trust is important is because it precedes the meeting of the Tata Sons board. Remember, the Tata Sons board, when it last met, had decided to defer any decisions and had decided to move their meeting to June. So this meeting is going to be important for the Tata Trust because, remember, the Tata Trust control 52% of Tata Sons. Now, two agenda items that we understand are going to be taken up. One is to consider nominations to the board of Tata Sons. What we learn is that Bhaskar Bhatt, the man who used to steer Titan, is likely to be considered as a possible nominee director for the Tata Sons board, to the Tata Sons board. This is going to be one of the decisions or one of the proposals under consideration of the Tata Trust. What we also are given to understand is that perhaps there is a question mark on Venu Srinivasan's continuation as a nominee director on the Tata Sons board. Whether or not his directorship continues is the question, but that is a decision we will have to wait to see. The other issue that is likely to be taken up on the 8th of May is the issue of listing of Tata Sons. Now, remember, this is a matter that the RBI has also been, we've been waiting for the RBI to opine on this. The Tata Sons have made it clear that they would like, at least some members of the Tata Sons board have made it clear that they would like for Tata Sons to be listed, especially if the Reserve Bank were to make that a consideration as far as compliance is concerned. Both Venu Srinivasan and Vijay Singh are in favor of listing of Tata Sons. They believe that it will help partially provide a growth trajectory, a resource allocation for growth, as well as provide an exit option for someone who may be looking at, and of course that includes people like Shapoorji Pallonji. But there are other directors who are not in favor of Tata Sons listing, so that is also going to be taken up on the 8th of May when the Tata Trust board meets. And as I pointed out, this is crucial because it precedes the board meeting of Tata Sons, which is scheduled at this point in time for June. Remember, there has been a boardroom battle on. There are question marks on the reappointment of N. Chandrasekharan as the chairman of Tata Sons, and that is a matter that is still pending and also likely to be taken up when the Tata Sons board meets in June.
Got it. Thanks a lot for that, Shireen. We'll keep an eye out on that and we'll stay tuned for that particular meeting. For the time being, though, we slip into a short break. On the other side, we'll focus on a couple of stocks in the broader markets that are moving around. We'll also give you an insight into the Indian rupee's move. Stay tuned.
Welcome back. A 200-point decline on the Nifty is what we've seen right now at the low point of trade, and a large part of the reason could be attributed to the weakness that we're seeing on the rupee as well. A fresh low is what we've hit on the rupee against the dollar. To explain the reasons and where we go from here, Lata joins in once again. Lata, more of the same or something fresh?
Well, absolutely more of the same. The rupee is falling simply because crude is rising. We saw that fall away from $126. That was the day the rupee had touched the previous all-time low of 95.22. But with the receding Monday, there was a bit of relief, and we saw the rupee at 94 and change for a better part. Though it ended, by the time the rupee market ended, already the fresh signs of news of trouble in Iran and Hormuz Strait had come in. And the rupee actually ended at 95.10, 3:30, and by 5 o'clock, it was actually at 95.22. But fresh news of claims and counterclaims of who attacked whose ships between US and Iran have led to this, over $113 on crude, and that's directly impacting India, seen as, the biggest importer, so we get impacted. But if you look at the rest of the Asian economies today, Indian currency is weakened the most. The only one giving it company is Malaysian ringgit, also down about 0.3. The others have fallen a little less than our own currency, which could be because some of the stock markets are closed. So that additional pressure of wanting crore rupees plus sales on Thursday, some of it gets remitted via dollars today. It usually happens after one working day. And therefore, the dollar demand could be coming even from FPIs. So there's an oil demand and there is the FPI dollar demand. The Reserve Bank apparently is supplying dollars, but that's, only in extreme situations. It's not as if they're holding any level, nor are dealers holding any level. So we are in blue skies territory, so people are just playing it, not even a day at a time, an hour at a time.
All right. Thanks a lot for that, Lata. Well, let's focus on Sunflag Iron. That stock is buzzing in today's trading session. Remember, there was a large trade yesterday at around 300 rupees per share. Mr. Vallabh Bansali bought close to 20 lakh shares. And in terms of the sellers, there was Mr. Bhupendra Gokuldas Sanghvi, who sold around 11.5 lakh shares. And there was, Bhavini Dhirendra Sanghvi, who sold close to around 8.3 lakh shares. Appears these are large individual holders. Not too sure about, anything else with regard to them, but they appeared on the sell side. And if you look at the March holdings, there were a couple of individuals with the similar surname of Sanghvi that had a very, very large stake in the company. So that's how, as of March 2026, we should pull their holdings up on the screen. Now, you'll be asking, why is the market excited? Well, first, what supports valuations of Sunflag? Well, as of March 2026, the company had close to around 10.66% stake in Lloyd's Metal. That is valued at around 10,500 crores. Now, you give it a holding company discount of around 60%. Still, the holding is valued at close to around 4,200 crores, which is a large deal. Now, besides that, you'll be asking, what about the operational performance? Well, if you look at the EBITDA for the last few years, it's been ballpark around 400 crores on an average. So you'll say that the stock trades at around 14 times EV upon EBITDA. However, if you take into account the stake that they have in Lloyd Metal and you give it a 60% holding company discount, then the stock trades at around 4.5 times EV upon core EBITDA, which is far more palatable. So that's why, in fact, the street is excited. You have a large shareholder that's come in there, a noted name, Mr. Bansali, coming in ahead and buying a large chunk in the company. And also you have valuation comfort because of the stake that it has in Lloyd Metal. You'll be asking what to track from here. Well, the management's intent is going to be important from here on. How do they intend to grow business? Is there going to be any expansion that they'll announce? We'll have to keep an eye out on that. And also keep in mind, a few years ago, I think between 2020 and 2024, the company didn't declare any dividends, and last year they gave a very meager dividend out there. So dividend distribution is something that you'll want to track as well. For today, large investor coming in. Lloyd Metal has already run a big time in the last month or so. This stock is playing a bit of a catch-up today.
Right, Nigel, thanks a lot for that. So that's about Sunflag Iron. With that, we'll wrap up on this edition of Chartbusters. But you stay tuned to CNBC TV 18 as Trading Hour comes up next. We track the markets which are at the low point of trade. Good morning. You're watching us here on Trading Hour. We come to you live from the CNBC TV 18 Motilal Oswal studio. I'm Mangalam Malu, with me Ritu Singh. Not looking very good for the markets right now. 200 points lower for the Nifty. We have the Nifty Bank lower by almost 500 points, and a lot of that is on account of the geopolitical risks coming back to the fore. Remember, the last few days we've been outperforming because of our domestic cues, hoping for continuity, in terms of political stability in West Bengal after the BJP has won the elections yesterday. And all those factors did well for us. But towards the end, we did see profit booking come by, largely because geopolitical situation hasn't improved as we speak. Brent is at 113 rupee at a fresh record low as well. Hi, Ritu.
Hi, yes, Mangalam, it's a push and pull between what's happening globally and the domestic factors. But today it seems, the worry is about that fragile peace between Iran and US. That's what's worrying the markets. Crude prices you spoke about, they rose to as much as 118 overnight. They now settled at about 112. But that is why you see the rupee at record low 95.40 is what we touched, and we're at, levels thereabout. Bank Nifty leading the fall. Names like State Bank of India under pressure, but names that are bucking the trend are, Mahindra and Mahindra, Adani Ports, ITC. They're seeing some marginal gains. Indigo Tech Mahindra, on the other hand, are some of the sectoral losers. If you look at the pack as a whole, IT is just about managing to hold on. The metal pack and pharma pack as well, flattish, but pretty much everything else is in the red. That's where we're at. Not looking like a good setup. We're at the low point of the day, below the 24,000 mark, 23,932 on the frontline index. But Hormaz is here to put a spotlight on the key movers and shakers.
It's not a very good start to the day indeed, and after the cool off that we saw from the highs of the day, we're just extending that fall as well, and the index now at 23,900 is what Ritu just highlighted. The 23,800 of course is the lower end of the range that the index finds itself in, at that 500 point range, with 24,300 being the upside. Now the Nifty Bank too was the first index that took the Nifty lower from the day's high in yesterday's session, and it is the principal culprit for the fall today as well. So almost 500 points shaved off on the Nifty Bank, and just continuing to struggle to sustain above that 55,000 mark on the upside, as was the case yesterday as well. So from yesterday's intraday high, the Nifty Bank is down almost 1,200 points. There are three major results that the street is awaiting today. Two from the automobile space, but look at L&T. L&T just won an order as well. It was a large order that it announced just a few minutes back. The stock is at the lows of the day. Mahindra and Mahindra too is now down around 1% ahead of its results, and Hero MotoCorp too, after some strong sales numbers, but the operational performance is something that will be watched out for by the street. You take a look at the positive earnings reactions that are taking place today. Tata Tech at one point was up 12%. It was the biggest single day gain that the stock has had since its listing all the way back in 2023. Wockhardt has extended its gains now to 12%, and CAMS, the earnings call, we'll hear from the management there in just a bit, but 6% higher on that stock as well. You look at the newsmakers, negative earnings reaction is Aarti Industries, 6% lower on the stock. Delivery as well, logistics stocks across the globe have taken it to the cleaners after the announcement made by Amazon, so 3% gone here as well. And Dynacon Systems, after the RBI order win, which is almost 50% of its market cap, doing very well for itself, 15% higher on that one as well. Sugar stocks having a good day, of course, unsurprisingly, higher crude oil prices. Dhampur, Dwarikesh, Ugar Sugars, all of them seeing gains of anywhere between 4 to 8%. Stocks at 52-week highs. Look at Idea Forge, now up 30% in 2 sessions, 7% in today's session, as well as an 18-month high for the stock. Sterlite Tech is also doing well for itself, and GE Power India is another one that's at a 52-week high. And one mention of Misho continuing to move higher, up 30% now in the last 3 trading sessions, set to report results later this week.
All right, Hormaz, thanks very much for putting the spotlight on some of the key names to keep in mind. But let's focus on another earnings that's come in, and that's CSB. Now, shares of CSB Bank have declined in trade today, despite posting what was a relatively healthy fourth quarter earnings. Their net interest margin, although has slipped for the full year compared to FY25. Let's go across to Pralay Mondal, the MD and CEO, to get us more on the numbers and the outlook for the bank going ahead. Pralay, always a pleasure to have you here. I wanted to start with, what you told us in the third quarter, the 10-11 accounts that had slipped from the SME book. And again, this quarter, you're attributing the increase in slippages to the SME portfolio. What's really going on there? Have you been able to make any recoveries from the slippages you saw in the previous quarter? And with what's happening in West Asia, how much of this book is really exposed?
Good morning, Ritu, and good morning to your viewers.
Yes, we had some slippages last quarter in the SMA book, but I think we have recovered or upgraded most of that. And this quarter actually has slippages lowest in the last 5 quarters. So what I said is that on the SMA book, it's doing very well now. We have recovered or upgraded most of it. But what we are careful is because of the geopolitical challenges and the supply chain disruptions, and initially it was the tariff disruption which was happening. So we are just cautious and careful, and hence we didn't grow the SMA book last year. But purely in terms of credit cost and slippages, actually this was one of our lowest quarters in the last 5 quarters.
Yes, let me also quickly get to your, gold loan book. That seems to be the key driver. It's more than half of your total book. While the growth numbers look good, the number of accounts has actually come down over the previous year. The tonnage growth is also down about 4%, even though, of course, the book has grown by 53%. So the same question as we were asking you, I think, mid-quarter when we spoke. Would you attribute most of the rise again to what's happening with gold prices and less with organic growth that you're seeing? And if that's the case, what is the outlook? How much more do you expect you can grow, and the user addition that you target for the year?
So Ritu, in the long term, we don't want to be a 50% kind of a gold loan business. We want to bring it down by 2030 to 30% and below. Having said that, at this point of time, the number of customers degrowth is primarily because our ticket sizes have improved significantly, because we have made a segmental shift out there. Because at the end of the day, we want customers whom we can cross-sell, because as a bank, we have to have multiple products with the customers. And given that perspective, we have our average ticket size is well above 4 lakhs, around 5 lakhs. And there are substantial portfolio above 10 lakhs. And that is something which we are focusing on. And that's the reason why you're seeing the number of customers are coming down. On the tonnage growth, you're right. But what typically happens is, because our customers are not really using as a consumption, but using it more for their businesses and other things, they will take whatever they need. And if they have to borrow more tomorrow, they have the metals with them. So as prices comes down, the tonnage goes up, and as prices goes up, tonnage comes down, because finally it's a collateral. That's the way it works. And hence, as and when prices come down, we see the tonnage growth come back again.
Right. Mr. Mondal, just to drive the point further on the gold loan portfolio itself, when gold prices were rising, obviously your LTVs, were reflecting that as well. Now gold prices are off highs. Your LTVs at around 67%. Do you think there is a bit of a risk out there if the gold prices either consolidate or fall a little more from what they've already seen at record highs?
Good morning, Mangalam. In the long term, as I said before, that gold book is not going to have 50%. But at this point of time, because it is 50%, we monitor it daily, whether it is the LTV or the balance bucketing in terms of what kind of portfolio is at risk, because it's not always the average LTV which matters. It is those 90th to 100% LTV or 80th to 90th percent LTV, those things matter. So we monitor it on a daily basis. I personally do. Having said that, another 10% drop will not really matter too much, because we must understand the large part of our portfolio is agri, and regulatory norms about 75% is not about agri. And to that extent, we have a fair bit of play out there. And so we have done our sensitivity analysis. Another 10% drop will not give us any challenge.
Right. So then X of gold, which is now 50% of your portfolio, for it to be sub 30%, you have to have other parts of your portfolio growing a lot more as well. Could you give us a sense of what kind of advances growth are you targeting over the next year or two, and what segments will lead it? And alongside that, an outlook on yields and NIMs as well.
Sure. So on the wholesale side, we grew this year around 36-37%. And that happened at a time when we were kind of writing down the DA portfolio, the securitization portfolio, which we put it under wholesale. So to that extent, actually have grown more than 40% in wholesale this year. And that will sustain because we have added our coverage team across. In SME, we have been a little bit of a muted growth at this point of time because we are managing the environmental and the ecosystem risk. But eventually, SME will be 18% of our portfolio, wholesale will be more than 30% of our portfolio, and retail will be around 20 to 25% of our portfolio. And hence that residual amount around somewhere around 28 to 30% will be on the gold side. So that's the clear plan. Retail, we just launched our core system 5-6 months back. We are launching new products right now. So on the back of a good quality liability franchise, we'll start building the retail assets. So in terms of priorities, wholesale will grow fastest after gold loan, and then SME and retail will also augment this growth. And hence, we think that we'll be able to achieve that mix by 2030.
All right, take that point. Pralay, very quickly before we let you go, ECL norms, now that RBI has finalized, do you have a rough calculation of how much additional provision you'll have to set aside, and how quickly will you start doing it, even though, of course, there is a transition timeline?
I think we're reasonably okay with the ACL guidelines in terms of the impact on the bank, because we had contingency provisioning of around 105 crores, which we did it in COVID time. We also have another, in addition to what RBI mandates, we have significantly higher provision. So we have around 210 crores of provision, which will get written back once the ECL norms comes in. Of course, the stage 2 provisioning, etc., there will be some adjustment will be required. So we are doing the final calculations, but we don't see any major impact, which is either greatly positive or greatly negative for us. It should be kind of within basis points. So I think we should be able to manage it.
Okay, so there's no ballpark number you could give us yet?
The final calculations are still going on, but if our CRAR is what, to at 20.6 or something like that on the overall CRAR, I don't think it will take it down below 20 under any circumstances.
All right. Thanks a lot, Pralay, for joining in and giving us a quick peek into what we should expect over the next 1 year or so. Obviously, the street will be eyeing asset quality extremely closely as we move along because of the geopolitical uncertainty and some decline in gold prices from the highs as well. But as you said, 20% decline from current levels will not hurt your business going forward. With that, we'll take a short break, come back, focus on the bond market with Manisha Gupta on the other side, even as the markets are seeing some bit of recovery from the lows. Welcome back. As promised, let's shift focus to the bond market action, where Manisha Gupta joins in with all the latest updates. Manisha.
Well, thank you so much for that. All the asset classes are right now reacting to the conflict intensifying at the Strait of Hormuz, and we've seen that impact come in for the money market as well. The bond yields rose to nearly 7.04% on the opening trades itself. We have seen the rupee decline to all-time lows, where we've seen 95.31 getting broken as well. And then there is just not the sell-off that you're looking at in rupee, but in debt, in various other currencies, in the regional market, and of course equities as well. The crude oil prices are trading at around $112, $113 a barrel, and we have seen the prices gain up by nearly 8% in a matter of last 1 week itself. The surge in crude oil prices also has led to inflation concerns. Market are looking at slowdown concerns in various countries as well. And then, of course, it is an impact that you will see on the inflation numbers, GDP numbers, and a turnaround in case of the rate cycle as well. So when you look at the higher crude oil prices, the couple of impacts that the markets are reading into that is, one, a sustained $10 rise in case of the crude oil prices can add to nearly 35 basis points to the CPI numbers itself. And then it can also increase the India's import bill by nearly $15 billion. If you continue with this calculation, well, remember, we have seen the crude oil prices gain up by 70 to nearly 110. So that has been nearly $40 of a jump up that we've seen in case of the crude oil prices. Apart from that, the markets really seem to be reporting one thing, and that is that the bonds with maturities of 3 years seem to be the most active. The 5-year maturity bonds, the 10-year maturity bonds are being traded even lesser, as there is a lack of clarity on what really the outlook or the forward-looking path is going to be in sense of bonds and other markets, and that has led to a decline in participation in the farther month bonds therein. If you look at the overall secondary market deals, well, that has seen a bit of a gain, by the way. On Thursday, we were trading at around 87 billion, while it is at 96.1 billion that we saw as volumes come in the markets yesterday. The primary market bond issuances yesterday stood at around 21.05 billion. And the most traded corporate bonds that the street saw in the trade yesterday was about Indiabulls Housing Finance, Vedika Credit Capital, Paisala Digital, and IFL Samasta Finance. These were the most traded ones and saw the best of the volumes yesterday. Another one that you need to watch out for is the private bond issuance, which the markets are anticipating today. It is Mindspace Business Parks Real Estate. It is looking to raise 5 billion, and this is being done via 10-year bond. But one event that the street will watch out for further direction when it comes to the bond market is RBI auctioning new 10-year bond. This is worth nearly rupees 34,000 crores. This is happening on 8th of May. This is something that would give us further cues.
All right, Manisha, plenty of cues from the bond markets there. Thanks very much for joining in with that. Now, as we take a short break here, a quick programming reminder for our viewers. We're proud to bring HSBC Presents CNBC TV 18 Future Female Forward Season 4 to Mumbai with the Mumbai Gala, which will be a celebration of equity and leadership. We'll have top industry leaders come together for a dynamic town hall that will shape the narrative of New India, alongside curated performances that will reflect the spirit of the city. The evening is also going to spotlight our continued commitment to empowering female micro-entrepreneurs through a dedicated advisory initiative, which will drive meaningful impact through the year. Tune in on the 6th of May, 5 p.m. onwards, only on CNBC TV 18. Welcome back. Let's focus on to some earnings that are expected later today. M&M is all set to report its fourth quarter numbers, and Sudarshan joins in with what to expect. Sudarshan, if the street is expecting a strong show, at least the stock price is not showing it yet.
That's correct. So from Mahindra & Mahindra, we are expecting another strong quarter, and earnings are expected to be released between 12:30 to 1 p.m. today. And on the revenue part, it would be led by the strong volume growth that comes 6 and in FY26. All the segments you talk about, auto, tractor, commercial vehicle, three-wheelers, all these segments have seen volume growth of more than 20%, and that will aid revenue growth. And in Q4, revenue growth is seen at 21%. Even profit can jump by 45%. And EBITDA too can see an increase of 15%. But as far as margin is concerned, it might hold the levels above 14%, but there can be a drop YOY. In Q4, margin can come in at 14.3% versus 14.9%, and that's mainly because of increased input cost and also increased contribution of electric vehicle. That will also impact on the margin front. Now, talking about the volume and realization, total volumes in Q4 were up 27%, with auto volumes rising 23%. Tractor volumes had seen a jump of almost 36%. On realization, there might be a drop YOY, there might be a drop of 5%, but on a sequential basis, there can be an increase of 4%. In the segment, auto EBIT margin is seen at 9.4%, and tractor EBIT margin is seen around 20%, exactly at 19.8%. But more than the earnings, like all the other auto companies, there will be focus on the commentary. Now, in the case of Mahindra Mahindra, FY26 was very strong for SUV, but FY27 started on a very soft note. In April, SUV volume growth was 8%. So on the high base of FY26, what's the volume growth for SUV companies looking at? Also in the tractor segment, FY26 was very strong, but for FY27, there is an outlook of below than expected monsoon, and also there is a concern of El Nino. So in the backdrop of that, what's the outlook on the tractor front that company gives? And apart from these outlook, also the focus would be what's the commentary that we get from company on recently released government's draft of CAFE emission norm. But on the earnings front, it would be a strong quarter.
Take that point, Sudarshan. Thanks a lot for that. So that's about M&M. But let's go across to Rajesh Palvia now, who joins in for a quick check on the markets. 180 points is what we've seen on the Nifty in terms of fall. The mid-caps are slightly outperforming by not falling as much. Rajesh, we've been flitting between this range of 23,800 at the lower level to about 24,200, 24,250. Over the last week or so, it's been fairly volatile but consolidatory in this range. Do you think this continues?
Yeah, morning. Yeah, it's the third week where we are seeing that, Nifty is stuck in this range, only 23,800 on the downside and 24,200, 300 is, attracting major supply pressure on the higher side. Looking at the large cap basket, still we feel that, this consolidation is likely to be there for large cap space. So Nifty is likely to consolidate in range for some more time. As major call writing activities witness at 24,200, 24,500, these range have attracted major call writing activity. So I think this may create a pressure for any kind of pullback action from the near term. But on the other hand, 23,800 is important and crucial support area for this corrective move. If Nifty able to defend this level, I think some support buying action we may see from the lower level. So 23,800 one needs to keep as a stop loss, those who are holding the long position at this juncture. Nifty is now negotiating with its almost 20-day moving average. So today's close is very important, whether we able to close about 23,950, 960 zone or not. This one needs to watch closely. But Bank Nifty structure has turned slightly weaker as most of the large cap banking stocks have attracted the supply pressure and under the selling pressure. So for Bank Nifty, until the Bank Nifty not crosses above 55,300, 500 zone, I think trend is likely to exhibit on the weaker side, and we may see further more pressure in Bank Nifty and banking stocks. But some of the pockets where strength is clearly visible. First one is metal space, second is capital goods, third one is power stocks, and fourth one is capital market related theme. So these 3-4 sector and stocks are showing good traction in terms of buying. Moving to the stocks where we are focusing at this juncture is first one is CAMS is looking promising. Stock managed to give breakout of falling channel on a weekly chart. Short covering is there in the data. Looking at the structure, we believe that this stock has potential to extend gain. Possible up move towards 795 to 805 we may see in the near term. So CAMS is a buy with stop loss of 768. The stock where we are holding bullish view on the other end is metal space is looking promising. Sale is looking attractive. The way stock managed to give breakout on the long-term chart, stock is consolidating at higher band of this breakout. So we believe that sale may extend its gain towards 195 to 198. So one can buy and accumulate with stop loss of 183.
All right, take that point. Thanks a lot for that, Rajesh. As we speak, there is a bit of a recovery that the market is attempting from the lows right now. Around the 23,940 mark is where we are at. Good time to get in an F&O perspective as well. If you look at the market, it's lower. The Nifty Bank, they're both, losing. In fact, the Nifty has given up all the gains that it saw in yesterday's trading session, and that's thanks to the Nifty Bank, which is currently at the low point of trade. The mid-cap index, however, is outperforming by not falling as much. It's down about 0.5%, down about 100 points. It's the macro impact. Oil is higher, rupee is weaker, and all of this is having an impact on the Nifty Bank. But there are some positive straws to clutch onto as well. What are those positive straws? One, there's been, despite the decline that we've seen in the market, just a moderate spike in the India VIX. It's up around just 1.8, 1.5% right now. So no major worry as per the street, estimates on the India VIX. The advanced decline ratio as well. Yes, firmly in favor of declines, but those lines are coming closer. We still have about 1,200 stocks which are advancing. On a day like this, you could have been very well about 2,500 stocks declining for about 700-800 stocks which are advancing. So that's a positive. And because of the weakness in the rupee, the lower end of the market is protected by the IT index, because the IT index typically outperforms in a weak rupee scenario, and that's the only green index right now as we speak. The Nifty is hovering around the 20-day moving average, so closing above that would be at least a positive from a bull standpoint. So the technicals of the market fairly well poised. The Nifty, if it has to bounce from current levels, even though if it faces some sort of resistance at 24,100, that's absolutely fine. And ahead of expiry, because of the weakness, a lot of the options are placed on the bearish side. The only bullish side option that we've seen is the 23,900 put, where there is a fair amount of writing for 30 rupees in premium, telling you around 23,850 to 23,870. There is support coming in for the market. But on the way up, look at the resistance. 24,000 call, very active. 24,050 call, equally active. 24,100 call, equally active as well. So all of this tells you that as we move higher, there is a lot of supply pressure which may come in the market. That is not necessarily a bad thing. Why? Because if it is so much on one side, if the market does surprise on the way up, recovers from the 20-day moving average, then all these shorts will be caught on the wrong side, and we may see a flare-up as we move towards expiry. Where does that data, reflect the shorts being piled up on one side? It is the put-call ratio, which has moved to 0.68. Typically, between 0.65 to 0.7 is where we see the put-call ratio bottoming out. Amidst all of this, there are a bunch of stocks which are seeing shorts caught on the wrong side as well. So CAMS is one of them that really stands out. 8% higher, and the shorts caught on the wrong side. That stock is surging on the back of that. With that, we'll take a short break. Up next, market fundamentals with Sunny Agarwal from SBI Securities.
Welcome back. You still have the frontline index at about below 24,000, 23,956 is where we are. A bit of a recovery from where we started, but still seeing some pressure. The Bank Nifty as well, trading with cuts of about 480 odd points as we speak. Let's bring in Sunny Agarwal from SBI Securities, who joins us now to discuss market fundamentals and his top sectoral picks. Sunny, thanks very much and welcome on the show. I was reading your note. You're talking about a earnings recovery in double digits starting this year and the next. But what are you factoring in? Because we all still don't know how long this war drags on, what happens to oil prices from here on. So what is the risk you're factoring in? And in the mid caps and small caps that you say are turning attractive, any particular sectors you'd like to call out?
Yes, good morning, Ritu. I think definitely risk of higher crude oil prices do exist, and that can have some impact in terms of margins for quarter one numbers for most of a crude sensitive companies. The only caveat is how much for what duration the crude oil will sustain in a triple digit number. In case the crude oil prices cool off to a double digit over the period of next week or two, maybe that can give to an optimism that at least the last three quarter of this FY27 can be better in terms of margin recovery. And at the same time, one has to keep in mind that corporates are taking measures to tackle this high inflationary pressure due to the spike in energy prices, whether it is in the form of price hike or in the form of cost rationalization. So I think, but still, having said that, June quarter is the quarter where there can be some marginal pressure in terms of profitability for the listed corporate entities. Among the mid-cap space, I think as per the recent results season, what we feel is that a few companies among the hospitality sector like Leela Palace have reported a very good set of numbers. Seems that trend will continue in terms of recovery. In addition to that, capital market players like Angel One, Grow, they have seen a very sharp recovery in terms of volume post changes in a lot of regulation by SEBI. So I think capital market place seems well placed. Among the banking space, we feel that there is one pocket likes of Industry, Bandhan or RBL, which were struggling with an growth, I think, and there we see a very swift recovery in terms of ROA or return metrics over the period of next 12 to 18 months. So this is the one pocket which we feel is somebody has a moderate risk return appetite. One can look forward to that. In addition to that, individual companies like APL Apollo yesterday reported a very decent set of numbers. Or for that matter, among the construction or building material play, Greenply has reported a very good set of numbers. Seems like MDF and the ply segment, which was going through weather since last 2-3 years, seems to be coming off and worse phases behind for them. So maybe hopeful that FY27 and 28 should be a good earning recovery period for players like plywood as well as tiles.
Okay. Sunny, very quickly, do the election results from the states we saw yesterday, does that in any way change your sectoral or stock preferences? Do you expect a meaningful increase in capex, especially in states like West Bengal, where the BJP has come to power?
Yeah, definitely. I think West Bengal going forward, obviously, I'm hopeful that it will be a more of an pro-growth policy. And the low-hanging fruit amongst within the West Bengal as a state can be on fisheries and aquaculture. Ports can be one of a segment where government can give a very strong push. Infrastructure, as you rightly pointed out, whether it is road, railway, bridges, that can be a low-hanging fruit over the period of next 2.5 years. And it seems that now West Bengal can start contributing significantly to overall country GDP growth number. So yes, as you rightly pointed out, West Bengal being a large state can have a good impact in terms of contributing to the overall GDP growth going forward.
A lot of the hallmark of this state elections and the last few have been the kind of handouts that have been made to the populations of these states as well. Do you think there could be an impact of the increased cash in the hands of people because of these benefits that have been given, populist measures, that could find their way into some consumption items?
Yeah, I think, yes, the consumer staple as a segment to some extent can benefit out of it. But that is the trend in most of the state. Despite of this cash handout, we have seen that many basic consumer staple companies like Bajaj Consumer or for that matter, Nestlé, which has got a widespread distribution network, they continue to benefit out of it. And in addition to that, what we have seen is that now coming off over a low base or disinflationary pressure during the last 2 years, now seeing that with an inflationary regime going ahead, it seems that unorganized or smaller player will have a tougher time ahead, and a branded, large, well-established player can recoup a market share. So I think going forward, consumer staple as a pack seems to be interesting, obviously selectively. So few companies like Bajaj Consumer or for that matter, Varun Beverages can continue to deliver healthy earning growth going forward.
Right. What about the cement space? Because the low-hanging fruit, like you said, in Bengal would obviously be infra. And that's been the plan for a lot of the other states as well. Do you think after consolidation for so many years, the cement space looks attractive, or do you think it will be consolidatory as well?
Within a cement pack, as we have seen yesterday, Adani Group has taken a stance that they are going to focus more on profitability rather than capacity expansion. Augurs well for overall cement as an industry. Anyway, industry is likely to report 6 to 7% kind of volume growth in FY27. And within that cement pack, what we feel is that the mid-sized players like JK Lakshmi, or for that matter, Star Cement, which is focusing more on a northeast other territory, Digvijay Cement, which has recently done a brand and sale agreement with an high bond as a cement company. So companies which are have a regional play and at the same time are expanding capacity seems a good FY27 and 28 can be good times in terms of expanding their profitability. So I think smaller players like Digvijay, Star or JK Lakshmi seem to be well placed among the cement pack.
All right, Sunny, thanks very much for joining in with those views. We'll leave it at that. Thanks for your time again. We'll slip into a short break then. And up next, we're going to be joined by Umesh Chaudhary of Titagarh Rail Systems on their fourth quarter earnings and, of course, the impact of the state elections that have come in, especially in the West Bengal region.
Once again, any sort of recovery has been sold into in the markets. The IT pack also is selling off. Look at Wipro, which has moved to the low point of trade, and fresh bout of selling coming in for the Nifty Bank. So ICICI Bank has moved to the low point of trade as well. All of this means that the Nifty is very close to breaking the 23,900 mark as well. But yesterday was a good day of trade, and that's because of the BJP victory in West Bengal, which is being viewed by analysts as a double-engine growth catalyst and will typically benefit companies involved in infrastructure, heavy industries, logistics, key sectors, and potential beneficiaries. One of them, based out of West Bengal for the longest time, has been Titagarh Rail Systems, from the time when it was Titagarh Wagons as well. Umesh Chaudhary, who's the Vice Chairman and Managing Director, joins us now for his take on what took place yesterday and how one should see it from a business standpoint. Umesh, you've been stationed in West Bengal in terms of manufacturing, a lot of the exposure that you have out there as well, for a fairly long time. You've seen the regime change earlier from the CPI to TMC and now the BJP. How do you see these regime changes in light of business, and how does yesterday stand in terms of that for the prospects of the company going forward?
Yeah, so good morning. This is actually a very momentous period for us, and like you just now said, it's a double-engine government, double-engine ki sarkar, and for a railway rolling stock manufacturer like us, having double engines, you can understand what it means. It gives us both gati and shakti, both speed and strength. So for us, they couldn't have been anything better to have a government which is the same as the government in the center. But apart from that, West Bengal historically has been a state which has been mostly an opposition state. And as a result of which, it has never received its share of development, it's never received its share of progress. And if you really look at the infrastructure in the state has been crumbling, the industrialization has not been to a great extent. There have been some companies that have come up in this period, but not too many. So the ecosystem has not developed. So there is a lot of enthusiasm, there is a lot of jubilance in the industry at large, the people at large, to see such a clear mandate to the BJP government, which will ensure that progress and growth return to the state and industrialization gets a big boost.
All right. So amidst all of this, I just wanted to understand, because you already have a manufacturing unit out there, do you expect some new schemes to be announced by the government via which they could attract investments? Because if there was one thing that was, the industry's ask, which was the capital going back to West Bengal and more investments coming in West Bengal, do you think that is likely to happen? And given the double engine that you spoke about, are you considering any sort of capex in the very near future? If at all there are any schemes that are announced?
Absolutely. I think this is definitely, we are going to see a number of things happen in West Bengal. Some of them have already been part of the manifesto about, for example, urban land ceiling. On a social side, the Uniform Civil Code, but also industrial incentive policy. We have been, earlier we did not have an industrial incentive policy. Whatever was there has been withdrawn. So it has been, industry has not been a priority sector, so to say, from the governments historically in the state. And that is something that we are expecting that will come back with a very big thrust, with a very big impetus. And from us, from our perspective, we have already announced the shipbuilding venture, where we'll be investing about 600 crores. We are already emerging as the largest passenger rolling stock manufacturing company in the country, maybe in the region. We are already the largest wagon manufacturing company in the country. So with all of these investments, we are definitely going to look at further investments going forward. We are very keen to get into the high-speed space, and we are very prepared to get into the bullet train or the high-speed train space, particularly with the additional land that we had acquired last year with the new test tracks and all of testing facility. We believe that we are in a very fit position to get into that as well.
Well, Umesh, let's say, this railway capital expenditure, for instance, which has been severely lagging in West Bengal. You spoke about how industry has not been really a focus and it's lagging behind states like Gujarat and Maharashtra. Let's say that picks up with the change in power there. What is the upside to your order pipeline? I mean, would you be able to quantify it already at this stage?
See, the infrastructure requirement, so we are not catering to the infrastructure requirement only of the state. So if I had to speak about specifically the state, the metro rail, for example, has been massively underinvested. The Calcutta Metro was the first metro system that came up in this country, and it is today probably the last metro system in terms of frequency, in terms of network or anything of that sort. So being a very prominent metro coach manufacturer, definitely we would love to supply our metro coaches in the state where we operate. We have done metros in Pune, we have done in Ahmedabad, Surat, Bangalore. We are now doing it in Mumbai. We are doing the Vande Bharat. So we have a very large base for doing these kind of trains, and we would love to do it for the state. But apart from that, being a state which is, or being in a state which is aligned with the policies of the center, the overall infrastructure story that exists, the overall growth trajectory that exists in the railway and in the urban mobility, we believe that it will become much easier for a company like us to be able to access that. That's exactly what this double engine growth is all about.
Umesh, again, if you could give us some numbers as well. What were your investment, sort of commitments, decisions you were looking at in the next year or two? And how does this election outcome change the quantum you were looking to invest overall and specifically in the state of West Bengal?
So most of our investments are going into the state of West Bengal. We had made some investments in Tamil Nadu in the last couple of years in a joint venture with Ramakrishna. And in fact, when we speak about incentivizations, this was one of the key drivers to our investment decision, which went outside the state, that there was no incentives available within the state of West Bengal. So going forward, we believe that we'll be investing in the naval part, in the shipbuilding part. We have already said that about 600 crores. Maybe this will further increase now in the revised environment. On the train side, we would like to get into the high-speed segment. We would like to expand our capacities in the metro, in the commuter train segment. So maybe, going forward over the next few years, we'll be spending or investing thousands of crores in this segment as well.
Right. Since you spoke about Tamil Nadu, there was a surprise victory of the TVK out there as well. What do you expect from that, that faction?
Yeah, that's a very, very, I would say unknown, that was very unknown from industrial perspective, but I'm sure Tamil Nadu has been a progressive state, and there's a very good mandate, very strong mandate that has been given to TVK. So we are sure that the policies of industrialization, of incentivizing industrialization will continue. And our investment there is already on the ground. We should start production within the next couple of months.
All right, take that point, Umesh. Always a pleasure speaking with you this time around politics, but hopefully we'll get you soon after your quarterly numbers and then get an update on how business is performing as well. With that, we'll take a short break, come back, more on the markets on the other side.
Welcome back. It's time to get you the macro signal. And after a year of losing ground, banks are very much back in the driver's seat. Remember, when businesses, industries in India need money to grow, to borrow or to build, they have choices. They can either go to a bank to borrow money, or they can tap the stock markets, or borrow from NBFCs or raise bonds. Now, 2 years ago, banks accounted for nearly 65% of the total funding to the productive sectors of the economy. But then that share dropped sharply to about 56% in FY25. But since then, the comeback has been just as swift, because in FY26, banks again regained their dominance and accounted for more than 65% of the total 45 lakh crores of funds that flew into the productive sector. So simply put, earlier in FY25, banks were getting 1 in every 2 rupees flowing into these sectors, and that reversed in FY26. So 2 in every 3 rupees that went into the productive sectors came from a bank. So what happened in FY25 when banks had lost the share? Well, you saw companies going to the stock market instead of going to their bankers. Equity issuances had boomed. The shares of equity in total funding had tripled from 3.8% to 11.4%. You had a bull run, high valuations, easy money. But in FY26, when the markets turned, indices fell and that window kind of closed. And then you had the companies coming back to borrow from banks. Now, there are 2 other shifts that are worth flagging in the non-banking world. First, bonds, where RBI cut rates through FY26, and that made bond markets more attractive. And the share of corporate bonds in total funding, it rose from 4.2% to 6.7%. Secondly, NBFC share has been falling for 2 straight years now, from 12.5% in FY24 to 8.1% now. So that is starting to look more like a trend and less like a blip. Now, here's the part that often gets missed as well, and that is how much of India's funding is really coming from abroad. Now, that number has been rising every year. Foreign sources accounted for 6.8% of the total funds in FY24, but by FY26, that was up to 11%. So India is drawing more from the world, and within that, FDI is doing the heavy lifting. It rose steadily from 6.2% to 7.3%. Foreign corporate borrowing, ECBs, that remains negligible at less than 1% across these years. The rupee's volatility, of course, makes dollar loans very expensive to hedge as well. So then what happens going ahead in FY27? What we do know is that external environment today is not very conducive to ECBs, given the volatile nature of the currency that we've been seeing through the year. Equity issuances could also be cautious, given that markets still look unsure in the face of the war in West Asia, and the rate cut cycle that drove borrowers to banks for cheaper rates could also be done. So even if banks keep the crown, it may not come with the same easy momentum, and that's the story to track for FY27. And on that note, we'll take your leave on Trading Hour from Manglam and me. It's a goodbye, but stay tuned. Halftime Report will be up next.
Stocks slip after US and Iran hostilities in Strait of Hormuz spark fears of a wider military engagement in West Asia. Realty as well as financials are the big drags, while IT and telecom see some green.
Tata Trusts will meet on May 8th to discuss the issue of listing Tata Sons raised by Vice Chairs Venu Srinivasan and Vijay Singh. It is also expected to induct Tata veteran Bhaskar Bhatt on the board of Tata Sons.
Oil prices flare up after US and Iran strike vessels in Hormuz. Global oil stocks nearing 8-year lows, and a Chevron CEO warning of upcoming shortages support the rise.
Rupee hits fresh low of 95.40 per dollar as crude prices surge beyond $110 per barrel due to claims and counterclaims from Iran and US about firing on ships in the Strait of Hormuz. Foreign funds selling equities were also adding to the dollar demand.
Biocon founder Kiran Mazumdar-Shaw says niece Claire Mazumdar, who leads Nasdaq-listed Bicara Therapeutics, will succeed her, but not right away. Claire's academic and professional credentials make her an interesting choice.
Hello and welcome to a halftime report live from the CNBC TV 18 Motilal Oswal studio. I'm Ekta Batra, with me Sonal Putra and Vinny Motiwala. Well, it is turning out to be a day where we are seeing red on the screen, and that is because of the rumblings of the war possibly taking place and really affecting sentiment at this point in time. So we have the Nifty, which is down over 200 odd points. We have the mid-cap index, which is down around 0.3% at this point. But the bank Nifty, which is really taking it on the chin, down over 600 odd points. And if you just look at it, if you look at it from the 8th of April, the ceasefire day, we have Brent crude, which has risen around 25% from the day of the ceasefire being announced. So that hit those lows of around $85 to $90 per barrel, but now has risen to around $113 per barrel. We have the rupee, which has also depreciated around 3% from the best levels that we saw of around 92.3. And we have the Nifty, which is just about flat from those levels. But let's cut across to our colleague Shireen, who's in conversation with the CII president. Shireen, over to you.
Well, exactly what you were talking about, Ekta. We are going to discuss the global environment and the impact of the West Asia conflict on India. Joining us now is the president of the Confederation of Indian Industry, Rajiv Memani. Rajiv, always a pleasure. Many thanks for joining us here on CNBC TV 18. Let me start by talking to you about the big event that is now out of the way, and that is the elections. We've got the results in West Bengal, a change with the BJP coming in, and of course the big surprise in Tamil Nadu with Vijay emerging as the king. Now, what it does eventually as far as these individual states are concerned is a different matter. But what does all of this mean, if anything, at a national level?
So I think the first thing at a national level is obviously, the state elections are now out of the way. So, hopefully, I think, in each of these states, there will be a clear vision, what will be the industrial policy, some of the projects that were stalled, how can some of those projects be developed. And hopefully that all these things, generally, Shireen, whenever you have a new government trying to address some of these issues, there is greater impetus on investments, there is more positive energy, greater job growth that happens. So I'm positive. I think these are positive changes, and hopefully it'll catalyze more investments, more development in some of these states.
One of the other issues that industry bodies like CII have been asking for is a sense of urgency to move on pending reforms, to push ahead on crucial decisions. We saw some decisions being taken, for instance, the Press Note 3 revision, which, by the way, isn't fully in execution at this point in time, even 50 days after the cabinet clearance. So given the fact that the elections are now out of the way, what would you like the government to focus on with a sense of urgency?
So I think the government, Shireen, has been focused on a lot of these things. Obviously, they are right now grappling with an energy crisis, and I think that's also taking some bandwidth and energy and time away. So I think I would say, as we step back, I think before this crisis happened, we just had the GST reforms. The capex investment private sector capex investment was moving very well. GDP growth numbers were strong, much stronger than what people anticipated. Fiscal deficit was under control. Sectors like automobile and others were doing very well. So we entered this crisis through a lot of strength, and we had strong tailwinds. But to the credit of the government, the moment this came, I think at least in CII, we really experienced very active engagement with our various constituents and the government. And the government was active almost on a daily basis to try and address issues, particularly around availability of feedstock, of gas, of other energy-related products, and also trying to see how do we navigate the logistics and others, trying to address some of the issues that industry was facing. And also took some measures like extending RODTEP, the duty structures on fuel and others, packing credit and others. So we saw a lot of action which was more short term. And obviously one of the things when you look at any economy, there's no doubt India is the fastest growing economy and will continue to be that for a period of time. But when you look at all those things, there are three components that come out very clearly. One is what's your resilience, growth and macroeconomic stability, and all on that I think India did very well. The other two areas was one to do with how are we doing on our overall autonomy, whether it's energy, whether it is on the overall dependence on global world. And as you become larger as an economy, from a $4 trillion economy to say a $10 trillion economy over the next 5 to 7 years, some of these things we have to be very mindful and very cautious about. So I think the reforms that the government now we are seeing engaged with are trying to address some of these issues. So our over-dependence on some geographies, our over-dependence on some routes, our the energy output not keeping pace with the energy consumption, and how can we alter? So how can we look at nuclear? How can we look at coal to gas? How can we, ensure that solar becomes? We have had fantastic growth in solar, in other renewable pieces, but how do we ensure that issues around transmission, grid balancing, availability of land, supply chain in some of these products are dependent? So I think a lot of conversations, policy notes that are being introduced around this. These are large projects. They have fiscal implications. There are new policies that are required for that. And I think the government has been working through this. I'm hopeful that we will see a lot of speed in some of these things because they are strategically very, very important for India. The second piece is around the issue that's come out through this is we have seen the rupee and the dollar rupee and the current account deficit. And in that, whilst the energy piece has still not played out, but that's not fully in our control, it's not a short-term measure. But if I look at the non-oil trade merchandise deficit, that number has grown by more than 30% last year. And I think whilst the part of it is also because of the growth in some exports, particularly in electronics and others. But I think that's another number to watch. So how do we look at our import basket of manufactured products? What are those which can be done in India? What are the PLI schemes, incentive schemes, technology transfers, and other incentives or protection that needs to be given to industry to ensure that we reduce that amount? Because one is it leads to weakening of the rupee, but also from a strategic dependence standpoint, if we are looking at Atmanirbhar Bharat, I think it's very important that we look at manufacturing of these items, which are maybe our top 50, top 100 import items, and there is a small basket of products there, and also looking at our future demand that's going to come, whether it's going to come because of the investments that are going to happen in data centers, whether that's going to come because of the investment that will happen in the entire energy cycle, and whether our manufacturing is really equipped for that, and how do we prepare that. So I'm seeing a lot of policy work that is happening in these two areas, and I think I'm hopeful that the changes, whether it's the ISM2 that's coming out, whether it's the coal policy, coal to gas policy that's coming out, whether it's Shanti bill that's getting implemented, whether it's what we do on the value chains on solar and the PLI schemes that we are looking at on the electronics manufacturing, how do we look at the component side? So there's a lot of activity. Some of these things have been cleared. I do hope that they have sufficient allocations for this, and then we move with speed and look at the right companies to select in that, so that we move with speed and these companies are able to implement some of these projects on the ground.
Right. I want to talk about the rupee because you brought that up, as well as the impact as far as the current account deficit is concerned. But when you talk to foreign investors, when you talk to your global peers, as part of the EY network, when you talk to your foreign clients, what are they telling you about the rupee? How uncomfortable is the rupee's depreciation making them feel about wanting to invest in India at this point in time, especially FIIs? And that has been the big worry, that has been the big challenge. In fact, the chief economic advisor saying that he believes that this is on account of the global allocation moving more towards AI, and when that starts to rebalance, the rupee should rebalance as well. But the rupee, how much of a concern is that today?
Yeah, I would say for more longer term investors, they look at what's happened in the last 5 years, 10 years. So if I look at the last 5 years, last 10 years, I haven't seen what, I haven't done that exercise in the last 2 weeks. But the average depreciation would have been between 2 to 3%. And I think right now people factor that in.
In the last 2 years, it's been 13%.
Difference between.
In the last 2 years, it's been 13%.
I'm looking at last 5 years, 10 years. But I agree. That's why I'm saying that this has been much sharper. But if I look at the last 5 year, last 10 year average, I think that's what it is coming to, Shireen. So I think the longer term investors are worried, but I won't say they are too concerned about it. But as a country, as an economy, I think we need to look at to try and see how we address that. I agree that there is a disproportionate allocation that has happened in some sectors, in some geographies. But not all currencies in the world have got impacted as much rupee has, particularly because of our vulnerability on energy and also because of our rising imports, non-oil merchandise imports. So I think what we need to do, I personally feel, is to have much greater focus on manufacturing, on ensuring that we are actually implementing the Atmanirbhar policy. We need to ensure that we get some of the large global value chain players. What we saw, the example that we saw in electronics manufacturing, on mobile phones, I think we need to get on an urgent basis, engage with the top 30, top 40, top 50 people, global value chain players. There are some very large players. We need to find a way that they set up in India, and whatever enablement that they require to be setting up in India, I think is very critical, because some of those structural flaws we need to address. The third is, I think we have to be much more proactive, deliberate in attracting FDI in India. Our FDI numbers have been increasing by 10 to 15%, but they're still 2% of GDP. I think we have to move it up to 3 to 4% of GDP to ensure, and a lot of that hopefully comes into for manufacturing, for building out some of the areas which are strategically important for India. And I think being more proactive, ensuring that we are getting all the clearances, having an empowered group that can help in getting all the clearances, land approvals, environmental approvals, at a much more rapid pace and much more transparently, openly. I mean, some of the best examples that we see in other parts of the world, I think we need to implement. Some of the states have done a remarkable job in this, in attracting FDI in those states. I think we need to see how we can implement that at the central level. I think we need to address these three things at a very rapid pace to ensure that at least some of those things will happen. Now, some correction will happen as oil prices stabilize, as the war stabilizes, as the AI investment stabilize. But I think those are things that are honestly not fully in our control. I think we also need to address things that are in our control. And how do we look at that? And I think the government is focused on that. My only request would be that if we can execute with greater speed, I think that will be helpful in addressing some of those issues.
Welcome back. You're still tuned into Halftime Report. Well, the rupee fall again, the depreciation is the big story that the markets are tracking. Let's get in some expert opinion coming in. Anindya Banerjee of Kotak Securities is joining us now. Anindya, good afternoon. Another record low on the rupee. A lot of factors leading to that, but there's an interesting comment coming in from the CEA as well, talking about maybe flows getting to the AI trade. Do you think that is one of the bigger reasons and we could see a further fall because of that?
Thank you for having me. A very good afternoon. Yes, actually, see, ultimately the pressure which is building on the rupee are twin. One, of course, is the FPI outflows, which is now around $10 billion a month, the run rate. And the second one, the big one, the oil import bill. So as long as the oil import bill or the oil prices is those are not coming down, I think the pressure will be on the rupee, and it will be up to the RBI where they want to basically draw the line.
Anindya, hi, good afternoon. Now, obviously, fresh lows that come in today. You mentioned FPI as well, but obviously the bigger concern, like you were saying also, is in terms of crude prices. How much of this is, maybe because of US-Iran, the geopolitical tensions, and how much is a deeper problem that one should worry about now?
See, if you look at the numbers just before this war, so let's take the Feb end numbers. So our average crude basket was around $70, and we had a monthly oil import bill of around $10 to $11 billion. Now the oil basket is around 130 at least, so that's a jump of 80 to 85%. So that means your monthly run rate of $10 billion jumps to $17 to $18 billion, additional $7-8 billion of demand for which is created. Now, this doesn't account for the rise in prices of other commodities due to the blockade of Hormuz, like, for example, industrial gases, industrial chemicals, fertilizers, and gases also. So I think entirely it is linked with what's happening in West Asia and of course Hormuz. So once that situation resolves, we will see this reverse as well. But till then, the pressure on the rupee will continue.
All right. Hi, Anindya. Just wanted to understand that what is the range that you're now expecting for the rupee? What is the base that we could expect, even if in case the best case scenario, the war does come to a decisive end, there is an appreciation bias which takes place for the rupee? What is the level that we would probably be working with on the upside now? And what is the level on the downside that we could possibly be working with?
So the risk of a downside is immediate because the war is still on, or we can say it's in a pause. But the main thing which matters for the world is whether the Hormuz flows have improved or not. That has not happened. So in case this continues for another month, that's May, then oil prices will surely jump towards $130. Yeah, it can. The Brent can jump towards $130. In that case, we could see even 97 or 97.5 on the currency. And once the situation resolves, we could see oil prices come down around, let's say, $80. We don't expect it to collapse to $60 because there's been a substantial erosion of the global oil inventories. Those have to be rebuilt. So the demand is going to be there. So that will support oil prices around $80. But at 80 also, it's good for the Indian rupee, and we could see the rupee actually appreciate towards 93 or 92 levels, because when we compare the Indian rupee with its peers on a real effective exchange rate framework, it appears undervalued. But that undervaluation actually kicks in when this situation is no longer there.
Okay, take that point, Anindya. Pleasure speaking with you. Thank you so much for joining us with your insights on the rupee. Continues to be a very volatile situation. M&M's numbers at the bottom of your screen. The EBITDA has come in slightly higher, 165 crore beat on the EBITDA. The revenues are higher as well. Margins at 14.1% versus a poll of 14.3%. But of course, we look at the absolute number because the revenues are higher and the EBITDA is higher than the poll. So is the net profit at 37 crore rupees, which compares with a poll of 35-24 crore crore rupees. It's actually the automotive and the farm equipment segment. Both of them have done well on a YOY basis. The EBIT for automotive has come in at 3,176 crore rupees, which is higher quarter on quarter and on a YOY basis. We also have the farm equipment EBIT coming in at 1,019 crore rupees, which is actually lower on a quarter on quarter basis. The last quarter number was 1,258 crore rupees, and it compares on a YOY basis at 942 crore rupees. But again, the farm equipment business is quite seasonal, so quarter on quarter is not the right way to look at it. But it looks like a decent set so far. It is higher than the poll, and we'll get Sudarshan in a bit to analyze the numbers as well.
Yes, absolutely. The stock is holding up with a gain of around 0.6% at this point in time. Like you said, the net profit has come in with a gain of around 53% on a year-on-year basis, and the profit itself is a little higher than what the street was anticipating. We were working with around 3,500 odd crores. It's come in at over 3,700 odd crores. Similarly, revenue has come in better than expectations, so that is possibly what is enthusing the street at this point in time, up around 0.6% currently for the stock. That's M&M for you. We're waiting by for more details on M&M at this point in time, but overall the stock is holding up quite steadily. Margins have come in line with estimates at around 14%. We're working with around 14.3%, coming at around 14.1%. I think maybe Sudarshan will join in just a bit, and he's going to come in just a bit, but overall the numbers look quite stable at this point.
Absolutely, it does look stable, and that's why the stock is at the day's highest point as of now as well. If you pull up the charts, M&M trading and moved on from the red to the green as well. So that's a positive sign coming in here. Numbers are really better than at least what we were expecting at CNBC TV 18. Revenues at 39,000 crores. We've given more details on that front as well. But commentary will be key also in terms of that, right? SUV volume growth, how is that going to be there going forward? Margins, what will we see? Whether we hold on to that, will they be able to hold on to that 14% level is going to be key to watch out for. Do we have Gurmeet with us as of now? Okay, we'll connect with Gurmeet also in a short while from now as well.
It is led by the automotive segment, the beat that we are seeing this time. If we look at the EBIT here, even in revenues, it is higher on a quarter-on-quarter and on a YOY basis. In fact, Sudarshan is joining us now. Sudarshan, a beat. Tell us more. What do you make of the numbers?
So earnings are on the expected lines. If you talk about the revenue, it's led by the auto segment, especially SUV segment, which had seen a volume growth of more than 20%. And that's the reason you are seeing a jump of more than 26% revenue, which had come in at 39,550 crore. EBITDA too has seen a jump of 19%, slightly above our estimates. And because of rising input cost and because of the increased contribution of electric vehicles, there is a drop in the margin, and margin has come in 14.1% versus 14.9% in the same quarter last year. And also, if you talk about the internals, so gross margin has come in at 23.6%. And on the auto segment, revenue has seen a jump of almost 25%. And tractor segment, the revenue has increased by 32%. On the EBIT margin front, for the auto segment, EBIT margin on expected line, it has come at 9.5%, almost at the same level or slight improvement YOY. On the tractor front, there is a drop in the margin. We were expecting it to come around 19.8%. It has come in at 19%, so there is a slight drop in the margin. But earnings are largely in line on every front, but we'll have to see what does company talk about the outlook, because that's the focus would be on both SUV as well as the tractor. But so far, earnings are good.
Okay, all right. But the stock is selling off at this point in time, so maybe the devil does lie in the details. So, Darshan, like you mentioned, the tractor margins have come in at around 19%. The street was anticipating maybe 19.6%. And you were talking about the auto segment. Remember that the input cost pressure was likely to be offset by the price hike, which was taken by the company earlier in the year. So that could have stabilized margins. But we do have Gurmeet joining in to discuss a little more about the numbers. Gurmeet, you've been hearing us talk. So what is your take in terms of what M&M has reported this quarter?
I think the numbers look steady, both in terms of revenue. I think a little beat on profit as well. The stock has corrected more than 25% from highs of almost 3,900, 4,000 levels to around 3,000 levels. So trades at about 20 times forward. So there is a bit of a valuation comfort. I would like to see more details in terms of their market share in SUVs and especially the tractor segment. SUVs, their market share had gone up to almost 26%. I think we'll have to see how with this, the MUV space with EV launch is, what's the commentary like. Also, the commentary on supply chain disruption. April numbers are good, more in terms of how the demand has been holding, and also this entire El Nino thing on agriculture. So I think the market would probably want to wait for the commentary more. But as I said, numbers optically look pretty good. Let's hope more details come in terms of segment wise. I've just seen the consolidated numbers so far.
Yes, Gurmeet, point taken there. So far, optically good numbers as well. We did see a run-up, but the stock was up 1%, and then it's come off from that high as well right now, 0.6% of gain. Gurmeet, just in terms of auto volumes, Darshan was also mentioning, right, SUVs have done well. You are also saying you'll wait out for more details in terms of the share that they're gaining in SUV. So your thoughts just overall from here on in the four-wheeler space, overall SUV, do you think M&M has a potential to move and increase furthermore from here on?
Yeah, I think they probably can get a little bit more in terms of market share. They've been steadily doing that. If you see the top 3 models across segments, out of top 10, top 3 is M&M. And in SUV they've really done well across, whether it is XUV 700, Scorpio, Thar, Bolero, etc. So all 4-5 models in that segment has done well, and this EV segment continues to get good traction. I think there will be some raw material pressure. I think the cuts we saw because of GST would now more or less neutralized by price hikes across models. And tractor segment also, they are maintaining 44-45% market share with good volume growth. And April numbers, if you see the monthly update, tractors showed good volume growth in terms of the monthly numbers. And that is why I think the segmental breakup is important. And stock, as I said, is very reasonably valued now. There has been a price and a time correction because of the recent energy shock. So let's just wait for how the demand is holding up. April numbers were pretty decent so far. So not seeing too much of a demand impact, which market is expecting in terms of discretionary spending getting slowed down.
Okay, all right. Well, Gurmeet, we do have M&M which has come in, we have Maruti which has come in, and now we have Bajaj Auto and Hero Motor which is expected in the next couple of days. Give us a sense in terms of what you're expecting from the rest too, and that's obviously the two-wheeler segment, but your sense in terms of which one could rule the roost.
I think Hero and Bajaj can maybe marginally surprise on the positive side. April numbers, thanks to Akshay Tritiya and etc., have been also very good. So the commentary could also be good. We are now more, focused on the ancillaries and other stuff. We've recently added Rajratan Global, which is basically makes bead wire for tires. We already have Sandhar Technology and Uno Minda in our portfolio. And amongst the four-wheelers, we have M&M, and two-wheelers, we have TVS. So we are actually quite overweight auto as far as our portfolio is concerned. So I just hope that, the numbers and commentary, do not disappoint.
Okay, all right. We do have the presser from the management at 1 p.m. So we'll keep tuned into that to get more details as far as the internals are concerned. Gurmeet, thank you so much for joining us with your insights and your check on the numbers coming in from M&M. As we take a break now, a quick programming reminder. We are proud to bring HSBC presents CNBC TV 18 Future Female Forward Season 4 to Mumbai with the Mumbai Gala, a powerful celebration of equity and leadership. Top industry leaders come together for a dynamic town hall shaping the narrative for New India alongside curated cultural performances that reflect the spirit of the city. The evening will also spotlight a continued commitment to empowering female micro-entrepreneurs through a dedicated advisory initiative driving meaningful impact through the year. Tune in on May 6th, 5 p.m. onwards, only on CNBC TV 18.
Welcome back to Halftime Report on CNBC TV 18. As of now, Nifty is at 23,950 levels, recovered from the day's lowest point, but yes, still below the 24,000 mark. Let's move on and move on to what's trending segment. Today, we're going to be putting the spotlight on the chemical sector. This is on the back of commentary that has come in from Aarti Industries saying that China's anti-involution supporting margin upticks. Sonal is here to tell us, more in terms of details here as well. What's happening on that front? Sonal, over to you.
A lot of commentary coming in. Of course, we'll listen to that through the course of this conversation as well. Let's first talk about what is anti-involution, because Aarti Industries today did indicate after their results that policy is leading to margin upticks in a lot of such products, commodity products like PNCB. Now, what is this policy? Now, it has been in works for a while across most of the industries. Chemicals is one of them which is impacted by this. They are curbing any sort of price wars. They are controlling capacity expansion because there's a lot of oversupply in the Chinese market. They're forcing industry consolidation where weaker players could get consolidated with bigger ones. They're shifting towards higher value, specialty and tech-driven production, and also focusing on less volumes but more margins. That has not been the story so far. They actually focus more on volumes with lower margins. We have seen a lot of build-up in a lot of products from China, be it ethylene, polyethylene, basic petrochemicals, which are big inputs in the chemical industry overall. And that was hurting the Indian manufacturers overall because it used to be dumped at lower prices. That led to persistent oversupply, falling prices, margin compression for our own Indian players. With the anti-involution, they are focusing now on specialty chemicals. That would mean better margins, better pricing, advanced materials, higher margin segments. What would that mean for most of the chemical players abroad and India as well? It would mean less dumping of cheap chemicals globally by China. China has disrupted the chemicals market with lower pricing and also margins improving for global players, and something that Aarti Industries did see in their own particular products as well. So that is just a comment coming from Aarti Industries, but that means something is changing in the entire specialty chemicals and commodity chemicals arena for the Indian manufacturers. And that's why there's continuous positivity, or at least positive commentary coming in for chemical players, and that's what I wanted to highlight.
Okay, yes, absolutely. So that's the positive commentary which is coming in for chemical players, not really reflecting in terms of stock prices today. But let's in fact listen into a bullish view of Ikigai asset manager Pankaj Tibrewal's view, where he says that the chemical sector is likely to be entering a strong cycle and it sees it as a dark horse going forward. Listen.
We believe that a good cycle is starting for most of the chemical companies. And we may be in a new cycle for chemical. Also, the top line growth will be in double digits because they are all derivatives of, oil, most of the raw materials, and hence they have been able to pass on to the end consumer. And margins, there could be some dilution, but coming to EBITDA margins, I think there could be operating leverage, which could kick in, and hence earnings growth of this sector, which has been subdued for last 3-4 years now, probably starts to look into double digits. So that will be my dark horse for this year.
Okay. So that's the word coming in from Pankaj Tibrewal as well. But not only that, a slew of Q4 earnings also have come in for the chemical space. SRF is also set to report its earnings soon. Sonal, what are we seeing here as well so far in terms of trends and expectations?
The trends are not so good so far. Even for SRF, the expectations are not high because we are talking about higher energy prices. We are talking about input cost pressures, and chemicals industry is also impacted by that. For Tata Chemicals, it was weak. It continues to be a weak set for last couple of quarters. Soda ash realizations have been lower. Higher energy costs continue to impact soda ash production as well. And they did take an impairment charge of 1,800 crore rupees on goodwill in the US business, around 182 crore rupees for deferred tax assets write-off, which was recognized. So overall, revenues were down 2%, EBITDA down 16%, margins declined by 200 basis points, and there was a loss this time, close to 300 crore rupees. Yes, loss was expected, but it is way higher than what the street was working with. For Aarti Industries, it was a decent set, but the commentary that we got from the management, we will hear it from him in just a bit. They talk about energy price pressures, they talk about supply issues, and that is something which the street might not be liking. But the numbers were decent, revenues up 9%, EBITDA up 30%, we had margins up around 200 basis points, and profits up 43% as well. SRF reports numbers today. However, the expectation is not very strong. EBITDA is expected to decline 3%, profits expected to decline 14%, a lot of it led by the specialty chemical segment particularly. Watching out for the commentary coming in from there because it's a big, it's a chemicals major in the listed space. As far as valuations are concerned, they remain elevated. For something like Galaxy surfactants, it's lower. So commodity chemicals do not value themselves very high. But specialty chemicals, something like an SRF is trading at 40 times, Naveen Fluorine at 50 times. Naveen reported really strong numbers. So it's been quite divergent because every chemical company is very different and every chemical supply and demand scenario is very different. But so far, elevated valuations continue for the specialty space.
Okay, all right. As you can see, the valuations on your list, SRF leading the pack there. In fact, we did speak to the management of Aarti Industries, who noted a 40 to 60% hike in input surge and says exports to West Asia has seen a significant reduction since the month of March. Listen in.
I think the raw material escalations have been phenomenal, and forget spot versus contract, because even contracts moves with the index. In general, any of our large raw materials, if you look at it, benzene, aniline, toluene, the price escalations have anywhere in the range of 40 to 60%. That's the kind of price escalation that we have seen. In most of the cases, we are pushing very aggressively to pass on this price rises to customer, and I think everyone is understanding the situation given it's a global phenomena. But there will be certain lag, there will be certain contracts that we will have to also honor from our mid to long term commitment kind of stuff. Export to Middle East have significantly reduced from 1st of March onwards. We are, of course, trying to secure alternate markets for these products. Again, it does take a little bit of time to diversify away and place those kind of volumes to alternate geographies.
Okay. That's the word coming in there from the management of Aarti Industries. But let's also bring on board Sachidanand Dekar of Trade Pools, joining us to maybe talk to us about the trading strategies who is looking at, as well as in terms of the Nifty outlook. But before that, Sachidanand, have you managed to look at any of these stocks, whether Tata Chemical, Aarti Industries, SRF, anything on the technicals that is maybe a right time to look at right now?
Good afternoon, Vinny. SRF is one particular counter that we have been tracking lately. Now, if you look at the overall price movement, it has been range bound, but it has been maintaining its closing above the 2,500 mark. Now, if you look at the broader structure, the range is placed at around 3,000 on the higher side and 2,500 on the lower side. So we are seeing some signs of a positive divergence emerging near this particular lower end of the support. So we are expecting that once the stock starts trending about the 2,580, 2,600 mark, we may see a substantial recovery in this particular counter. The immediate resistance which we see on the higher side is 2,800, where its 200-day exponential moving average is placed. So I think the stock has spent a good enough time near that particular support of 2,500. And it looks like an ideal situation wherein some long positions can be committed from a positional perspective. The stop loss for the trade can be placed at around 2,480 on closing basis, and positions can be reviewed on a rally towards 2,800.
Okay. All right. Well, we didn't quite get your Nifty strategy for the second half of the trading session, as well as your picks.
Good afternoon, Ekta. The Nifty looks relatively stable. For the last 7 trading sessions, we have seen a range-bound action within 24,200 on the higher side and 23,800 on the lower side. At least for the day, we are expecting that the worst for the Nifty is done. We may not see further slippages below 23,900. Even if we see, a slight of a decline, I think 23,850 looks like a decent support wherein some contra long positions can be, deployed at least for the second half. We are expecting the expiry to shape up somewhere close to around 23,950, 24,000 within this particular short range itself. So I think it's an ideal time wherein contra long positions can be deployed. The stop loss for the trade can be placed at around 23,850 on a closing basis, and we may see an intraday jump towards 24,000 levels. Now, when we look at stocks, we have already seen a very strong breakout on HDFC AMC. Now, if you look at the overall structure, it looks like a bullish continuation pattern in progress, which is indicating a price target somewhere close to around 2960 on the higher side. The call addition has also been very significant. We have already seen important cluster of 2,800 being breached. So we're expecting further momentum in this particular counter. Hence, we are recommending building fresh long positions with a stop loss at 2790 on closing basis. We may see a accelerated move towards 2960 in a day or so. The other stock on our radar has been Aurobindo Pharma. Now, if you look at the last 7 days performance, it has been gradually on a declining trend. But if you look at today's performance, there has been a substantial price gain. There is support which has emerged near its 20-day exponential moving average. We have already seen an engulfing bullish kind of a reversal pattern, which has also occurred on the daily scale. Now, if you look at the overall structure, again, the price pattern is indicating a move towards 1455. The reward to risk opportunity is very favorable. One can start deploying fresh long positions with a stop loss at 1395 on closing basis and review their positions near to 1455.
Okay, Sachidanand, thank you so much for joining us. That's the technical trade. Time for a break. On the other side, Manisha Gupta joins in with Sandeep Bajoria, CEO at Sunwin Group, to discuss edible oil prices surging. Stay tuned for that conversation.
Welcome back. Joining us on the show now is Sandeep Bajoria. He's CEO at Sunwin Group. Mr. Bajoria, thank you so much for joining in. I want to get your first sense on the rise in the prices of edible oil that we have seen. Palm has been trading on a positive side, so has been the case with sunflower. Soybean futures at CBOT are trading at a 7-week highs as well. And while there are other factors at play, but much of that, would you say, has to do with sentiment, with the crude prices trading where they are?
Manisha, you are absolutely right. The edible oil prices have gone up. See, the world's 25% of veg oil is going into biodiesel. Every country which has an excessive veg oil is have a very strong biodiesel program. Like Indonesia. Indonesia produces about 51 million tons of palm oil. Out of 51 million tons in B40 program, which they said, already they are consuming about 13.5 million ton in biodiesel. And they said they're going to B50 from 1st July. So that is going to put an additional 1.5 million ton in the biodiesel. So from 13.5 to 15 million tons of palm oil will go into biodiesel in Indonesia from 50 million tons. Same way you see Brazil, they have B15 program already. And there are reports that this Thursday they will make it B16. So they will suck up another 500,000 ton from that. In B15 itself, they are sucking up 7.5 million tons of soya oil into biodiesel. So it will become 8 million tons. Same way US. US is also consuming around 8.5 million tons. Very strong biodiesel program. Argentina. So Malaysia was doing B10. Now Malaysia is saying we're going to do from 1st June B15. Again, Malaysia is going to suck up another 300,000 tons of palm oil for half a year. So Malaysia overall, every country who are palm oil, Indonesia, Malaysia were our main exporters. Soybean oil, US, Argentina, Brazil were main exporters. Everybody is inputting more oil, which was for food, into fuel. So when the fuel goes up, the crude oil goes up, the veg oil automatically goes up. So every $10 rise in crude oil automatically puts around $50 to $70 rise in the veg oil. So the crude went down up from, you say, $70 to the $105 or $110. So that put veg oil $150 to $200 higher than what it was. So this is the linked item, which we cannot help it. And it's a global thing. India is the largest importer in the world. We have to import 16.5 million tons, and we produce only 10 million tons. Our total consumption is 26.5 million tons of veg oil per. So per person per year, we consume 18.5 kgs on a population of 1.44 billion. This is our consumption, 26.5 million tons. So prices are automatically going to rise. If the crude softens down, the prices will come down. So that is the theory here. On the top, Manisha.
Joria, I also want to understand.
Also, the local crop is rapeseed, mustard seed, and soybean. Both the prices have recently gone up in last 1 week. Soybean prices, which were as low as you can say 5,000, 5,200, have gone up to 7,000.
I get your point, Mr. Bajoria. There have been various reports suggesting that availability for edible oil is not a concern. It is the affordability, the price rise that perhaps we will have to live to. And when you look at the overall chart of food inflation, edible oil at this point in time really is topping it. And that is exactly where you see it going further from here as well. Are you looking at higher edible oil prices from here on?
You are absolutely right. The problem is not the availability. No veg oil comes through Strait of Hormuz. So there is no disruption in the supply. All the veg oil comes through Black Sea, Red Sea, or Cape of Good Hope. But only thing, as I told you, because of the high crude prices, veg oil prices have gone up, and freight has also gone up. Freight from South America to India was $70 per metric ton, which is $140 today. So as you rightly said, availability is there. In every port in India, enough oil is available for the consumer. There is no shortage. But yes, the prices have gone up, and we have to bear with those prices as we are bearing with the crude prices. In crude, government is subsidizing the oil marketing companies. On the consumer, net impact is very minimum. But in veg oil, there is no system like this. So veg oil, everything gets passed on to consumer. So yes, we have to live with the higher prices. And we are in now off-season time. New crop will only come in Kharif, which is in the October onwards. And so domestic supplies are also dwindling. And domestic markets also, prices of soybean and rapeseeds have gone up in last 4 weeks. So we have to live with it. But still, I can tell you, historically, if you see, and overall, as you rightly say, among the full inflation graph, if you really see, veg oil is nothing great. And as I told you, veg oil is like 1.3 kgs per person, 1.5 kgs per person per month. So in a family of 4, you are consuming only 6 kgs per month. And in that 6 kgs, if the prices have gone up by, let's say, 25 rupees, it's only 150 rupees per family of 4, it has gone up per month.
Yeah, all right. I'll get that calculation, Mr. Bajoria. And as always, thank you so much for coming by and explaining it with so much ease on what the edible oil really means for India. Important commodity because 60% of our requirement is what we import. But with that, let's go for a short break. When we come back, we'll get you more markets and stock-specific ideas.
Welcome back. Some recovery which is underway. Nifty is up 100 points from the lows of the day, led by Nifty Metals. We have some buying coming in the FMCG pack as well. The mid-caps to have turned into the green. However, the advance decline ratio continues to be in the favor of declines. We'll keep tracking markets for you, but we have to slip into a short break and wrap on this show. Business Lunch comes up next.
Stock slip after the US and Iran hostilities in the Strait of Hormuz spark fears of a wider military engagement in West Asia. Energy and financials are the big drags, while IT and telecom see some green. Tata Trusts will meet on the 8th of May to discuss the issue of listing Tata Sons raised by Vice Chairs Venu Srinivasan and Vijay Singh. It is also expected to induct Tata veteran Bhaskar Bhatt on the board of Tata Sons. Mahindra Mahindra has surpassed estimates in the fourth quarter, riding on strong volume growth, especially in the SUV segment, and by taking price hikes to cope with the rising commodity prices. The currency has hit a fresh low of 95.40 against the US dollar as crude prices surged beyond $110 a barrel due to claims and counterclaims from Iran and the US about firing on ships in the Strait of Hormuz. Foreign funds selling equities were also adding to dollar demand. And Biocon founder Kiran Mazumdar-Shaw says niece Claire Mazumdar, who leads Nasdaq-listed Bicara Therapeutics, will succeed her, but not right away. Claire's academic and professional credentials make her an interesting choice. Good afternoon, you're with us here on Business Lunch. We are coming to you live from the CNBC TV 18 Motilal Oswal studios. I am Hormuz Fatakia. It's the weekly expiry of the Nifty and the index is seeing equal volatility as of now. There is a smart recovery though that has played out from lower levels. 23,882 was the low that the index made, but we are back above 24,000 as we speak. Earnings have started to come in, trickle in for the day. It's a busy earnings day. The second half is going to be that. Numbers from PNB at the bottom of your screens. Asset quality is stable, but the net interest income has seen a decline compared to last year. A 3.5% drop in the net interest income for PNB. The profits have gone up by 14%, but of course that might be also due to another income component as well, so that needs to be monitored. The asset quality is stable, at least on the net NPA front. You see the gross NPA figures as they come in, but as of now the stock is selling off. There you can see the gross NPAs, well, largely stable, 2.95 compared to 3.19 in the previous quarter. So, but of course the core income drop not being received well by the street. It will be interesting to see what is the kind of the slippage figure that the lender puts out, and of course the loan growth and the deposit growth guidance for FY27. That will be watched out for as the lender comes out with its investor presentation. That will be more details awaited on that. Some lines are flashing for Mahindra and Mahindra as well. The management was aspiring for mid-teens growth in their SUV sales for FY27. That was the line that was flashing at the bottom of your screens just a few minutes prior. And Mahindra and Mahindra, of course, the results were decent. The revenue growth was higher than expectations. The margins were marginally lower, if you could call it that, but largely in line, if you could call it that. The automotive segment's revenue did well, the 25% growth there. EBIT margins also saw an expansion compared to last year. So a percent higher on M&M. That's doing okay for itself as of now. So the two major results reported so far, M&M and PNB. Now, tensions in West Asia continue to escalate, with the UAE reportedly taking down 15 missiles and 4 drones launched from Iran. The Indian embassy in Abu Dhabi has reported that 3 Indian nationals were among the injured after a fire broke out on the Fujairah petroleum industry zone following the drone strikes originating from Iran. CNBC's Dan Murphy gets you all the details.
This is the most serious escalation of the conflict since the April 8 ceasefire. Iran has struck the UAE's critical oil port of Fujairah and fired on American ships in the Strait of Hormuz. The US is threatening retaliation, Israel is on high alert, and this fragile ceasefire is facing its most serious test yet. Iran fired 12 ballistic missiles, 3 cruise missiles, and 4 drones at the UAE overnight. That's according to the UAE Ministry of Defense. A drone struck the Fujairah oil industry zone, sparking a major fire there and injuring 3 Indian nationals. The attack was also severe enough to turn commercial flights around mid-air, and the damage is now still being assessed. The UAE Foreign Ministry saying it would not tolerate any threat to its security and sovereignty under any circumstances, and also warning this morning it reserves the full and legitimate right to respond to these unprovoked attacks. The UAE is maintaining a defensive stance, but anger is growing here that Iran continues to threaten the safety of civilians without consequence. Meanwhile, inside the Strait of Hormuz, the US said it destroyed 6 Iranian small boats and intercepted multiple cruise missiles and drones. The UAE also said Iran was targeting an ADNOC tanker in the waterway, and a South Korean cargo ship also caught fire. President Trump was on Fox News overnight, and he warned Iran it would be, quote, blown off the face of the earth if it continues to target US vessels. The president now, of course, also facing a very difficult choice. He can either retaliate here and risk deeper entanglement, or absorb these attacks and press ahead with diplomacy. As for Iran, its response has been quite contradictory so far. A senior Iranian official told State TV that Iran had, quote, no plans to target the UAE, even as the IRGC's own Telegram channel appeared to claim credit for these UAE strikes. The Foreign Minister Abbas Araghchi, meanwhile, taking to X, saying that events in the Strait made clear there is, quote, no military solution to a political crisis. The regional fallout here is also significant. The UAE President Mohammed bin Zayed and the Saudi Crown Prince Mohammed bin Salman both warning that further Iranian attacks could trigger broader regional escalation. Qatar also condemned the strike, specifically on the ADNOC tanker, and Egypt also rejected what it called attempts to terrorize civilians. Bahrain also calling the attacks a, quote, dangerous escalation threatening regional security. So here in the UAE, we are waking up to the unfortunate news that it appears this ceasefire is looking increasingly fragile, and all eyes now are on what happens inside the Strait of Hormuz to understand the trajectory of this conflict. It's back over to you.
Dan Murphy, thank you for that update there. Let's go across to the management of Mahindra & Mahindra, who are talking about the road ahead for the company after their results.
It's still small in compared to where we want to be and where we can go from here. LCV market share also up 60 basis points off a very high base. Our farm business, you see the numbers to the top right, up 36% for the year, excluding the international subsidiaries. When we bring the impact of that impairment in, they're up 13% for the year. And that's the key action this year, in fact, in terms of cleaning out the challenges we had internationally. And that positions the farm business much better as we go forward. Market share up 30 basis points. Farm machinery is up 32% for the year. So as we just look at execution across the board, it has been very, very strong. Not just in auto and farm, but in Mahindra Finance and TechM as well, and Agro Gems. Mahindra Finance, we talked about the numbers, we talked about the AUM and the tech and controls that are in place. I mentioned diversification that will be into mortgage, SME, a few other areas. And we're starting to really position Mahindra Finance as the lender of choice, the financial services provider of choice for rural and semi-urban in India. And given its strength in those marketplaces, it's very well positioned to really be the leader in rural and semi-urban in India. TechM on a solid path. There were specific targets laid out for F27, on track to achieve them. And what we have talked about is once that is achieved, we will lay out the plan for the next few years, which will be a further acceleration. And therefore, we see strong execution, a good team in place in TechM. And we've therefore been able to address all our weak spots that we've had in terms of getting them on a very strong footing. And that has resulted in a very consistent delivery in our commitments. We had talked about maintaining an ROE of 18%. We are at 20, but as I always do, I will say that our target is 18. We may be slightly higher or lower depending on the investments we make in the short run. At this point, we are higher at 20%, which is a good place to be, but our target remains to be 18. On EPS, we had promised a 15 to 20% EPS growth at the start of fiscal 21. And that's something that we have not just achieved, but we've beaten that quite significantly at a CAGR of 57%. We're looking at growth from F21 onwards, given the time we promised it, rather than F20, which is a low number. It's obviously we're going to be much higher off that low base.
Well, the management of Mahindra & Mahindra there on the road ahead for the company. The stock has moved to the highest point of the day now, 2.5% higher on the stock. 3180 is where it currently stands. Of course, the stock may have not done much over the last 1 month, but on a year-to-date basis, it's been a bit of an underperformer, still down around 16 to 17% before today's trading session. So Mahindra & Mahindra at the highs of the day. But no change in the currency as of now. Another day, another record low for it, 95.40 now against the dollar, and after claims of Iran attacking a US ship sent crude prices higher. Foreign funds also selling Indian equities. That continues as well. Lata is here with more on this. Lata.
Yes, that's right. Once again, the woes come from West Asia as crude marches above the $110 mark. The rupee also took another turn towards the 95.50 mark. Actually, 95.40 was the all-time low that it set today. The reasons for the crude rise have not gone away at all. There are claims and counterclaims by Iran and the US about ships being fired at, and now UAE appears to be jumping into the fray as well. So all that keeping oil red hot, as it were. The selling of 8,000 crore or more of shares by foreign investors on Thursday last some of that, the foreigners buy dollars and take it back home, remit it. Some of that remitting is happening today, say dealers. So there was demand from importers as well as the foreign investors. The market was kind of distracted or took note of statements made by the chief economic advisor, who very correctly points out that actually India's macros are among the strongest compared to countries of larger and smaller and similar size in terms of inflation, low inflation, high GDP, controlled fiscal deficit, and yet the rupee is being rewarded very unfairly, unjustly punished, he says, given the strong macros. And he believes that when the AI cycle turns, India will get a look in. Well, all that FPI investors have been telling us on the channel is that we can't buy the GDP, we can only buy corporate growth, and their earnings are subdued compared to the valuations at which they're trading. So it looks like we are set for another day of FPI selling equities and buying dollars.
That's showing up on the price as well. Latha, thank you for that update. But the markets, though, they staged a very, very sharp recovery from the lows in the last few minutes. The mid-cap index has now turned positive, and the recovery on the index is being led by the Nifty Bank, which has also recovered. So it's an almost 200-point recovery now from the lows of the day. 23,882 was the intraday low. The Nifty Bank too has seen a recovery of over 500 points now from the lows of the day. Of course, the weekly expiry playing its part as well. Take a short break. More news and updates follow on the other side. Stay tuned. Welcome back. Shifting focus then, sources tell CNBC TV18 that Arvind is in talks to buy US-based non-wovens firm Hindalco Nonwovens. Rachna is here with the exclusive details. Rachna.
Well, sources tell CNBC TV18 that Arvind Advanced Materials, the technical fabrics and industrial division of the Ahmedabad-based textile giant Arvind Limited, is in active discussions to acquire a majority stake in Hindalco Nonwovens, which is a needle punch nonwovens manufacturer based in North Carolina, USA. Now, this deal is estimated at between $125 million and $140 million. Hindalco, which serves the automotive, geotextile and industry segments, is currently owned by US private equity firm Snow Peak Capital, which acquired it in 2022 and is now looking to offload some stake. So Arvind could be looking at acquiring some majority stake there. For Arvind, this will be more than just a factory. It will be a made-in-USA manufacturing base that gives the group a tariff-sheltered foothold at a time when American buyers are actively rewiring the supply chains away from China.
Arvind Advanced Materials already operates in automotive fabrics and needle felts through their joint venture, Arvind OG Nonwovens. Hindalco would be a direct bolt on to that business, is what we understand from our sources. Now let's look at the numbers. Arvind ended Q4 FY25 with roughly 827 crore rupees in cash, which at current rate, of course, falls short of the deal value, which is close to 1100 crore rupees in rupee terms. Now, the acquisition would likely require a combination of internal accruals and fresh offshore debt, and what we understand from our sources is that a debt line has been secured already. Now, the group's debt to equity ratio is of about 0.42, which suggests there is, of course, headroom. But this would be a significant balance sheet commitment for the company. CNBC TV 18 reached out to both Arvind and Hindalco Nonwovens for a comment, but neither have responded to us as yet.
Interesting, Rachna. Thank you for that update there. Now, Tata Trusts will hold an important board meeting on the 8th of May. Shireen is here to tell us what is on the agenda. Shireen.
Trust board is going to meet on the 8th of May, and this meeting assumes significance because it precedes the Tata Sons board meeting. Remember, the last time that the Tata Sons board met, there was a decision to defer the meeting and leave the decision on N. Chandrasekharan's reappointment pending. Now, we are given to understand that the agenda items of the trust board meeting on the 8th of May include two items in specific. One, to deal with the composition of the Tata Sons board. What we are given to understand is long-time Tata veteran Bhaskar Bhatt, who used to steer Titan, could be a contender for an induction into the Tata Sons board. That is up for consideration. What we're also given to understand is Venu Srinivasan, who is on the Tata Sons board, his reappointment is under question at this point in time. So we will have to wait to see what happens now to Venu Srinivasan, who is a director nominee of the Tata Trust on the Tata Sons board. The second agenda item for the trust is to consider the listing of Tata Sons. Now remember, the vice chairman of Tata Trust, including Venu Srinivasan and Vijay Singh, have both publicly stated that they are in favor of listing Tata Sons. This matter has, of course, also been something that the Reserve Bank of India has been conferring on, because Tata Sons is an NBFC, and whether they can get an exemption or not from a listing is still pending with the Reserve Bank of India. This is going to be a matter that has split the Tata Trust as well as the Tata Sons board. Noel Tata and some of the other trustees do believe that Tata Sons should continue to be a private entity. It should not be listed. But Venu Srinivasan and Vijay Singh are among those who believe that it should be listed. So this is going to be something that will be up for consideration. And then, of course, this will lead then to the Tata Sons board meeting and the big question on N. Chandrasekhar's reappointment, whether it is a 5-year tenure, it is a 2-year tenure, it's a 3-year tenure, or a reappointment at all. All of those questions remain to be answered.
Shireen, thank you for that update there. All eyes will be on that all-important board meeting. But Biocon's Kiran Mazumdar-Shaw has named her successor at the company. While the pharma veteran will not be hanging up her boots anytime soon, her niece, Claire Mazumdar, will take over at quote-unquote the right time. Ekta tells us more about Claire Mazumdar. Ekta.
Well, yes, this is definitely an interesting piece of information where Kiran Mazumdar-Shaw has in fact chosen Claire Mazumdar as her successor. She's 37 years old, niece of Kiran Mazumdar-Shaw, which is basically Kiran Mazumdar-Shaw's brother's daughter. Currently, she's the CEO of Bicara Therapeutics, which is basically a NASDAQ-listed company with a market cap of around $1.6 billion, and was in fact a company which was incubated by Biocon and focuses on cancer therapy. Now, interestingly, like you mentioned, Ms. Shaw has indicated that she's not stepping away immediately, and it is noting it with a post that she did tweet out earlier today. And the role transition will happen at a right time, and she's not planning to hang up her boots just yet. So just a quick update with regards to whenever this transition does happen, what are the credentials that Claire Mazumdar comes with? She has a biological engineering degree from MIT. She has an MBA from Stanford, and she has a PhD in cancer biology from Stanford as well. She was previously with a venture capital firm, and she took over as the CEO of Bicara Therapeutics in 2018. Her track record, Bicara listed on the Nasdaq in 2024 with an $800 million valuation. Currently, the market cap is $1.6 billion. It has a lead cancer therapy for head and neck cancer, which is still in clinical trials at this point in time. Biocon holds around 10% stake in this post the Nasdaq listing. Now, in terms of the family ecosystem, Claire does have a brother, Eric Mazumdar, who is a professor in the US and also a non-executive director at Biocon. Her husband is an oncologist who, in fact, works very closely in the field of head and neck cancer. Now, in terms of restructuring, remember that Biocon is already going under restructuring. They're integrating Biocon Biologics into Biocon with a valuation of $5.5 billion. Biosimilars and generics will now come under one roof. The leadership transition, however, Ms. Shaw, whenever we've spoken to her, said that, Biocon is going to be a professionally run company. Shreyas Tambe, who heads the merged Biocon, will head the merged Biocon entity, whereas Siddharth Mittal, who was the CEO of Biocon, will now lead Syngene as the MD and CEO.
Ekta, thank you for that update there. Just before we take that break, look at Voltam Transformers. Numbers were flashing at the bottom of your screen. Profits had halved, margins have narrowed, EBITDA is down 30% from last year, and the stock is now down 16%. This is a very, very sharp knock that the stock has taken, and that's been the trend this earnings season, right? Good earnings getting rewarded, but ever so slight miss, and the stock gets hammered, as you can see here for Voltam Transformers, 16% lower on the stock. As we slip into this short break, here's some good news for our viewers. India's business news leader is now just a click away, and that is CNBC TV 18's all-new app, which brings you breaking news, in-depth articles, and financial world updates all at your fingertips. You can download the app from the Apple Store or the Google Play Store, or you can even scan the QR code that comes up on your screens. So take a short break. We'll be right back. Welcome back. Earlier on the show, we addressed Mahindra and Mahindra. The stock was at the highest point of the day. Sudarshan is here to break the numbers down for us, and of course, what the management also said. Sudarshan.
So I'll give you some of the important highlights and why the stock has seen a sharp recovery from day's low. At this point, the stock is up almost 2%. So first, the revenue growth. The company has seen a revenue growth of almost 26%. And despite increase in the cost over the last few months, there is a reduction in the gross margin in Q4 FY26. So gross margin has come in at 23.6% versus 25.9%, almost 200 basis points. So it tells you that the price hike that company had taken in January, it has offset the increased cost that the industry and the company had seen. Second, realization. So increase in the volume and also the price hike helped the company to see the realization drop much below than what we were expecting. We were expecting a 5% fall in the realization, and there is a fall, or say it's almost flat on YOY basis. Besides all this, the outlook that company has given for tractor, SUV, it's much above the expectations. So first, talk about the tractor industry. Company is saying that it's expecting mid-single-digit growth. If you talk about the expectations were of flat for FY27. For SUV, company is expecting mid to high teen growth. That is the aspiration for FY27. So here also the expectation was 6 to 7%. So here also it's much above the expectations. And for LCV, industry growth is expected in high single digit for FY27. So LCV that company targets, that's the above 3.5 tons. So good outlook, healthy earnings, sharp reduction in gross margin has helped company to report a strong set of earnings and also sharp recovery in the stock price that we have seen.
Recovery in the stock indeed. Sudarshan, thank you for that update there. Close to 2% higher on Mahindra & Mahindra. Take your leave on this edition of Business Lunch from me and the team. Thank you for watching. The market looking to recover from the lows of the day. We hand it over to the team of Midcap Radar on the other side.
Good afternoon. Welcome to Midcap Radar. We are coming to you live from the CNBC TV 18 Motilal Oswal studio. I'm Sonam Bhutra. With me, as always, Vivek Iyer. Substantial recovery from the lows is what we are witnessing currently. Nifty is above the 24,000 mark. It's almost a 120-point recovery from the lows of the day, led by metals. We do have the auto index, which is doing well, and a lot more that we'll discuss on the show today. Hey, Vivek.
Good afternoon, Sonal. We saw the numbers of M&M, and that led to quite a bit of a recovery as far as the entire auto pack is concerned. Good guidance coming in over there, but a lot lined up on the show, and corporate conversation, important conversation as well lined up. So let's start off with the top headlines. Market sees a sharp recovery from the lows of the day. Nifty now trades back above 24,000. Auto and FMCG see gains, while consumer durables and realty lag.
Steady Q4 earnings for CAMS. Revenues in line with estimates. Margins beat expectations. Company issues a 20% non-MF business margin guidance for FY27. Stock gains in an otherwise weak market.
Wockhardt swings to 166 crore profit in the March quarter. The company reports an over 1,400 basis point expansion in EBITDA margins. Emerging market revenue more than doubles to 320 odd crores. Turnaround to profitability gives the stock.
Strong Q4 fails to buoy RT Industries. Consistent volume growth across product lines, but select projects see delays on account of geopolitical uncertainty. Management flags near-term volatility, tells cnbc TV 18 that they are exploring alternate export markets amid war-led disruptions.
And sources say the cabinet is likely to take up emergency credit line guarantee scheme today. The scheme is set to target all sectors, with the government likely to give credit guarantee cover of 2.25 lakh crore to 2.5 lakh crore rupees.
Okay, all right. Those are the top headlines that we are tracking. As we've been pointing out, a recovery which is underway. We'll have to see whether that sustains or not, especially in the last 1 hour of trade. Autos leading from the front. We do have the metals pack, which is doing as well. The mid-cap index is in the green, but the advance decline ratio in favor of advances.
That's right, in favor of the advances. Select stocks, some of them that we just highlighted, especially some names from the pharma pack. Aurobindo Pharma today, a clear outperformer, up almost 3.5%. Wockhardt Pharma is another name from the pharma pack that's doing quite well. But these names, along with a whole host of stocks, is what Ria has on her radar. She's standing by the big wall with all the mid-caps that are moving around in the session.
Well, yes, a lot of stocks moving around in trade today, starting off with Credit Access Grameen, seeing a very strong move today. This is also the 6th consecutive day of gains for the stock. And today, the stock is also trading with very strong volumes, 8 times the 30-day average volumes traded today. Netweb Technology is also seeing a move of around 5% today, and it's also up around 30% just in the last 1 month as well. Even Gabriel India trading on strong volumes, 4 times the average 30-day volume traded today, and also up around 20% in the last 1 month. Finolex Cables hitting its 52-week high today, up 32% in the last 1 month as well for the stock. And Idea Forge hitting an upper circuit of 10% today after yesterday's 20% upper circuit, after reporting a very strong set of numbers for Q4 and for the full year FY26 as well. And remember, just in the last 1 month, the stock has also doubled. Moving on to the losers for today, we have JP Power. They've reported a very weak set of numbers for Q4 and for the full year of FY26 as well. The stock is also down around 34% from its 52-week high. Syngene also taking a hit in today's trading session, down around 30% on a year-to-date basis. CESC also down today after climbing nearly 30% in the last 1 month. Ola Electric also down around 30% in the last 1 year. Today also the stock is down around 4%. And the last stock is Pardeep Phosphates. This stock is also down around 3.5% today, and it is also down around 30% in this year so far, and down around 46% from its all-time high as well.
All right, interesting list there. Thank you so much for joining us, Ria, with that detail. Volatile Transformers, that is all the stock on our radar. We'll discuss it in greater detail, but the stock is down 13% post numbers that it reported a while back. Let's get going and get the first management of the show now. Bagmean Prime Office REIT, they are set to come out with their 3,400 crore issue. It opens today. The price band for this IPO is set at 95 to 100 rupees per share. The company will use the proceeds from IPO to fund acquisitions and other corporate purposes as well. Let's welcome Ashay Shah, who's the Chief Financial Officer, to break down the details and to understand what the guidance going forward is. Mr. Shah, good afternoon. Thank you so much for joining in. REIT is something something which has become an interesting asset class overall. We have 5 listed REITs and you will be the 6th one now. Let us understand some of the aspects of the business, because at 100 rupees a share, what is the implied distribution yield that you are targeting? Because the other peers of yours have it anywhere between 6 to 8%. So what's the target for your own REIT?
Yeah, so we've given out our projections as per RHP, and we are going to distribute for the first year 2,095 crores, which comes to at 100 rupees, it comes to 6.16 rupees. And to compare with other REITs, they range right from 5.5% to 7%. Right. And what also matters is the nature of distribution. So in our particular distribution, 65 to 75% on an average over the next 3 years will come as dividend, which will be completely tax-free. So if you see the post-tax yield are on the numbers that I've given, it'll be much better.
Understood that. Thank you so much, Akshay, for joining us, and we wish you all the best for your upcoming REIT. Give us a sense of how you're going to fund capex going forward. You have a little over 3,160 crore of capex. What will be the debt ratio? What is it that you will be using from the proceeds of the REIT, and what is the ideal debt ratio or ideal debt you'd like to have on the books of the REIT?
Right. So today we are the lowest levered REIT in the market. We going in, we have just 5% loan to value ratio. Right. And once we get listed, all the accruals will be distributed to the investors, and hence the construction will be debt financed. So even when we finish the 3,000 odd crores of construction, we will hardly be reaching the 10% LTV mark. Right. And generally, we would look at third-party acquisitions as well, which are more accretive to the investors. And we are comfortable in that 15 to 25% LTV range.
15 to 25% LTV range is what you're comfortable with. And with this capex, you will be at 10%.
That's right.
Okay, just coming back to the distribution yield. You said 6.1%. Is that post-tax or is that pre-tax?
6.17% pre-tax. However, almost 70% of that is tax-free.
Correct. So post-tax, it can be lower than 5%, lower than 6%, around 5.8 to 5.9%?
That's right.
Okay. All right. Google is around 18.9% of your gross contracted rentals. What is the lease expiry profile of Google's space specifically? When does the bulk of it expire? What are the renewals in place for this particular client?
So Google has been with us since 2015, and they have continuously taken space from us. In fact, one of our marquee buildings, which is called Bagmane Rio, it's a 1.7 million square feet building, which is their largest standalone premise outside US, that they've taken 3 years back. Right. So we have not specifically disclosed individually for each tenant what is the expiry profile. But if you see over the next 4 years, between 3 to 8% is the expiry that is happening every year in our portfolio.
Okay. Akshay, the other important part is while you've said that you're looking at acquisitions across various portions to go ahead and add to the portfolio, what are the targeted acquisitions that you will be looking at? Will it solely be focused in Bangalore? Will you also look beyond Bangalore? And within Bangalore, will it mostly be IT companies? Will it be GCCs? What will be the profile of the customers also that you would like to onboard?
Sure. So if you look at our tenant profile today, it is quite unique and a very high quality tenant base. Almost 90% of our tenants are GCCs, right? So it's almost a pure GCC play by investing in our portfolio. And the sponsor assets, there is a huge ROFO of 47 million square feet, the assets that the sponsor holds, and which could eventually be offered to the REIT as and when they mature. And the sponsor also has added assets in Chennai and Delhi in the last couple of years. So we see the other markets coming into play eventually when these assets mature. We as a REIT look at completed assets and the assets which could be part of our philosophy, which could match our philosophy of high quality assets, great locations, and where we can have amazing tenants and parks to work for. Right. So we look at all the core cities, right from Mumbai, Pune, Hyderabad, apart from Delhi and Chennai, where the sponsor has already entered.
You know, Akshay, we are in an era where we are talking a lot about AI. Of course, GCCs are driving the commercial real estate demand, but there is a fear that if AI brings in more efficiency, that could impact office demand in a certain way as well. I wanted your take. If global tech companies right-size their footprint, talk about lower infra needed for their businesses, would that impact NDCF projections that you have, the distributable money that you have? What's the word that you're getting from your clients?
Right. So we've spoken to a lot of our clients through the last year, and what we've understood from them is that there is not any material impact on account of AI. In fact, the way some of our clients see is that AI could be a net addition to the overall office space in India specifically. What they are focusing on is reducing some costs, and that is more in the Western markets where the cost of employees is much higher. And also, the GCCs specifically, they are quite sticky. So in fact, through the COVID, you can see our portfolio's performance, where in COVID, it was a worst period for commercial real estate. Our committed occupancy has never fallen below 94%, right? So that shows the stickiness of the GCCs. And I think they continue to grow. Every couple of months, we are seeing more new interesting names coming to India. One interesting fact is just 35% of Fortune 500 companies today have their GCCs in India. They are 65% yet to explore India as a market. And India is now really a GCC hub for these global giants.
Well, Shai, thank you so much. We wish you all the very best for a good subscription, and we invite you once again to join us once you do list onto the exchanges. Well, we'll now slip into a short break. We'll be joined by FADA's Sai Giridhar to discuss the April data on the other side. Stay tuned. Welcome back to Mid-Cap Radar. Well, on the bottom of your screen, just a while ago, you saw the numbers of PNB hit. On a sequential basis, the bank actually saw slippages rise quite significantly. But when you're looking at it on an overall basis, the company has managed to go ahead and meet all of the parameters on which it had given guidance. And in most cases, it has actually gone ahead and been at the midpoint of the guidance. As far as FY27 is concerned, a loan growth guidance of 12 to 13% what the PNB has given. This compares to 11 to 12% the company had given for FY26 and achieved 12.7%. A deposit growth guidance of 9 to 10% is what the bank has given for FY27. On the back of that, PNB that saw a sharp dip post the slippage number has recovered once again. Some of the other stocks on the radar, of course, are some of the names in the EMS space. Look at Amber Enterprises, that particular name up almost 3.5%. A very sharp recovery as far as Amber is concerned. And Dabur is the other stock that is now up almost 3% in the session. But moving on, Indian auto sales hit a record 26.1 lakh units in April, up 13% on a year-on-year basis. The Federation of Automobile Dealers Association says that FY27 opened with broad-based year-on-year growth. To discuss this and more, we have Sai Giridhar, the National Vice President of FADA, joining us. Well, thank you so much, Mr. Giridhar, for joining us. The first question is, despite the worry that we saw, especially as far as West Asia crisis was concerned, supply chain disruption, we've started off April on a very strong note. Should we moderate expectations for the coming months, or will this growth sustain?
So, thank you for having us over. See, April has been a record month, and why we are saying that it's a broad-based growth is because this growth is not limited to a particular segment. So if you talk about two-wheeler, three-wheeler, passenger vehicles, commercial vehicles, tractors, so it's a record month for all these segments which I'm talking about. And doing what 26 lakh 11,000 vehicles with a growth of 13% close to is a remarkable task. And we're coming from a large base from last year. So overall, it's been a good, healthy start for the financial year. And the survey at which we've done, our members are pointing out that this growth is sustainable. It's going to stay for the entire financial year. And if you talk about near midterm, if you talk about next 3 months, definitely the growth will sustain. Though the cautious factor is, as you rightly pointed out, the Middle East crisis. Till date, there's hardly any disruption which we've seen due to the Middle East crisis, though there have been few instances, particularly related to few models or variants rest. There have been no disruptions as far as the Middle East crisis till date. But if this crisis goes on for a longer period of time, I don't think any country can say that they would be insulated, because today it's a global buying which most of the OEMs do. It's definitely going to impact if it continues for a longer time. And second worrying factor is also about the fuel prices. We know that fuel prices across the globe have increased. In India, our government has done pretty well by not increasing the prices till date. So the consumers have benefited for it. But for how long that price can be sustained, or the current level of prices can be sustained, that is also a big question mark. And the Indian Meteorological Department pointing out above normal heat wave in most of the states. So these factors force us to take a kind of a cautious approach. But otherwise, if you talk about the overall growth momentum is there. The booking pipeline is very healthy. The inquiries are there. So we see a healthy growth going forward.
So when you say healthy growth, can you give us a range here? Will it be low single digits, low double digits? Will you see what you saw in the month of April itself? And when you talk about demand being strong and also cautious approach on the raw material prices, energy pricing rising, do you think if these companies do take a price hike, the customers will not be able to absorb that? Is that something which is quite plausible from here on?
See, as far as the growth is concerned, when in September last year, this GST 2.0 reforms kicked in, and for a couple of months we started doing good. The questions were asked that whether this growth will sustain or not. Now, probably with 4 months gone in this current calendar year also, we've seen a good, robust growth, a double-digit growth across segments. So we feel that the growth will be there. It will sustain for the entire current financial year. And as far as the number is concerned, number would be a bit difficult, but still, I think it would be a double-digit growth overall. If you talk about passenger vehicle segment, the way the passenger vehicle segment is going, I think this should be the year wherein we cross a 5 million mark as far as the passenger vehicle is concerned. But disruption because of Middle East crisis and with the fuel prices going up, that can play a spoil sport. That can definitely derail the growth which is there. So that's a cautious approach which we are taking. But overall, the sentiments are good. If you talk about the circulation of money, especially the rural belt, if you talk about, so the rural belt has started outperforming the urban segment. If you talk about passenger vehicles, the rural belt has done thrice as well as the urban.
Take that point. Thank you so much, sir, for joining us with your insights. That's a detailed understanding of what FY27 or the next year look like for the auto industry. We'll do one thing. We'll slip into a short break. As we do that, a quick programming reminder. We are proud to bring HSBC presents CNBC TV 18 Future Female Forward Season 4 to Mumbai with the Mumbai Gala, a powerful celebration of equity and leadership. Top industry leaders come together for a dynamic town hall shaping the narrative of New India alongside curated cultural performances that reflect the spirit of the city. The evening will also spotlight a continued commitment to empowering female micro-entrepreneurs through a dedicated advisory initiative, driving meaningful impact through the year. Tune in on May 6th, 5 p.m. onwards, only on CNBC TV 18.
Welcome back to Midcap Radar. Well, one stock from the broader market that's hit almost the lower circuit is Volatile Transformers. The company just delivered its numbers. Winnie joins in with the key highlights.
Hi, so absolutely a weak set of numbers that's reported by the company, and that's why the stock is down also more than 19%. When you look at it for the revenue for Q4 FY26, that's down almost 1%. Margins, a sharp contraction that we're seeing, around a 500 basis point contraction versus the last time, same quarter. So 13% approximately is the EBITDA margin at versus 18.6%. We have overall the profits of the company which have seen a decline by 50%. Now, obviously, do not forget, other income is also down. There's a negative other income this time of 10 crores versus 17 crores last time. Now, what is this? This is actually a forex loss adjustment that is there as well. So that other income is negative this time. And that is what is something that is impacting the PAT. But even if you adjust it, still the PAT is negative and it's seeing a decline of more than 20% as well. For the full year also, if you look at it, revenues have just seen an 11% growth. Previously, they were seeing much stronger and sharper growth, more on the 20s side. Now, it's a much lower growth there. EBITDA, that's seen a decline as well. So operationally, that performance is weak. Seems like execution is a challenge that's come in here as well. And profits of the company for the full year were also down by 6%. Cash from operations, that's also come off significantly. 139 crores versus last year, it was at 219 crores. So seems like we're seeing some impact of execution, realization. That also seems to be a challenge coming in, Vivek.
Well, thank you so much, Winnie, for joining us and giving us all of the details as far as Volatile is concerned. As you can see on the bottom of the screen, the numbers of Marico are just out and the stock correcting 2%. It's a mild 20 basis points margin miss. Important to see the domestic volume growth. We were working in the range of 8 to 9%. Stock seeing a bit of a cool off. But with that, it's all the time we have on this edition of Midcap Radar. MF Corner when we return.
Hello and welcome to MF Corner. I'm Sonal Putra. With me as always, Vinny Motiwala. On the show, we talk about your mutual fund investments portfolio, how you can plan for different goal-based investment as well. And two of that will be covered on the show today. So Vinny, take it away.
Absolutely. So today what we're going to be discussing is every time we talk about the corpus that is created for retirement, right? Let's talk beyond that as well. You create your corpus, but how do you plan it through your retirement time as well? You have a couple of decades, more than that as well. How do you plan it? How do you look at your investment strategy to move, inflation comes in, that keeps going higher. There are expenses, health expenses, other education costs maybe that could come in as well. So how do you save your corpus from shrinking? What should your strategy be as well? So we're going to be talking about all of that in today's session as well. And obviously we have our experts who are joining us on the show today. We have Prableen Vajpayee, founder of Finfex Research and Analytics, as well as Mrin Agarwal, who is joining us as a financial educator and director at FinSafe as well. Mrin as well as Prableen, good afternoon. Thank you so much for joining us on the show. Let me start with you, Mrin. Most people, always obsess over building the corpus. We talk about the amount coming in till the corpus. But on the actual day, when you start seeing that retirement coming in, what is the first decision that you would say one has to make with this sort of investment that you have, a goal-based investment? So how do you go about it after your corpus is ready?
So good afternoon, Sonal and Vinny, and it's lovely to be here today. Well, yes, it's quite a momentous occasion for most people. And, typically what is normally seen is that you'll get a lump sum from the Employee Provident Fund for the salaried people and, possibly some other amounts. Now, what typically happens is that people tend to say that, okay, let's say my expenses is 1 lakh rupees per month into 12, so I need 12 lakhs. But, the most important thing that they don't do is actually taking into account the inflation, right? And that is very, very important. So, I just give you a small example. So typically what we do is that we give you like a cash flow calculator, which basically helps you figure out how long your corpus is going to last. And I think it's very, very important for most people to first figure this piece out, that the corpus that they have, the incomes that they have coming in through retirement, like, for example, you might have rental income that might be coming in, you might be having pension coming in from somewhere. So some amount of, superannuation, for example, if you have a pension due to that. So some amount of regular income that is basically coming in, you need to take all of that into account, but very, very important to inflation adjusted. So just to give you an idea, so for example, let us say that somebody retires with a 3 crores corpus and they want to withdraw 1 lakh rupees per month, right? And I've kept it simple, no other income coming in basically. Now this corpus will only last 20 years, right? On an inflation adjusted basis. But actually, if you had worked it out without taking into account inflation, you would have seen that this corpus will last you 25, 26 years. So I think, the first thing that anybody should be doing as they're nearing retirement, or, if they are in retirement, of course, I'm sure by then you figured out where you're going to stay and all of those things. But firstly, based on your assessment of regular expenses, figure out, how long your corpus is going to last. And then secondly, of course, you have to figure out, where you're going to invest this amount in order to be able to get that monthly return. And by the way, the calculation that I had given you was assuming only 6% return on investment, right? So I think, the first thing is to figure out how long this corpus is going to basically last based on your monthly expenses. Also, I think another factor that you actually just brought it up in your question is to really think about how much you want to spend on family, family matters.
Okay, take that point. So big numbers that we keep talking about. Prableen, let me come to you now, because we often hear the number 5 crores, 10 crores. They're actually thrown around as retirement targets. But is a corpus number even the right way to think about retirement planning?
Absolutely, Sonal. We recently heard about 40 crores as well. So definitely big numbers around. And to to be quite honest, yes, it is a reality that retirement corpus numbers are definitely going into crores. It's no more in lakhs, and that too higher digits in crores, Sonal. So let's just dissect how we get to this number first. So there are a lot of variables when we are calculating, and we're also working on a lot of assumptions, Sonal. That is one problem, because today we know for certain that this is the taxation, this is the interest rate, this is what we are getting. But when we are planning for retirement, and retirement is a very longish period, it can run into 3 to 4 decades. We are totally unsure of what taxation, interest rates, what circumstances would be. So definitely, basis the inputs that we have, we work on numbers. And to give you a simple example, like Prin said, like with a monthly expense of 1 lakh, Sonal. Today, let's say if somebody is 45 and needs to retire by 60, this 1 lakh expense after 15 years would become roughly 2.4 lakh a month. And of course, it keeps increasing during retirement. That is the problem, that the person retires at 60, this is 2.4. And by the time the person is 70, it further goes up. So that number will be almost double of that. To be able to manage retirement during this longish time period, let's say we assume 90 as your lifespan, a corpus of about 8.6 CR in this case would be required. And so the numbers are very crucial because they give us a broader guidance as to what needs to be achieved. And of course, then, for example, in this, a monthly SIP as on date, if somebody is 45, a monthly SIP of 1,70,000 would need to be done to achieve it if no other instruments are there. And once, Sonal, you get there, let's say you're closer to your goal, or if you were not able to reach the goal, let's say somebody is just able to make about 6 crores instead of this 8.6. Then we figure out, how do we manage the different buckets are created at the time of retirement, because that transition from work life into retirement, it's not that your expenses are going to shrink overnight. So that transition needs to be smooth. So roughly, catering to 2 to 3 years of expenses, which requires that, proper cash flow management, that there is no volatility, that monthly income is coming for you now through a systematic withdrawal or through interest payments. Beyond that, that corpus needs to be deployed in a way that we are still able to combat inflation and manage the increased expenses even during retirement, because it's only the nature of the expenses would change. Maybe you're traveling more during your early retirement and it would be more of life care during your later years of retirement. But zonal expenses is one of the biggest certainties of life, I think, as on date. And that is why definitely these big numbers need to be taken seriously, but each to his own. So this number would be different for everybody. A tier 2, 3 person, somebody who's sitting in these cities, their corpus maybe just about 2 crores would also be sufficient. So it really depends on case to case basis. And I think that is why personal, finance is all about taking into account your situation and then working out a solution.
Okay, absolutely point taken there, Prableen. Thanks so much for that. I had just heard that 1.7 lakh investment SIP that you need to make if you're 45 and you need that 8.6 crore corpus. But thanks for that. Madan, coming to you now, other than that, when you're going to move on in age at retirement side as well, healthcare inflation, that's also a concern. You need to plan for that as well. So on the financial planning side, how should retirees actually specifically plan for this medical cost as well, right? Or an inflation that comes in around 10-12% for health inflation. So how do you plan on that front?
So there are a couple of things that you can do. So firstly, if you are a salaried employee and you have cover from the organization, you should certainly look at porting that policy. Typically, that process, I think, starts 45 days in advance. So, you should certainly do that, because what happens when you port the policy is that all the waiting periods and everything gets taken into account, so it doesn't get reset, right? So that's a big advantage. Typically, also, you'll see that the group covers have better terms and stuff like that. So that's point number one. Of course, we all know that today, anybody in this age group would need at least 25 to 30 lakhs cover, given the cost of treating large illnesses and, of course, the medical inflation of 12 to 14%. So I think another thing that one can do is to take super top-up covers. They're incredibly cheap because there is a co-payment angle. So a good way to do this is that when you port, let's say you have a policy that you've ported, you can use that as the base cover. and take a super topper from the same health insurance company, because that works out much, much cheaper. Even for people in 60s, for example, it doesn't work out that expensive. Of course, I mean, these days you also have unlimited covers that are available, but you'll have to check what's going to be the premium, like given the age, right? Above all, I've always believed that, it's important to have a health savings fund, which is just a small amount that you're allocating towards. It could be any large expense, honestly. I would say it's different from the emergency fund. It's like a life happens sort of a fund, right? Where, you're just allocating some amount, or at least what I'm saying is that, part of your investments, you do need to have some amount where you say that, look, if I have a large emergency, then, I should be able to pull out this amount, right? So you could call it health savings fund, you could call it whatever it is, but allocate one investment in your portfolio towards this purpose as well. Because again, within all the health insurance policies, we read a lot about all the restrictions, and, people getting huge bills because a lot of things don't get covered in their policies.
Right, and health insurance is a different topic altogether. That's a big part of finances, but that is not something we'll discuss in the show, but it's a big talking point when it comes to planning your investments as well. Very interesting discussion, but we have to take a quick break. On the other side, we'll continue our discussion, also talk about some common investing mistakes that we make, investing in too many mutual funds, understand more dynamics of this one with the same guests. Welcome back. You're still tuned into MF Corner. Let's try and understand at what point does a portfolio stop being diversified and starts being diluted. Still have with us Prableen Bajpai, who's the founder of Finfix Research and Analytics, and Rin Agrawal, who's the financial educator and director at FinSave India, to understand the fine line between a perfect portfolio spread and just a clutter. Prableen, let me start with you. Just a simple one, because many people, fail to understand this. How many funds are too many? Is there actually a number, or does it depend on the investor?
Actually, there's no standard number, Sonal, over there, but definitely you want your portfolio to be easily manageable And, a single digit, I think, works best for everyone. So you're restricting yourself to under 10. Broadly across goals. So you have some gold, you can have some debt as well, you can have equity funds. So I think till the time you are below 10, you are okay. An ideal portfolio, honestly, for a goal like retirement can be managed in roughly 5 to 6 equity schemes. And of course, then how you want to, cater to other goals, that would depend. Do you want to use the same schemes? Do you want to add something separate? Every investor would definitely have a different view on it. But I think that's a safe number to go with. Overall, definitely, if you're looking at your portfolio and if you just sort of, try to streamline that, these are the schemes I have and these are the categories I have. And if you're seeing that, you have, let's say, 4 large cap funds, 5 flexi cap funds, or 2 small cap funds, that is the point where you need to rethink that am I actually diversifying, or is it, resulting in, what they call diversification. So it should not be, worsening your portfolio, because monitoring becomes difficult, Sonal. And, I think the performers which are actually able to add to your portfolio get a lower weightage. At the same time, it's very, very hard to then start making the calls as to what should be exited. There is tax implications. So I think once you're nearing that, double-digit number, it should be a warning sign that, you should go and check what wrong you're doing with your portfolio in terms of adding more schemes.
Absolutely, Prableen. Point taken there. No diversification. Diversifying is fine, but no diversification. But that's my next question, right? Mrin, is there a case where, maybe if someone is over-invested or has too many mutual funds, that can actually reduce your returns rather than protecting you?
Oh, yes, absolutely. It does actually do that always, that it reduces your return. Prableen also pointed out that, the allocation that you have to your performing investments basically drops. And, what basically happens is that you are basically holding you're holding funds with the same stocks, right? So there is a huge amount of overlap. Also, there's this very nice data that I came across that when you look at the overlap of stocks in categories, for example, in the large cap category, you have schemes which have 44% overlap. That's the average overlap in the stocks. So I think what is really important is that you don't want to be stuck with the same type of schemes. I mean, we've all talked about diversification, but diversification among large, mid, and small cap, right? So you want to have a good, a good blend of all of these styles, market caps, and stuff like that. And one of the other reasons also why you could look at a drop in returns because of having too many funds is because it's so difficult to monitor it, right? And to figure out what to hold, what not to hold. It's very difficult for the lay investor to really do that. Again, the whole piece on trend chasing, which we always see that people are always chasing the recently well-performing funds, that those behaviors also come into place. So net, when you also look at the data, it actually shows that holding more than 2 to 3 funds in a specific category actually does not improve your investment returns.
Okay, all right. Prableen, if, say, a viewer of ours is sitting on a portfolio of 20 plus funds right now, what are the steps, the process to rationalize it? And there are tax implications of switching as well, right? So what do you suggest, and how do they figure out their overlap that they have in their portfolio?
Right. So, Sonal, I think first step, open your Excel sheet, write down all the schemes that you have, create another column with the category. So you know that this is the number of schemes that, I'm holding from category A, category B, category C. Once you have that, I think also very important there is to write the percentage allocation. So let's say, are you holding 10% in a flexi cap fund? You may have 2 other flexi cap funds, let's say, where you just hold about 1% and 2%. So percentage allocations, writing that down is equally important. So once you have this data, broader data with you, then of course, a bit of hard work there in the sense that you need to check that, let's say, I'm holding 3 flexi caps. What is my allocation? Maybe you have a huge allocation, let's say 10% to a flexi cap, and you do have a goal, let's say, which is 3 years away. Then, Sonal, I would recommend, even if it's not the best performing flexi cap, maybe, you can postpone exiting that, because that particular fund can be used for that specific goal, which is 3 years away. But if all your goals, let's say, are 10 years away, then I think undertaking a bit of tax implication, paying tax, it's okay. And then you can decide that out of these three flexi caps, I'm going to continue with the better one, maybe which has a lower allocation, even at the cost of paying some taxes. But overall, I think the first step for any investor should be that try and avoid having more than one fund from the same category. Even if you want more than one fund, maybe then for a long-term portfolio, it should be a combination of an active and passive approach, or you're very sure about the different fund house approaches, then probably you can add two funds if you want to continue, which has, let's say, a growth style and a value style. But I think for a layperson, Sonal, just writing down this basic details and trying to exit funds which are underperforming, have a very low allocation, can be a good starting point. And I think they can definitely come down, reduce the number of funds in their portfolio.
Okay, point taken there. So, Prableen, you're saying that if one fund in one type of portfolio, right? Like if you have in your one portfolio, like flexi cap, one flexi cap fund is what would be ideal to hold, and then one large cap fund or whatever they want to invest in. So one of each category that one could go about.
Really, yes. So broader structure should ideally have, let's say, one large cap, one mid cap. You can have one multi cap or a flexi cap, depending on the goal. You should also have some allocation to gold, maybe a 5% allocation overall. Do you need, let's say, a contra or a value style of investing? So these are the broader 4-5 categories, I think, which should be there as part of your portfolio. And I strongly recommend that for any portfolio which is for long term, let's say 7 years and above, it should also be a mix of active and passive strategies. So I think, large cap and mid cap can be passive, remaining can be active. Of course, gold would be passive. So you have to work on a broader structure and then accordingly start reducing your duplication in the portfolio.
Okay, so that can be done to avoid any overlaps. Mrin, what does an ideal clean portfolio actually look like? How many funds, which categories, for what kind of investor? I know it's very specific to investors, but if we take into account the risk parameters for an investor, how would you bucket it?
So maybe I'll just talk about an equity portfolio. Of course, you go in for debt if you have shorter term time frames. But let's say here's an investor who has a goal of, who has goals which are more than 7 to 10 years away, can take some amount of risk. So again, very important to be diversified on the style of investing, the market cap that you are basically choosing again. So we have a good allocation between a Nifty 50 index fund, a flexi cap fund, a mid cap fund, and a small cap fund. I think 4 to 5 funds is all that you need. In terms of the allocation, you would vary the allocation based on the risks that you can take. So if you can take higher risk, of course, higher allocation to mid caps and small caps funds. And again, I also believe you really don't need more than 1 to 2 funds, ideally one fund. Honestly, keeping the portfolio really simple is important. The last point that I would like to make, because I see a lot of portfolios where people have chosen, 2 funds from the same fund house. So I also believe that you should have a good diversification within the fund houses because each of them have a different style of management. So you wouldn't want to have mid cap and small cap from the same fund house, even if the overlap is not there. I would say so style, market cap and fund house diversification.
Okay. Style, market cap and fund house diversification. Maybe investing in one category of each funds. That's the roundup that I have as well. Don't invest more than, don't go into double digits in different mutual funds as well. Prableen as well as Mrin, thank you so much for joining us on the show, explaining us firstly about the retirement funds, how you should be planning in terms of corpus and beyond that as well. And also taking us through in terms for how we should be decluttering maybe a portfolio in a wiser way, better way. What is the right strategy to go about that as well. Mrin as well as Prableen, thank you so much for joining us. And viewers, thank you so much for joining in and tuning in as always as well. Sonal and myself will take your leave. Thank you so much for that. But the last hour of trade is still left and you have closing bell up next for that.
Go beyond market headlines to understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC TV 18 Motilal Oswal studio.
Taiwan index, which is open, which is indicating as of now 2/10 to 0.3% of decline. The UAE has reported taking down 15 missiles and 4 drones launched from Iran.
There was a drone hit which sparked fire at a large oil hub in UAE.
All of our lines of service and all of our industry verticals were firing.
Starting is largely flat to sideways, basically.
Volume growth in the quarter is around 12.5%.
May onwards, we are very much hopeful that the production as well as the offtake quantities will definitely pick up.
2 agenda items that we understand are going to be taken up. One is to consider nominations to the board of Tata Sons.
If you look at the rest of the Asian economies today, Indian currency is weakened the most.
Trade merchandise deficit, that number has grown by more than 30% last year.
The automotive and the farm equipment segment, both of them have done well on a YY basis.
Currently, she's the CEO of Bicara Therapeutics, which is basically a NASDAQ-listed company.
A substantial recovery from the lows is what we are witnessing currently. Nifty is above the 24,000 mark.
Well, that is the day so far, and it has been actually a pretty swingy kind of day. At one point, the market almost coming back into the green before selling off once again. That, I think, was about 45 minutes, an hour back. But now we're down at the last I checked about 100 odd points, right? 24,040 on the Nifty, 77,035 on the Nifty Bank. This is Closing Bell. We are coming to you live from the CNBC TV 18 Motilal studio. I'm Prashant. With me, my colleagues Rima and Nigel. Guys, hi. Afternoon.
Hi, afternoon. Pretty much back to where we started trade. The Nifty is above the 24,000 mark, 24,043. But from the day's low, it's been a pretty stark recovery. At the day's low, we had gone below 23,900. So from that level, things have improved. The mid-cap index is managing to hold up in the green marginally. The advanced decline ratio, though, in favor of the losing side. It's also the Nifty weekly expiry, so keep your eye on volatility and big earnings expected post-market as L&T in particular.
Well, that's right, Rima. And in fact, you're getting a couple of very big earnings reactions as well. Voltam, the stock is down now close to around 20%. Remember, that's one of the big wealth creators over the years. That's moved to the low point of the day. I think Marico, the numbers are pretty much okay, but the guidance actually sounded very, very positive. So that's why the stock, after seeing a bit of a knee-jerk reaction, Marico actually has recovered considerably from the lows of the day. I think you should pull that up. That's a stock actually to watch going by the guidance that I'm reading. And the other one is KEI Industries. I recall when market started, the stock was down 5, 6, 7%. They sounded reasonably optimistic when they spoke to us. And later on, there was a con call where the management sounded very, very bullish. And that's why from being down 7%, now the stock has moved into the green. 17 to 18% volume growth, revenue growth of 20, 25, and even 30% is possible, with margins inching towards 11%. I think the management sounded extremely bullish on the con call at around 12 noon. Explains why that stock has moved back into the green.
Well, it sounded pretty positive on our callers as well, because they said that the 12.5% volume growth. Q1 so far is looking pretty solid, pretty strong. Exports are strong. I mean, about 12-13% of revenue, so no large hit because of what's happening in the Middle East. And 20% revenue growth maintained, EBITDA margins in the range. So no real kind of... if you look, I mean, I think the stock started recovering as we spoke. And of course, I mean, I guess the market waited for the final comments in the analyst call.
The only point in the con call was he also spoke about 30%. You know, he said 20% is a given, but at current pricing, you could do 25 to even 30% in the best case scenario. And I think he clarified on the call as well. We tried to, push the management a little bit that how can you have volume growth of 12.5%? So actually, the volume growth is around 2.5%. There was a bit of a mix-up in terms of the guidance that was given over here. But the way ahead, 17 to 18% volume growth is something.
What is the volume growth?
The volume growth is 2.5% for the past quarter. Management mentioned.
Q4.
Yes, Q4. It was mathematically not possible to do 12.5% with realizations being up so much. But the guidance ahead is what the street is taking note of and explains why that stock has bounced up. But you have Voltam, that's down 18% now. One of the big wealth creators of the years coming for massive profit taking.
Actually, what we should do is, and we'll do that, we'll get someone to detail out the KEI management call transcript. That 30% number, and maybe some of the new stuff which came through in the conference call at 12 o'clock. So that in just a bit from now. Well, let's just quickly run you through the lineup here. So there's a move across indices and sectors, etc. Nifty, of course, around the 24,000 levels. Real estate stocks are dragging, while autos, metals and pharma are in the green. A slew of stocks reacting to earnings. Voltamp, of course, I mean, numbers came about 40 minutes back, and we'll tell you what went wrong with the numbers, but the street's disappointed at least. Tata Tech, Walk many others. Marico just came through. Also, a quick eye on those numbers as well. And by the way, we've had many of these companies with us here on the over the last few hours, so you'll hear from the management themselves as well. Well, L&T will report numbers today, and we'll have Coforge, which reports numbers today, and Hero, which will report numbers. So we'll get you, a sense of the numbers in terms of what to expect, what the street is expecting rather from them. Mitesh is with us with what you should be doing as we begin this new session. Mitesh, good afternoon. Good to have you with us here. Quick word in on the setup. How would you trade indices and your stocks?
Good afternoon, Prashant. So one, I think, very clearly the market is still contracting and we're seeing some recovery from the lows, but we've not seen a positive, reading on the tape. So waiting it out, I think, as I said, it's still a contracting market. So avoid the index. Today morning, you did get a low of around 23,882 and I was hoping to buy around 23,850. But then I think, once it gets closer to 23,800, that's a safer zone to buy. On the stock side, though, I have one buy and one sell call. On the buying side is Chola Finance, which I would recommend buying with a stop at about 1630. Look for targets in excess of around 1700 over here. And the other stop call is a negative call on Dr. Reddy's with a stop at about 1295 for targets of 1225.
So we've been in a range for the last couple of trading sessions, 23,800 on the way down, 24,300 on the way up. And Mitesh says continue to play that range. Dharmesh Kant, head of research, Chola Securities, is now joining in. Dharmesh, did anyone in your team listen into the KEI conference call? What were the key takeaways and what's the read on the stock after that?
Yeah, Dr. Rimano, we missed the KI conference call. We have kept it for the evening to hear it later and go through it is because there were some, gaps apparently it appeared in the understanding of the numbers. We were involved in, say, BHL, M&M and other companies' numbers, so we missed it out.
Okay. So from the analysis that you'll have done today at the research desk, which is the standout number?
Yeah, Rima, we have discussed it earlier. Tata Technologies appear to be a standout number of what they've reported. I mean, they have, beaten their own guidance in Q3 and the numbers looks pretty strong. We actually had an initiating coverage on this company a year back in the month of January 2025. And what we thought would play out thereafter is a year delayed. The reasons being, first was the tariff thing, and then there was slowdown in the EV vehicle space, and then the ransomware attack on the Tata Motors JLR division in London. So, but now I think things are coming back into play. 4, OEM deal wins with a European manufacturer, one with North American, one with Japanese, augurs well. And then Aztec is now, acquisition is playing out quite beautifully. So I think going forward into FY27 and 28, all the pent-up demand which was delayed because of many macro headwinds which are playing out is likely to play in. We are recalculating the numbers, but the back of the envelope rough cut calculation suggests that around 1,000 crores of profitability they will do in FY28. So building that into place and at 30 times FY28 earnings multiple, around 1,100, 1,050 kind of a price target is there. So there should not be any headwinds coming into play, but if the situation plays out the way it is, I think it's a good attractive buy at current levels.
Okay, all right. Dharmesh, I wanted your view on Marico, and I think we should just pull that stock up because I'm looking at the EBITDA number for last fiscal. The absolute EBITDA growth is closer around 9% approximately. But I think what the street is getting excited about is they aspire to deliver high teen EBITDA growth, subject to the current macros. So they're talking about high teen EBITDA growth. which compares with high single-digit EBITDA growth in the previous fiscal, that's FY26. I think that's the reason why the stock, after seeing a bit of a knee-jerk reaction to sub 770 rupees, that's bounced up from the lows, and that's why it's moved to the high point of the day. You want to come in on this one, Dharmesh? For the time being, the street, I think, is clinging on to that positive commentary that they've given.
Yeah, Nigel, I mean, as you pointed out, it's a knee-jerk kind of a reaction. And I was having regard to the business update which they have given for Q4, I was expecting 590 crores plus kind of an absolute EBITDA and translating into a teen kind of a growth with a better margin. So there has been a margin miss definitely. And guidance is fine, but there are so many things which plays into the agri input prices. So, I mean, coconut oil prices and everything, it's difficult to have a steady guidance on that count, which is beyond your control. So if things play out, they may be able to deliver. But as the copra prices and everything is on the rise as we speak, so I think it will be a challenge for them, despite taking price hikes. So I am taking it with a pinch of salt. To my mind, the numbers which came out was a disappointment from the expectation.
Okay, all right. Margins contracted in the past year. They're guiding for better times ahead. They're talking about revenue, absolute revenue number more than 15,000 crores, which compares with around 13,600. Dharmesh says he'll be a little bit cautious on this guidance because input costs as well have moved up. Dharmesh, wanted your view on Voltam transformers. For the time being, though, let's get in Vinny. She'll dissect those numbers for us. The stock is down more than 15%. Vinny, take it away.
Hi, Nigel. So, yes, absolutely weak set of numbers that came in from the company, right, versus what the street was expecting versus what we had in terms of a poll as well. When you look at the numbers, revenue has seen a decline of around 1% in Q4 FY26. Margins are down by around 540 basis points. So, contraction in margins. EBITDA is also weak, 30% decline there. Profits of the company also down by 50%. Now, other income for the company is negative this time, 10 crore negative number that came in there versus 17 crores. So, that is something that obviously impacts the profits of the company. What is this other income that is there? This is negative due to some foreign exchange losses that were there. So that is the reason we are seeing that negative number. Now, even despite that, if you adjust that number also, you would still see profits were still down by almost 20% plus. Even the adjustments that come in on the EBITDA front due to rupee depreciation, increased cost of RM, that all is something that has impacted the margins of the company. And that's the update that has just come in the press release that the company has reported. So adjusting all of this, also weak set of numbers that came in from the company. Now, overall, when you look at it, the margins are at the lowest levels that one has seen since June 2023. Operating cash flow for the company for FY26 is down by 36% at 139 crores versus 219 crores. Overall, nothing exciting that's come in on the numbers. Order backlog now stands at just 1,200 crores. They're increasing capacity, expected to come up in July 2026 is what the press release highlights. So that'll be key to watch out for. But obviously, weak numbers keeping the stock under pressure today.
Dharmesh, thanks very much, Vinny, for that. Voltam, any thoughts?
Yeah, but I mean, the numbers are weak, and going forward, Q1 and Q2 will be challenging for them because the entire input cost, right from the transformers they make to the oil which is being used in that has gone up, and it's likely to be, margin not accretive. It will be reducing the margins going forward. So there will be a challenge for them. But at the same time, the stock prices have run up quite sharply in last few months. I mean, 35% kind of a sharp up move we have seen in the stock price. So some, profit taking and repositioning is happening at that count. So my own sense is this entire power theme has been overplayed to a great extent, giving regard to the kind of environment we are sitting in. Things don't happen in power segment overnight or in couple of months. It takes 6 months to 1 year to play out the theme. So no new incremental order flows has been there in light of what has happened in last 2 months. So most of the power companies, they are still citing the same kind of order book they were sitting on with the same kind of a run rate. So one has to be cautious by selecting a place. Voltam at best should be avoided at current levels.
BHEL as well. I mean, I said maybe it's kind of overdone. We had a bunch of views coming in this morning. Stocks done well. There's one view that maybe the best of ordering, etc., is behind now. So, and the other thing is it's broadly as this rise of solar, as more and more solar is used to meet daytime peak energy demand. At some point we'll have to reckon with what happens to the thermal side of things, right? I mean, of course, it's still, I think solar is still much smaller, but it's increasing rapidly. So with estimates for 2034, 35, etc. the projected capacity installed is going to be much larger from the current 150, 160 gigawatts that we have. So what happens to on the thermal side? You need it for evening hours, but maybe by that time battery etc. will come up, right? Battery storage to supply evening power. So a lot of IPPs who are largely coal focused, you think, they maybe pivot to something, but there's a fair bit invested here, right? Dharmesh?
Yeah, Prashant, as far as IPPs, yeah, Prashant, am I audible?
Go on. Dharmesh, go on. Okay, I think we got I think we lost the line. So maybe give it a second and maybe the line comes back up. But just sort of recapping more numbers, right? Ria is here with exactly that. As we were saying, lots of numbers have come through last couple of hours. Ria, take it away.
Well, yeah, starting off with Tata Technologies, that one is gaining by around 4 to 5% after a strong set of numbers in Q4. The revenue has seen a beat. The constant currency revenue growth has come in at 12.5% sequentially and up around 14% on a year-on-year basis as well. And remember, the street was estimating just about a 10% revenue growth on a sequential basis. And the company has also guided for a double-digit growth in FY27, so that is leading to optimism in the stock. CAMS as well trading with very strong gains of 9% after its numbers. The revenue has gone up by just about 1.3% on a sequential basis, but this is in line with the estimates, and margins have also seen a beat versus estimates. The EBITDA margins have come in at 46.5% in this quarter. Net profit is largely flat at 127 crores for the company, and they've also achieved their FY26 guidance of 20% growth for the non-mutual fund portfolio. For Wockhardt as well, very strong set of numbers here once again, 7% up on the stock. The revenue has gone up by 30% compared to the previous year. Margins have also improved to 23% in this quarter versus just 9% compared to the previous year. And the company has also reported a profit of 166 crores versus a loss of 25 crores in Q4 of last year. For KEI Industries, this stock is up around 7% from the lows of the day. The Q4 results have come in above the estimate that we were working with. The revenue growth has been seen at 19% this time around versus an estimate of around 17% growth for the quarter, and the growth has largely been driven by the wires and cable segment as well as the stainless steel segment for the company, and they've also given a very strong volume growth guidance of 17 to 18% for FY27 ahead. Aarti Industries on the flip side is trading with losses of around 5% today. The EBITDA had gone up by around 30% and net profit also jumped by around 43% for the company, and they also witnessed volume growth across all key products for the company except for MPDA. But today in an interaction, the company had told us that the input cost surge has been quite phenomenal for the company, between around 40 to 60% in some cases. But they are saying that they are pushing hard to pass on the input price cost to their customers, but that will not be possible in most cases.
Okay, I think I'm being told. Thanks very much, Ria, for that, for those numbers. And of course, we had the managements of Aarti and others with us in the morning. That one is not recovered, unlike KEI, which was on the channel. But of course, I think the call, there was some clarifications as we pointed out, and we'll put details out with regards to KEI in a bit. But the bigger sort of, question. Sorry, Nigel, you want to
just
come?
one more point on Marico. I think the street is getting pleasantly surprised with the guidance that these companies are giving. I recall Nestlé as well, the stock, no one's really interested in the Nestlé's, Maricos of the world. And the guidance that they're giving and the numbers that they're reporting actually are a little bit better. And that's why the street is catching on to that. Just take a look at that. The stock that was at around 765 when we started off the show, that's picked up. It's at the high point of the day. The guidance is very good. Dharmesh is, though, sounding rather cautious whether or not they can deliver it. For a company that's grown 9% EBITDA absolute number, is talking about high teens growth on the absolute EBITDA number, with your revenue moving from around 13,500 to around 15,000 crores also. They're guiding for margin expansion after a sharp margin contraction in the previous year. So sometimes when in an inflationary environment, some of these larger players do relatively better. I think that's the reason why the stock, going by the commentary that they've given, the stock has recovered. Numbers are pretty much in line, but commentary is good.
Just to highlight the commentary, high single-digit volume growth in FY27. double-digit revenue growth to cross 15,000 in FY27, high-teen EBITDA growth, and they're confident of volume-led, healthy volume-led revenue growth. So 15,000 crore top line, double-digit revenue growth, and high-teen EBITDA growth in FY27, and the stock is reacting.
That's what we highlighted at the start of the show, and that's...
We have the numbers for 26. I mean, very poor, very low base or...
Yeah, there was, if I look at the absolute number, going by the release itself, the EBITDA number, absolute number is up only around 9%. In terms of margins, the margins are down 265 basis points. So they contracted to around 17% from closer to around
26
20%.
over 25 was contraction.
And on that base, they are saying that things will improve drastically. So, that's why I think the street is excited.
Yeah. Okay. So 16 rupees higher, and there's a sharp move coming through on Marico. Well, I think the other big, away from single stocks, etc., is the bigger question, right? What do we have to do to get foreign investors back into the country? I mean, I think we should put a table up. There's been so much debate and drama around that question. Lots of views, lots of opinion, and all fair and square. Because I mean, I think it's not one single thing, but a bunch of things which makes up the answer. But those are numbers up on lakh crores. So 2018 was negative, 19, 20, 21. If you can move the timeline ahead to where we are now, you can see the last 2 years, 1.6 lakh crores selling last year. And this year is already about 2 lakh crores of net outflows coming through from India right now. Now, you ask that question, what's responsible, and you'll get many different answers. Latest, of course, which caused a fair bit of hullabaloo was AI, that India doesn't have AI. And there's been a debate, and that's what makes the market. Devina Mehra is with us, founder and chairperson and MD at First Global. She's in our studios. Devina, good to have you with us here. Always on the line, but now today face to face. So what's your answer, Devina? What's responsible?
So first of all, let me say that, which I must have repeated sometime or the other on your shows also, that I do not think that FII is coming or go. I mean, why do we ask the question that will FIIs come in or not? We say that when FIIs buy, the market goes up, and FIIs sell, the market goes down. But that doesn't hold. If you look at a long enough period, there is no correlation, let alone causation. And we had these red kind of bars. But remember, when FIIs first started coming in, the bars were all green. But 1994 is roughly when the FIIs started coming in. And 94 to 2003 is a 9-year period in the Indian market history where the net displacement was zero. You would have thought this is a new source of money and tons of money coming in, it will drive up the markets, but it didn't. But of course, the fact is that, and which is something I posted on, that recently Wall Street Journal did a piece on emerging markets, and either as a positive or a negative, India was not mentioned at all. So you are really, I mean, this is as good as being off the radar. I haven't checked the latest numbers, but till a few weeks ago, the top performing markets in the world were all emerging markets, and still you were bringing up the rear. So that's there. But the diagnosis, what you mentioned, that it is because India doesn't have an AI play, or if you want to use consultant speak, India does not have an innovation story. That's how people say it. But that is, again, yesterday's story. If you look at how the global markets have moved, and particularly also how US has moved, everybody thinks it's the Magnificent Seven driving the US. That was the story 2 years ago. It's changed considerably since. So if you look at the Mag 7, which is the 7 big tech companies, Microsoft, Meta, Amazon, Google, Nvidia, Tesla, they accounted for more than 50% of the S&P up move in 24, in 23. In 25, it was down to about 40%. But the more important part is that only 2 stocks drove it, Google and Nvidia. All the other 5 underperformed the S&P. This year, again, of the 7, 5 had underperformed the S&P. Only Google and Amazon have outperformed. But more important, the S&P has hugely underperformed the Russell 2000, which is the broader index. So the action has moved to old economy. So in Russell 2000, every single sector is up. So Russell 2000 in the first 4 months is up 13.5% versus 5% for S&P. And the more important thing is, even when you see that in both these, the technology appears positive, but technology is not what you are thinking as the AI play in the narrow sense of these companies which are setting up the AI facilities. Actually, now what is moving is all the stocks that are gaining from the huge capex going into AI. So it is the electronics, it is the
memory, etc.
Yeah, semiconductors.
I'll tell you, a small 20% of S&P of Russell is AI, by the way. Now 20%, and I was just looking. If you take out AI, that 20% from the Russell 2000, earnings growth, and we're in the earnings season. Earnings growth of the Russell reduces by 50%.
I haven't done that cut, but the fact is that...
no, my only point is...
No, but I mean, the valuation of even, let us say, of course, the energy companies are leading, but even companies like Walmart or Costco, all these have done very well. So Johnson & Johnson. So a lot of the old economy companies have done well. And as I said, the AI play is now the capex into AI play.
No, that's fine. I'm just saying that I'm just sort of bunching everything in there. Basically, AI, one broad kind of. It's not just LLMs or the data centers. It's everything, which is as they call
so
it,
even old style networking companies, Dell and SanDisk and all these have kind of come out of the woodwork and are doing very well.
What is your diagnosis, Devina? What is it?
So I'm saying first
the FI question.
No, as I said, I don't spend time on the FII question because I have seen no correlation between the FIIs coming in and what happens to India in terms of the stock market. Where it does concern me is the balance of payment. So you're on net FDI, you're not doing well.
I'm not the end result. You're bothered about it, but for a different reason. But what is the diagnosis?
So, I mean, see, all these things are kind of, you can build any story at any point in time. So, if FIs were coming in, you could have come up with a good story. And you can come up with a good story if they're not coming in. Yeah. So, it is just, as of now, you are off the radar. Saying that you are expensive, I mean, India was always expensive. So, you should have made that case in 2024 that India is too expensive. Why make it now when it is far less expensive? And relative to its own history, most sectors in India are actually lower than where they used to be. Many sectors, the PEs are below average, and they're certainly not at extreme ends. So, I mean, this is just looking for stories to justify what's happening in the market. Just as, you know, consumption also in 2024, beginning consumption was at a 21-year low, but nobody was talking about it because the market was booming. Once the market started to go down, it became that consumption is slowing down.
Okay, let me, so, you know, AI, no AI, earnings growth matters, right? For stock markets from an investing point of view. So this is the latest Jan to March, if you can have the numbers up on the screen. I just pulled this up. This is 3 days old, so maybe numbers are a little different. MSCI India, if you can, do we have the, yeah, there you go. That's Jan to March because it's Q1 in the US. MSCI India earnings growth is 8%. S&P so far is 24%. Expectation was 12%. And the MSCI emerging market EPS growth is 38%. This is the quarter that we're in, Jan to March, for which we are still getting numbers and which is now coming to a bit of a close, right? Korea and Taiwan are driving regional and emerging market EPS growth for reasons that Devina also sort of alluded to, SanDisk and whatnot. There's TSMC and, I mean, lots of stuff here, right? But all in that broad AI basket. AI capex super cycle, I mean, some of these reasons are well known. And this is interesting. Korea's 12-month forward PE is now 6.6 times, Devina. 6.6 times.
Actually,
last week it was 7 times. Right. So from 7, it's come to 6.6, despite the index going up 2% because of the earnings upgrades that I'm talking about. And to the point of how much these companies, the 5 largest hyperscalers, are going to spend in capex, $751 billion in 2026. It's up 83%. They'll spend 83% more than they spend in 2025.
Yeah, I mean,
so that money is kind of.
Yeah, I mean, they used to spend $150 billion a year. Now they're talking 700 plus. Yeah. It's another story, and I think it's a when, not an if, that you will not make enough return on capital and all this. That
is another debate.
Yeah, so I mean, well, that is coming. As I said, it's a when, it's not a if. Because right now you're just spending because you have, in order to be in the game, you have to spend. But that's never a good thing. Yeah. And that's also what is giving pricing powers to the Microns of the world, that you can charge anything, but they just want... power utilities are doing well in fact, in India also power utilities and power equipment manufacturers are looking good because of data centers. Because
you're constructive as far as the market is concerned here in India right now.
In India, I think 2026 will be, in probability terms, better than 2025, simply because for the first time I hear everybody talking risk. Otherwise, everybody was selling the quote-unquote India growth story. So, now that you're talking risk, sentiment is a contraindicator. I mean, this is not my opinion. This is research studies around the world.
Talking about sentiment, Devina, here's Samir Arora. If you can quickly pull up that soundbite. He said, well, he's been marketing for 30 years. He was in the US. He's never heard people so upset. So, again, indicator that sentiment. Let's just play out a quick piece of that soundbite.
I'm on the way back from US, and the people that are upset, my God, I've never seen people so upset with India. And I've been marketing for 30 years. I started marketing in 93 for our first offshore fund and must have gone to 30, 40 countries. This is just too much on taxes. I didn't realize even on debt taxes, people are upset. I met some debt guys who said that they have been saying forever that the debt taxes also India stands out in the sense that I believe, tax, I don't know all these because I don't do debt, that even on, like if you buy a bond and there is some interest accrued before that, no other country charges tax on that to the new buyer. So they say that also we have to pay. And then they were a little bit upset with FX. There are many, many things they are upset with. And in general, I would say, these things on whether we have AI or not. Actually, I recently saw on social media that Ruchir Sharma said that India does not have AI and that is the reason FIs are not investing. So that question came up everywhere. And I used to say that there are 198 countries we do not have their own LLM models. So you treat us like those 198 at first level, not just compare us to US directly. And then I found that in India, people are saying, no, that is not the reason. Ruchir Sharma is wrong. So then what is the reason? Because there is something definitely different. And according to me, that difference is not LLM and it is not this thing. It is taxes which are obscenely different. And because of currency weakness, they are upsetting people even more because the taxes have been charged on rupee profits. The other problem, which I also had, but I never realized that everybody has, is that if you are running an open-end fund and you pay taxes every quarter, and then if in the end you make losses and then you have to get your taxes back, for another 15, 18, 12 months, you won't get your money back. And how does that work in an open-end?
Okay, well, that is Samir. So another contraindicator. Samir himself acknowledged that he's bullish, by the way. He's saying, I'm not negative, but people are upset and he blames taxes. And it's been a pet peeve with him for a while.
Yes, he's tweeted often enough on taxes. But then they're saying the research studies show that sentiment is a contraindicator. So when sentiment is overbuoyant, the next period returns are below normal, just as you saw, through 2024, and then that whole Samvat was a zero. And on the other hand, when sentiment is down in the dumps, when your people are asking that should I get out of the market, is when the next period returns are above normal. That is wherever the study has been done, Portugal, Brazil, US, India, everywhere it's the same pattern. So the times you have to be cautious is when your brain is telling you it's so easy to make money.
Yeah, and often it's not. It's kind of it's very hard to do. Devina, lovely speaking with you. Thank you very much. Appreciate you joining in. We have earnings, so the Mahindra earnings came through, and we have the management waiting. Thank you very much.
Thank you.
Okay, well, that's Devina Mehra with perspective on markets and, of course, that important question, which, of course, Devina is worried about for another reason, not for market returns and what foreign money can mean for that, but basically for from a balance of payment point of view. You can see what's happening. The dollar rupee, that's where Devina kind of is approaching it from, but saying, well, a lot of this stuff, of course, is now at one extreme of being negative, which essentially means that maybe you're at the fag end of all of it. Let's hope. Fingers crossed. 95.37. I think we went to about 95.40 or so on the dollar rupee a little while back. Mahindra is, by the way, up about 3%. And it took time. Numbers came through and it was slow. The reaction seeped through slowly. And now, of course, it's at the day's highest point, about 90 rupees higher, 3,200 almost back on M&M stock at this point in time. I think we can toss it across to Rajesh Jajurikar, Executive Director and CEO, Auto and Farm Sector Mahindra and Mahindra.
Thank you, Prashant. I'm joined by Rajesh Jejurikar to speak about the earnings of Q4 FY26 and FY26 and also about the outlook for FY27. Rajesh, thank you very much for speaking to CNBC TV team. So before I go into detail about the earnings for Q4, let me start with the volume. FY26 was very strong for across the segments. Your SUV segment has seen a growth of 25%, similar growth for tractor segment, LCV segment. Now going into FY27, you have started FY27. The first month of FY27, SUV growth was 8%. We have several headwinds, especially in the tractor segment. There is an outlook of below than expected monsoon. There is a concern related to El Nino. So considering all the factors, what's the growth expectation you're looking at for both SUV as well as tractor?
Thanks, Sudarshan, firstly, for being with us here and pleasure to be on the show with you. We are very happy with the way F26 has gone. As you said, it's been a year where we've literally fired on all cylinders. So the SUV performance was very good. We did have 660,000 vehicles in the year. The LCV and gained market share. The LCV performance was very good as well. We gained market share again. Electric three-wheelers, we were number one with a very strong market share. Launched Udo, which has done very well. Trucks and buses did very well. The very significant highlight I want to call out is the electric SUVs, where we sold 55,000 vehicles since launch and also became the number one electric passenger vehicle brand by revenue market share. So overall, it's been a very strong performance. We grew our SUV portfolio by close to 20%, as you said. F27, we are putting out for ourselves a very strong target of trying to do mid to high teens in the SUV portfolio. For the tractors, we have said the industry, we expect that for the industry, not our volumes, to be at mid single digits. And for LCVs, less than 3.5 tons, we've said high single digits. So that's for the industry, store for the industry. That's how we are seeing the year which is coming up.
So especially about tractor, largely expectations were that FY27 might be flat, considering the below than expected monsoon that Met Department is forecasting, and secondly, El Nino impact. How confident you are that industry will see the growth target that you have given for FY27?
Yeah, Sudarshan, as you know, we are always, when we look at tractor industry outlook, we always put out numbers and keep updating the numbers, sometimes upward, sometimes downward. It is very hard to project a tractor industry for a 12-month period because it is dependent on so many macroeconomic factors. The reason we are right now starting with mid single digits is while there is a probability of rainfall being lower than expectation, I think that's 65 or 70% probability that rainfall will be below expectation. There are other positive enablers. So the reservoir levels is a positive enabler. In states where irrigation is good, if the reservoir levels are good, that brings water into the farm. The overall spending of the governments in rural and agri sectors is very strong. That is an enabler to growth. So, there are positive factors as well that we are seeing on the farming side. And of course, we'll have to adjust the growth as we go along and we see what's actually happening to the rains and other macroeconomic factors. But right now, that's our best estimate.
Now, if I can talk about LCV. So last time we were talking about, you said that we're still in the first phase of the upcycle that we are in 12 to 18 months. Currently, we are in which stage, especially if you talk about the commercial vehicle?
So the LCV market post the GST drop in September and the prices came down. That was a very significant price adjustment because 10% drop in our commercial vehicle segment is very uncommon. And the GST drop enabled that to happen. So we've seen a very strong revival in the category since the price drop announcements that happened for the industry. And that momentum continues even as we've come into April as well. So we would expect this momentum to continue. The reason we are saying single digit, high single digit and not double digit, which is what we've seen in the last 7 months, is because of commodity inflation. There is two things could happen. One is commodity inflation will push product prices up. The second is it is possible that the fuel prices in the fuel pumps will go up. and fleet operators or individual truck operators will pay more for fuel. Both of these could be a bit of a dampener, and which is why instead of the current run rate of double digits, we've kind of moderating that, keeping inflation in mind, to a high single digit.
You have talked about the price hike. So first price hike this year you had taken in January 2026. And if I'm correct, it kind of largely offset the commodity cost increase that we have seen in the last few months. And that's reflecting in your gross margin. If I compare YY, there's a drop in the gross margin. Is there any chance of another price hike that you are planning?
1.6% increase.
It's for SUV as well as LCV?
SUV we took 1.6 and LCV we took 1.3 or something like that.
Correct. So from volume to margin, what would be the margin band? So for auto core EBIT margin, you have reported 10.9% if I'm correct.
Yeah.
And even tractor segment also it's around 20%. FY27, what could be the margin band that we should be looking at?
We don't give a guidance at all. So
medium term, not FY27, just going forward another like 2 to 3 years if I can.
We don't give any margin guidance for the reason that there are many factors which affect margin. And, our role is to make sure that we protect price points to customers so our products stay in very good demand and customers love buying our products. Today they do. The reason they like it is we are able to give so much at a really good price. Which is why our customers like our products. And we believe that getting volume momentum is very important. There are multiple elements of cost that have to be managed so that we are able to give the kind of outperformance we always give on profits and margins. So that is an important deliverable, but we don't want to make that the goal. The goal has to be to create customer excitement around our products. And then we have to manage everything else so that we are able to deliver strong financial performance as well. There are
Welcome back. Markets are down close to around 100 points thereabouts. The good news, though, is that the broader markets are in the green. As always, let's hop across to Nimesh, who joins us to give us a sneak peek into what he's picking up on D-Street Chatter. Hey, Nimesh.
Hi, Nigel. Another day of consolidation. I guess 24,300 is acting as a very strong resistance on the upside. So that's been the big trend from a technical point of view. Again, a day where the broader market seems to have outperformed. The mid-cap index is in the green. A lot of individual names in the broader markets have actually outperformed in today's market. So seems to be that momentum is back in the broader market names today. From a flow perspective, another mixed day of trade. Even yesterday, the number looked large because of the Adani block. X of that, it was a selling pressure from the FIs. That seems to be the trend today as well. But selectively, there is a buying back in the consumer names. So all the consumer stocks have seen a bit of buying interest from larger FIs today. I guess macro headwinds is something to talk about, and that's a big challenge to face. And also earnings are a bit erratic. So you're seeing a lot of reactions to earnings. But broadly, from a direction point of view, there is selling from the larger FIs. And again, technically, 24,300 is acting as a bit of a resistance.
Stocks, Nimesh, what are you looking at?
So the first on my list is Hindustan Aeronautics, HAL. That's been buzzing in the last couple of days. The daily volumes have picked up. Couple of reasons. One, there is a bit of interest back from institutions. A leading AIF and a leading global fund seems to be actively buying into HAL at current levels. So that's the first name. The second stock is SAIL. This is going to be interesting. It's been consolidating in the narrow range. Most of the time the stock is in the band. Luckily it's not off late. But the street is anticipating a large block deal in SAIL very soon. So that's something to track there. The third is Nestlé India. Part of the consumer basket. This is one stock which is relatively outperforming on the back of very strong delivery-based buying in today's market. So watch out for delivery stats in Nestlé India today. And the last couple of names where there are block offers for the last couple of days. Reddington as well as Paradeep Phosphate. And when both these names have actually underperformed and are under pressure of late, largely because there are some block offers in both those names from large distributions.
All right, Nimesh, thanks a lot for that. Well, it's weekly expiry, so we'll just keep an eye out on a couple of strikes. In fact, in today's trading session, the Nifty went down to around the 20-day MA, and from there it did see a bit of a bounce. And that 20-day MA seems to be an important support because the Nifty bounced off that, and I think the 23,900 mark is important. It coincides with what the options data as well is telling us. So that 20-day MA comes in around that 23,900, 23,950 mark. Take a look at the 24,000 put. The premium came down to, I think, $4-5 from around 50 rupees at the start of trade. So those writers, they were working with that level of around 23,950. 50 rupees you deducted from around 24,000. On the upside, the 24,050 call, the premium has come down to around $13 from around 140 rupees. So, you know, the levels that you're working with for today's trading session was on the upside 24,140 because there was writing that was seen at higher levels. Well, moving to the India VIX, that's cooled off a little bit. And this is a positive sign, actually. Remember, the VIX just around a month or so ago had gone dancing away to around 29. From there on, it's steadily coming down. You wanted to breach that 15 mark on the downside. That's what will give the bulls fresh reason to be, fairly bullish. Moving to individual stocks, Keynes is a stock I'm looking at. There were some shorts in the system. There's a bit of a short covering bounce that's taken place on that particular name. On Voltas, after seeing a bit of a good run, that's come in for some fresh shorting in today's trading session. And Vodafone, I recall, towards the end of last series, I was highlighting that the rolls actually were looking a little bit positive. Seems the street is hopeful of something or the other coming about because even in today's trading session, you're seeing a good amount of fresh buying. If you look at it in the last 15 sessions odd, the stock has bounced up more than 15%, I think. So from around 9 rupees, it's moving to around that 11 rupee odd mark. So that's the important stock. Expiry is going to be playing out right now, and that's why I think the Nifty is in a bit of a band. Well, I think let's slip into a short break, come back. Our technical expert is waiting to tell you what to buy today and sell tomorrow. Stay with us.
Welcome back. Let's get into a few technical trading ideas. Mitesh is back with us. Mitesh, any more stocks on your radar?
Well, I think, the market isn't giving you much. So the trading, as I've been maintaining for the last few days, has to be some kind of stock-specific basis. And two calls that I have for tomorrow. One is Godrej Consumer. Now, this is one stock in the FMCG pack which kind of corrected, but now today is trying to bounce back and is given some crossovers. So we'll take a BTST with the stop at 1086 for targets of 1115, 1120 on the upside. And the other one which I have is BTST on IDFC First Bank. We'll keep a tight stop at about 68 for targets of around 70 half of the hours.
Thank you very much for that. Let's get to L&T then. Expected to report numbers post-market hours. Vivek joins in to fill us in with the key expectations. Vivek.
Well, that's right. Remember, this is going to be an extremely crucial quarter for L&T, given the fact that this particular quarter the company has had to navigate the important headwinds it has faced, especially as far as the West Asia crisis is concerned. Remember, the company has a significant portion of its order book and a lot of execution ongoing as far as that particular region is concerned. So that is going to be the backdrop against which L&T will be declaring its Q4 FY26 results. In terms of the numbers itself, expected to be a steady quarter if all of the things have gone on track. Remember, the company did give a mid-quarter guidance saying that 95% of the projects are going on as usual. Now, revenues are seen higher by 12%, EBITDA seen higher by 14%, margin seen expanding by 50 basis points, but that is going to be an important figure to track, especially given the kind of inflation you've seen across various raw materials, and profitability seen higher by 5%. Domestic execution is expected to outpace international execution, and however, it is expected to be slightly softer versus the 9-month comparable performance. Gas shortages is something that the company will need to give some commentary on, and this could result in some softness both in terms of margins as well as execution. What is it that the street will be watching out for? Remember, most of the company's subsidiaries have gone ahead and reported their results. So Lakshya 2.0 is something that the street will watch out for, whether the company gives all of the parameters till FY31 whether today or tomorrow in the media call, or whether they hold a separate day to go ahead and give those particular details is something that's going to be important. West Asia operations, what is the update over there? And also any impact in terms of margin, especially due to cost overruns.
All right. And, last few quarters, post numbers, L&T, the stock, of course, has made large moves. So it's going to be interesting, with everything which has been happening, as Vivek pointed out, in the Middle East. Well, let's shift focus now. Arvind Limited and one of its 100% subsidiaries is likely to make a pretty meaningful, large-sized acquisition in the US. That's what we reported earlier today. Rachna is here to revisit that story. This is an exclusive. Rachna, take it away.
Sources have told CNBC TV 18 that Arvind Advanced Materials, the technical fabrics and industrial division of the Ahmedabad-based textile giant Arvind Limited, is in active discussions to acquire a majority stake in Hindalco Nonwovens, which is a needle punch nonwovens manufacturer based in North Carolina, USA. Now, the deal is estimated between $125 million and $140 million. Hindalco, which serves the automotive, geotextile and industrial segments, is currently owned by private equity firm Snow Peak Capital, which acquired it in 2022 and is now looking to offload. For Arvind, this will be more than just a factory. A made-in-USA manufacturing base gives the group a tariff-sheltered foothold at a time when American buyers are actively rewiring their supply chains away from China. Now, Arvind Advanced Materials already operates in this segment, which is automotive fabrics and needle felt, through its joint venture, Arvind OG Nonwovens. Hindalco would be a direct bolt-on to that business. On the numbers, Arvind ended Q4 FY25 with roughly around 827 crore rupees in cash, which at current rate falls short of the deal value. The acquisition would likely require a combination of internal accruals and fresh offshore debt, is also what we understand from our sources. The group's debt-to-equity ratio of about 0.42 suggests that there is headroom, but this would be a significant balance sheet commitment from Arvind. CNBC TV 18 reached out to both Arvind and Hindalco Nonwovens for a comment. Neither has responded as yet.
Thank you very much for that. Let's get back to the markets then. Still pretty much unchanged. It's 24,050 on the Nifty, exactly where we started, 72 points lower. Jay Bala of cashthechaos.com is now joining in. Jay is stuck in a bit of a range for the markets. Do you see a breakout?
Yeah, I do, Rima. As I pointed out last week, the markets needed to go below the April 24th low, and the markets have done that. But though the breakdown below that level is not an ideal level, so that's a reason for the markets exhibiting some ambivalence right now. So if the markets were to cross 24,350, then it will signal that it's ready to take a swing higher without dropping lower. My ideal drop for this markets is about 23,500. But I don't think the markets are willing to do that. But I will be patient and watch the market as to what it's doing. But I've been insisting from a medium-term to long-term perspective. This market is headed much higher, 29,000, 30,000 by summer of 2026.
2026, 29 to 30,000. Wow, that'll be really good news, Jay. And you've been maintaining that view. So, aapki muh mein ghee shakar, as they say. Let's focus on a couple of sectors then. And themes. What's going to lead us to the 29,000 odd mark? Will it be the big boy Reliance Industries that's been finding its form? The Nifty Bank today, after a while, the dip got bought into and it looked quite strong, while the IT index actually has been a little bit of a weak link. So just stated out the three pillars. What takes us higher?
That's right, Nigel. You've nailed it. And Reliance is trading above 1440, like I pointed out a couple of weeks ago. So that's an important, level for me. So I think it's beginning its move for the medium term to fresh record highs around the 1700 mark. So that will be a contributor for the market, need not be the leader. From where it is, it looks a little attractive, but I don't think that's where the leadership is going to come from. The leadership is going to come from, or it's going to continue from the capital goods space and the defense space. And when it comes to IT, Nifty IT needs one small low below the recent low made in April. So closer to 27,000, 26,000 mark. Once that's done, I think IT will also start to bottom. So that will probably come back to compensate for the underperformance over the last several months. So that's where Nifty IT and Reliance and the banking sector I missed out. Yeah, banking sector is also going to contribute, but I don't think that's going to be the leader.
But is there any trade on the banking stocks? If they're not contributing on the way up, do you see a trade on the way down? Or because markets are headed up, just avoid any shorts?
I don't have a perfect setup yet, but we got to be bullish on the banking space. Shorting may not provide much downsides from here on. Axis Bank is the one that's very interesting for me, but it still needs a little bit of squiggles that needs to be done in the very short term time, somewhere about the 1200 mark. So once that's done, I think it will start looking bullish. But that's not the ideal setup. I'm looking for opportunities in the capital goods space, real estate space, and the IT names. IT has got a little more downsides to work with.
Got that. Stay on, Jay. We need to slip into a short break. A quick programming reminder. We are proud to bring HSBC Presents CNBC TV 18 Future Female Forward Season 4 to Mumbai with the Mumbai Gala, a powerful celebration of equity and leadership. Top industry leaders come together for a dynamic town hall shaping the narrative of New India, alongside curated cultural performances that reflect the spirit of the city. The evening will also spotlight our continued commitment to empowering female micro-entrepreneurs through a dedicated advisory initiative driving meaningful impact through the year. Tune in tomorrow, 6th of May, 5 p.m. onwards, only on CNBC TV 18.
Welcome back. Well, keep your eye on a couple of stocks in the broader market. Tata Tech, the one that's got smacked, that's bounced back and bounced back quite strong today. That's moved up. And Vedanta, after the initial selling, that as well is finding its way up. So both those two are moving higher as we speak. Since we're talking stocks, Jay, I'm coming across to you to give us a fresh idea. Give us a couple of names that you like or you don't like, in terms of trading ideas.
Yeah, I like I said, I'm bullish on the capital goods space. I like both the Crompton's names here, and I like CG Power more than Crompton Consumer. So CG Power is bullish with a stop loss of 760. It's got a far superior structure, although it's very close to fresh record highs. I would anticipate it to be a very powerful breakout once it takes out the fresh record highs closer to 874, and it's because it's on a larger term uptrend. So keep a stop loss at 760 and remain bullish. It's likely to be a very big mover. And the second stock, like I said, Crompton Consumer is also good, but not as good as this. The second stock for you is Aditya Birla Capital. This is a short-term bullish call. With a stop loss of about 335, I'm anticipating the stock to scale about 440 or around about that ballpark. So this is not a medium-term call like Crompton CG Power, but this is likely to be a short-term move.
Any view on M&M? Big move today.
Yeah, it's the most bullish in the auto names, and auto sector as such it needs to scale past resistance at about 30,000. So the decline from the 2026 high of about 3,800 close by has signaled this is a corrective decline. So we're probably getting fresh 52-week highs in the next few weeks once the stock crosses 3,300.
Any view on any of these FMCG names, Jay? We were just talking about stocks like Nestlé. I don't know, when is the last time we saw a reaction of 5-8% in a single trading session on a stock like Nestlé? The market was pretty okay on that day. And Marico today. These are not, stocks that bounce up 5-6% on earnings reactions, but that's precisely what's happened. You like any of these names?
Yeah, I've been avoiding FMCG names for quite some time. Since last 2025 September, I've been avoiding FMCG names, and Marico and Nestlé are outliers. And I anticipate the FMCG index to rally to somewhere close to 58,000. I'm not too sure if it's a start of a fresh uptrend or if it's a counter trend move. We can take it as a counter trend move and then expand on it if it happens to have the potential to scale fresh short-term highs. I'm still a little bit cautious. I'm treating the bounces with the major FMCG names like Britannia, ITC, and HLL as a counter-trend bounce. Dabur and Nestlé are the outliers here. They have much bigger potential. So these two names are better off than the other FMCG names.
Yeah. Okay, Jay, hang in there. We'll come back. We're just wrapping up markets here and where we've kind of left off. 70 points lower off the highs, off the lows, by the way, by quite a bit. Just like yesterday, it was off the highs by quite a bit. So the low was made at what, 23,882, which is exactly where I think supports come in. And we bounced off those levels. 24,050 is where we leave. So it's a pretty flat sideways kind of close for the Nifty. Just look at the Nifty Bank as well, which was under pressure a little bit more, 0.6%. Private banks more than public banks. And if you want to talk about more sectors where there was pressure, real estate as a pack was down. And you had pressure coming through in the consumer pack, which was under pressure. And there was, of course, the private bank, as I said. Defense did well, capital market stocks did well, autos did well coming through. Jio Finance, Coal India, ICICI Bank were the top 3 Nifty losers. Mahindra Mahindra, Bajaj Finserv and UltraTech were the top 3 winners on the Nifty. If you look at the broader market cuts, right, Voltamp was under pressure, Godrej Properties was under pressure, Chempro, it was formerly known as ITD, was under pressure. Of course, it was up in the morning. 2 days it's done very, very well. But today it was down. There was Voltas, Paytm, Emcure, Chennai Petroleum. These were all stocks which were down and out. Wockhardt was a big mover on the upside. There was Credit Access, which did quite well. Tata Technologies, Titagarh was a big one. with volumes. NetWeb has done well. CAMS, Idea Forge, Garden Reach were some of the others. So there were defense names. Not just an Idea Forge, which has been running up for the last 3 days in a row now. Well, that's a wrap on this edition of Closing Bell. Goodbye from all of us here, but of course, more comes up in just a bit from now.
Hello and welcome to On The Record with me, Shireen Bhan. It has been a challenging environment for India Inc. in the last few months since the West Asia conflict began. It is increasing input cost pressures, and of course the worry is around inflation. Price hikes have been undertaken across many sectors, but perhaps more is in the coming. Separately, we've also seen in domestic politics big changes, big shifts in the election results that were revealed only 24 hours ago. Joining me now to talk all things India, all things demand, and all things ITC is the man who's steering the company forward, Sanjeev Puri. Many thanks for joining us here on CNBC TV 18. It's always great to have you join us on the program. Before I talk about business, I want to talk to you about what we've seen happen with the election result. ITC, of course, is headquartered in Kolkata, one of the oldest companies to continue to maintain its roots in Kolkata. What does this very dramatic change, dramatic shift in politics in West Bengal mean for industry?
First of all, thank you, Shireen, for having me on the program. It's always a pleasure to interact with you. Well, I think we've seen a fair bit of changes in the elections. I mean, West Bengal is just one example. It's been also, other states prior to that. And I think what we really see is that the democracy in India is vibrant. It's very clearly a vote of confidence on the development vision of the Honorable Prime Minister. It's a very strong endorsement of his inclusive and growth policies. That's evidently clear considering the number of states that BJP has been winning. And so let me also take this opportunity to congratulate him for the performance, not only what we heard 24 hours back, but in the past as well. And we are headquartered in Kolkata, but we are a pan-India company.
Yes.
Right? We are a pan-India company, and we have operations everywhere. And I think change is always good. And we are hoping that we shall get a accelerated pace of growth in the states where we have seen the change. And we'd be particularly happy to see that in West Bengal also.
You were talking about the pace of growth as well as how you operate pan-India across different states. And there's been a lot of focus on the ease of doing business, not just at the level of the centre, but at the level of individual state governments. You operate across different states, Sanjeev. What is the tangible difference that you're seeing on the ground, and where do you believe the rubber still needs to hit the road?
Well, there is first of all an overall difference in terms of intent to industrialize, intent to draw investments. I think there is certainly a positive momentum, and there is a very strong effort to facilitate the same. But yes, as far as ease of doing business is concerned, I think there is a fair degree of variability across states. And the states that have had better success as easing the processes and providing the facilities to industries have been receiving better investments. So there is a variability, and there is a lot of reform that has happened in this center, but there is a fair bit of stuff that gets stuck at the last mile. That is a reality. But in states where things are moving faster, that's where you find capital also going to those places. And overall, I would say, while we have made some progress, I think there's a lot more that needs to be done. Whether it's land, it's agriculture, whether it's power, all of these are areas, and a small, micro issues at all the points that need to be addressed. Let's look at a very simple area, for example, this issue of climate change. And India has also got very strong commitments for NDC, and we're doing quite well. Now, for renewable energy, a lot of investments are required. Not only do you need public capital, you also need private capital to come in. And private capital flows where the economics work out right. And the economics will work out right. One of the facets is, of course, the market-related incentives, but the other is also the frictions in the system. So the open access rules that have come out by the center, I think they're fantastic rules. But they're all stuck at implementation at the last mile. And if some of those, small things are dealt with, then we will find a lot more investments coming into renewable power. That's just an example, but I would say there are many areas that need to be dealt with.
I'll come back to investments and what could ratchet up investments in just a second. But let's talk about the global environment, which of course is impacting sentiment here in India as well on account of the West Asia conflict. How concerned are you about demand at this point in time? Do you see signs of a slowdown or any kinds of a slowdown at this point?
I think let us recognize that the challenge that we have in West Asia, it's a very serious economic challenge for the world, depending on how long it will prolong. Because not only it's about energy infrastructure or fertilizers or petrochemicals, also the logistics piece, and all this is fueling inflation. Prolonged impact could have the second order impacts even on fertilizers and therefore on agriculture and food. And also on supply chains, because petrochemicals is connected with many chemicals, right? So many second order effects could happen. So that is a concern. Having said that, let me say I think India has managed it quite well. So far, the supply chains have been largely fine, and energy is not an issue. I think the government has been particularly proactive. Yes, we are seeing inflation coming in, things like anything related to petrochemicals. Some parts of energy. So inflation is starting to come in, and it will, over a period of time, we will see that more and more prices will get passed on to consumers, because many companies were sitting on hedges or past inventory. But it will happen. And that is definitely, if the inflation creeps in, it is definitely going to be a worry. And there is data, the Economist published that every $10 increase in the crude is about 30 to 40 basis points. So we are, say, at about 100 or at least 100 plus. So we are talking about 1% already.
Yeah.
If it settles at 120, we are talking of 2%. So this is definitely something to be monitored. And besides that, I think as far as India is concerned, although we've managed, very well, but we are over-indexed in terms of our dependence on certain areas as far as the West Asia is concerned. Then we have trade links. I think exports are impacted because of logistics. Then there is a sole challenge of remittance. So it can have impact if it prolongs for a long period of time. And but we have to stay with the course on the domestic drivers of consumption, which is what I think the government is very much focused on. They've done the bit on GST and income tax, and many things are happening to focus on the domestic drivers of consumption. And that is what I think really will make our economy resilient.
But, I just want to double down on the input cost side and the kind of pressure that you are seeing. And if I were to look at the commentary that's come in from your peers, for instance, HUL, they've taken a 2 to 5% price hike versus an 8 to 10% inflation in raw material that they're witnessing. What is it like for you in terms of the input cost pressure? And have you already taken some price hikes, and what can we expect on that front?
Well, we have done some marginal increases where it is relevant. Our idea is always to see how we can manage the cost through internal efficiencies and then only pass it on to the consumers. There is inflation on account of anything to do with petrochemicals, which is really the packaging material, and there is the oils also, the oil for manufacturing. That is also inflationary. So these are the two items that are really inflationary, and it's impacting cost in the FMCG side. And of course, in paper, etc., there are chemicals and so on and so forth that are impacting. So some correction has already happened in all of the segments, and depending on how it pans out, we will have to see and take some action here.
And react to that. So what would be the pressure at this point, in the range of 8 to 10%, as we heard from HUL, or?
No, it would be lower for us. It would be lower. I won't give you a figure because, there are so many different sectors, but it's not to that degree. It's not to that degree.
Not to that degree. What does all of this mean now in terms of volume growth, and what is the expectation as far as FMCG volume growth in specific is concerned?
So we are seeing that, after all the measures that the government had taken, be it income tax, be it the GST rationalization, and then food inflation has been benign, and there's a cumulative effect of the pickup of the public investments that had kind of, slowed down some time back. Now they have gathered pace. So all of this is in fact giving buoyancy to consumption. Consumption has improved. There is better volume growth than the past. I won't give you to specifics because, we are near the, quarter four, but as a trend, and that's the
10 to 12% kind of growth?
No, I won't give you any figures right now because, but trends have improved, which is the commentary we gave also in the last quarter, and you're hearing it from some other companies as well. Things have improved, and we are not seeing anything immediately that is kind of dampening this at the moment, but we'll have to watch and see because it's still early days. The price increases have not really gone into or gone into the market in a limited way. The impact of some of the inflationary item may not have as yet got transmitted, may get transmitted with a lag. So we'll have to watch. But it is something that we need to monitor and be cognizant. At the moment, I'm not seeing any significant change.
Any significant change or any imminent signs of a slowing down just yet?
In FMCG? In FMCG, yes. In as far as hospitality is concerned, because the Middle East is also, it's a hub for international travel. So that was impacted. It's still impacted, but it's improving now. It's improving now with passage of time. People are taking alternate routes, etc. So that had kind of dampened occupancies a bit for the hospitality industry in general, but it's starting to improve. And I think, like FMCG, the hospitality industry is also focusing more on the domestic drivers. And there are strong opportunities in the Indian market itself that is growing. So that's where I think things are improving.
Yes, and with the rupee being at a record low, international travel plans perhaps are going to be recalibrated, which might be good news as far as domestic travel is concerned. But, I just want to understand from you now in terms of what next as far as FMCG is concerned. I mean, you've got your next strategy laid out in terms of the pillars that you intend to focus on, but what can we expect, which are measures on the anvil?
So let's put it this way. I think all of this is really a journey. It's really a journey, and you referred to the ITC Next strategy. So since the time we started, we have gone from about 10,000 to 22,000 crores. We also said that we will improve margins by about 1% every year. So by and large, in fact, at an aggregate level, we have done it. There have been years where, because of serious inflationary pressures, it wasn't so. But medium term, if you look at it, yes, that's a trend that we have delivered. So having said that, I think the journey is still, there's a lot more to be covered in the journey. Whilst our, the core brands we said have scaled up, have all got, substantial size over time. A lot of adjacencies have been covered. If you look at, brand like Ashirwad, which started as an atta brand. Now from atta, it's gone into vermicelli, besan, salt, spices, so on and so forth. And it's a continuous expansion that we're seeing. Strong center of plate brand, just as an example. So, but there's a lot of headroom to grow because the addressable market in the FMCG portfolio that we have built is actually in the next few years, the size will be 7 lakh crores. So there's a lot of growth through per capita consumption and penetration led, which we have to drive. That's the huge agenda for us. At the same time, we also realize that there's a lot of change happening in India. Bharat is aspirational. I mean, the preference for very premium, specialized products, variety-seeking behavior, health and wellness, yet I want it to be tastier. So all of these trends are, very strong trends are emanating. And it is now today, it's an age where you can really micro-segment. Not only from a communication perspective, but from a portfolio perspective. Because, the new age channels also provide you the access to the market for niche and smaller segments. So that's what, the portfolio we are creating is let's say the categories of the future. Although I am saying a niche, but in India, a niche can also be fairly large.
Yes.
Okay, given the size of the market.
So how many categories of the future are you looking at?
So we've got, several we have built, both organic and through inorganic routes. So if you look at it internally, we've launched something called Right Shift, which is for people over 40 years who want an active lifestyle, nutrition-dense products. We've got Prana, it's wellness through aromatherapy. We have launched, this is not wellness, but this is to look at the need for indulgent products, Sunfeast baked creations, or these are actually gourmet cookies, short shelf life bakery style cookies. We have launched it because short supply chains can be managed through the new age channels. So we've launched it. We are now fine tuning the whole business model around it. So these are some internal initiatives, and we have supplemented through several of inorganic Yoga Bar, which is a protein-based health snack. There is Mother's Purse, specialized baby care. There is 24 Mantra, organic. Prasumma is an kind of an Asian frozen food, and complemented with ITC master chefs. We have very strong presence now in the frozen food segments. So many categories we're building up for the future.
How many 1,000 crore brands are you adding? Are you looking to add?
We will over a period of time we will add many, because although if I look at it, we probably are the headroom in terms of size is probably just with one other company. We want to be the largest FMCG player, so that's how we are building up. That's why we're building our portfolio in that fashion. Even the smaller brands that we had acquired some time back, whether it's Yoga Bar or Prasumma, etc., they have a run rate of 1,300 crores. And the average growth of all of them put together is about 60% last year. So even those are, getting to scale. So we'll have many brands that are crossing that.
This aspiration of being India's #1 FMCG company was an aspiration that your predecessor, Vaisi Deveshwar, made on my program 20 years ago, exactly 20 years ago, in 2006. When do you get there? When does that 1 lakh crore rupee number, when do you get to that number?
So I'm not giving any numbers of 1 lakh crores or 50,000 crores. I'm merely saying that to be the #1. It's a journey. It's going to take time. It's not something that will happen overnight. I think where we have got in the period since we launched FMCG, now if you say 20 years back, we were just kind of starting. We were taking baby steps in FMCG at that time. In the last 2 decades, to get a turnover of 22,000 crores, this is FY25. I'm not talking about this year that is going to close. That will be something more than this, right? So 22,000 crores in about little over 2 decades, being I would say somewhere like the #2 listed company here, maybe Foods the largest, that kind of size. I think that's an unparalleled progress that's been achieved in the FMCG space. So given what we have achieved in 20 years, I'm sure we'll also get there. We'll also get there. It is not something that I can say will happen in 2 years or 4 years or 5 years. It's a journey, and we are committed to it. Whether it's our investments in innovation and R&D, whether it's in our investments in the supply chain, investments in digital, all of these are preparing us to get there, and we will get there certainly.
Well, we look forward to being able to help you understand which are the next milestones that you want to clock as far as FMCG is concerned. But, on some of the other businesses as well, and I want to understand from you what the outlook is like as far as agri is concerned, hotels, as a listed entity now today, the internal targets that you're working with in terms of the next milestones, what is the ambition in each of these?
So each one of this is making, I think, significant progress. If I look at the agri sector itself, I think it's a segment, again, just like FMCG, of immense potential. When we started ITC Next, again, we were about 8,500, 9,000 crores. Today it's a 20,000 crores kind of business. Not only have we scaled the core, made a lot of progress in value addition, value-added agriculture or value-added products. But more importantly, I think we've built a very strong foundation for next generation agriculture and the next horizon of progress. And this foundation is being built on the back of something I've spoken about in the past, which is called the ITC MARS, Meta Market for Advanced Agriculture and Rural Services. Started a little over 2 years back. We have about 2.5 million farmers, 2,200 FPOs connected with that system. And let me start by saying, those that have farmers that are connected have already experienced people who are there for at least a year and a half with us, 25 to 30% increase in income. So that's created a lot of value for the rural economy. It has created a value for us because it has given us new capability, which I will talk about. It has also optimized our logistics and the quality of procurement for my foods business. Now, ITC Mars is a platform on its own. And there are many, agri-related platforms that are being created in the country. Very happy to say that in the third year itself, we have broken even there.
Okay.
And now it's there to create surpluses over a period of time. Now, what capability it has given us? Now, we're now launching this year what we call farming as a service. So if somebody wants, say, high protein wheat, high gluten wheat, or some produce manufactured or produced by sustainable practices, we have the capacity to create that because we have this network of FPOs who are empowered through ITC Mars, who will be educated on the practices and so on through ITC Mars. So we are launching these kind of, for example, maize is becoming important for ethanol. But what can you do? The question is, what can you do for maize so that it gives you a better yield?
Okay.
So that's the kind of maize we are developing. Horticulture is a challenging area in India. So we did some very interesting pilots with quick commerce, a combination of open sky and climate-controlled infrastructure to create a supply chain for horticulture.
Okay.
It worked out well. We are in fact going to invest in 4 climate-controlled infrastructure in various parts of the country and working with Q-commerce to really try it at scale now.
Okay.
And of course, 4 is not enough for India. India needs several hundred.
Right.
But these 4 are going to be the full-fledged ones. Through ITC Mars, we will also be doing a completely integrated precision agriculture management.
Okay.
Remote sensing, drone spraying, all of the elements coming together and seeing where we can take it from there. So that's one part that we are focusing on, and that is giving us many more capabilities. We are also getting the certifications for ourselves, for the FPOs, so that we are able to ultimately connect the small farmers or the FPOs with global markets because they require a host of certificates.
Okay.
So we're building a strong foundation there. The EDOR compliance, etc., are coming up. So we have all of that, stitched in here. The third piece that we are doing in agriculture is really around biological extracts. So the first one is the pharmaceutical grade nicotine, which we are already exporting. It's a proprietary technology, the most sustainable process in the world. That's completely proprietary. And that's going on very, very smoothly. And now we are starting to progress on medicinal and aromatic plants extracts. We had started with a farm in Seor a few years back, trained farmers, buybacks. Then we are now also gone into extracts. And now R&D is on to develop proprietary extracts. That's where the real value addition will happen. But that's again a journey. It's a long-term game. The fourth area that we are dialing down is, I think there's a lot of opportunity in certain seeds for India. Because that's very important to improve the productivity. We're now making a large investment to double our Technituber capacity for early generation potato seeds.
Okay.
And with that expansion, we'll probably be the largest player in the world. So that is one area. There are other seed lines that we are also looking at that will come to aid of the Indian farmers. So several areas new areas that we are looking at in agriculture.
So on the back of all of the initiatives that you just spoke of, as far as the agri-business is concerned, what can we expect the agri-business to look like in terms of size, say 5 years on?
I don't give guidance.
An aspiration.
So we will just watch how it progresses and see, and I'm sure that it will progress very well.
So what kind of overall investments, if I were to ask you on the back of the investments that you're making in agri, but also the other investments that you're looking at, what would the capex number be for the coming year?
Yeah, for the group, 1 year is, capex investments tend to be lumpy.
Sure.
It's not that it's linear. So we'll really look at it in medium term. Medium term, we're talking about 20,000 crores for the group.
20,000 crores. And medium term would mean what, 2 to 3 years?
4 or 5 years.
4 or 5 years.
Yeah.
So 20,000 crores over the next 4 to 5 years.
Yeah.
Let's also talk about the cigarette business, because that's seen a regulatory impact on account of the tax incidence. In fact, the tax incidence has been quite high. What is the outlook as far as volume growth is concerned, and how much have you been able to absorb? How much have you been able to pass on?
So let me start by saying that, yeah, you're right. I mean, the tax increase is quite severe. And what we have seen is that every time the tax increases, it only gives a fillip to illicit. And that's not just Indian experience, it's global experience. In fact, in a country like Australia, there is discussion going around the fact that is the tax incidence on cigarettes overdone to the degree that it's created a lot of unintended consequences of smuggling and social issues in the society. In another geography, there was a multinational that stopped manufacturing because illicit became 75%. This is no more viable to produce, right? So these are global experiences. And if you look at it in India, already it's just about 10% of the tobacco consumption in India accounts for 80% of the taxes. So therefore, it's many times taxed than other products. Our taxes are about 14 times on a per capita GDP basis higher than countries like the US, right? So that's just to give you data on the intensity of the taxation. Illicit is equal to 1/3 of the legal industry. So that's the magnitude. So that's the concern that all of us have, that every time the taxes go up, it gives a fillip. And this is what worries us. That's what worries the industry. So the view we have, the way that we are approaching it at least, is that if we passed on, we have to ultimately, the tax increase is massive, we have to pass it on. There is no question of absorbing it. But if we were to do it at a single stroke, then it probably can lead to a larger shift to illicit. So we want to stagger it up. So we are staggering it up so that...
How much have you already taken?
We've taken about, I think, 50-60% of it, something like that. It's ongoing. You see, it's ongoing. I don't have an exact figure. It's ongoing. And some more will happen with passage. Ultimately, we have to pass on the whole thing. And we're just cushioning it so that we can retain as much volume as is required. We are also concerned that when all these volumes, drop, the requirement for Indian tobaccos goes down. There is also stress in the plantation and the tobacco economy, that belt also. So we will like to cushion it as much as possible, so the impact to the farmer is minimized. The impact to the the retention of the volume as much as possible we can do. We will try and do it. We'll try and do it as best possible.
6% volume growth, is that?
No, I'm not going to give any guidance. And secondly, let me tell you that it's too early to give any guidance. It's too early. The price changes are just starting to happen from March. There was old pipeline. New stocks have just kind of gotten from March. And some prices were done immediately. Some prices are in the process of getting into the market. So it's too early to give a guidance or assess, let me say. Guidance, we don't give in any case.
Yes. No, so hard to give an outlook as far as volume growth is concerned at this point in time.
It will definitely, volume will shift to illicit. So in the short term, I think there's no question of growth of volume. Volume growth happens, legal industry regains volume clawbacks from illicit industry when there's stability in taxation. Whenever taxation increases, volume shifts to illicit. So therefore,
there will be an impact.
There will be an impact. Volume growth, there will be degrowth. The question is, what degree of degrowth? Right? What degree of degrowth of the volumes? That's the only question to be answered, right? And past experience has shown that it does happen.
Yeah.
Volumes degrow, and they have their own trajectory of, with stability, things start coming back.
You talked about cost efficiencies, cost optimization as well. What have been some of the gains that you've already been able to accrue on that front, and what's the outlook going forward?
Cost efficiencies from what?
Savings, taking costs out of the business.
Oh, I think we've done plenty of stuff on that. On all our businesses. So one I think tool that has given us a lot of value is, for example, digital per se. And I'm not talking about headcount reduction. We are not into that game. We are more about creating value out of digital, right? Value out of it. So if I go, for example, to our paper boards business, just by digital, we have added 230 basis points to our margin. Structurally, we've become more competitive. I think in our supply chain, we've become more efficient with the application of digital, right? Insighting, we've become more efficient. So a lot of gains are happening. Then the second lever for us on reducing cost has been around import substitution. Wherever we could do backward linkages, that has created a lot of value. And a great example is again paper boards, because that's manufacturing intensive. So we started 30 years back on the fiber chain. Then we started some type of pulp mills. Then we did BCTMP. Then we did the herb boiler. So it's an ongoing process of backward linkages that is giving us a lot of cost takeout. So combination of efficiency through, I think, application of digital tools and investments has kind of given us a lot of efficiency. We have a tool called Astra. Astra is, again, it's part of the agriculture tech ecosystem. It helps us decide when to buy, where to buy from. Right. It looks at all the variables on the climate and so on and so forth, and does some predictive modeling and guides us where to buy. So that gives us efficiency in buying.
I'm not asking you for guidance, but what could all of this result in terms of margin expansion?
That's again guidance.
broadly, not for the next quarter.
I can of course give you data after it is done, like I gave you for paper boards.
Yes.
And I told you for even FMCG, about 1%, we are improving margins every year. But that's not just cost takeout. It's also operating leverage, it is cost takeout, it is premiumization, mix, all of that put together.
So very quickly then, quick commerce and e-commerce, how much is that now contributing in terms of ITC's sales, and how much do you foresee that contributing to ITC sales using that channel, and what has that meant for the company?
So it is the new channels that we are looking at, and in fact we put all of them together, which is quick commerce, e-commerce, modern trade. We also have this app that goes on to with the retail Unnati app, etc. If we put all of that together, actually it's about 34% of our revenues come through that route. So it's a large chunk.
And that will continue to be a focus area? What could that 34% number look like?
It will continue to be a focus area. I think we are doing quite well in these channels. But for us it's omni-channel. You have to be where the consumer is going.
Correct.
And of course, we put in special effort as far as the general trade is concerned, because those have been our partners and will remain our partners, will remain our very strong partners. So a lot of effort in strengthening the general trade also, while we continue to maximize our benefits out of the new generation channels.
You talked about a whole host of D2C acquisitions that you've done. Appetite for more?
Yeah, appetite for more, and it's not just for example just acquisitions, also internal. So what I didn't speak about, just to give you another example, internal, it's actually not FMCG, but it's a new line of business. But now that you mention it, I can. So we went into what we call the fresh foods business. It's about a 3-year-old business. We started during just around the COVID time through cloud kitchens. And we've made, I think, great progress there. We have about 70 kitchens, 4 different cuisines. So right from Ashirwad, the Soulful Creations, which is comfort Indian home-cooked food. Then we have ITC MasterChef Creations, indulgent North Indian. We have Sanshu by ITC MasterChef, Pan-Asian. And we have Sunfeast Baked Creations. Now, ITC MasterChefs is already the #1 premium North Indian cuisine in South India. Ashirwad is #1 overall in the full segment in a short period of time. And we started in Bangalore. I think the progress has been remarkable in Bangalore. The unit economics are remarkable. And then we went into Chennai, into Hyderabad. Last year we went into Pune and Mumbai.
Okay.
And this year, the central kitchen is now under construction. We'll be in Delhi also later half of this year.
Okay.
So that's an area that we will build up. And not just through crowd kitchens, now we are also making that omni-channel. whether it's corporate parks, whether it's physical outlets. So all of these things are being modeled and piloted. And I think we have a strong play there because we have what it takes to win there. Cuisine expertise from hotels, solutions on food sciences from our foods business, and we have the FMCG brands. So brands are the mark of trust, and then these expertise coming together. So I think we have really what it takes to win there. So we're going to develop this organically and really, scale this up.
And on the hotel side?
And this is growing 100% year on year.
100% year on year.
On the hotel side, I think of course, we listed some time back, and the progress is remarkable. We are now about 150 plus properties. We've added new brands to our portfolio. One is the ITC Mementos by ITC Hotels. The first one opened in Udaipur, and these are luxury resorts. Then Story, which are boutique properties for leisure. Then we have the Epic Collection, and of course our Welcome Hotel, the ITC Prefixed Hotel, Fortune, and Welcome Heritage exist. And we are opening, at least one hotel every month. Ours is an asset-right approach, a combination of managing and building our own hotels. So we are right now going to be building 3 hotels, or in the process of building. There is one in Puri, one in Visakhapatnam. Yashobhumi is the other one that we're going to build. And we're expanding the Bhubaneswar property. And many others will come because we are also looking for the place where to build some more properties.
Overseas, Sri Lanka is done?
Sri Lanka is done. So we are examining that. But I think right now, I would say our priority is India. We will probably do something outside India also, because there are certain things we are looking at. But I think the opportunity is India. If you look at the room density in India, and tourism is just starting to take off in India. There's a huge headroom to grow. So we rather focus our attention here, and something we will do also outside, but focus more on India.
Let me end then by asking you, not for guidance, but what are you most excited about? You talked a little bit about everything in your portfolio today. What are you most excited about?
I'm most excited about the enormous opportunity that India offers. And what gives me great hope is that all the businesses that we are into are businesses which have got huge headroom to grow in India. Whether it's hotels or agriculture or FMCG, even paperboard, our per capita consumption is really low. So I'm really excited about the fact that India has so much opportunity, so much headroom to grow, and all of our businesses are in spaces which have enormous headroom to grow.
Well, we wish you the very best of luck, Sanjeev. Always a pleasure speaking with you. Thanks very much for joining us on The Record. And we look forward to hearing more specific details from you as and when you are able to share those with us. But with that, it is time for us to wrap up this edition of On The Record. From all of us here on the team, thanks very much for watching. Do stay tuned to CNBC TV 18. The news continues.
Bye.
Hello and welcome to Business 360. I'm Archana Solanki. Here are the headlines we're tracking this evening. Fresh attacks in the Gulf threaten the fragile ceasefire between the US and Iran. President Trump blames Iran for the attacks on UAE. US claims to have struck 7 Iranian speedboats. The Speaker of Iran's parliament warns the US, says we have not even begun yet. Crude oil prices whipsaw after the fresh escalation. Sensex and Nifty decline in trade even as mid-caps outperform. Nifty manages to stay above 24,000. Rupee sinks to a new low of 95.40 against the dollar before recovering some losses. BJP in a huddle after historic Bengal mandate. State chief says the new government will be sworn in on Saturday. Mamata Banerjee alleges loot and manhandling after losing to Suvendu Adhikari in Bhawanipur. Multiple premises housing TMC party offices reportedly vandalized by BJP cadre. Vijay formally stakes claim to form government in Tamil Nadu a day after his party emerges as the single largest, seeks 15 days from the governor to prove majority. TVK is 10 seats short of the halfway mark. M&M beats estimates in Q4 thanks to strong volume growth. Revenue rises 29% even as margins contract. Management expects annual growth in SUVs and tractors to be higher than estimates. Biocon founder Kiran Mazumdar names her niece Claire Mazumdar as her successor, but also adds the transition will be gradual and she's not hanging up her boots anytime soon. 37-year-old Claire Mazumdar is currently the CEO of Bicara Therapeutics, a US-listed company incubated by Biocon. And Amazon's CEO Andy Jassy defends the proposed $200 billion AI spending this year, calls it a once-in-a-generation opportunity to drive long-term growth and returns, says investors are overlooking Amazon's history of investing ahead of demand, adds profits and cash flows will follow as infrastructure utilization improves. All right, the top story this evening, the US and Iran vie for control of the Strait of Hormuz as fresh attacks wane on the fragile ceasefire. Here are the top developments. Iran has said that it struck UAE's Fujairah port because of USA's attempt to facilitate the transit of ships. Iran's top negotiator Mohammad Baghir Ghalibaf warned the US, saying, and I quote, "We have not begun yet." End of quote. The attack caused a fire at a nearby oil facility and injured 3 Indian nationals. The UAE Foreign Ministry said it reserves the right to a full and legitimate response, while India's External Affairs Ministry condemned the attack and urged for the free and unimpeded navigation in the critical waterway. US President Donald Trump hit back at Iran for its attack. He said, and I quote, "Iran has taken shots at unrelated nations with respect to ship movement, including a South Korean cargo ship." End of quote. Trump did not categorize the escalation as a violation of the existing ceasefire, but he did warn that he would, and I quote, "blow Iran off the face of the earth if they attacked any ship." End of quote. The president also said the US has targeted even small boats in the strait. Iran has denied Trump's claim. Iranian state media insisted that the US had targeted civilian vessels carrying goods and passengers. Tehran claimed that 5 civilians were killed in these attacks. Iran's foreign minister has cautioned the US and the UAE against being pulled back into a conflict. He added that recent events show there's no military solution to a political crisis. Crude prices continue to whipsaw amidst all this tension and uncertainty in the Strait of Hormuz. Around 2,000 ships are estimated to be struck in the strait. The US says 2 were able to leave yesterday. Shipping company Maersk confirms one of its vessels was able to leave. Reuters has reported the ship was accompanied by US military assets. Meanwhile, attacks by Israel and Hezbollah intensify in Lebanon amid the ceasefire. Lebanese Health Ministry said that Israeli attacks killed 17 people in Lebanon yesterday. With this, 110 people have been killed in military strikes since Thursday. All right, let's talk about the day's market action. The market ended largely in the red, but off day's lows. Nifty closed below the 24,050 mark, dragged by ICICI Bank, L&T and HDFC Bank. The mid-cap index outperformed and the Nifty IT emerged as the top gaining sectoral index. The Indian rupee sank to a fresh low of 95.40 against the US dollar. The fall was due to a surge in crude prices and escalating tensions in West Asia. However, reports that the central bank may allow PSU banks to borrow via dollar bonds helped the currency recover some losses. Lata Venkatesh joins us with more details on the currency move. Lata.
But it started off like a more of the same day with crude prices going well over $110 per barrel and claims and counterclaims from Iran and the US about bombing of ships. The rupee obviously reacted to the crude prices, and along with several Asian currencies, it did touch a new low as 95.40 per dollar in early trades. Of course, today the rupee was a little weaker than other currencies, other Asian currencies. Also, some of them are not trading today. The stock markets were not trading. But the FPI selling also added to the dollar demand. However, what came to the help of the rupee was not so much RBI providing dollars, but a story in Bloomberg saying, a story that appeared towards the end of the trading day, that the Reserve Bank may allow state-owned banks, like State Bank, Bank of India, Bank of Baroda, state-owned banks to raise dollars through dollar bonds abroad. Now, an influx of dollars will obviously mean, something that supports the rupee, and the rupee immediately shaved off its losses and ended a little more benign at 95.28. Still an all-time low, but not as bad as intraday lows. But it would be an interesting ploy if the Reserve Bank were really to allow Indian banks to go out and borrow instead of the Indian sovereign bond. This is a semi-sovereign going and borrowing. We have to see whether this idea actually works. CNBC TV 18 could not immediately reach the Reserve Bank to confirm the story.
Right, thank you, Lata, for that. Moving on, the BJP is in a huddle after securing a landslide two-thirds majority and ending Mamata Banerjee's 15-year reign in West Bengal. Home Minister Amit Shah has been appointed as a central observer for the Legislative Party leader election. This is the first time that the BJP would form a government in the state. In what was a comprehensive performance, the party made significant inroads into TMC bastions of Howrah, Hooghly, Kolkata, North and South 24 Parganas. The TMC, which has been reduced to 80 seats, failed to open its account in several North Bengal districts. Mamata Banerjee lost to BJP Suvendu Adhikari by a margin of over 15,000 votes in her home turf, Bhawanipur. Refusing to concede defeat, Banerjee has instead alleged loot at the behest of the Election Commission and the BJP. Sporadic incidents of arson and vandalism targeting TMC offices were reported as BJP supporters celebrated their landslide win. The Election Commission has said that strict action will be taken against those involved. BJP state president has said that new government will be sworn in on May 9th. There are reports suggesting the new government may consider moving the secretariat from Howrah to Writers' Building in Kolkata. The building had served as the erstwhile left front government secretariat. Addressing a press conference earlier, Mamata Banerjee alleged she was physically attacked at the counting centre yesterday. Said her party will bounce back.
We will bounce back, we will fight this battle. But whatever this government of India's direct interference and to control the autocrat system, to finish the democratic system, the brutal murder of democracy. In this line they won in Maharashtra, in Bihar, in Haryana and other states. They were not able to fight it out, but we fought it just like a tiger, and we will fighting, and we will be fighting. All we are together.
From Bengal to Tamil Nadu now, where Vijay has disrupted the traditional bipolar nature of Tamil Nadu politics in his debut electoral outing. Outgoing Chief Minister Stalin and a dozen of cabinet ministers lost their seats a day after emerging as the single largest party in the state with a 35% vote share. The actor-turned-politician met the governor and staked claim to form the government. With the TVK falling 10 short of the majority mark, Vijay would need to talk across the aisle to cobble the required numbers. In a letter to the governor, Vijay sought 15 days to prove majority. In what is a mere formality, he was elected as the leader of TVK's new legislative party. All right, the Congress-led UDF alliance is also in government formation talks in neighbouring Kerala. The alliance stormed back to power in the state after a decade. The CPM-led LDF lost power with 13 ministers losing their seats. Outgoing Chief Minister Pinarayi Vijayan won his seat but with a reduced margin. There are reportedly 3 major contenders in the Congress for the CM's post. Leader of the opposition VD Satishan, Senior Leader Ramesh Chennithala and Lok Sabha MP KC Venugopal. And with that, it's a wrap on this edition of Business 360. News and updates continue right here on CNBC TV 18.
Hello and welcome to Commodity Champions. I'm Manisha Gupta. Iran's alleged drone and missile strike on the UAE did not go down well with the US President Donald Trump, who condemned the attack. He has now warned Iran that it will be blown off the face of the earth if it plans to target U.S. ships sailing in the Strait of Hormuz. This after Trump announced Project Freedom, under which the U.S. ships would guide vessels in the strait hostilities will guide the strait. The strait hostilities in the region have resurfaced after Trump claimed that the U.S. tagged small Iranian boats in the strait, alongside Iran's attack on the UAE. Meanwhile, Qatar, Saudi Arabia, Kuwait, France, Germany, and the United Kingdom have all condemned the suspected Iranian attack on the UAE. The recent escalation has pushed crude prices in a volatile trajectory, with Brent crude hovering above the $110 a barrel mark. Experts believe that the elevated crude prices are not just due to supply disruptions, but also fears of further oil infrastructure damage and the likelihood that the Strait of Hormuz could be shut for a longer time than the timeline outlined by the Trump administration. Brent has surged around 50% since the beginning of the conflict in late February. To understand the implications of the flare-up in West Asia and the outlook for crude, we speak with Iman Nasseri, his Managing Director, Middle East Research at FGE Nexantica. Iman, hi, thank you so much for joining in. There is a breach of ceasefire clearly between US and Iran, and the markets are perhaps readying to witness a second round of hostilities in that area. What are your readings on the things on its way?
Suppose this is the most obvious breach of ceasefire, certainly since it was first announced on April 8th. There have been a few other incidents of missiles going to Kuwait and Bahrain. Those were kind of attributed to other proxies and groups within Iraq and elsewhere. But this is obviously the very significant act by Iranians on basically on the UAE and on vessels going through the Strait of Hormuz. So I suspect this means that we may be already at the end of ceasefire and potentially into round two. And the market has already reacted by around $5 jump, but I guess everyone's in a bit of a wait and see mode to see that if it's a full ceasefire basically end, or it was a temporary that could potentially be put back into ceasefire by both parties.
Iman, the Strait of Hormuz has been shut for more than 60 days now. Where do you see crude oil prices, let's say, by end of May, if the situation is status quo, even until then?
Regardless of whether we go back into a full military conflict and war like perhaps March and early April or not, we do not expect the Strait of Hormuz flows to resume and recover anytime soon. Depending on the extension of this level of disruption, which is basically over 90% of the flows are disrupted, and we're at 5-10% at best, if not even less. We are expecting the prices to stay in $120 to $150 range, with potential spikes depending on incidents that may happen on physical supply assets, such as what we hear that might have happened in Fujairah last night. And if, in our base case, we assume flows to start resuming in June, July, based on some developments around the parties involved, and basically another form of agreement or a system in place by the Iranians to allow certain flows, we expect the prices to drop only to $100 to $120 range by the end of the year. In our base case, we do not expect the flows of oil through Strait of Hormuz to recover to more than 60% of its pre-war levels by the end of the year. And into next year, assuming this gradual recovery to continue, we expect prices to go below $100 in a high $80 to $100 range. That has a lot of assumptions built into that in terms of fundamentals. But at this point in time, we think that we're taking a middle ground, meaning that we could potentially see the flows to stay out at this current levels of 95% or so for much longer than we had already anticipated.
All right. Iman, so your worst case scenario is $150 a barrel and best case scenario is 80 to 100, and that too in the next year. Doesn't sound like a very good number there. But the fight for the control of Strait of Hormuz, I mean, that really seems to be taking center stage. There are reports that Iran is widening the area under its control. How are you looking at Iran wanting more control? And how are you looking at Strait of Hormuz? Is it ever going to be free yet again?
I think we have to wait until the main issue and the fight and the conflict is over and the dust settles before we know what is going to happen to the new framework around the flows. Obviously, Iran assumes and is looking after retaining its control over flows. Perhaps different systems, different mechanisms have been flying around by parties in charge of Iran. Iran is not right now under one single voice. There is the current government, there is the ICICI, and there are different fractions and factions within the leading kind of groups, political parties in Iran. And those askings and kind of proposed systems assumes from pure control and partial involvement into approving vessels to go through and perhaps even bringing the lanes closer to Iran from original pathway through Oman, going all the way to charging tolls and also banning certain flags and certain owners to go through. So it is all very much up in the air, and we won't know until the Gulf is clear from being a war zone at the moment, meaning that the blockade and all the missiles and naval forces to clear, then we only know. But as it stands, what is very clear is that the current political regime and political system in place in Iran do want to retain some form of control over Strait of Hormuz and do not want to go back to pre-war in terms of being a no say in the flows and who pass through and even charging them.
Does not sound good yet again. But Iman, you know, when we've seen earlier energy shocks, and that was the time that it was 100% about fossil fuels, would you say this is not very energy intensive? Because we're looking at, while 80% of all energy demand is still fossil fuels, but we're talking electricity and renewables, etc. There are serious concerns, but how are you looking at this mix going forward?
I think the higher energy prices, higher fossil fuel energy prices, together with more supply risk is going to work in favor of new energies and renewable energies. It has always been like that. When the price of oil goes $100, we saw that for a few years back in 2010s. It expedites the move towards clean energy. However, on the other hand, basically right now, it's not only prices, it's basically the lack of supply and that could work against any form of development, especially in investment in expensive projects, including new energy. So there are two forces at play. One is that, yes, the world is worried about the security of supply when it comes to fossil fuels. Also, the prices are encouraging to spend capital on new energies and basically try to bring the share of new energies higher. But at the same time, the economies are under massive pressure in terms of availability of energy, which is one of the key ingredients of economic development and growth. So we have to see, and there is so much uncertainty in front of us. We have to see how long this prolonged lack of energy input into economic sectors continue, and then we will know which of these two forces are going to win in terms of contributing to more development and growth of new and renewable energy sources.
And Iman, finally then, there also are concerns about demand destruction, slowdown in economies, maybe more austerity measures from the governments. What are you anticipating?
Yeah, definitely demand destruction have been part of the solvers of this supply disruption. So previously during COVID, basically we saw a huge amount of demand disappearing. That was basically controlled demand management, meaning that people were staying at home, many businesses were shut down only because of the fear of COVID and health risks. This time, it's basically the lack of supply that is forcing some part of demand to be shut down. That is going to be a different format, and in terms of longevity, it's different from the other form. When people control their demand, they could immediately put it back. When the demand is forced to disappear, it may take some time to recover. We expect a lower demand profile for the time being. We were first among many analyst groups and research firms that forecast demand contraction in 2026 as a whole. It was followed soon after by the IEA showing only a small demand decline this year, but it is serious, and that's mainly driven by lack of supply. Demand has to be curtailed, and it's going to be a mix of demand for power generation, which is a shift from fossil fuels into other forms of new and renewable energy in residential and industrial, as well as transportation. All of these sectors are going to be slightly contracted just to solve for the balance of energy in the market.
Iman, that's a very interesting way to put it. Demand that I bring down by myself and demand slowdown that is forced on me, well, of course, will take longer time to come back. But as always, thank you so much for joining in and making sense of what's really happening in the international markets and, of course, the crude oil prices, which you believe are going to be higher for longer. But on that note, it's time for a break. Don't go anywhere. On the other side, we discuss the impact of West Asia war on agriculture sector, that and more on the other side. Welcome back. You're watching Commodity Champions. An already distressed agriculture sector is set to reel under pressure from West Asia tensions. Compounded by El Niño woes and the cascading impact of the West Asia tensions on India's agriculture sector is largely driven by higher crude oil prices, leading to increased biofuel mandates and potential fertilizer shortages if the Strait of Hormuz is disrupted. The weather-related challenges are adding to the strain, with El Niño expected to play a major role. Weather agencies anticipate a powerful El Niño pattern, which could become one of the strongest in 3 decades. Conditions may develop as early as May to July, with expectations of a below-normal monsoon, a higher likelihood of heat waves and reduced rainfall. Joining us now to take this discussion further is Atul Chaturvedi. He's Executive Chairman at Sri Renuka Sugars, and Siraj Hussain is former Agricultural Secretary. Gentlemen, hi, thank you so much for joining in. First of all, your sense on the West Asia conflict and its impact that we've seen on agriculture. Mr. Hussain, it much has to do with fertilizer, higher freight rates, and of course, logistic concerns. But have we baked all of that in, or do you think going forward, the next quarter or so could be even more difficult?
My sense is that in the Kharif crop, the availability of fertilizers is not going to be very badly affected. And one reason for this is improved supply of LNG for urea plants in the month of April. After reduction in supply in March, the government moved quickly and the supply to urea manufacturing facilities improved in the month of April. So the government also did a good job in contracting 2.5 million tons of imported urea at a very high price. So before the war, the imported price of urea was about $400–450 per ton. And this contract by IPL for 2.5 million tons has been done at about $935 to $1,135 per ton, which means that availability may not become a real issue, but the government will take a big hit on the subsidy front.
Mr. Chaturvedi, let me come to you with another thing. So fertilizers are available, but at a very higher cost, and that would mean a higher input cost as well. Add to that the fact that the rupee has continued to depreciate very, very strongly. Rupee is down 4% since the war began. Rupee is down 12% in last 12 months itself. And various commodities, whether it's going to be edible oil or pulses, are largely imported into India as well. So are we importing inflation in sense of fertilizer and then, of course, the rupee?
We really don't have an option. Just imagine if we did not have a bumper mustard crop. In fact, we would have actually been paying through our noses for imports during this period. It is mustard which has saved us and saved us big time. And that is also one of the reasons why the edible oil prices in the country have not skyrocketed to the extent people anticipated they would. Coupled with this, what we are also witnessing, and witnessing it big time, is demand destruction. Whether we like it or not, the fact remains that our take, a back of the envelope calculation tells us that almost 1.5 lakh tons of per month demand for edible oil has actually evaporated. So all these things are keeping a lid on the prices. And that, I think, most of the factors, whether it is the Hormuz blockade or it's the El Nino, they've all got factored in the prices which we are seeing as of today. So I think prices would probably remain elevated, but to think that they will go in the stratosphere in the near future, I don't subscribe to that view. Yep.
Mr. Hussain, what is your sense on that? Demand destruction on one side and the fact that the input costs have been on the higher side as well. And as Iman before break was telling me that this is a different kind of a demand destruction. This is forced on us.
Yes. So before that, I would like to mention that as far as the farmers are concerned, there is no increase in the price of urea. They will continue to get a bag of urea at 266 rupees. So it is the government which is going to bear the burden of very high cost of imported fertilizers. Now, as far as demand destruction is concerned, you see there are several states in India where urea consumption is much higher than the recommended dose. So possibly, if the government musters the courage to reduce the movement of urea to those states, for example, Punjab, Haryana, UP, Bihar, and increase the supply of urea to those states where the consumption per hectare is less than the recommended level, then I think it will be a good use of the circumstances. But I do not know whether this will be politically possible or not. Now, as far as demand destruction of other commodities is concerned, I do not think that in case of food, there is going to be any significant destruction of demand because in India, a large population still consumes, less than the recommended quantity of proteins, etc.
Mr. Chaturvedi, I was speaking to somebody, an official really, and the point put forth was that 56% of India is now irrigated, but 44% is not, and that is where the concern comes in from.
So I was reading an article by Mr. Siraj Hussain a couple of weeks back, and what he said was that India has not, it is not the first time India is going to be facing El Nino. India actually faced El Nino in 2014-15 and 15-16 as well. And at that point of time, India's gross irrigated area was something roughly about 96 lakh hectares, 96 million hectares, which has now grown to about 122, which is a significant change. And secondly, this time the talk about El Nino and all has been happening for quite some time. So I think as a country, we are much better prepared to face the El Nino. And secondly, we also don't know what is the spatial distribution going to be. My take is that the rain-fed areas like oilseeds and pulses, they could be affected a bit, but bigger problem would be the next year's Rabi. And Rabi is important from our perspective because that is a mustard and a wheat crop period. So my take is that I think the worst as far as the prices are concerned has already got factored in. And now what we are seeing is a massive demand destruction, whether it be edible oils or whether it be sugar, whether it be other things. At the ground level, we are not seeing, and this is also getting reflected in the imports. In fact, the imports have not gone up. In fact, last month, which is April, our imports have been only about closer to about 11 lakh tons or 1.1 million tons. And palm oil, in spite of whatever they are pricing themselves out with biodiesel mandates and this and that, so palm oil imports have also come off quite a bit, whereas soybean oil has not gone up that much. In fact, now you'll be surprised, soya and palm oil are more or less at the same level.
Similar levels.
Yeah.
Oh, yes, yeah. But I just want to take that point back to Mr. Hussain then. Mr. Hussain, we understand this is not the first El Nino, but it is the worst in or the strongest in 3 decades. Does that bother you?
You see, in 2015-16, I was the Secretary Agriculture, and there was a real deficiency in monsoon. So we are surely better prepared. And I do not think there should be much cause of concern because now there are several varieties of various crops which are drought resistant, which have been released in recent past. If these varieties actually become available to farmers, then I think the yield may not be very much lower. You know, what should really worry us is the continuation of US and Israel aggression against Iran, due to which Hormuz is closed and imports are not taking place. And our exports are also very badly affected.
Sure.
You know, that is a real cause of concern. So a friend has just returned from Salem in Tamil Nadu today only, and he has written to me that mango crop cannot be exported because of this closure of Hormuz.
Oh, yes. I just want to go back to the biofuel mandate as well, because that really seems to be impacting the food part of it. And I know Mr. Hussain has always been against food into fuel. But Mr. Chaturvedi, I was reading a report which says 60 countries are now working on renewables, advanced biofuels and etc. India, one of them, of course. But the way we've been looking at mandates being, put forth, accelerated, whether it's from Indonesia, Malaysia, Argentina, US, etc., India wanting to do it as well. Are we looking at a concern going forward? An El Nino year, biofuel mandates, Indian rupee declining. What are we getting into?
So I don't think we are getting into, but the fact remains that the energy security as far as India is concerned has been compromised big time, just as our edible oil security has also been compromised. So India will necessarily have to look at all options which can possibly bring down a semblance of Atmanirbharta as far as energy is concerned. And biofuels is one such sector. In fact, my take is that they should actually concentrate big time on diverting sugar cane juice into ethanol big time, and if required, import the sugar, because sugar values in the world are pretty low. and it's available in plenty. There's absolutely no issue on that front. As far as maize is concerned, maize, whether we like it or not, is going to be taking away land from soybean or maybe pulses as well. And the maize farmer is getting very good returns. So I think we have no other option but to go in that direction as a country. And I think India has done a sensible thing in the sense that they have now put across the draft rules for EVs and 100% biofuel and 85% biofuels. So going forward in the next 3 to 5 years, I think most of the nations would actually start implementing, and our dependence on fossil fuels, whether we like it or not, is going to keep coming down as we go forward.
All right, so there's just so much to watch out for. Of course, the West Asia conflict is one thing, and as a point Mr. Hussain made, that import and export is one area that seems to be impacting not just the exporters and importers, but the farmers as well, because a lot of agri-produce is not able to go. Biofuels, of course, is yet another full thing to watch out for. Indian rupee, another one. El Nino and weather is something that we'll be looking at. So agriculture as an area is going to be quite interesting, important to watch out for as we move ahead from here. But gentlemen, thank you so much for joining in and putting across so many more further points, valid points to ponder on. With that, that's all the time that we have on Commodity Champions. Thank you for watching.
Hello and welcome to News Center. I am Ashmit Kumar. Now, the BJP is in a huddle after securing a landslide 2/3 majority and ending Mamata Banerjee's 15-year reign in West Bengal. Home Minister Amit Shah has been appointed as the central observer for the legislative party leader election. BJP's state president has said that the new government will be sworn in on May 9th. Now, this is the first time that the BJP would form a government in the state. In what was a comprehensive performance, the party made significant inroads into TMC bastions of Howrah, Hooghly, Kolkata, North and South 24 Parganas. Now, the TMC, which has been reduced to 80 seats, failed to open its account in several North Bengal districts. Chief Minister Mamata Banerjee lost to BJP's Suvendu Adhikari by a margin of over 15,000 votes in her home turf of Bhabanipur. Addressing a press conference a short while back, a defiant Mamata Banerjee refused to concede the election and refused to step down as Chief Minister. Flanked by party members Abhishek Banerjee and Derek O'Brien, Mamata Banerjee alleged that she was physically attacked at the counting centre yesterday. She accused the BJP of stealing the mandate and termed the Election Commission as the real villain.
কেন কিসের জন্য আমরা তো হারিয়ে নিয়ে যাব হারলে আমি যদি শপথ দিতে যেতাম তাহলে আমি রেজিগনেশনটা করতাম এখন তো কোশ্চেন ডাজন্ট অ্যারাইজ জোর করে দখল করে যদি কেউ মনে করে যে আমি কি রেজিগনেশন দিতে হবে নো নট দ্যাট নাও অলসো আই ওয়ান্ট টু সে দ্যাট we didn't lose the election. It is their forceful attempt to defeat us. Officially they may, through election commission, can defeat us. But morally I am telling you that we won the election.
Well, from West Bengal to Tamil Nadu, actor turned politician Vijay has disrupted the traditional bipolar nature of Tamil Nadu politics with a historic political debut. A day after emerging as the single largest party in the state, Vijay met the governor and has staked the claim to form the government. The TVK won 108 seats, I beg your pardon, to defeat both the DMK and the AIADMK. Now, that's just 10 seats short of the 118 figure required to form the government. So this means Vijay will need to reach across the aisle to cobble together the required numbers. In a letter to the governor, Vijay sought 15 days to prove majority. Vijay rode a wave of charisma and welfare pledges to reach the seat of power in Tamil Nadu. But delivering on those promises could pose to be an immediate fiscal challenge. Estimates suggest that an additional 42,000 crore rupees will be required in the first year to make good on these promises. Tamil Nadu's economy has grown between 8 to 11% since the COVID pandemic. That's one of the strongest growth rates among any of the states in the country. Now, it has paid for this with a persistent revenue deficit and rising debt levels. The state's fiscal deficit is already projected at 1.22 lakh crore rupees, which is around 3% of the GSDP for 2026-27. So how can Vijay balance his promises with progress? And will this weigh on Tamil Nadu's growth and fiscal deficit? These are questions that many now are asking, even as the dynamics post the election begin to unfold in the state of Tamil Nadu in Chennai as we speak. And to help us understand some of these dynamics is with us Nanda Kumar, political analyst. Also joining us is Professor Karthikeya Batra, assistant professor at Azim Premji University. And also with us, senior journalist Shabir Ahmed, joining us live. Mr. Ahmed, let me come to you first. Let me get your perspective. Just a broad overview at first. Is this the end of the Dravidian duopoly as we know it since 1967? Or is it, as anticlimactic as it may sound, just a minor road bump perhaps for the duopoly going forward?
Ashmit, thanks for having me, and happy to see you after a very long time. And Ashmit, as you know, you have worked in Chennai. So, writing off DMK and AIADMK is something which is not so easy. So one should understand that both the parties, both the Dravidian parties, the DMK and AIADMK, they still hold considerable amount of sway in Tamil Nadu politics, considerable amount of ground in Tamil Nadu politics. So it's a temporary setback for both these parties. But as far as the DMK is concerned, the numbers are not so bad. In fact, the chief minister has lost from his Kolattur constituency. In fact, he contested for the fourth time from that constituency. And 15 other ministers along with the chief minister have lost from their respective constituencies. Yes, the mandate is completely against the misgovernance of the DMK, anti-incumbency factor that has played a major role in these electoral results, and also the kind of fatigue that both these the kind of fatigue that prevails against both these political parties, DMK and the IADMK. So I think people, when Vijay launched his political party, people saw him as a refreshing change. But it all depends on how Vijay delivers his promises. Like you said, you have listed out the numbers here. So if Vijay is able to fulfill those promises, if Vijay is able to provide everything that he has promised in this election, then probably things will be much more easy for him to go for a re-election or to convince the people. But as far as Dravidian parties are concerned, they still have a larger say in Tamil Nadu. So I wouldn't write off both the DMK and the IADMK at the moment.
Sure. Mr. Kumar, Nand Kumar, let me come to you again. Before we dive into, of course, what the work will go into as far as government formation and then the subsequent governance of the state is concerned, we'll come to that. But before that, when you look back at these elections, 2026, Tamil Nadu, do you see this as a vote for Vijay, or do you see this as a vote against the existing Dravidian parties, the incumbents?
There are two major factors, Ashmit. One is Vijay's wave, and the second one is anti-incumbency wave. And the current ruling government, DMK, they wanted to carpet the anti-incumbency, but we have been telling them how much is the severity of anti-incumbencies among the public based on the promises, unfulfilled promises, and also all the government employees, because DMK government has earlier promised bringing back the old pension scheme, but they have brought in one called PLAPS, which is worse than the current CPS. And also there were a lot of protest by the contract employees, teachers, and also the workers. So the people were not so happy with the current government, but they wanted to manage that and they wanted to carpet all those things. And another thing is the law and order issue, because in Tamil Nadu we didn't have the regular DGP. So a DGP in charge has come, and for that DGP in charge and another DGP in charge has come. So the law and order was not so good, because of which the drug menace are so very bad in Tamil Nadu, which has led to the woman safety and also the child abuse also, and especially this ganja. So there were so many factors combining together, and once that is added with Vijay's wave, so it has gone like tsunami, which has no party in Tamil Nadu since independence. For the very first time, the party registering the highest vote percentage of 35% is the Tamilaga Vetri Kalagam. They have made the history. And also, if you take the DMK history, the earlier leader of DMK, Mr. Kalaignar Karunanidhi, has never lost an election. But this time, Stalin himself, he has lost, and he has been defeated by his earlier colleague, Mr. Babu, who was DMK MLA in 2006. And he has joined TVK very recently before the announcement of candidate. So he could able to defeat Stalin, because there was a tagline in Tamil Nadu which was highly propagated that Stalin is more dangerous than Kalaignar. So that was the tagline, and that was the video propaganda campaigning, everything. It was revolving around Mr. Stalin. He was the poster boy, and every single campaign was revolving around Stalin. And he himself has got defeated, which means that the public has not accepted the last government. And there were a lot of anti-incumbents.
Falling out of favor.
So,
Right, so a lot of anti-incumbency falling out of favor as far as the voters of Tamil Nadu are concerned. But let's look at the brass tacks now. Professor Batra, let me come to you. TVK stands at 108. They are short by 10 seats of that magic figure of 118. How do they go about putting together this alliance? Is the AIA-DMK an option for Vijay? Vijay has called himself to be a leading this, what he calls as a secular front. He himself, of course, is a Christian, so he'll want to pander to that side of the aisle as well. So can he approach the AIA-DMK with the BJP coming in alliance? Or will he look to stitch together some kind of patchwork of alliance with some of the smaller parties, the Congress, the PMK, the VCK?
I think Ashwin will be the latter because, having fought the entire election against the duopoly of the incumbent parties, DMK, AIA-DMK, I think it will be risky for the TVK to now approach them for an alliance. A, that it may not sit well with their own voters. B, if at all they did in a hypothetical world, just imagine the kind of power equations it will lead to. You think that Udaynidhi Stalin will want to work as deputy CM under Vijay? MK Stalin has lost the election, so there's Udaynidhi Stalin who's the next kind of successor. Let's look at the other side, the AIA-DMK. Would EPS be happy to work as a deputy to Vijay or not be a part of government? Would Vijay want to concede the CM's position for either of the two? Of course not. So it just looks very difficult for any of the two major Dravidian parties to ally with the TVK, and that the same goes the other direction as well. I think what you referred to at the end makes more sense. Luckily for Vijay and luckily for some of these smaller parties, they have 2 MLAs, 1 MLA. In the case of Congress, there are 5 MLAs. PMK has 4 MLAs. That is a more plausible idea. And I think the Congress, having missed this morning's meeting, if what I'm hearing is correct, with the DMK, it is possible they may be rethinking their alliance strategy, although that then jeopardizes the India alliance in Delhi. So I think that remains to be seen. As far as PMK is concerned, they may have been a potential ally, but again, one comment that I've heard from Tamil Nadu, which makes sense, is that given the 1-year SC lack of compatibility, would the TVK want to risk that kind of an alliance in northern Tamil Nadu? So I think, but still, they have 4 left MLAs, they have 2 IUML, I think 2 VCK, 1 AMMK, 5 Congress. There's enough kind of MLAs to fish from, I think, and if they give them a fair share of power, they might want to come across. Although, again, from the rest of the alliance with the DMK, all the alliance partners apart from Congress, at least as of now, are saying that they're committed. But to answer your question, I think TVK would want to form a patchwork and kind of see how things go. Because right now, touching any of the major parties might not sit well with their own established kind of vote base. I might just add one more thing, Ashwin, quickly before we move on to the next question. Although TVK is at 107, what is very interesting mathematically in this election is that the DMK plus is at 30% and the AIA-DMK plus is 27%, 52 seats. Essentially, what we have seen is a bipolar polity turning into a tripolar polity. And so therefore, even with a 34% vote share, the TVK seems very close to government formation. I think a lot of the exit polls were assuming that the AIA-DMK's collapse would have been much sharper, but that does not seem to have happened. And that is the result why you've had this kind of fractured mandate with TVK having zoomed ahead. It has eaten into both the AIA-DMK's votes as well as the DMK's votes.
Sure. I'll just come to Mr. Ahmed for a quick question before we slip into the break. If the TVK is to go for this patchwork of an alliance, even putting together all the numbers of all the parties minus the AIA-DMK and the DMK, there'll only be a couple of seats more than what the figure they need, which is 118. They'll probably maybe stretch it to 120, 21, even if they get all the remaining parties put together. Will that lend to greater instability? Again, these are first-time MLAs coming to power. The understanding is they may be vulnerable to inducements, to pressure. Will that be an unstable government that you're looking at, which is just about managing to hit that majority figure?
Well, Ashwin, what Vijay has managed to, achieve is something historic, something unprecedented, something that has never happened in the past 50 years. But the challenges that lies ahead for TVK Chief Vijay is even more, it's huge because one, the party lacks any kind of experience in administration. There are a few senior leaders of TVK who know what administration is. Having said that, the one thing that the party is confident is about at this point in time is that they can pull it off. They can manage the numbers. They can get the party. They can cross the magic number is what they are pretty confident about. And one more thing that many analysts and many journalists are missing at this point in time is TVK would never go for, TVK will never ask for support from AIADMK, which is backed by the BJP, because that means it's indirectly opening the doors for the BJP. So TVK would not like BJP trying to, play a role in their government, directly or indirectly. Having said that, there is also one more thing that why I agree with Karthikeya is that if you align with CPM, if you align with VCK, if you align with Congress Party, then there is some sort of continuity. What binds all these parties together is a common minimum program that they are all against anti-BJP. So this will be a new anti-BJP front in Tamil Nadu. So far, it was led by the DMK. Now it will be led by the TVK. I think that's the only thing that will bind all these parties together, that will, bring some kind of common agenda so that all these parties can come together.
Well, it's interesting how you put it, a common minimum program between these parties to oppose the BJP. But that's on that note, let's slip into a very short break. We'll continue these conversations with our panelists on, again, the road ahead for Tamil Nadu as well as for Vijay, the TVK, on the other side. Welcome back. You're watching Election Exchange. I have with me a distinguished panel, Nand Kumar, political analyst, Professor Batra, assistant professor at the Azim Premji University. Also with me, senior journalist Shabbir Ahmed. Professor Batra, let me come to you. We were just discussing how whether the TVK alliance with some of these smaller parties could be vulnerable to inducements. Again, Tamil Nadu not being any stranger to resort politics. But speaking of headwinds, here's another one. He's made lavish promises as a part of his manifesto. Now, it's one thing to make those promises pre-election, but now, of course, as the leading party, he'll have to square with, he'll have to reconcile with some very hard numbers. The assurances that he's given, 2,500 rupees monthly aid for women, 8 grams of gold for marriage support, 6 free LPG cylinders. The initial estimates say 42,000 crore rupees. That's the kind of figure he'll be looking at in the very first year. Can he deliver? on these promises? And if he is not, will that cause some amount of discontentment within the voters?
And I think this is where what Shabir was saying, the experience in governance will come into the fray, right? So, Ashmit, this is a business channel, so your audience understands the idea of marginal utility, right? So, think about this. There are certain elements in this particular manifesto which are a continuation or an augmentation of existing policies. Is that the charm because of which the TVK has been brought to power? I don't think so. I think they would place higher weightage, or they should place higher weightage on the novelty factors in their manifesto. So what are those novelty factors? Are there promises of jobs for the youth? Are there other promises that previous governments have not made? If they're able to deliver only on a handful of those, I think that's not a bad start. And you're absolutely right. A lot of this may not have been the most math-savvy calculations that they have put in. But given the fact that they have a 5-year window to deliver on these promises, and they have not set any criteria yet. So there are other creative ways of doing it that, you promise 2,500, but then you say we'll give it to only this category of women first and then that category. So all that can be managed eventually if you just want to satisfy the narrative that I delivered what I promised. But from a perspective of the voters, the newness that the voters are expecting is that this will not just be continuation of what was being given to us. This is going to be a disruption. So in the sense of being disruptive, what are the new things that you are talking about which previous governments have not talked about? Can you deliver on those? And if we can deliver on just those in the first 2-3 years, or maybe the first 2 years, or seem to be delivering on those rather, I don't think that will be a bad start.
Interesting bit of advice for the TVK as they head into government formation. But Mr. Ahmed, coming to you, Tamil Nadu is one of the most heavily industrialized states in the country. We've seen the auto sector, the electronic sector bloom as far as Tamil Nadu is concerned. And that is on account of generous support that the government has given, whether that's capital subsidies, interest subsidies, cheaper electricity, access to land. Is there a concern, or should there be concern? We've not heard a lot from TVK regarding its industrial policy or regarding its vision for the private sector. Is there a fear, apprehension that perhaps he may look to finance some of his social welfare schemes by pulling off benefits that they have been extending, that the governments have been extending to the private sector, to the industries?
See, to answer your question, there are some immediate priorities that the TVK is looking at the moment. Immediately after assuming charge, they would want to make some kind of changes with regard to how the law and order machinery is being controlled, how the police machinery is being controlled. Because law and order has been a major concern, women's safety has been a major concern, the drug menace has been a major concern in Tamil Nadu. And these were all the campaign planks, something that resonated with the people. So I think on those fronts, Vijay will be able to deliver. Vijay's focus will be to ensure that something has to be done to ensure that these promises are fulfilled, or at least there is a sense that these issues are being addressed by the new government. So I think that will be the first and foremost priorities of the new government. As far as policy decisions are concerned, with regards to industry or IT industry, I think it is going to be a continuation. I don't see a drastic change in any of the policies, because whatever the industries department or the information technology department has achieved in Tamil Nadu is not something that the DMK has created. It has been a continuous process. So several governments in the past have been following the same pattern, and they have infused new ideas into it. They have improvised these policy decisions. So I think Vijay will also continue that trajectory, because the bureaucracy in Tamil Nadu is strong. So I think there are good bureaucrats in the state who will give Vijay a sound advice. And I don't think Vijay wants to change everything. What Vijay wants to do is, he wants to limit the amount of corruption that's taking place, the manipulation that happens during giving away contracts or tenders. And he wants to present a clean government. So I think that's his idea of governance, of good governance. So I think he has been stressing upon 3-4 things. One is a clean government. a government with integrity. He wants his ministers to behave. He wants his ministers to be more attentive to the cause and concerns of the people. So I think these are the issues that he is looking at, to address immediately. So I think there is not going to be any change in the policy. There is not going to be much of a concern for the industrialists or for people from the business industry, because you cannot change everything overnight. You can bring about a change, but that should be a gradual move.
Sure. Mr. Nandkumar, we're running out of time, so I'll come to you for a quick closing comment. The rise of TVK coming at the expense of the DMK, what does that do to the anti-BJP, the India alliance? What happens to them now with the rise of this new figure, this new power out of Tamil Nadu?
This will change the alliance dynamics in Tamil Nadu because Congress, they have been with DMK for a long time. After 2001, they have been with DMK. And now they will be eyeing to go with TVK, because before this election also, they were trying to have all the alliances with TVK. But because of the too much of interference from the Tamil Nadu State Committee, they couldn't go ahead. And now, after this, politics is an art of possibilities. No, when you talk about how Vijay will be arriving at the numbers of 118 or 120, Congress will be the first option, because not only making the TVK to be to the chief ministership, but also then in the near term, there is a rural body election is awaiting. So now there is a Vijay wave, and whichever the party is aligning with Vijay, definitely they can have a great winning possibilities in the local body. And also 2009, it is just 3 years from now. So Congress is very much keen in looking at Vijay as an alternative to that of DMK, because they have been not they have been in alliance for more than 25 years, and now they are not in a great alignment. So they also wanted a new party, and especially majority of the Congress people in Tamil Nadu also wanted to rejuvenate the party in Tamil Nadu, coming up as one of the primary force or the secondary force in Tamil Nadu, which they can achieve only through a new coalition partner, not through the DMK, because their philosophy is that they never share power with any parties. That is their philosophy. But as far as Vijay is concerned, even in his first political conference itself, he has announced that he is ready for power sharing. So that will be attracting the new alliances going forward.
Right, Mr. Kumar, it's been a pleasure speaking to all of our panelists, Mr. Kumar, Mr. Batra, as well as Mr. Ahmed, for sharing your insights. Again, no easy choices at this point, but it's interesting to see how Vijay chooses to go about government formation. Of course, he has staked a claim before the government. We'll, of course, continue to stay on top of these developments. I beg your pardon, he staked his claim before the governor. But thank you once again to all of our panelists for sharing your time and perspective. With that, it's a wrap on this special broadcast. Thank you so much for watching. For more news and updates, stay tuned to CNBC TV 18. Hello and welcome to Business 360. I am Ashmit Kumar. Here are the headlines that we're tracking this evening. Fresh attacks in the Gulf threaten the fragile ceasefire between the US and Iran. President Trump blames Iran for the attacks on the UAE. US claims to have struck 7 Iranian speedboats. The Speaker of Iranian's parliament has warned the US, said that we have not even begun yet. Crude oil prices whipsaw after the fresh escalation. Sensex and Nifty decline in trade even as mid-caps outperform. Nifty manages to stay above 24,000. Rupee sinks to a new low of 95.40 against the dollar before recovering some losses. A defiant Mamata Banerjee refuses to step down as chief minister, says question of her resigning does not arise as her party had not lost the elections, alleges that she was physically assaulted. BJP in a huddle after historic Bengal mandate. State chief has said that the new government will be sworn in on Saturday. Vijay formally stakes claim to form the government in Tamil Nadu a day after his party emerged as the single largest. Seeks 15 days from the governor to prove majority. TVK is 10 seats short of the halfway mark. M&M beats estimates in Q4 thanks to strong volume growth. Revenue rises by 29% even as margins contract. Management expects annual contracts in SUVs and tractors to be higher than estimates. Well, U.S. Secretary of War Pete Hegseth is addressing a press conference. Let's go across to Pete Hegseth speaking to the media.
We know the Iranians are embarrassed by this fact. They said they control the strait. They do not. So American ships led the way, commercial and military, shouldering the initial risk from the front, as Americans always do. And right now, hundreds more ships from nations around the world are lining up to transit. CENTCOM, along with partner nations, is in active communication with hundreds of ships, shipping companies, and insurers. All of these ships from all around the world want to get out of the Iranian trap that they have been stuck inside. As a direct gift from the United States to the world, we have established a powerful red, white, and blue dome over the strait. American destroyers are on station, supported by hundreds of fighter jets, helicopters, drones, and surveillance aircraft, providing 24/7 overwatch for peaceful commercial vessels, except Iran's, of course, which is why our ironclad blockade remains in full effect as well. In fact, 6 ships tried to run the blockade out of Iranian ports as Project Freedom commenced, and they were all turned around. This is more than strategy, it's also humanitarian. By breaking Iran's illegal stranglehold, we're protecting the lives and livelihoods of sailors from dozens of countries, securing global energy routes, and preventing shortages that hit the world's poorest people the hardest. Once again, America is using its strength to lift up others. Iran is trying to subjugate the world. To what remains of Iran's forces, if you attack American troops or innocent commercial shipping, you will face overwhelming and devastating American firepower. The president has been very clear about this. We prefer this to be a peaceful operation, but are locked and loaded to defend our people, our ships, our aircraft, and this mission without hesitation. To Iran, let innocent ships pass freely. These international waters belong to all nations, not to Iran to tax, toll, or control. To our partners, allies, and the rest of the world, this is a temporary mission for us. As I've said before, the world needs this waterway a lot more than we do. We're stabilizing the situation so commerce can flow again, but we expect the world to step up. At the appropriate time and soon, we will hand responsibility back to you. To the incredible Americans executing this mission right now, simply thank you. Your courage, your readiness, your unmatched professionalism and precision are why the world can breathe easier today and every day. You are and always will be the greatest fighting force in human history, unmatched always. Project Freedom is underway. Commerce will be flowing, And America is once again leading with strength, clarity, and purpose for the benefit of the entire world. Our will is unshakable. God bless our troops, and God bless the mighty United States Navy as well. Mr. Chairman, over to you.
Thank you, Mr. Secretary, and good morning, everyone. Thanks for being here. On Sunday, at the direction of the President, CENTCOM initiated Project Freedom with the objective of facilitating the safe passage of international commercial shipping through the Strait of Hormuz. Over the past 7 weeks, Iran's repeatedly threatened and attacked commercial shipping in the Strait in order to effectively cut off commercial traffic and damage the global economy. By obstructing one of the world's most critical maritime checkpoints, a vital transit route for approximately 1/5 of the global oil consumption, Iran is weaponizing the global supply chain. This action disregards established navigational rights and the law of the sea, and the regime led by the IRGC is effectively attempting to hold the entire global economy hostage. Let me give you an update of the last few days of activities, and if you take a look at the map here, as the Secretary said, the United States has established Project Freedom to open up the Strait of Hormuz. This graphic highlights the kinetic engagements that the Iranians have attempted to make or have taken against the region. The green dots and blue dots show the groupings of commercial, cargo, and tanker vessels. And the United States has established a significant presence over the strait here in order to open up the free flow of commerce, noting the blockade still continues along the eastern flank. The map shows the examples and samples of Iranian attacks against commercial vessels in the strait, as well as the Gulf of Oman and up in the Arabian Gulf. Since the ceasefire was announced, Iran has fired at commercial vessels 9 times and seized 2 container ships. And they've attacked U.S. forces more than 10 times, all below the threshold of restarting major combat operations at this point. You can also see the group of tankers and cargo vessels in the U.S. blockade line, as I mentioned. As a result of Iran's indiscriminate attacks across the region, there are currently 22,500 mariners embarked on more than 1,550 commercial vessels trapped in the Arabian Gulf, unable to transit. In addition to shipping, Iran has continued to deliberately attack its neighbors. Just yesterday, Iran attacked Oman once and the UAE 3 times, including an attack on Fujairah oil terminal, which was successfully defeated. They also launched cruise missiles, drones, small boats at U.S. forces defending commercial shipping in the Straits, and United States Navy MH-60 helicopters and Army AH-64 Apache helicopters successfully defeated those threats. Thus far, today is quieter. Let me describe this defensive operation just a few clicks down for you. As the Secretary said, Project Freedom is designed to protect commercial shipping and help restore the flow of commerce through the strait and sustain freedom of navigation. CENTCOM has established an enhanced security area on the southern side of the strait that is now protected by U.S. land, naval, and air assets to help defeat further Iranian aggression against commercial shipping. I'd like to share a little bit more about U.S. capabilities, but for operational security purposes, I'm not going to get into specific details out there. On the surface, guided missile destroyers and other warships are detecting and defeating Iranian threats. This includes fast boats and one-way attack drones. In the air, more than 100 fighters, attack aircraft, and other manned and unmanned aircraft synchronized by the 82nd Airborne Division are in the air 24 hours a day, providing defensive overwatch for the enhanced security area and its approaches that I discussed. These forces are comprised of over 15,000 American service members and have established localized air and sea control to protect against Iranian threats. Commercial vessels that transit through the area will see, hear, and frankly feel U.S. combat power around them on the sea, in the skies, and on the radio. And as of this morning, as was mentioned prior, 2 U.S. flag merchant vessels have transited, and we anticipate more to transit over the coming days. Further up the Gulf, U.S. Naval Forces Central Command continues to work to identify and mitigate any threats. Beyond Project Freedom, CENTCOM and the rest of the Joint Force remain ready to resume major combat operations against Iran if ordered to do so. No adversary should mistake our current restraint with a lack of resolve. And the President has said, as the Secretary has, that now is the time for those with equity stake in the strait to come assist. Before I turn it back to the Secretary, I want to take a moment to highlight part of our joint force today. And today I want to talk about the paratroopers of the United States Army 82nd Airborne Division. When the President or the Secretary need immediate, scalable, and lethal combat power in CENTCOM or elsewhere, the All-American Division answers the call. The 82nd is the core of our nation's immediate response force and ready to deploy within hours of notice. These paratroopers are capable of accomplishing any mission in any environment, constantly training, constantly ready to jump from Air Force aircraft into ground combat and seize key terrain if ordered to do so, just like their predecessors did in Sicily and Normandy in World War II.
Welcome back. Now on to the day's market action. The market ended largely in the red, but off the day's lows. The Nifty closed below the 24,050 mark, backed by ICICI Bank, L&T and HDFC Bank. The mid-cap index outperformed and the Nifty IT emerged as the top gaining sectoral index. Well, the Indian rupee sank to a fresh low of 95.40 against the US dollar. The fall was due to a surge in crude oil prices and escalating tensions in West Asia. However, reports that the central bank may allow PSU banks to borrow via dollar bonds helped the currency recover some lost ground. Lata Venkatesh is joining us now with more details on the currency move. Lata, tell us, what is the big takeaway from the rupee moves like you saw them today?
But it started off like a more of the same day with crude prices going well over $110 per barrel and claims and counterclaims from Iran and the US about bombing of ships. The rupee obviously reacted to the crude prices, and along with several Asian currencies, it did touch a new low as as 95.40 per dollar in early trades. Of course, today the rupee was a little weaker than other currencies, other Asian currencies. Also, some of them were not trading today. The stock markets were not trading. But the FPI selling also added to the dollar demand. However, what came to the help of the rupee was not so much RBI providing dollars, but a story in Bloomberg saying, a story that appeared towards the end of the trading day, that the Reserve Bank may allow state-owned banks, like State Bank, Bank of India, Bank of Baroda, state-owned banks to raise dollars through dollar bonds abroad. Now, an influx of dollars will obviously mean, something that supports the rupee, and the rupee immediately shaved off its losses and ended a little more benign at 95.28. Still an all-time low, but not as bad as intraday lows. But it would be an interesting ploy if the Reserve Bank were really to allow Indian banks to go out and borrow instead of the Indian sovereign bond. This is a semi-sovereign going and borrowing. We have to see whether this idea actually works. CNBC TV 18 could not immediately reach the Reserve Bank to confirm the story.
We have seen the rupee and the dollar rupee and the current account deficit. And in that, whilst the energy piece has still not played out, but that's not fully in our control, it's not a short-term measure. But if I look at the non-oil trade merchandise deficit, that number has grown by more than 30% last year. And I think whilst the part of it is also because of the growth in some exports, particularly in electronics and others, but I think that's another number to watch.
Well, the BJP is in a huddle after securing a landslide two-thirds majority and ending Mamata Banerjee's 15-year reign in West Bengal. Now, Home Minister Amit Shah has been appointed as the central observer for the Legislative Party leader election. BJP state president has said that a new government will be sworn in on May 9th. This is the first time that the BJP would form a government in the state. In what was a comprehensive performance, the party made significant inroads into TMC bastions of Howrah, Hooghly, Kolkata, North and South 24 Parganas. Now, the TMC, which has been reduced to 80 seats, failed to open its account in several North Bengal districts. Chief Minister Mamata Banerjee lost to BJP's Suvendu Adhikari by a margin of 15,000 votes in her home turf of Bhabanipur. Addressing a press conference today, a defiant Mamata Banerjee refused to concede the election and refused to step down as the Chief Minister. Flanked by party members Abhishek Banerjee and Derek O'Brien, Mamata Banerjee alleged that she was physically attacked at the counting centre yesterday. She accused the BJP of stealing the mandate and termed the Election Commission as the real villain.
Hardly আমি যদি শপথ নিতে যেতাম তাহলে আমি রেজিগনেশনটা করতাম এখন তো কোশ্চেন ডাজন্ট অ্যারাইজ জোর করে দখল করে যদি কেউ মনে করে যে আমি কি রেজিগনেশন দিতে হবে নো নট দ্যাট নাও অলসো আই ওয়ান্ট টু সে দ্যাট we didn't lose the election. It is their forceful attempt to defeat us. Officially they may, through election commission, can defeat us. But morally, I am telling you that we won the election.
Well, from Bengal to Tamil Nadu now, where Vijay has disrupted the traditional bipolar nature of Tamil Nadu politics in his debut electoral outing. Outgoing Chief Minister Stalin and a dozen of cabinet ministers lost their seats. a day after emerging as the single largest party in the state with a 35% vote share. The actor-turned-politician met the governor and staked claim to form the government, with the TVK falling 10 short of the majority mark. Vijay would need to talk across the aisle to cobble the required numbers. In a letter to the governor, Vijay sought 15 days to prove majority in what is a mere formality. He was elected as the leader of the TVK's new legislative party. Well, switching tracks now from Tamil Nadu to Kerala, the Congress-led UDF alliance is also in government formation talks in neighbouring Kerala. The alliance stormed back to power in the state after a decade. The CPM-led LDF lost power, with 13 ministers losing their seats. Outgoing Chief Minister Pinarayi Vijayan won his seat, but with a reduced margin. There are reportedly 3 major contenders in the Congress for the CM's post. Leader of the opposition VD Satisan, senior leader Ramesh Chentarala, and Lok Sabha MP KC Venugopal are the frontrunners. Well, with the dust finally settling on election season, let's take a look at the fiscal impact of elections on state coffers and how it impacts them in the long term. Ritu Singh decodes.
Well, no two ways about it. State elections are becoming fiscal turning points. Welfare-led promises are central to elections, and that is changing how states are spending. An NK report shows that since 2023, election cycles have pushed up state deficits, with the fiscal deficit rising by about 1 percentage point in election years, and crucially, it does not come down after. What's more concerning is the stickiness of the spending. So revenue expenditure tends to rise during elections, and it continues to rise even after, reflecting the permanent nature of the welfare commitments, while capital expenditure remains flat. Now, layer on the scale of promises in the key states. So Tamil Nadu's pre-poll promises can add about 2.2% of GDP in extra spending. West Bengal can see an even larger hit of about 3.4% of GDP. And this is happening at a time when state finances are already under pressure. So West Bengal's fiscal deficit has remained at more than 3% for the last few years. Tamil Nadu is around 3.5%. Kerala at about 3.4%. Assam's last reported deficit again near 4%. So overall, aggregate fiscal deficit is tracking above budgeted targets at around 3.4% of GDP on average versus 3.1% that was budgeted. At the same time, borrowing cost is also rising, with SDL spreads widening to almost double the long-term average. Put all this together and the pattern will show you that the 3% fiscal deficit threshold, which was once seen as the ceiling, is effectively becoming the floor for states. So the signal is clear. State elections are pushing deficits structurally higher, spending is getting locked in, and capex is getting crowded out, and that will have clear implications for borrowing cost and, of course, the overall macro picture.
Well, Biocon founder Kiran Mazumdar-Shaw has said that her niece Claire Mazumdar will succeed her. However, she clarified that the transition will be gradual. Claire Mazumdar is currently the CEO of Nasdaq-listed Bicara Therapeutic. Ekta Batra has more. Ekta, what does this mean for the company now?
At 73, Kiran Mazumdar-Shaw, founder and chairperson of Biocon, India's largest biotechnology company, is thinking about succession. She has picked her niece, Claire Mazumdar, to succeed her. A 37-year-old biotech specialist who is currently CEO of Bicara Therapeutics, a Nasdaq-listed cancer therapy company that Biocon itself incubated. However, Kiran Mazumdar-Shaw has indicated she is not stepping away right away, noting in a post that Claire will move into her role at the right time and that she is not planning to hang up her boots just yet. So the transition will happen when it has to. But who is Claire Mazumdar? The credentials are formidable: a degree in biological engineering from MIT, an MBA from Stanford, and a PhD in cancer biology, also from Stanford. She cut her professional teeth at venture capital firm Third Rock Ventures before taking over as CEO of Bicara in 2018. Under her leadership, Bicara listed on Nasdaq in 2024 at a valuation exceeding $800 million and now commands a market cap of over $1.6 billion. This is when the company's lead cancer therapy for head and neck cancer is still in clinical trials. Biocon holds around 10% stake in the company. The family ecosystem adds further depth. Claire's brother, Eric Mazumdar, is a professor in the US and an AI expert. He serves as a non-executive director at Biocon. bringing technology expertise into the boardroom, say experts. Claire's husband, Thomas Roberts, is an oncologist in the US as well. The succession is happening against the backdrop of a significant restructuring. Biocon is fully integrating its biologics arm, Biocon Biologics, into itself, valuing the biosimilars business at around $5.5 billion and bringing biosimilars and generics under one roof. An important point also, Kiran Mazumdar-Shaw has always been emphatic about professional management. In line with that, Shreyas Tambe, who is the current head of Biocon Biologics, will lead the merged entity, while Siddharth Mittal moves to lead Syngene. So while the baton is likely to be handed carefully and in stages, one will have to see whether Claire Mazumdar, who has the credentials, can scale Biocon the way her aunt built it from scratch.
Well, with that, it's a wrap on this edition of Business 360. More news and updates will continue right here on CNBC TV 18.
Hello and welcome to the CNBC TV 18 special. I'm Shireen Bhan. The West Asia conflict is showing signs of an escalation. All of that is having an impact on oil prices. The currency continues to be under pressure. The stock market's under pressure too. What is the mood like in the India Inc. camp? Joining us now to discuss all of that and more is the President of the Confederation of Indian Industry, Rajiv Memani. Let me start by talking to you about the big event that is now out of the way, and that is the elections. We've got the results in West Bengal, a change with the BJP coming in, and of course the big surprise in Tamil Nadu with Vijay emerging as the king. Now, what it does eventually as far as these individual states are concerned is a different matter. But what does all of this mean, if anything, at a national level?
So I think the first thing at a national level is obviously, the state elections are now out of the way. So, hopefully, I think, in each of these states, there will be a clear vision, what will be the industrial policy, some of the projects that were stalled, how can some of those projects be developed. And hopefully that all these things, generally, Shireen, whenever you have a new government trying to address some of these issues, there is greater impetus on investments, there is more positive energy, greater job growth that happens. So I'm positive. I think these are positive changes, and hopefully it will catalyze more investments, more development, in some of these states.
You know, one of the other issues that industry bodies like CII have been asking for is a sense of urgency to move on pending reforms to push ahead on crucial decisions. We saw some decisions being taken, for instance, the Press Note 3 revision, which, by the way, isn't fully in execution at this point in time, even 50 days after the cabinet clearance. So, given the fact that the elections are now out of the way, what would you like the government to focus on with a sense of urgency?
So I think the government, Shireen, has been focused on a lot of these things. Obviously, they are right now grappling with an energy crisis, and I think that's also taking some bandwidth and energy and time away. So I think I would say, as we step back, I think before this crisis happened, we just had the GST reforms. The capex investment private sector capex investment was moving very well. GDP growth numbers were strong, much stronger than what people anticipated. Fiscal deficit was under control. Sectors like automobile and others were doing very well. So we entered this crisis through a lot of strength, and we had strong tailwinds. But to the credit of the government, the moment this came, I think at least in CII, we really experienced very active engagement with our various constituents and the government. And the government was active almost on a daily basis to try and address issues, particularly around availability of feedstock, of gas, of other energy-related products, and also trying to see how do we navigate the logistics and others, trying to address some of the issues that industry was facing, and also took some measures like extending RODTEP, the duty structures on fuel and others, packing credit and others. So we saw a lot of action which was more short term, and obviously one of the things when you look at any economy there's no doubt India is the fastest growing economy and will continue to be that for a period of time. But when you look at all those things, there are three components that come out very clearly. One is what's your resilience, growth and macroeconomic stability, and all on that I think India did very well. The other two areas were one to do with how are we doing on our overall autonomy, whether it's energy, whether it is on the overall dependence on global world. And as you become larger as an economy, from a $4 trillion economy to say a $10 trillion economy over the next 5 to 7 years, some of these things we have to be very mindful and very cautious about. So I think the reforms that the government now we are seeing engaged with are trying to address some of these issues. So our over dependence on some geographies, our over dependence on some routes, our the energy output not keeping pace with the energy consumption, and how can we alter? So how can we look at nuclear? How can we look at coal to gas? How can we ensure that solar becomes we have had fantastic growth in solar, in other renewable pieces, but how do we ensure that issues around transmission, grid balancing, availability of land, supply chain in some of these products are dependent. So I think a lot of conversations, policy notes that are being introduced around this. These are large projects. They have fiscal implications. There are new policies that are required for that. And I think the government has been working through this. I'm hopeful that we will see a lot of speed in some of these things because they are strategically very, very important for India. The second piece is around the issue that's come out through this is we have seen the rupee and the dollar rupee and the current account deficit, and in that whilst the energy piece has still not played out, but that's not fully in our control. It's not a short-term measure. But if I look at the non-oil trade merchandise deficit, that number has grown by more than 30% last year. And I think whilst the part of it is also because of the growth in some exports, particularly in electronics and others, but I think that's another number to watch. So how do we look at our import basket of manufactured products? What are those which can be done in India? What are the PLI schemes, incentive schemes, technology transfers, and other incentives or protection that needs to be given to industry to ensure that we reduce that amount? Because one is it leads to weakening of the rupee, but also from a strategic dependence standpoint, if you are looking at Atmanirbhar Bharat, I think it's very important that we look at manufacturing of these items, which are maybe our top 50, top 100 import items, and there is a small basket of products there, and also looking at our future demand that's going to come, whether it's going to come because of the investments that are going to happen in data centers, whether that's going to come because of the investment that will happen in the entire energy cycle, and whether our manufacturing is really equipped for that, and how do we prepare that. So I'm seeing a lot of policy work that is happening in these two areas, and I think I'm hopeful that the changes, whether it's the ISM2 that's coming out, whether it's the coal policy, coal to gas policy that's coming out, whether it's Shanti bill that's getting implemented, whether it's what we do on the value chains on solar and the PLI schemes that we are looking at, on the electronics manufacturing, how do we look at the component side. So there's a lot of activity. Some of these things have been cleared. I do hope that they have sufficient allocations for this, and then we move with speed and look at the right companies to select in that, so that we move with speed and these companies are able to implement some of these projects on the ground.
Right. You know, I want to talk about the rupee because you brought that up, as well as the impact as far as the current account deficit is concerned. But when you talk to foreign investors, when you talk to your global peers, you know, as part of the EY network, when you talk to your foreign clients, what are they telling you about the rupee? How uncomfortable is the rupee's depreciation making them feel about wanting to invest in India at this point in time, especially FIIs? And that has been the big worry, that has been the big challenge. In fact, the chief economic advisor saying that he believes that this is on account of the global allocation moving more towards AI, and when that starts to rebalance, the rupee should rebalance as well. But the rupee, how much of a concern is that today?
Yeah, I would say for more longer term investors, they look at what's happened in the last 5 years, 10 years. So if I look at the last 5 years, last 10 years, I haven't seen what, you know, I haven't done that exercise in the last 2 weeks, but the average depreciation would have been between 2 to 3%. And I think right now people factor that in.
In the last 2 years, it's been 13%.
Rate difference between.
In the last 2 years, it's been 13%.
I'm looking at last 5 years, 10 years. But I agree. That's why I'm saying that this has been much sharper. But if I look at the last 5 year, last 10 year average, I think that's what it is coming to, Shireen. So I think the longer term investors are worried, but I won't say they are too concerned about it. But as a country, as an economy, I think we need to look at to try and see how we address that. I agree that there is a disproportionate allocation that has happened in some sectors, in some geographies. But not all currencies in the world have got impacted as much rupee has, particularly because of our vulnerability on energy and also because of our rising imports, non-oil merchandise imports. So I think what we need to do, I personally feel, is to have much greater focus on manufacturing, on ensuring that we are actually implementing the Atmanirbhar policy. We need to ensure that we get some of the large global value chain players, what we saw, the example that we saw in electronics manufacturing, on mobile phones. I think we need to get on an urgent basis, engage with the top 30, top 40, top 50 people, global value chain players. There are some very large players. We need to find a way that they set up in India, and whatever enablement that they require to be setting up in India, I think is very critical, because some of those structural flaws we need to address. The third is, I think we have to be much more proactive, deliberate in attracting FDI in India. Our FDI numbers have been increasing by 10 to 15%, but they're still 2% of GDP. I think we have to move it up to 3 to 4% of GDP to ensure, and a lot of that hopefully comes into for manufacturing, for building out some of the areas which are strategically important for India. And I think being more proactive, ensuring that we are getting all the clearances, having an empowered group that can help in getting all the clearances, land approvals, environmental approvals, at a much more rapid pace and much more transparently, openly. I mean, some of the best examples that we see in other parts of the world, I think we need to implement. Some of the states have done a remarkable job in this, in attracting FDI in those states. I think we need to see how we can implement that at the central level. I think we need to address these three things at a very rapid pace to ensure that, you know, at least some of those things will happen. Now, some correction will happen as oil prices stabilize, as the war stabilizes, as the AI investments stabilize. But I think those are things that are honestly not fully in our control. I think we also need to address things that are in our control, and how do we look at that. And I think the government is focused on that. My only request would be that if we can execute with greater speed, I think that will be helpful in addressing some of those issues.
Let's talk about the impact of the West Asia conflict, and all indications are pointing towards an escalation at this point in time. Rajiv, what kind of pressure are we seeing on input costs? We've seen many sectors, many companies across different sectors announce price hikes. We still haven't seen a price hike as far as fuel is concerned. What are the cost pressures that industry is grappling with today, and what are you bracing yourself for?
I would say any industry that has fuel or is consuming raw material or products which has fuel as a feedstock, either directly or indirectly, I think that those industries we are seeing pricing pressures on, and that covers a broad swathe of industries. So I think definitely there is pressure on raw material prices. There is pressure partly because of the energy, increase in energy cost, the weakness of the rupee. I think there is pressure on that, and I think that some of it will start, the end products of some of the products will start moving up. We still have to see what the real impact on demand is. From whatever we have seen in some sectors, still the impact, the demand is still strong, numbers are still are going through, but I think at some stage, if this continues for a longer time, this may have some impact on demand. I think because of inflation and other things, there could be some impact on demand. But I feel confident, Shireen, that once the crisis settles in, and whenever it is very hard to predict whether it will take a few weeks or a few months, but whenever it settles, whenever the crisis closes, it will take 2 to 3 months more to normalize because of the logistics, the transport. Also, some of the capacity has been taken out, whether it's 15% of LNG capacity in Middle East or 10 to 13% of the oil capacity that's been taken out. So as we see the rebalancing of that happening, and also we have seen some fractures in some of the agencies like OPEC and others. Once the impact of this is known and things settle down, which may take 3 to 4 months, I think the growth momentum will come back in India. Because as I said, the balance sheets are still strong. The growth, the IMF projections on growth And otherwise also what we are seeing on the ground is there. Private sector investments are happening. Some of it may have slowed down in the last few months, but if I look at the last 12 to 18 months, there's good momentum that is there on investments, and hopefully once capital markets come back, we will see the momentum in the economy come back.
You were talking about corporate balance sheets being strong, and even though it is an uncertain and volatile global environment, we've still seen some pretty large deals go through, Sun Pharma being one of them. Do you believe that the ambition and the appetite for more outbound deals is strong, and this might be the best time for India Inc. to go shopping?
I would say there is great appetite for investment in India. It's very sectoral, Shireen. So I would say if you're in manufacturing, if you're in infrastructure, if you're in the energy transition space, if you are on the chemicals, automobile, EV, there is great appetite to look at investments in India. But in some sectors, I would say particularly in IT, particularly in pharma, where you're looking at both acquisition of technology and acquisition of markets, I think there we will see greater outbound momentum. But I still think that the disproportionate amount of capital will be consumed in investments in India. And I think it will vary company by company, it will vary industry by industry. And I would say in maybe IT industry, in pharma, you may see a greater trend towards outbound, or in some sectors like in semiconductors or in some parts of medical devices and others, to acquire technology or to acquire partnerships, you may see some of those investments happen, some of the outbound investments happen, but substantial capital allocation will still happen in India, in investments in India.
Right. Let me end by asking you, Rajiv, we have, of course, seen the government hike commercial LPG prices. 5 kg cylinders have also gone up. And all of this has had an impact as far as migrant labor is concerned. Anecdotal, feedback coming in suggesting that there is a shortage. People have gone back. What is the pulse check at CII on how significant a problem, a challenge, migrant labor availability is today?
Yeah, I think initially, the feedback that we got from our members, that initially there was a scare and you had people, going back to their states. Also, some of it was also because of the impending elections in some of the states. But I think now things are normalizing. I think a lot of those laborers are coming back as they have more comfort that the government, that there is no shortage in areas, particularly like LPG and others. So I think some of that stabilization of expectation is happening. I think, Shireen, I think the bigger issue is how do we look at skilling? How does corporate India, a partnership with academic institutions, in partnership with government, how do we look at skilling in a much more serious way? Because I think that's the best way. Right now, a lot of those demand-supply mismatch, yes, this was one event, but otherwise also the demand-supply mismatch that is happening as we are seeing scale up in investments, scale up in companies. I think this is one area where I think corporate India really needs to address, to see how do we address the issue of skilling, how do we address the issue of R&D. And then the third issue is, how do you balance between what is given out? We have massive income disparity. So how do we balance the issue of providing benefits to people who are in the lower income brackets, and how do we ensure that that doesn't disincentivize them to be looking at jobs and other things? So that's a very tricky balance to achieve.
Yeah.
I think till now we've done a very good job, and because of which availability is there, social unrest is not there. And I think how do we achieve that tricky balance is very, very important. So you talked about a short-term event. I think that probably is behind us. But as we look forward, the issue of skilling and the issue of balancing between the benefits that we are giving and how do we create the right incentive model for people to be being actively looking at work, actively looking at skilling themselves, I think that's also important.
Well, you're absolutely right. Of course, skilling is a long-term challenge that we need to address and grapple with. But it's good to hear that you believe on the back of feedback that you're getting from your members that there is a stabilization as far as the migrant labor situation is concerned. We had seen migrant labor move back to villages on account of the LPG shortage. You're saying that that is now starting to normalize. Rajiv Memani, always a pleasure. Many thanks for joining us here on CNBC TV 18 to take us through the pulse check of India Inc. on the back of the West Asia conflict and, of course, the electoral results that are now finally behind us. Appreciate your time.
Thank you so much, Shreya. Thank you.
Well, with that, it is time for us to take a break. There's a lot more coming up. Don't go anywhere. We're back in a moment with more.
Hello and welcome to Startup Street. I'm Shruti Mishra and with me are Arundhati Ramanan and Ritu Singh. These are the top headlines from the startup space. Health Fab, a menstrual hygiene startup, has secured 20 crore rupees from Atomic Capital. The funding will fuel expansion beyond period underwear into a comprehensive period care platform. The company aims to bolster its offline presence and invest in R&D, building on its 5 lakh user base.
Dream Sports has launched Dream Street, a new stockbroking platform designed to simplify investing for Indian retail investors, especially newcomers, leveraging AI for insights and offering access to research analysts. The platform aims to build confidence among those hesitant to enter the market.
Delivery has granted over 1 lakh stock options to employees under its ESOP 2012 effective May 1st. The options, exercisable at 1 rupee, will vest over 4 years, with a portion vesting after 12 months and the remainder over subsequent periods.
Amazon CEO Andy Jassy defends the proposed $200 billion AI spending this year, calls it a once-in-a-generation opportunity to drive long-term growth and returns, says investors are overlooking Amazon's history of investing ahead of demand, adds profits and cash flows will follow as infrastructure utilization improves.
Bullish, a cryptocurrency exchange is set to acquire Equinity, a global transfer agent. The deal is valued at $4.2 billion. This transaction is expected to conclude by January 2027. Equinity plays a crucial role in processing substantial annual payments and managing millions of shareholders.
Those were the headlines that we're tracking for you from the startup world. But on what's brewing today, Crude, India's first AI unicorn, has repositioned the company as a focused domestic AI cloud services provider while announcing encouraging financial figures for FY26. Rachna Dhanrajani is here with all of those details. Rachna, a new pivot there for Crude.
Well, you know, Crude was supposed to be India's answer to everything. Its own language models, chips, AI assistant, all of it. Bhavesh Aggarwal launched it in April 2023, called it the country's first AI unicorn. And for a while, that ambition seemed to have no ceiling. But the last 12 months tell a different story. 3 rounds of layoffs, over 150 jobs cut, senior executives walking out the door. The AI assistant Kruti was quietly pulled off the web and app stores, and an employee's death that put focus on work culture of the company. Now the company says the reset is complete. Chip design has been paused and capital redeployed instead of chasing long horizon research bets. Crude has gone all in on enterprise cloud. It is a full stack domestically built platform, runs real-time workloads across mobility, manufacturing and customer operations, and it has no dependence on external infrastructure. The numbers it is putting out are extremely significant because revenue has tripled to rupees 300 crore in FY26. The company has posted its first ever annual net profit with margins above 10%. It has over 25 large enterprise clients spanning telecom, financial services, healthcare and logistics. And it says GPU computing capacity is largely committed to external workloads. And the timing of it all is interesting because Indian enterprises are increasingly anxious about data localization and hyperscaler dependency. The government's push for sovereign AI infrastructure has created real demand, and Crude is positioning itself squarely in that gap. But the open question now is whether the numbers hold up to scrutiny. How much of that 300 crore rupees actually comes from outside the Ola group? For now, this pivot looks clean, but the journey here has been anything but that.
All right, Rachna, stay with us. Dipinder Goyal's brain monitoring wearable startup Temple has hit its first hardware milestone. The company's first 100 devices are now ready to ship. Take us through the details.
100 device, that is all Dipinder Goyal needs right now. And that tells you everything about where Temple is in its journey. He's not trying to sell you anything yet. He's trying to convince the world and perhaps parts of the scientific community that what he has been wearing on the side of his face for over a year is not a vanity project. The founding cohort, he said, would be full of athletes, scientists, doctors, founders, very carefully chosen people because Temple needs credibility right now. The gravity aging hypothesis hypothesis that gravity itself is slowly starving our brains of blood flow and accelerating how we age remains contested. Neurologists have pushed back hard when Goyal first went viral with his device. Then Goyal's response was pretty sharp. He said, "You're criticizing a device that you can't even buy yet." But the device now is real and the scrutiny will, of course, follow. In February, he closed a $54 million round at a $190 million valuation. This was from the people who've bagged Zomato in its earliest days. More than 30 of his own employees have put in their money. And then there were temples hiring posts as well, which specified body fat percentages as a criterion for candidates that drew equal parts amusement and criticism. Now, the gravity aging hypothesis may yet be proved wrong. The device may not perform the way early data has suggested, but Dipinder Goyal has built one of India's most unlikely success stories once already. He clearly believes he's onto something here. The first 100 people who get the device will help the rest of us figure out whether he's right or not. So we'll have to watch out for that one.
Absolutely. All right, Rachna, many thanks for taking us through those details. Now, moving on, India's trading ecosystem is evolving rapidly with a new generation of active retail investors demanding faster execution, smarter tools, and institutional-grade insights. Now, Sahi is tapping into that shift, building what it calls a high-performance broking platform designed specifically for serious traders. The company has just raised $33 million in a Series B round led by Axel, less than a year after its previous fundraise on the back of strong traction, clocking 24 times growth in trade volumes and 19 times growth in active traders. With a chart-native interface and a full-stack trading engine, Sahi is now betting big on AI and product expansion to scale its next phase of growth. Joining me now to discuss this further is Dale Vaz, the co-founder and CEO of Sahi. Dale, thank you so much for taking time out and being here with us on Startup Street. You know, you are building the platform on the belief that serious retail traders in India are underserved, right? What exactly is broken in the existing broking platforms, and what gap did you sort of see that made you build a high-performance trading platform?
Yes, good evening, and thank you for having me on the show. In terms of the thesis that we have, it's very simple. We believe that the last 10 years has really been about driving accessibility to the markets, helping people come online and build investing and trading accounts. But when we look at the next decade, the next 10 years, we believe that the customers that we have are going to demand more. They will demand performance. And these customers, as they get used to the market and used to trading, they're going to look at their portfolios and want platforms that can help them make the best informed decisions. And in that ecosystem, we believe that today the products out there are focused either on people who are mostly investor cohorts, or you have products on the other end which are more complex and sometimes even cluttered. So where Sahi is trying to exist is right in the middle, where we want to provide the power of the professional platforms, but wrap them in this interface that is easy to use, that is intuitive to use, and make the life of this active investor, active trader easy.
Absolutely. You're trying to make the life of the active investor easier, but your platform is built around a chart-native interface with integrated execution and risk tools, right? How does this fundamentally change the trader's workflow? What are the kind of efficiencies you're bringing in, and what are the one or two product features that have really driven adoption among active traders?
Yeah, so when we looked at the trader journeys, I think one of the things that we realized, and this is coming from my personal experience, I've been trading for about 17 years now as a retail trader, used a ton of apps. And one of the things that we've observed is that most of the apps are optimizing for features and individual features within the product experience. But if you look at a trader goes through what we call a workflow. There are a series of steps that a trader does and executes them multiple times to be able to plan, interpret, and execute their trades every day. And so at Sahi, we took a different approach to the traditional broking infrastructure. We said, let's look at the end-to-end experience that a trader goes through in this cycle of planning and managing their trades. And let's build what we call a single screen optimized experience. So here, with focused on our individual traders, we built single screen trading on Sahi. With single screen trading, all the information that you need is available right there. And we've carefully handcrafted this experience to have all the data, the tools, and the execution capabilities that these traders have. A specific example of what we've done there is essentially we've gone out and we've built our own charting system. So in India, a lot of the current brokers use a third-party charting software called TradingView. And TradingView is something that's been out there in the market. It's a pretty popular software. But unfortunately, for a trader, it separates out the analysis from the execution.
Sure.
You have to analyze on the charts and then you execute. With Sahi, we built this integrated experience where we can do both from the same screen.
Absolutely. Okay. So you've explained how it makes your life easy as a trader. With $33 million in fresh capital that you've now raised from Axel and Elevation, right? Where are you sort of placing your biggest bets? You know, there's AI-driven insights, new trading categories, or sort of just scaling the user base. And, you know, what does your next phase of growth look like?
Yeah, it's all three actually. So one, we do want to expand on the different categories we offer. So we are looking at commodities and expanding into margin funding, which are two key categories in the trader segment. In addition, from a product experience perspective, while we continue to expand on the technical edge we are also investing in AI in a big way. We believe AI will help change the consumer experience and how interactions happen. And then the third piece is expanding the reach, where we spend marketing dollars towards expanding our reach towards customer bases across the breadth of India.
All right. And you've seen sort of 24 times growth in trade volumes, 19 times growth in active traders in just a year. What's kind of driving this scale? You know, can you explain to us the shift, or like, you know, what sort of trader behavior you're noticing to see this kind of growth?
Yeah, we're seeing, I think what's interesting is more than 90% of our traders are people who already exist on other broking apps. So these are traders who are trading today and choosing different apps, and then they're choosing Sahi because they really like the consumer experience. We're hearing a couple of things from our traders. One, the fact that we have the integrated experience into one single screen makes it very simple, very fast. And these are two recurring themes that keep coming up. So a lot of I would say the love that we're getting from our consumers are from the fact that we've taken their complex workflows and combined them into this efficient and simple user interface. And frankly, when we look at the user acquisition, we see customers from across the breadth of India. We're also seeing customers from parts like in Kashmir, all the way to Kerala, and of course, Northeast and Gujarat. So we've been able to also get a great span in the very few months that we've been live.
All right. And in 10 seconds, where are your revenues at and what's the target that you have now?
So, I mean, while we can't disclose revenues, we've been growing our monthly revenue almost 40% month over the last 12 months. And we continue to see that expansive growth. We believe that we can grow our business by 3 to 4x in the next 12 months.
All right, Dale, we're completely out of time, but thank you so much for joining us on the show today, and we wish you all the best on this journey going forward.
Thank you so much.
All right, moving on. On the hot seat today is Ghost Kitchens India, a tech-forward F&B brands company focused on creating the next generation of value-driven, digital-first food brands for Indian consumers. Operating across cloud kitchens, celebrity-led QSRs and franchising, the company is building strong brand IP backed by data-led insights and scalable systems. Founded in 2019, it has already turned profitable and is targeting over 35 crore rupees in revenue by FY26. Joining me now to talk about building brands, cracking unit economics, and what's next on the menu is Karan Tanna, the founder and CEO of Ghost Kitchens India. Karan, welcome to Startup Street. You've positioned Ghost Kitchens India as a brand-first, tech-enabled F&B company spanning cloud kitchens, celebrity-led QSRs, and franchising in a market where many players are still largely kitchen operators. What's your differentiation today, and what's really driving your brand stickiness and repeat demand?
Thank you for having me. Yeah, I mean, it's it's a very tough competitive industry, and there are many cloud kitchens, many QSR brands out there. And that's the reason that, in spite of having a very good experience in F&B, credible teams, penetration across cities, we still decided to have a vertical of celebrity-led brands where we feel it will give us a huge benefit in terms of top of the funnel. And then it'll help us to have footfalls into the store. And once we have those footfalls, it is upon us to give them value for money. The product has to be great and we retain them, and they keep coming back to us. So I feel that overall understanding of the brand personality that resonates with the celebrity and focus on product holistically gives us a great moat and puts our brand as a differentiation over all the other brands that form a clutter in the market.
Sure. Surely, Karan, it has. You've hit profitability both operational and at the corporate level at a time when many food tech players are still struggling with unit economics. What worked for you? What did you get right that others didn't?
I have been doing this for last 14 years. This is my third company, and our leadership team also is very well experienced. So I think what worked for us is we having done a lot of mistakes in our past avatars in the same industry. And being prudent about the growth, we have just grown in cluster-based approach. We have put our focus on product first. We have not gone on an exorbitant growth path because we understand and we believe that it's a high brick and mortar, extensive business, and to just develop a brand first and focus on unit economics is very important because if you have a lot of overhead expenses, and if the unit is not throwing good profit, it becomes irreversible to kind of be profitable at the corporate level. So I think just prudence and experience has helped us to grow in a manner where we focus equally on bottom line along with focus on steady growth.
Yeah, you've seen modest growth. You've grown, your revenue growth has been grown from 10% year on year. And your portfolio, Karan, spans multiple cuisines and formats, from pizza and burgers to regional comfort food across cloud kitchens and franchise formats. As you scale, how do you ensure consistency in taste, quality and delivery experience while also avoiding brand overlap or cannibalization within your own portfolio?
Yeah, I mean, food is very, very diverse. I mean, if you look at a particular cuisine, pizzas, you have pizza eaters that can spend $1,000 on a meal, and then you have a huge demography of audience that can spend only 300 to 400 rupees on a pizza meal. So, essentially, we target demographies rather than just looking into one cuisine segment. And wherever there is a huge market. So our brands do not overlap with each other as far as the target customer is concerned. And when we grow, we always make sure that the menu is engineered in a way that it can be scalable. The SOPs at the outlet level are very simple. The product is just assembled at the outlet. We have a great back-end vendor database and support, a great supply chain, a lot of training and audit modules that are tech-driven, which help us to monitor the quality on day-to-day basis. And lastly, cluster-based approach helps us to keep a good hang of things.
All right. Karan, you've also brought celebrities onto the table, from Badshah to Rana Daggubati, to build brands like Bad Boy Pizza and other celebrity-led food ventures. Is celebrity branding a real demand driver or just garnish on the plate?
Oh, no, absolutely. It's a great demand driver. We have seen it playing really nice in a couple of other industries. I am really a fan of how Kusha Kapila is built underneath. Of course, Ranveer Singh and Super You is a great success story. So there is a lot of merit in bringing a celebrity, but it is not enough. So the association with the celebrity has to be seamless. The brand has to be part of celebrity's lifestyle. And then end of the day, once you have a top of the funnel and eyeballs, you can probably win the customer through your product, and they keep repeating and buying from you. So yes, there is a lot of merit in building celebrity brands if done right and if done patiently.
Sure. Karan, you've raised about 50 crore rupees in capital so far. As you scale from here, what's the next course? More cities, new cuisines, or even stepping beyond delivery into dine-in formats? If you could also take us through your revenue growth targets.
Oh, yeah, absolutely. So Bad Boy Pizza is one example which was a pivot for us, which is 95% dine-in today as we speak. It has some outlier numbers per square feet, and we plan to double down on such formats. We will scale Bad Boy Pizza, which is with Badshah, into multiple stores by end of this year. We will also launch at least 2 to 3 celebrity brands. Something is brewing in Korean space, something is brewing in dessert space. So we won't grow geographically in a lot of cities, but we will again focus on cluster-based growth. And we plan to close FY27 by with 50 crore plus of revenue, and FY27 with 80 crore plus revenue, while maintaining the EBITDA and improving the EBITDA.
Well, on that very positive note, it's time for me to wrap up our conversation. Karan, many thanks for your time and for joining us on Startup Street, and wish you the very best for all your growth plans.
Thank you. Thank you for having me.
Well, with that, it's time for us to head into a short break. But coming up, Singular Gulf invests $40 million in Trimex Foods to scale global restaurant brands in India. Details when we come back. Stay tuned.
Well, Singular Gulf, an $18 billion multi-strategy private equity firm headquartered in New York, has just made its first institutional bet on India's organized restaurant space. The firm is putting $40 million into Trimex Foods, the exclusive Indian franchise partner for Chili's, Paul and Cinnabon, which currently runs more than 50 outlets across 13 Indian cities. With me now is Sean Koopchandani, partner and co-portfolio manager at Singular Gulf. Sean, thanks very much for your time here. You know, Singular Gulf has more than $18 billion in AUM across buyouts, emerging markets, credit, real estate. So why does a $40 million bet on India's restaurant franchises fit your portfolio right now? What is the strategic logic?
So maybe just a bit more on, firstly, Ritu, thanks a lot for having me. Just a quick note on Singular Gulf. So we're an $18 billion asset manager, but as far as India is concerned, we are a mid-market private equity player. So our check sizes are $25 to $100 million. Our sweet spot's around the $40 to $50 million mark. So this is bang within our sort of target zone of size of check size, of the check sizes we like to write. And in terms of the segment, I think, food has been a very interesting, it's been a hot button sector for private equity. And we've been scouring the market for a few years looking for the right platform. And for many reasons, which I'm sure we'll get into, this felt like the right bet for us. It's in a high growth market with a huge addressable end market. And frankly, with a very seasoned operating team. So we're thrilled by the investment and really excited to talk more about it.
All right. Well, Sean, India's casual dining space has had a pretty rocky decade. Specialty restaurants, Yum's India struggles. Even some global QSR players have pulled back. So what gives you the conviction that this time the unit economics actually will work at scale?
So Ritu, great question. First, I think I would separate between quick service QSRs and casual dining. If you look at the portfolio here, it's a much more premium crowd. So this is actually a in-restaurant dine-in audience versus takeout. I think a lot of the names that you mentioned are brands that are seeing margin compression because of delivery, quick commerce, etc. What we liked about this business is it's an operator that's built a large portfolio. He used to run, he was one of the senior people at Subway India. So he's gone through the 0 to 1 scale-up journey of building a business to around 650 stores. And if you look into the numbers here, what we were most astounded by is phenomenal same-store sales growth, incredible unit economics, and I think the brands really matter. If you look at a Chili's, Brinker's has had a phenomenal turnaround story in the US. And so from a menu perspective and also from a location perspective, we felt that this is a really differentiated portfolio.
Well, you've described India's food services sector as undergoing a structural shift. Now, break that down for us. Is this a metro story, a tier 2, tier 3 city story, or is the opportunity somewhere in between that?
No, so again, I come back to the brands, right? Chili's and Paul, these typically cater to premium customers. Those customers are usually walking through a high street location like a mall. And if you go to some of the malls in which Trimax has a presence, you'll see that the anchor locations are actually held by Chili's or Paul. So it gets your happy hour crowd, it gets your premium lunch going crowd, and it picks up a lot of the crowd that today is choosing, instead of sitting at home and eating at home, maybe cooking a home cooked meal, is entering a mall because it's experiential. And when they're in the mall, a Chili's or Paul is a really solid option for them as a dining alternative. So the structural change is, we're seeing a lot more casual dining concepts succeed, but again, the brand really matters. So, we spent a lot of time understanding the unit economics. If you look at the same store sales growth metrics for this business, they're unparalleled. They're some of the best numbers we've seen. And so I come back to, it's a brand positioning perspective. And for the audience that goes here, they view this as a premium dining experience. And I think it's very different from the positioning you mentioned of some of the QSRs, which maybe cater to more for tier 2, tier 3, tier 4 crowd, or at least are trying to build scale in those markets. I don't think this is a business that will grow to 300 Chili's across the country. That's definitely not the thesis. But it's a tier 1 and hypermarket phenomenon.
All right, take that point. Well, Trimax has taken 15 years to cross 50 outlets in 13 cities, which seems like a pretty measured pace. Is the plan now to step on the gas with this funding, or does the aggressive expansion risk that operational discipline that probably attracted you to the platform?
Yeah, so Ritu, it's a good question. I think it comes down to our investment philosophy. We're backing an operator that has spent a lot of time in the industry and is very measured with the scale out. This is going to be a business as usual thesis. I don't think we're going to multiply the pace of expansion by 5x per year or take some crazy execution risk. And it's a very execution intensive business. So the goal with our capital is to provide the founder, who, by the way, has bootstrapped the business so far. This is a first institutional equity check for the company. And our capital will be used to continue supporting new store openings. So obviously expanding the Chili's, Paul and Cinnabon franchises in India. And then also take on new brands. Look, you touched upon Singular Gulf being a global brand and a global firm. Our value add is, we can help introduce new global food concepts, US food concepts to India. And what we were looking for is a food platform where we have a proven operator that knows how to do that. So it's very much a business as usual playbook. I would be surprised if we saw the pace of store openings changing dramatically.
All right, Sean, we'll leave it at that. Thanks very much for your time here today on Startup Street.
Likewise. Thanks a lot for the time. Yeah, I appreciate it.
Well, on that note, we're going to wrap up this edition of Startup Street. Many thanks for tuning in. From all of us, it's goodbye. Thank you for watching.
It's the dawn of a new political era in West Bengal. Another film star ascending to power in Tamil Nadu, and the left is shown the door in its last bastion. The voters stick to an incumbent government in Assam and Puducherry. The verdict for the elections to 4 states and 1 union territory is out. Let's decode the verdict for you. First up, Bengal, which was being pitted as a battle royale between the BJP and the TMC. The BJP is cruising towards a 2/3 majority, bringing an end to Mamata Banerjee's 15-year tenure. The BJP made major inroads in Kolkata, in the South 24 Paraganas, Howrah and Hooghly, long considered a TMC bastion. The BJP also inching towards a clean sweep in several North Bengal districts like Alipurdwar, Cooch Behar and Jalpaiguri. Several ministers in the outgoing Bengal government trailing in their state. Mamata Banerjee herself is in a neck-to-neck contest in Bhabanipur from Bengal. And that is the picture there in Mamata Banerjee's bastion falling to the saffron wave. On to Tamil Nadu, where film star turned politician Vijay has scripted a blockbuster, relegating the 2 primary Dravidian parties, the DMK and the AIDMK, to below 60 seats each. The state, which is no stranger to film personalities donning political hats, has given a decisive mandate to Vijay, a greenhorn in Tamil Nadu politics. The TVK, however, may fall short of majority and may need to speak across the aisle to cobble the numbers together. More than a dozen ministers in the outgoing DMK government, including Chief Minister Stalin, trailing. In Kerala, where the Congress-led UDF has stormed to power after a period of 10 years, this leaves India without a left-led state government for the first time in 50 years. The BJP, a fringe player in the state, is leading in 2 seats. On to Assam, where the BJP-led NDA has secured a hat-trick, with its tally likely to touch 100. The Congress is languishing at a distant second, with its state chief Gaurav Gogoi likely to lose from the Jorhat seat. TMC Supremo Mamata Banerjee, whose party is on its way out in Bengal, is yet to concede the elections.
আমি সব আমাদের কাউন্টিং এজেন্টদের আমাদের সমস্ত পার্টির কর্মীদের বলবো অত মন খারাপ করার কারণ নেই। আমি বলেছিলাম সূর্যাস্তের পরে আপনারা জিতবেন। 3 রাউন্ড 4 রাউন্ড কাউন্ট হলেও এটা 14 রাউন্ড থেকে 18 রাউন্ড কাউন্ট হয়, তখন আপনারা জিতবেন। ওয়েট অ্যান্ড সি, ওয়াচ, আমরা সবাই আপনাদের সাথে আছি, আপনারা কেউ ভয় পাবেন না, নিশ্চিন্তে থাকুন, আমরা বাঘের বাচ্চার মতো লড়াই করে যাব।
Well, wait and see. That's the view in from Mamata Banerjee, but the numbers telling you the story. It is the BJP that will take Bengal. While Vijay scripted a blockbuster in Tamil Nadu, one man who predicted that he would do so, Axis My India's director and CMD Pradeep Gupta. He joins us now on Election Exchange. Pradeep Gupta, congratulations. Yours was the outlier as far as Tamil Nadu is concerned. You got it spot on. Take us through what made you capture the pulse that no other exit polls were able to.
Thank you so much, Serene. I mean, I would say this full credit to our Axis My India team, people who are working in front end, which is the field force, and the back here in office. And the processes, the scientific process of data science, what we follow, I should give full credit to these 2 particular aspects. And in fact, it's not only the Tamil Nadu, all the 4 states we predicted, our vote share, sheet share is bang on, spot on. There is no change at all. And again, we are able to live to the expectation of the people at Axis My India till today. We have predicted 74 election accurately out of 81 total. With these 4 states, now tally goes to 78 out of 85 elections so far. Yeah, so this is this data science, I would say, the full credit to.
Well, that is an enviable number, Pradeep Gupta, that you're sharing with us. I know you've broken into your signature dance moves already. Unfortunately, you're on Zoom, or I would have got you to replicate the same for us. But, you know, coming back to what you were able to capture, the data is one thing, but the mood, what was it that you believed swung things in Vijay's favor? What was the X factor that worked for Vijay specifically in Tamil Nadu?
So actually, there was a good space which have been developed over a period of time, particularly last 50 years. People of Tamil Nadu have seen and witnessed a rule of 2 major alliances, which is DMK and AIDMK. So this was one Secondly, the kind of newness people are witnessing, the kind of demographic shift is taking place across the country and to some extent, to the large extent across the globe, which is the youth in the age group of 18 to 39 in Tamil Nadu, which contributes 42% of the population, the voting population. That is where among these group, Vijay scored way higher than the other two party. And the second most important demography which played the trick in favor of TVK or Vijay, which is the women voters, which contribute 50%. That in among the women also, Vijay has scored phenomenally good than the other two alliance. So these are the two things, and one, there was a space, and three, Vijay himself as a stardom or a personality for last 20 years seen as a hero for them. And this is the right time Vijay could pick up. Earlier, the Kamal Hassan, the star Kamal Hassan has tried but couldn't do so. And the other neighboring state of Chiranjeevi and then to his brother Pawan Kalyan has tried, but they couldn't succeed beyond a point.
Yes, he certainly has emerged as a hero and delivered a blockbuster as far as Tamil Nadu is concerned. But let's talk a little bit about the DMK and the AIADMK, Pradeep. And, as far as the DMK is concerned, well short of what you had predicted in the exit poll as far as the DMK is concerned, what do you believe went wrong there?
See, pure anti-incumbency. Anyway, in Tamil Nadu, the 5-year term is the rule. So this time the anti-incumbency, and that too again the family politics of particularly in the part of DMK and the Stalin family. I mean, and this is the precisely reason why in particular Chennai, the Chief Minister Stalin, as you mentioned, is trailing big time, more than 9,000 votes he is trailing too. His son was also earlier was trailing, now it's about 1,000 votes he's leading too. So these are the few things. And when I say the vote share, about 35% plus minus 2% we predicted for DMK, they scored around 32% at this point of time. And in triangular contest, the victory margin is very narrow. So this is the reason why they are winning, likely to win about 72 odd seats. The DMK alliance we predicted as about 90 seats. So 20 or 18 short of our tally for DMK.
Let's talk about the poll that was never revealed, Pradeep Gupta, and that is West Bengal. And you said that you chose not to reveal the West Bengal exit poll because you didn't believe it would be fair, because you were getting conflicting signals, conflicting messages in the data. Does the result today surprise you?
No, not at all. In fact, it was not confusing data, but it was no data or incomplete data. I would say we could speak only to 20 to 30% of the people of our sampling process. 70 to 80% people were not willing to talk to us. In fact, myself was also gone there. I also tried hard. But people were very, having some kind of a fear. They didn't speak a word. Straightway, we cannot go and ask whom we are voting to. There is a process. We try and get some kind of a comfort level. That is when we start, discussing about the political preferences. But people were not talking. So as I told you, until unless we have a representative data sample, how can we, that conviction was not there. And people were asking in the media, based on that 20, 30%, whatever you polled, what is your gut feeling? Based on that, I said, BJP is doing extraordinarily well. The question is how well. This was precisely the question. And people expect the exit poll kind of a thing out of our exit poll. So this is something I don't want to do, the half-hearted, the half-cooked food to the people.
Do you regret not having put out an exit poll on West Bengal, considering the fact that you're not surprised by the number, and you believe that the BJP would have, in your words, done extraordinarily well?
No problem at all. I have to stick to my processes, my system, and my team. Most importantly, I have to be with team. Had I done this half-hearted job, I would have been setting the wrong precedent to my team member. That sense of belief among the team member is the most important aspect for me.
But, let's talk a little bit about the factors in West Bengal. Anti-incumbency, of course, a big factor, 15 years of the Mamata Banerjee government. But what else do you believe has worked in favor of the BJP? How much of the factor was the SIR in being able to deliver the kind of numbers that the BJP has managed to get? The X factors for Bengal, for the BJP?
See, beyond anti-incumbency, of course, anti-incumbency has to be there. But to capitalize on to those anti-incumbency in your favor is something very important. And that can only be done when you have full-fledged organizational structure across all the assembly constituency, across all the polling booth. Until and unless you have that, no political party can win. And for BJP particularly, last 5 years after they lost the last term election in 2021, they have made sure they have pinpointed those seats, particularly 75 seats last time BJP last with less than 10% of margin, less than 10% margin. Among them, 38 with less than 5%. And 37 seats, 5 to 10%. So 75 these seats, 77 last time they won. They focus purely on these seats, and we can see the result over here.
Well, congratulations again to you and your team, Pradeep Gupta. Many thanks for joining us here on CNBC TV 18. Well, it is the dawn of a new political era in West Bengal and another film star ascending to power in Tamil Nadu. The left is shown the door in its last bastion. The voters stick to an incumbent government in Assam and Puducherry. The verdict for the elections to 4 states and 1 union territory is out. Let's decode them for you. First, Bengal, which was being pitted as a battle royale between the BJP and the TMC. The BJP cruising towards a 2/3 majority, bringing an end to Mamata Banerjee's 15-year tenure. The BJP made major inroads in Kolkata, South 24 Paraganas, Howrah and Hooghly, long considered TMC bastions. The BJP is also inching towards a clean sweep in several North Bengal districts like Alipurdwar, Cooch Behar and Jalpaiguri. Several ministers in the outgoing Bengal government trailing in their states. Mamata Banerjee herself in a neck-to-neck contest in Bhabanipur. From Bengal to Tamil Nadu, where a film star turned politician Vijay has scripted a blockbuster, relegating the 2 primary Dravidian parties, the DMK and the AIDMK, to below 60 seats each. The state, which is no stranger to film personalities donning political hats, has given a decisive mandate to Vijay, a greenhorn in Tamil Nadu politics. The TVK, however, may fall short of majority and may need to speak across the aisle to cobble the numbers. More than a dozen ministers in the outgoing DMK government, including Chief Minister Stalin, trailing. Over to Kerala, where the Congress-led UDF has stormed to power after a period of 10 years. This leaves India without a left-led state government for the first time in 50 years. The BJP, a fringe player in the state, is leading in 2 seats. On to Assam, where the BJP-led NDA scored a hat-trick with its tally likely to touch 100. The Congress is languishing at a distant second, with its state's chief, Gaurav Gogoi, losing from the Jorhat seat. We're now joined by Congress Lok Sabha MP from Thiruvananthapuram, Shashi Tharoor. Mr. Tharoor, thanks very much for joining us here on CNBC TV 18. Well, congratulations to you and to the Congress for pulling off a victory in Kerala. Let's start there, Mr. Tharoor. What do you think worked in your favour as far as Kerala is concerned? How could you capture the mood and the pulse?
I think the public were really ready for a change. There's no doubt about this. They had seen 10 years of misrule, misgovernance, a stage where the economy was in complete free fall. State government was broke by September everywhere and used to have to borrow money even to pay their own bonuses and salaries. We were plunged into debt. Industry was simply not coming. Young people were fleeing the state to other states and other countries because they felt they had no opportunities whatsoever. in Kerala. And in that situation, we told the people, we understood their messages, we guaranteed them a different approach, and we pledged to bring about a revival in Kerala's fortunes. So I think 10 years of anti-incumbency and misgovernance, plus a positive message, a united Congress campaign, all of this helped immensely as we got our message across.
It begs the next question then, Mr. Tharoor, who is going to be the Chief Minister?
That will depend very much on the High Command. They will probably send, I'm sure the Congress President will send an envoy to meet with the victorious MLAs. The MLAs will then end up expressing their preferences. Those will be conveyed back to headquarters, and then the High Command will decide. That's the usual way the Congress proceeds.
We know the process. Mr. Tharoor, we're well aware of the process. Who are the front runners, though? Is it likely to be K.C. Venugopal?
Look, I'm not going to get into that game, Shireen. Let's talk about something else. Results, action.
Okay,
a 1991 moment in Kerala. That's the analogy I think of. That we really have to be transformative and coming with that kind of message.
Let's pick up on that, because that's a pretty bold statement that you make, that you're likening this to a 1991 kind of moment as far as Kerala is concerned. What does that mean, Mr. Tharoor, in terms of reviving industry, in terms of opening the state up to investments, foreign direct investments, domestic investments? I mean, what should we realistically expect now as next steps?
All of those. In fact, there are a number of ideas that I've been discussing with all the potential chief minister candidates. One of them would be to completely roll out a red carpet for investors, and that would include the passage of a Investor Protection Act, which doesn't exist anywhere in the country, but there are international models available that would give investors a guarantee that their money would be safe from anything except business vagaries in our state, and they would not be facing the kind of red flag demonstrations, protests, bureaucratic and political obstruction that have bedeviled industry in Kerala so far. We would ban some of the more unpleasant Kerala practices, such as hartals and so on, or at least make a darn good effort to do so. And I think the majority of the people have given us, emboldens us to really be bold in the initiatives we can take, to be brave as well. Ban hartals, for example, stop some of the disgraceful practices, empower the police to uphold the law, start stripping the regulations that are far too excessive in our state. I think really this is going to be a moment of transformation. And I do believe that if we have interpreted our mandate correctly, it is a fundamental mandate for change. People are tired of business as usual. And I think this is certainly on my campaigning, and I campaigned in 12 districts and 59 constituencies. I can tell you that I found my message resonating very, very well with the general public.
You know, you said people are tired of business as usual, and this is what you interpret this mandate to say. But Mr. Tharoor, you know, perception and changing perception is tough to do. So what can we now expect in terms of perception management, perception change? What will be the first few executive decisions, the first few legislative actions that your government is going to take?
Look, I can only think about what I can recommend, but I think it would be presumptuous of me to speak for a chief minister who hasn't been appointed yet. Let us just say that in the internal discussions, I intend to be an advocate for dramatic change, and I do believe there is a receptivity to that amongst many members of the top leadership of the party.
Okay, if I may move away from Kerala for just a second and talk about some of the other results that have come in. And I want to focus on Tamil Nadu because, you know, we've been speaking with a lot of people here on the results, the surprising result where, you know, TVK and Vijay have emerged as kings in Tamil Nadu, opening up a third front quite literally there. And the view is that the Congress missed an opportunity by not tying up with the TVK. How would you respond to that?
Well, look, I think 2020 hindsight is all very well. The Congress party felt it did the right thing in staying loyal to the party that had supported it in bad times as well. And I think there's nothing to be ashamed of in having been a loyal ally. I think we could all use loyal allies in politics, even if sometimes the temptations are different elsewhere. Secondly, the TVK victory was truly astonishing when you look at it objectively. For a first-time party led by a first-time candidate to sweep 105 seats is something that I think most of us would not have expected or even assumed was even possible. And I think in these circumstances, we have to understand that as far as the Congress party is concerned, it does have a lot of introspection to do. But I don't think it's right to say with hindsight that we did the wrong thing. I think we stayed loyal to an ally, and now we will see what lessons we should draw from the experience with that ally. I will say, however, that my focus has been overwhelmingly on Kerala, and I don't at all want to pretend that I have actually been following all of this in the kind of detail that will be useful for you in both Tamil Nadu and Bengal, which, to my mind, were both surprising victories, but perhaps you don't think they were.
Well, the exit polls did indicate that it was going to be the BJP in West Bengal, and Axis My India did say that it would be TVK in Tamil Nadu. But Mr. Tharoor, you talked about learning from losses, and I want to just bring up a data point that we just got from Pradeep Gupta of Axis My India on Bengal, and he said the BJP focused maniacally on the 75 seats where they actually lost with a margin of 10% or less in the last election. And that made all the difference between where they were in the last election and where they find themselves today. It seems that the BJP is dogged about learning from loss, and it doesn't seem like the Congress seems to be able to do that.
Well, I'm not sure that's an entirely fair criticism, given that we've just reversed 2 successive losses by winning 101 seats in Kerala. So it varies perhaps from place to place. But I will say that I do accept the argument that the BJP is meticulous and thorough and professional in the way in which they fight elections. And there's a lot of lessons we can all learn from their approach. I'm not sitting around just saying that that they won by either fluke or chicanery or anything else. I think they are very, very single-minded in their focus. They have a strong organization, and they also tend, it seems to me, to devote all the resources required, including financial resources, to pull off a win. When you think that back in 2011, Bengal, if I'm not mistaken, BJP had 0 seats in the assembly. In 16, it was something like 8 seats. By 21, it was up to 77, and now it's up to 100 and whatever, 198. It's quite astonishing, and that is the kind of progress that any company that follows your channel would be gratified by. But for a political party, it's truly remarkable.
It is truly remarkable. But what is the message that you, Shashi Tharoor, take away? And, Kerala, of course, is a victory in favor of the Congress, but anti-incumbency clearly was not something that you could leverage, for instance, in Assam, where the BJP has managed a hat-trick. What do you take away from what voters have told you from these 5 elections?
Well, I think the 5 elections have given us very different messages. And that's partially a reflection of the gorgeous diversity of Indian democracy, is that each state has its own political reality and its messages will vary. I don't think the message of Kerala is the same as the message of Assam and vice versa. I think we have to understand that there are different realities in different states, particularly when it comes to state elections. Congress has been doing well in Lok Sabha elections in Kerala for some time now, but it's been doing poorly in state elections. Now, this time we've done well in a state election. We've got to make sure we consolidate that so that we repeat our good performance in the national elections the time comes. In other states, there are different lessons we need to learn. And I do believe that just running after the victor is not the right thing. We have to see what our strengths are. I've often been an advocate of returning to the whole idea of politics as social service between elections, and not just getting ourselves organized in time to fight elections. That was part of the theme of my unsuccessful bid for the Congress Party presidency. I do believe we need to get us much more organized into a full-time grassroots entity everywhere. And I believe we can. We have done this before, and I think we can do it again.
Mr. Tharoor, I'll end by asking you, you talked about this being a 1991 opportunity for Kerala to transform itself. One of the concerns on account of the West Asia conflict is the impact on remittances, which is likely to impact the state of Kerala much more, or at least disproportionately higher than other states. How do you believe the new government will have to factor that in? Is this something that you have discussed ahead of the elections?
Well, look, I think this is a very, very serious issue. Congress has no illusions about how badly the financial situation is. It's been grossly mismanaged by the communists, and we are looking at a state that's already deeply plunged into debt, excessively reliant on remittances, lotteries, and liquor taxes. So that's no basis for running a state, and certainly remittances could take a hit if the Gulf situation doesn't resolve itself very quickly. So we do have to worry about the implications of all of that. We also know how dependent we are on those things until such time as we can seriously bring investment into the state. But if we weren't able to do that, if we were able to bring in investment in a credible way, which I believe we should be able to, we do the right things, then I really, really, really do think that we should be able to move forward and transform the economy of the state. The 1991 moment was a reference to the economy because the economic transformation of India that happened at that time, we are all benefiting from 35 years later. It's that kind of sea change, a genuine parivartan that we'll have to see in Kerala. And I believe this is the time to do it. With the kind of majority we have, I think we should really have the support we need from the public for genuine change.
Well, Shashi Tharoor, we wish you the very best of luck. Thanks very much for joining us today on what has been a good day for the Congress party as far as the state of Kerala is concerned. Thanks very much for your time. We look forward to speaking with you once there is a decision on the Chief Minister and, of course, the next steps of action. We will take a break, but don't go anywhere. Our election coverage continues when we return. Stay tuned. We're back in a moment on CNBC TV 18. Well, let's talk about the big election, and that is the state of West Bengal. The BJP has not just made inroads, but it has consolidated very firmly its position. It has decided unequivocally to dislodge Mamata Banerjee after that 15-year reign. Joining us now to talk about what that means for economics in the state of West Bengal, what it means for industry. Joining us now is Mr. Sanjeev Goenka. Mr. Goenka, appreciate you joining us here on CNBC TV 18. Let's start with that, because what one is hearing from your peers, many have taken to Twitter, including your brother, to say that this is going to be a return of the development agenda, that the business community in West Bengal is in jubilation on the back of the BJP victory. Mr. Goenka, what is this going to mean now as far as the state is concerned and its development agenda?
Honestly, Shireen, it's, I'm someone who comes from a family who spent 200 years in Kolkata, and therefore, in addition to a financial investment. So I think, let me just say that there is a huge anticipation, huge expectation, and great confidence that BJP will bring development on the forefront. They will scrap laws which are ancient, like the urban land ceiling, etc., and there are several of them. And you will see Bengal rising under the BJP rule.
If we can talk a little bit about in terms of specifics, Mr. Goenka, because Mamata Banerjee, like other chief ministers, also held investor conferences. The vibrant Gujarat equivalent of an investor conference was being held in West Bengal as well to draw in investors. Now, what do you believe are the gaps, the missing links? You talked about the Urban Land Ceiling Act as one, but what would be some of the other specifics that you believe the next government needs to focus on?
I think consistency of policy, for one. That is very important. You can't sort of announce policies today and 12, 24 months later withdraw it. That doesn't lead to confidence building. So I think consistency of policy, clearly articulated policy, and to have the confidence, industry needs to believe that their investment is welcome. So I think there is great confidence that the BJP, they've done so brilliantly at the center. They've done so well in every state that they've been in. So I think there is anticipation, there is expectation for sure.
I was just talking to Shashi Tharoor. The Congress has managed an upset in the state of Kerala. And Mr. Tharoor told me that he believes it is a 1991 kind of opportunity for the government, in the next government in Kerala, to pull off an economic transformation. And what I'm hearing from you, that seems to be the mood, that seems to be the expectation, even as far as West Bengal is concerned. I want to understand from you, he talked about, for instance, an Investor Protection Act to give investors confidence, something that you were talking about as well. Would things like that help change perception and draw in investment?
I specifically, there could...
Welcome to Genomics. Ever since the war on Iran began on Feb 28 and crude prices started climbing, questions have been raised over India's 7% growth pace. However, in the past 2 weeks, some pleasant surprises have sprung up. Many FMCG companies like Hindustan Unilever and Nestlé, which had been reporting low single-digit volume growth for the better part of the last few quarters, reported higher volumes. Quite a few reported double-digit volume growth, as you can see, for the Jan-March quarter. April should have been worse, 2 months into the war. But take a look at the auto sales numbers for April. Almost all of them showing, over 30%. Many of them showing over 30% growth. Likewise, take a look at the tractor sales, commercial vehicle sales, and two-wheeler sales. All of them also growing impressively. So April sales volume growth is excellent. Therefore, is the Indian economy witnessing better growth than we all feared? Or is April just the last hurrah before growth slumps under the combined weight of triple-digit crude prices, El Nino, and possible export slump? Joining me to discuss the India growth picture as well as emerging worries in other macros like inflation and current account are experts, three experts: Abhishek Upadhyay of ICICI PD, Sakshi Gupta of HDFC Bank, and Lalit Bhise of the market research firm Bizom. Well, Sakshi and gentlemen, thank you very much for your time. Let me start with you, Abhishek. What's the sense you are getting with the April numbers? First of all, did the Jan-March numbers surprise you pleasantly? I was quoting the FMCG numbers. And is April, at least auto sales-wise, not as bad as we feared?
Well, so the high-frequency data available since war started, mostly for the month of March, some for April, I would say paints a mixed picture, but overall would still term it quite resilient. Auto sales, particularly, you pointed out, has been quite strong. So, I mean, the so-called tier 1 data, auto sales, core GST collections, credit growth, these indicators, which are more correlated with domestic demand situation, have been quite strong, and that means economy entered this crisis in a good place. At the same time, what we are starting to see is external sector indicators such as non-oil exports growth, which is available for the month of March only, which was down 9% YOY, a marked shift from growth that was seen for the full fiscal overall. Or tier 2 data, such as diesel sales, for instance, which really slowed down in the month of March. GST e-way bills, which has also slowed down, are indicating that, or I would consider these as leading indicators that growth could weaken. As we know, bulk diesel prices, industrial diesel prices have gone up, and some of that weakness could be a result of that. Going ahead, we are likely to see external sector indicators weaken much more as terms of trade shock spills over more broadly into the economy. From the framework perspective, when we are looking at how much growth will be, what matters is how the burden sharing of this higher oil prices happens between the government, the firms, and the households. I mean, if most of the shock is absorbed in terms of lower savings from government or corporate sector, we will not see as much impact on growth. But I would not say that is a good outcome, because that means current account deficit could be higher. That means because fiscal deficit could be higher, interest rates overall in the economy could be higher. So government needs to, calibrate the policy responsibility.
Abhishek, I'm coming to the coming quarters in a minute. Just tell me if if the Jan-March quarter surprised you positively.
I think it would be, growth in that quarter would be in line with what CSO indicated, around 7.4, 7.5%, which is a good number.
Okay. Sakshi, your take. Do you think Q4, Jan-March, all analysts were pleasantly surprised by the FMCG numbers and the auto sales numbers. That's why I'm asking you, was Jan-March better than you thought?
No, absolutely, Radha. I agree that we knew that Jan and February, there was a strong momentum in the economy. Some of the indicators, like you pointed out, for the month of March, and let me add the IIP growth number that also came out for March, I think was slightly better than what we were anticipating, given the fact that there was an extreme shock. That the system was kind of handling in the month of March, and oil prices and the Indian crude basket at that time, if you look at the month of March, was actually very, very high. I would kind of agree with you and say that, some of the indicators have performed better. I think it is a strong signal of the fact that the absorptive capacity of the system at this point, if I talk about households, if I talk about the corporate sector, definitely seems to be better positioned. And therefore, our estimate for Jan to March quarter is close to 7.4%, which is, the derivative of the annual numbers that the CSO came out with.
Okay, so 7.4, you would stick your neck for that number. Lalit, now let me come to the, month of April itself, for which only you have data. Of course, we have auto sales data, but auto sales is a consumer discretionary number. How did the rest of the consumption basket perform in April compared to normal Aprils or compared to the previous quarters?
Right. So thanks, Radha, for having me. But yeah, so April was also a pleasant surprise. All of us expected that war might have impact on consumption and stuff like that. But turns out even in April, the whole FMCG consumption has gone up overall by 6.3%, primarily driven by rural, which continues to be really strong. Also, the whole heat wave seemed to have increased the consumption of stuff like beverages, which has gone significantly higher. Packaged foods is surprisingly high up, which essentially indicates that maybe the LPG shortage has allowed people to, stock up on packaged foods. Other interesting thing was commodities, at least in value terms, have gone up. Packaged commodities, which is like packaged oil, rice, atta, all of that, has gone up quite significantly in the month of April compared to last year. So overall, it's been about 6.3% compared to last year, which is obviously a pleasant surprise for all of us, negating the effects of war, at least in short terms.
Okay, so you're saying that the April consumption trend did not show too much of a slowdown?
No, it did not. It overall actually went up to about 6.3%, which was actually quite pleasant surprise, as I said. I think the only category which significantly degrew was home care, which essentially meant that people preferred the food rather than surfaces in general. And obviously, urban continues to not show as exciting growth. Urban, I think, overall grew only by about 2%, but it was more than compensated by rural. So it turns out, I think, like the brands like Nestlé and public brands who are claiming, I think there still seems to be a distribution-led growth that is available in rural. We also see regional brands growing quite fast, which also indicates, a rural consumption growth overall.
No, that's a very important point, that it isn't just the listed stocks, but you're saying there was also a transfer to unbranded, and Correct. That would mean that, the growth is more than what the listed space is telling us. But Lalit, the very important point, and let the table come up again, rural-urban. Urban growth in April has been as bad as 2% for FMCG products. Correct. Abhishek, what would you take away from that? Do you think that the slowdown has started well and proper? When you look at cars, you don't get that feeling. But when you look at the urban numbers that Bizom is putting up, it's looking troubling. What would you conclude of the April, May, June quarter?
Well, so urban demand has held up much better than I thought. I mean, after GST cuts, very recent data that is available. Because we have yet not seen these higher impact from food prices being passed on to consumers in a big way, and therefore inflation still stays low. I would not think that we should see abrupt weakness in urban consumption demand indicators immediately. Would rather wait for more data to confirm that. My thought process would be that external sector indicators worsen first, and that then leads to further spillovers into other indicators. So accordingly, we'll think that domestic demand indicators should still hold up well for in the first quarter. Therefore.
Okay, that assumes that the Reserve Bank will not pass on fuel price hikes anytime now. The expectation is that LPG, commercial LPG has been passed on. It won't be long before petrol and diesel is also passed on. Are you factoring that in? And what is your GDP number?
I think it is highly likely that retail prices for auto fuels will go up. The kind of shortfalls that all marketing companies are facing right now is clearly not sustainable, and it will be prudent for government to allow some of this price adjustment to happen so that demand adjusts suitably, and that could then bring down current account deficit a bit, and rupee could stabilize also. Accordingly, I do think that it is quite likely, and it will show up in inflation numbers. Our estimate for inflation really for the full year is around 4.7, 4.8%. So quite a sharp increase from what we saw in the last fiscal year. Of course, only partly this is because of higher crude prices. Also, what we're likely to see is food inflation is likely to go up from very low levels last year. There's a risk of subpar rains, which could have some impact there. But we are not building a very big upside at the same time from that side. Overall,
Abhishek, 1 minute.
we are seeing at
Abhishek, I'll come to the inflation bit in just a minute. Just tell me your growth number. RBI stands at 6.8. Will we do that?
At 95 crude, we are also at 6.8, but risk is for weaker number for the full year.
Okay, and Sakshi, what's your growth number? I'll come to the details later. Very quickly, your growth number for the first quarter.
So for the first quarter, Lata, we are estimating 6.5% growth. Assuming that oil prices average somewhere around $95-100 per barrel in the first quarter.
Okay, got that. So you're expecting growth to fall to 6.5, but Abhishek says the full year average is still close to what the RBI forecasts at 6.8. I guess the bigger hit is going to be on rupee, on current account deficit, and above all on inflation. Those questions after the break.
Things, but fundamentally, let me just say that consistency of policy, predictability of policy, and just the confidence that your investment is welcome.
Mr. Goenka, you know, as you pointed out, you have a long history. The group has a long history with the state, over 200 years and counting. Take us through how confident you feel now about further investments in the state. What is this going to mean, for instance, as far as the group is concerned from a capex perspective?
You know, emotionally speaking, I would say very confident. I've always been investing in the state because it's been an emotional call sometimes. But right now, when you have BJP leading the government, that emotion turns into emotion plus confidence. So I think you will see a lot more.
I also want to get a sense from you on what business confidence is looking like. Of course, we've got the elections to deal with today, but outside of that, we've got a tough global environment. We've got the West Asia conflict and what that's doing as far as commodity prices are concerned, what it's doing to input costs. Overall, what is the sense that you get in terms of the headwinds that Indian industry is faced with today?
There are headwinds for sure. But equally well, let me tell you that I, for one, and Indian industry generally has confidence in the leadership of Prime Minister Modi. And the belief is that Modi hai to mumkin hai.
Yes, that certainly seems to be the mantra, at least at this point in time, and it certainly is the mantra for the BJP as far as the state of West Bengal is concerned. But Mr. Goenka, a pleasure speaking with you. Thanks very much for joining us here on CNBC TV 18 with your first reaction to what is a dramatic shift in West Bengal's politics. Mamata Banerjee out. It is the BJP that stakes claim. But we will take a break here. There's a lot more coming up on CNBC.
Welcome back to this special Indianomics, where we are looking at the growth numbers. Our enthusiasm was perked up by the very strong auto sales numbers for April. But I've been speaking with economists Abhishek Upadhyay and of ICICI and Sakshi Gupta of HDFC Bank. Also, the head of market research firm Bizom, Lalit Bise, is with us, giving us some very interesting data on consumption, FMCG consumption in April. Gentlemen, and Sakshi, thank you very much for staying on. Sakshi, before the break, you told us that you're expecting growth to fall to 6.5% for the current quarter, April, May, June. Abhishek, what is the current quarter anticipation for you?
We are working with a similar number, Lata. So, I mean, if you look at our actual imported prices for crude, it's around $115 for data which is being made available by BPAC for the month of March and April. So, yeah, in that context, we are likely to see growth being around 6.5%, if not weaker, in the first quarter and in the first half of the fiscal year before it picks up.
Okay, so the, Lalit B says very encouraging numbers for FMCG in April, and the auto sales is unlikely to continue in May and June, you think? Abhishek?
Yeah, so auto sales, again, because there is fair bit of momentum there, would think that it doesn't weaken abruptly. Would think this is durable. There is a durable element to this upsurge, especially the two-wheeler sales, etc., that we have seen. But we'll expect domestic demand indicators to also progressively weaken. What we've already seen is financial conditions have tightened, equities are lower, but interest rates have also moved up. And all this will have some impact on interest rate sensitive sectors, including autos, for instance.
Oh, yes, absolutely. We have seen interest rates move now, even for the 10-year bond north of 7%. Lalit, what is the experience normally when prices are pushed up? At the moment, it's only cooking gas prices, that to commercial cooking gas, that has gone up. But eventually, we should expect, increase in packaging costs, which already must be factored in. How does demand normally respond? Were there any price rises you saw in April already? And has that been withstood by the demand? If prices packaging, etc., rise further, do you think demand falters in May and June?
Right. I know there's already some indicators about it in April, month of April itself. If you look at something like packaged commodities, which is very fluctuating or very, so to say, sensitive to price rises, there are already price rises in April. So overall, packaged commodities do show growth, but that is primarily a value-driven or price-driven growth. There is actually volume has contracted in urban for packaged commodities already. It is still up in rural, but that growth is also pretty small. I mean, low single digits kind of a growth in packaged commodities. And if the prices are increased in other categories, I fully expect a similar kind of a behavior, that overall value growth may be there, but the volume growth is likely to be impacted going in May or June. So that's essentially how I look at it.
Okay. Now let me come to inflation and then get back to growth if I can. Sakshi, would you say that, your 5% inflation forecast, which most of you are around the 5% mark, most of the economists I did in my survey said that they have moved up their average by about 50 basis points, but they've all assumed an average crude prices of $80 or $85, like the Reserve Bank itself has assumed. Now that assumption is under threat. There are more and more commodity experts who believe a $90 average would be a safer average. If that were to happen, what is your inflation forecast and your interest rate forecast?
Right, Lata. So as you said, yes, the 5% inflation forecast that we currently have, I think there are more upside risks to this forecast than this being, the risk being balanced. So one clearly is, oil prices averaging above what we are assuming. Our assumption is $85 per barrel. If it is higher, I mean, for every $10, increase from our average, we would increase our, inflation forecast by about, 30 to 40 basis points. Moreover, in addition to this, I'm not still factoring in the kind of disruption that we could see because of El Nino. I mean, it is difficult to kind of predict the volatility in food prices that may happen because of that. So clearly, from a risk perspective, inflation could end up, retail inflation could end up being higher than what we are anticipating. And lastly, I think that we'll have to wait and see. I think there's a fair chance that we could see an upward revision in petrol and diesel prices. Right. So once that comes through and how much they are increased would also kind of have an influence. We estimate that for every 1 rupee increase in petrol prices, the direct impact on CPI is close to about 5 basis points.
Okay, so we are looking at a higher inflation forecast than the 5% that you'll have already factored in. Abhishek, assuming, say, a $90, I'm not saying it's a $10 rise over the 85 that RBI has assumed, but assuming it's a $5 increase, what kind of inflation numbers, and there is the rupee depreciation as well, and the El Nino, what are your worst fears on CPI?
Well, so as you said, mix of factors, including, higher crude, weaker rupee, potential El Nino, fading of one-off effects from GST cuts that happened mid last year. All these factors should be a catalyst for higher inflation. Also, we are seeing much of this, biggest stress of this crisis at a time when companies anyways tend to increase prices around start of the fiscal year. So we should see impact. If crude, again, we don't know where crude prices will be for the full year, so this is very simplistic at this stage. But assuming crude averages 95 and government only increases retail prices once, maybe by 10 rupees or so, we are inclined to work with a 5% inflation forecast in that scenario. Of course, if crude prices are higher, then there will be further upside. Final impact depends on, again, what happens to global fertilizer prices, global food prices, which could continue to seep into domestic inflation pressures, not just immediately, but over the next 12, 18 months. So RBI should be cognizant of the fact that this is a bigger inflation shock at this stage compared to the growth shock, more so given starting point of growth, which was quite favorable.
Oh, favorable. That's right. But the starting point of inflation has also been favorable. 5 is not scary by Indian standards at all. In fact, pretty much within the average. Abhishek, Sakshi, very quickly, I want your current account deficit and balance of payments issues, because we have a bigger rupee problem than an inflation problem at this point in time. Abhishek, current account deficit, BOP numbers for FY27. I know we are just starting the year, but what is the expectation?
At around 2% CAD based on 95 crude. But the worry is that absolute CAD will be closer to 80 billion in that case. That could then mean BOP deficit, which was likely around 30-35 billion deficit, last fiscal year in our estimation, could again be in the same ballpark, 35-40 billion deficit for this fiscal year also.
Okay, and therefore more pressure on the rupee.
Yes, so I mean, near term clearly because actual imported prices are higher. Also, there are technical factors, including RBI is doing a lot in the NDF market, and those maturities are coming due. Dollar is also strong, but deeper into the year, would expect a rupee to settle down, assuming dollar also starts to weaken again.
Okay, what are you working with, Sakshi, in terms of current account and balance of payments and rupee, if you have a view?
Sure. So, Lata, on the current account, we are estimating 2.1% of GDP for FY27, assuming oil averages at 85. But clearly, with the way oil is moving currently, if the average is higher, there's an upside risk to our forecast. On the balance of payment, I mean, look, of course, it is very difficult to make assumptions on capital flows at this point. But assuming we see a de-escalation in the conflict and India does start attracting some portfolio flows and FDI flows, the capital account situation could improve. But on the balance of payment, we still anticipate that there could be a deficit of closer to $25 to $35 billion. And that'll be the third consecutive year that, the balance of payment would be in a deficit, which means that, the pressure on the rupee, I think, in my mind, for this calendar year continues. Near term, of course, reacting to what is happening on the geopolitical front, the depreciation pressure seems to be very high. I think if and when things settle down, I do agree with Abhishek that, the rupee could become a little bit more stable. But I would still not anticipate a reversal in the rupee or any large appreciation pressures in the rupee. I think we would then just turn to a more gradual depreciation.
Fair enough. Sakshi, Abhishek, Lalit, thank you very much indeed for giving us a 360-degree perspective of the economy. The key takeaway, growth is not that bad. That's where we are starting. Our starting point of growth is good, but inflation could be under far severe pressure because that $85 assumption is now increasingly becoming difficult to hold on to. But the bigger problem is going to be current account deficit and the balance of payments. Third year in a row, the capital flows will not be able to bridge a widening current account deficit, and that could be in continued pressure until such time that we start seeing capital flows resuming, hopefully, when the crisis, the war on Iran ebbs. Thank you very much for watching this special edition of Indianomics.
Hello and welcome to India Business Hour. I'm Ashmit Kumar. Here are the headlines that we're tracking this evening. Fresh attacks in the Gulf threaten the fragile ceasefire between US and Iran. President Trump blames Iran for the attacks on UAE. US claims to have struck 7 Iranian speedboats. The Speaker of Iran's parliament warns the US, says we have not even begun yet. Crude oil prices see some wild swings after the fresh escalation. Sensex and Nifty decline in trade even as mid-caps outperform. Nifty manages to stay above 24,000. Rupee sinks to a new low of 95.40 against the dollar before recovering some losses. A defiant Mamta Banerjee refuses to step down as chief minister, says question of her resigning does not arise as her party has not lost the elections. Alleges that she was physically assaulted. BJP in a huddle after historic Bengal mandate. State chief says that the new government will be sworn in on Saturday. Vijay formally stakes claim to form government in Tamil Nadu a day after his party emerges as the single largest. Seeks 15 days from the governor to prove majority. TVK is 10 seats short of the halfway mark. M&M beats estimates in Q4 thanks to strong volume growth. Revenue rises by 29% even as margins contract. Management expects annual growth in SUVs and tractors to be higher than estimates. L&T reports a muted fourth quarter as the crisis in West Asia takes a toll. Profits decline by 3%. Management expects double-digit growth in order inflows. Fiscal, even as it predicts disruptions will continue in Q1 and Q2. Union Cabinet clears an emergency credit scheme worth over 18,000 crore rupees for small businesses and aviation industry struggling due to the crisis in West Asia. Airlines can avail peak credit of up to 1,500 crore rupees. ITC could undertake price hikes if inflation creeps in, says Chairman Sanjeev Puri. Adds that